business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
Non-GAAP versus estimates of 278, revenue coming in at $2.26 billion versus estimates of 2.25. Synopsys sees full year 2026 revenue of $9.61 billion. That's above the consensus of $9.58. The company is ending 2025 with an $11.4 billion backlog. Keep in mind they have the Ansys acquisition to factor in here as well. Coming up, the CEO of Synopsys is going to join us exclusively to break down the results before he dials into the call with analysts.
Well, let's get another check on Oracle meantime. After Q2 numbers that were out just moments ago, shares are under pressure, down about 4% right now, off the worst levels. Joining us now is Rishi Jaluria. He is RBC's software analyst. He has a sector perform rating, a 310 price target on Oracle. Rishi, your initial takeaway on what we got from this earnings report.
Yeah, absolutely. And thanks so much for having me. Always a pleasure to be here. Look, I think it was a pretty inline quarter. They obviously telegraphed a lot at the analyst day, which wasn't that long ago, although it feels in AI lifetime, ages ago. But the RPO was very much in line with what they had kind of pre-announced. Numbers were relatively in line, slightly missed on the top line. But overall, I would say, in line with what people expected, but we don't have answers to the big question, which is how are we going to pay for all of this build out? How are we going to pay to meet those RPO demands? What's the certainty around this? And I think this is going to be a very eventful earnings call in about 40 minutes as we get more color into those questions. What does a timeline look like? Anything like that? I think that's why you have the stock down a few points. But realistically, the implied volatility heading into the quarter is a lot more than that. And maybe the earnings call will change that.
That focus on potential financing alternatives and what paying for all of this looks like, is that ultimately what's driving the stock, at least here in the near term?
I think that's exactly right. All the enthusiasm around the large deals, including with OpenAI and everything like that, that's all there, right? And that's all embedded in the stock. Now the question is, okay, well, how do they get this out there? What can they do beyond debt? Are they willing to lose their investment credit grade rating? Are they going to dilute shareholders? Are they going to, look at alternative financing, look at maybe sovereign wealth funds? I think there's a lot of options on the table, and I don't know that they're going to give a very definitive answer, but I think they can do a lot on the earnings call in that hour to really calm fears that there's not going to be a huge delay in the recognition here, that the margins on this deal and on similar AI deals are in fact something that's going to be accretive to profitability over, call it, the next 5 years.
Rishi, I guess we knew that Oracle was offloading Ampere to SoftBank, and the idea behind Ampere was chips sort of designed specifically for AI. This is a departure from what we see the big hyperscalers doing, who I know Oracle would like to be held in the camp of, at a time when there are already questions about what kind of margins Oracle is going to be able to get out of its data center strategy long term. How are you modeling what they're going to be able to do, especially given how successful their hardware strategy was in another era when it raised eyebrows?
Yeah, look, I think it's a great question and one that we need to ask because, as you correctly pointed out, all the other hyperscalers, Amazon, Microsoft, Google, are all designing their own AI chips and using third-party vendors alongside that. And I think the rationale there is to reduce dependency on NVIDIA over time. And, obviously that can have near-term implications, but over the long term, no one wants to be all in on AI infrastructure and only have one supplier behind that. Oracle, I think they recognize that all the fortunes here are very much dependent on them being a big vendor or middleman of choice around these NVIDIA chips, their close partnership with NVIDIA and with Jensen. And I think that's why, right, is just kind of calming those fears that Oracle would design something competitive with NVIDIA. And I think that's why they're doing that. So not surprised to see that, just given I think Oracle does have a higher degree of dependence on NVIDIA than others.
Okay. Rishi Jaluria, thank you.
Thank you.
Well, Synopsys also reporting results. The stock rising here in overtime. We're about to talk to the company CEO, ask him about the numbers, the latest on U.S.-China chip export rules after the NVIDIA news earlier this week. Overtime will be right back.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign policy decoded on Global Lens on CNBC TV 18 Prime.
Did post record sales, inline guidance, at least on the revenue side. There may be some profit taking here as the stock has done well this year. It's up 60% even after today's drop. The other thing I would note, John, is some of what's in this report is government shutdown and the fact that higher margin foreign military sales were delayed. So expect that to start to roll out next year. An
important caveat. All right. Meantime, Synopsys shares are up 7% in overtime. Joining me now in a first on CNBC interview, Synopsys CEO Sassine Ghazi. Sassine, the numbers overall looking good here. And of course, you got Ansys as part of the picture now. Last quarter, a lot of talk about the IP business. So tell me, is that getting any more predictable? And how does that affect not only this quarter, but how you're looking at the coming year?
Hey, John, great to be here. Yes, for Q4 and the FY26 guide, you can look at it as a combination of meet and beat on the top line and bottom line, which is very exciting. As far as Q3, we did hit a bump with some of the China restrictions. We could not sell to China for about 6 weeks, which is half the quarter, and it had an impact on our IP business in particular. But as we look ahead, we're continuing on de-risking China, and we're taking this as part of the guide for FY26.
So how should investors understand that? Because we got some news this week that sounded like relatively good news on China when it comes to chip restrictions. And one might think, oh, well, that could be good for Synopsys. But then again, the wind has a way of changing direction rather quickly these days.
Yeah, so you're referring to the NVIDIA H200, I'm assuming.
Yes.
Yeah, which is very good news. And the reason it's very good news because the more you can build the AI stack on the foundation silicon that is US-based, like the NVIDIA or AMD or whomever, it's good news because it has stickiness to it. Because the more you develop software on the hardware layer that the US provide is good news. From a Synopsys perspective, NVIDIA, of course, as they're designing the H200 or whatever chip they're shipping, it's using Synopsys technology. Now, inside China, the race is on. There are many companies that are developing alternative chips. And if these companies are not under government control or restrictions, we can sell to. But increasingly, these companies, we cannot sell to them. And they're trying to find local alternatives to design these chips.
So what do you do about that? And how long before that becomes a problem and a ceiling to growth? Are there other ways that you can expand into various other markets and blunt the impact?
Exactly. So that's how we're looking at it. For FY25, our business in China was declined, was down about 20+%. So as we're looking at FY26 guide, we're assuming the environment in China is not changing, meaning we're not guiding or taking into account in our forecast an uplift in the market in China. So we're taking a more balanced, pragmatic view. However, the increase in investment in chip design and now with the Ansys portfolio increasingly at the system level across the globe, in the US, in South Korea, in Europe, etc., we're seeing a very nice tailwind that is making up for the headwind that we're assuming in our guidance for China.
How much momentum potentially comes out of that Ansys acquisition sooner, given that digital twins, the ability to really model what impact a design will have on operations is now very much in your portfolio. Are you finding that customers around the world are leaning into that kind of investment, or is it going to take more time for that to materialize?
John, I know you and I discuss this topic quite often. If you believe that the future of AI is going to move to the physical world, meaning an intelligent car, robot, drone, and many applications, aerospace, etc., you need a more sophistication in designing these complex products. Therefore, you need more use of the Synopsys Classic, the semiconductor, as well as the Ansys portfolio in order to create a digital twin, to be able to simulate, in order to reduce the cost, improve the time. Most of these markets traditionally have engineered these products through physical prototyping. You know that's expensive, that takes time, it's not intelligent, does not take into account an AI-powered product, more software content. And that's where we see significant opportunity. And that's where the endorsement of NVIDIA a couple weeks ago is a validation of that direction.
It's tended to be a nice endorsement indeed. Sassine, thank you. With the stock higher by more than 5%, let you get ready for that analyst call. Thanks for joining us first on CNBC.
Thank you, John.
Well, it's time now for a CNBC News Update with Bertha Coombs. Bertha.
Hey, Morgan. President Trump says Ukraine requested he meet with his Ukrainian counterpart Volodymyr Zelensky. He said Kyiv requested a meeting over the weekend in Europe and that he would make a determination based on what Ukraine comes back with. Zelensky said earlier today that Kyiv would submit an edited peace plan to the U.S. today. Canada has launched a $1.2 billion initiative to bring leading researchers to the country after the U.S. started charging $100,000 for new H-1B visa applications. Canadian officials say the funding will be used to attract and retain more than 1,000 highly skilled workers, such as doctors and scientists. And YouTube is making a move to unbundle the cable package. The company announced today it will unveil 10 genre-based packages to customers starting next year in a bid to let customers tailor their subscriptions. YouTube did not share pricing or what the plans entail, but said one will be geared towards sports and reportedly another towards family viewing. Of course, there are cable providers like Spectrum that are actually bundling all of the streaming into their offerings. So there's a lot of war here in terms of bundling.
All right, 2.0. We'll keep watching it. Bertha Coombs, thank you. A big day for the markets following the Fed decision. The Russell 2000 jumping to an all-time high. So is the S&P Mid-Cap Index. We've got much more on the markets coming up.
And Bank of America CEO Brian Moynihan joins us after this break. The Fed seems to be turning its attention from fighting inflation toward boosting the economy. Does he agree with the Fed's approach? Overtime will be right back.
Business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Welcome back to Overtime. A big day for the markets with the Dow gaining nearly 500 points. That's following the Fed's decision to cut interest rates and policy decisions, outcomes that were seen as more dovish than expectations. The S&P 500 finishing just a few points shy of a record closing high. The Nasdaq up 1/3%. We did see a record high for the Russell 2000, the small caps. The Dow transports jumping nearly 3%. Truckers such as Old Dominion and J.B. Hunt leading the way, but airlines including Alaska Airlines and Southwest also seeing big gains. Shares of Oracle sinking in overtime, though. Those earnings were 62 cents per share. That was better than expected. Revenue did come in a bit light. Its software unit was one culprit for that revenue miss. Those shares are down about 7% right now. Planet Labs, those shares are doing the opposite. Those are soaring here in after hours, up 14%. The satellite imaging company and AI-enabled analytics company had a break-even quarter compared to the estimate for a small loss. Revenue was also better than expected, also came in at a record. Revenue guidance seen ahead of forecasts as well. And the company says its backlog is up more than 200% from last year. I did speak with co-founder and CEO Will Marshall over the weekend. You can check out that interview from Planet Labs on CNBC.com.
Well, the major averages are ending the day higher after the Fed cut interest rates for the third time in a row, which might be a tailwind for bank stocks. One of those stocks is Bank of America, up double digits this year, outperforming the broader market. Leslie Picker is at Goldman Sachs Annual Financial Services Conference, and she joins us now with Bank of America CEO Brian Moynihan. Leslie.
Hey, John, thank you. And thank you, Brian, for joining us today. An important day from a macro standpoint as well as from an industry standpoint. The Fed, of course, cutting for the third time this year, but indicating that preemptive easing is done. Based on what you're seeing in terms of the labor market, in terms of inflation, do you think this is the right call?
Well, I think let's separate those two things because they're two different things. So our team, our research team, which is the best there is, came to Fed cuts later than everybody else because they really believed the inflation was the issue. What got them there was the labor market softening. And so they didn't think the Fed, they still were of the opinion the Fed may not cut rates today, a couple weeks ago. So they came to this last cut. So, but they do believe they cut a couple more times next year, and they bring it down to around 3%, round numbers, 3.25%. And the reason why is the softening of the labor market. So it's not like people are, new claims for unemployment shooting through the roof or continuing claims. It's just that when you watch the numbers of people being reported being employed, the job formation is low. And so that's going to be on their mind because they have that dual mandate and they have to make sure unemployment's moved up to 4.4, which is still low in a relatively historic context, but is moved from 4.1 to 4.4. So our team thinks that they cut a few more times by the data they'll see between now and then. Meanwhile, the consumer's in good shape. They're spending money. Your team had Liz Everett on earlier, and she does a great job describing it. And when you look at the broad base of what they're doing, about 4% of the money year over year, November went in the economy. The consumer's healthy. There's money in deposits. It's a little bit, they were talking about K-shape or alligator shape. They had all different points, but a little bit faster, the upper tercile of income versus the lower. But it's all healthy. They're all growing. They're not growing fast, and they're worried about affordability and all the things you report on and talk about. But the reality is the consumer's in pretty good shape. If that continues on, then that might put more purchase power into the economy, and that might be inflationary. But that'll change quickly if they believe their jobs are not strong. And when we look at our data, we're not seeing unemployment move a lot, but we're not seeing a lot of people adding employees because we can see the paychecks coming.
Yeah, how do you square all of that? Because if the labor market looks kind of bad enough to justify a cut here and potentially some more cuts next year, but the consumer is still spending, do you see a tipping point where that kind of inflects and you start to see maybe some deterioration in the labor market affecting consumers in a bigger way?
Well, we haven't seen that yet. And that's what they have to watch out. But one of the things they got to get the official data out there, then everybody will have a more common view. So whether you see the ADP data or data like our firm puts out and stuff, you see a little bit running to stay in place on the labor market. You're seeing not a lot of job formation. You're seeing the numbers of jobs slow down. But the question is whether that's temporary around just because of the dynamics at the end of the year, people setting their budgets for next year, people start to think about will AI have a big impact or not? Maybe I should slow down my hiring anticipation. But I think you got to see it sustained. And I think our team believes that sort of weakness on the labor side will continue to cause them to reduce rates next year. But again, we get in this great debate about a quarter here or a quarter there. But if you think about it overall, there's not a lot of debate about getting it down around 3%. But no lower. People have to focus on because that's a different rate environment that will have a 3% round numbers plus or minus Fed funds rate and a 4.5% 10-year Treasury rate. That's a real rate environment with a real, a steepness of the curve. We had an inverted curve for a number of years now, but also it's been since before the financial crisis that we had a rate environment that
ងភ្លើងតាម ABA Mobile អាចឈ្នះ BYD Sealand N5 និងទឹកប្រាក់ 40,000 រៀលដើម្បីមានឱកាសឈ្នះគ្រាន់តែទូទាត់វិក្កយបត្រភ្លើងតាម ABA Mobile អ្នកនឹងមានឈ្មោះក្នុងការចាប់រង្វាន់ប្រចាំខែដោយស្វ័យប្រវត្តិរៀងរាល់ខែនឹងមានអ្នកឈ្នះទឹកប្រាក់ 40,000 រៀលចំនួន10នាក់ចំណែករង្វាន់ធំ BYD Sealand N5 នឹងធ្វើការជ្រើសរើសរកអ្នកឈ្នះនៅពេលចប់ promotion បង់ភ្លើងបង់តាម ABA Mobile BYD Sealand N5 ឬទឹកប្រាក់ 40,000 រៀលអាចជារបស់អ្នក
Do you find yourself saying, my marketing agency just doesn't know my business? We've heard it before, and well, we're different. At Kinetic 319, we specialize in strategy, planning, buying, and analyzing paid media campaigns for businesses across the globe, while seeking to know your business better than any other agency team. With over 20 years of experience, what is our #1 KPI? Your business's success. Join us at kinetic319.com and get moving today.
Labor availability up so they can have people to work and do a good job with it. Then you go to mid-sized clients, and what they're doing is you're seeing they're not using their lines of credit quite as active as they did pre-pandemic. If you think about that, what would be the condition if you borrowed at 40% average uses, they're borrowing at 35, 36? That means you're not as aggressive and the cost of borrowing went up. So as rates come down, that'll favor the small business, middle market borrower because they borrow off of short-term rates, and that'll be good, and that'll probably have them be slightly more aggressive. When you go to the market side, the IPO market is opening up. The private equity firms that have businesses they've held for a long time, they need to sell them, so you're seeing some strategic activity go on. You're seeing some large mergers that you talk about all day long in your shows. But, there's a lot of activity. But I think if you think about that, that's going to take a good environment, and we think the economy grows at 2.4% next year. That's an environment where deals and things should take place.
And strategically, what does that mean for Bank of America? I know you had your investor day about a month ago. And yesterday, we heard some guidance from one of your biggest competitors, JP Morgan. Marianne Lake there providing guidance on expenses yesterday that surprised the street, at least temporarily. It bounced back a bit today. How are you thinking about their increased expenses in the context of what many analysts are describing to be this uniquely competitive environment for the banking industry?
With 4,000 people competing in the banking sector, then the non-bank sector, then the private equity funds, and the private capital funds, and the fintech, and all this, there's been lots of competitors. So I don't think that changes. I think at the end of the day, as we think about expenses and thought about it across time, the first way we can manage expense growth the most is about people, headcount, and we manage that very carefully because what we always are trying to do is make our processes more efficient and take the savings out of that and plow it into the front end, client development, both people, products, new technology capabilities. So if you think about over the last 5 or 6 years, our headcount looks like it's relatively flat, but in that process, we added 4,000 technology coders. We added 2,000 people in the relationship management business going out in the field and covering clients. So you're adding people, but what are you doing? You're engineering out other processing capabilities. And as a management team, our team has the task of managing the human being aspect of that. So we have about an 8% turnover rate a year. That's 16,000 people. If we hire 14,000, we go down 2,000 people. So we have opportunities to shape the head count, but you got to be ahead of it and do it. Our expense growth rate, I told the analyst earlier, was year over year, 25 to 20 over 24 was about 4.5%. Fourth quarter, we said it's year over year, it's about 4% plus. But if you add back, we had a credit from the FDIC, all of us got last year, fourth quarter, it's like 2.5%, 3%. In a 2.5 to 3% inflation environment, that's pretty good management. But you have to be on the process and engineering. We're investing a ton in the front. I mean, literally, we have, we're up to about $4.2 billion in annual initiative technology spend. This isn't the base. The base is $10 billion. This is just to put new products out there. And we're investing in people all over the world in our international business, local business, salespeople. So you got to have that. The nature of our business is there's 4,000 competitors. So if you look at across long periods of time, the competitive nature of the industry has had us make it the same sort of returns across time, even though the return on assets in our industry has come down, because the competitiveness leads you to giving that to the customer.
Real quickly on the competition side of things, reports indicate you're scheduled to meet with senators from both sides of the aisle to discuss crypto legislation, particularly this idea of allowing interest payments on stable coins. What would something like that mean for the traditional banking industry?
Well, I think we're meeting more broadly about the issues that affect us at stable coins and making sure they get the other parts of the legislation passed, and which we got to make sure if you're going to have an industry, it's got to have great structure to it. And it's got to have great industrial strength to it in times of stress. It's got to have an understanding of how the market, what they call the market infrastructure works. We don't think twice about DTC and stock trades, and they just go on all day, and billions of shares trade, and billions of quotes are quoted. We don't think twice about it because that's been at it for a lot of years. It used to be paper, go down to the floor exchange, all those people run around now. There's very few people, and it's automation. So the question of getting that market structure right is a critical thing, and we got to get it right, because if there's a bounce in this and it's a new technology, people may walk away from it, and that's what we want to make sure it's set up right. And so whether there's interest paid and this stuff, we got to make sure that especially small, medium-sized banks are not disfavored by this type of activity. We as Bank of America, we can compete with anybody, but you want to make sure deposits don't flow out to only be able to buy treasuries or cash, which, if you look at the money market funds, $6 trillion cannot be lent. So the only borrower for that amount of money is the federal government. Mm-hmm. And I think we ought to calm down the federal government's borrowing and have them borrow less. But if you think about it, you don't want to take a bunch of deposits and move them outside the industry in a way that doesn't allow them to be relent to generate small business loans. We're the largest small business lender in the country, not by a lot, and have been for many times. We're the largest small business lender in most markets out there. We're very proud of that. We drive that. That's what you want those deposits to go to.
Yeah, it's certainly an area to watch. Brian Moynihan, CEO of Bank of America, thank you so much for joining us today. Guys, I'll send it back to you.
All right, thank you. Leslie Picker, to you as well. Coming up, the latest developments on the battle for Warner Brothers Discovery. Overtime.
CNBC TV 18 Prime, from Wall Street to your wallet, connecting the dots before the market does.
Introducing a brand new global business news channel, your new destination for global business and market insights. Tune in to CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Brothers Discovery shareholders, urging them to accept the $30 per share tender offer. Some key notes here in this letter. The letter says to suggest we are not good for the money or might commit fraud to try to escape our obligations, as certain reports have speculated, is absurd. They go on to say that absurdity is underscored by the fact that Warner Brothers Discovery and its advisors never picked up the phone or typed out a responsive text or email to raise any questions or concern or to seek out any clarification. They go on to say, for the avoidance of doubt, our $6 billion synergy estimate does not rely on cuts to content budgets at our studios, and they intend to continue running both separately post-close. They say those synergies will be from technology, linear networks optimization, and real estate rationalization. They also criticize Netflix's strategy when it comes to regulatory approval, saying Warner Brothers' transaction with Netflix appears to be in for a long and bumpy ride as it navigates the global regulatory review process. They say that the argument being advanced publicly by Netflix and its proxy states that regulators should ignore the streaming video on demand market and instead utilize a gerrymandered market definition that includes services like YouTube, TikTok, Instagram, and Facebook. Going on to say Netflix's claim boils down to trying to mask its dominance in streaming video on demand by grouping together all internet-enabled video media and social media or otherwise, saying no regulator has ever accepted such a broad approach to market definition, and to do so would require regulators to give up on merger enforcement in media and social media alike. Quite harsh words here in this letter that Paramount Skydance is sending to Warner Brothers Discovery shareholders, urging them to tender their shares. And we will reach out to the parties for comment, especially the criticism of the regulatory potential. Back over to you.
Yeah, it's super fascinating, especially when you see shares of Paramount up more than 1% on this reporting. Julia Borston, thank you. Up next, we will discuss whether the Fed's latest rate cut could spark a December to remember year-end Santa Claus rally.
Business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Is the cut the spark investors needed for a year-end rally? Well, joining us now, Barbara Duran from BD8 Capital Partners and Brent Schutte from Northwestern Mutual Wealth Management. Great to have you both on, and let's start right there. Barb, given what we saw and we heard from the Fed today and from the Powell presser, is the Santa Claus rally starting early?
I think it may very well be. I think going into this, and the market was discounting a 25 basis point cut. And the question is, would the market sell off if they were hawkish, and what would happen if they were more bullish? And I think we got some very unexpected commentary. I mean, they talked about GDP growth next year, raising it 0.5 percentage point from 1.9 to 2.5%. That's a big jump. And he also went out of his way to talk about how unusual to see 5 to 6 years of productivity growth of 2%. And this is before the expected AI productivity improvements kick in. And basically, productivity means you're getting growth without inflation. And when he talked about, we're still in this, inflation is sticky, but you don't see it running away. Labor, we're watching, it's slowing down. So I heard a very bullish call, and I think the market could really continue strongly on this.
Yeah, it was interesting, too, to see those forecasts that signaled that maybe inflation starts to come off a little bit in 2026 as well. Brent, what's the biggest risk to this market here?
Well, I think the dissents on the Fed show that the economic environment is still very uncertain, where you have this narrow path the economy is on, where there are risks on both sides of that mandate. So there is certainly the risk of an economic contraction that is still out there. That's typically where the labor market weakness shows, which he did mention his belief that jobs gains have been negative for the past 5 months. On the other side, you have a potential for a rise in inflation, which could actually throw off Fed rate hikes or cuts in the future and turn them into hikes. And so to me, the near term is uncertain. The longer term, to me, still, back to your question of a December to remember, I think it's going to be a time period to remember for those that remember diversification. And so to me, if you saw the market action today, you saw small cap stocks move up over 2%, around 2%, while broader parts of the S&P did better than the previously Mag 7, which are more tied to the AI theme. And so to me, I think going forward, small and mid cap stocks offer potential for investors to remember, just given the fact that they trade at really cheap valuations. Plus, if rate cuts do hold, you will see the market broaden out because the economy will broaden out.
Barb, do you agree? And is there a subtle shift beneath the surface in 2025 that some people might have missed the broader implications of, with international picking up and perhaps small and mid caps showing that they can gain traction, because that wasn't a great bet over the previous years?
Yeah, no, I think that
Dreaming of studying in Australia? We make it easy with new scholarships, affordable fees, and a big future for job-ready graduates. Apply, study, succeed today.
Codziennie robimy mnóstwo rzeczy, bo kochamy. A dzieci nie czekają, dorastają. Niektóre rzeczy możesz odłożyć na chwilę.
Tato, a co teraz?
Teraz czytamy. Znajdź czas na czytanie, rozmowy i wygłupy. Łap momenty, które zostaną z wami na zawsze. Czytaj chwilę.
Your side in this, within international, what particular regions do you view as the best bets?
I think developed markets offer more, at least a better risk-adjusted rate of return, because I do think risks are still high in emerging markets. And so on the international developed front, I would lean towards those developed markets, or international front, I'd lean towards the developed markets. To me, if Barbara's right, perhaps she is, but I think history would suggest that relative valuation matters. And that's where you have that backdrop for if you decide to invest today, and it's not perfect timing for that to occur. I think at least historically, relative valuation has won, and that's where small and mid-cap stocks at least offer that for intermediate to longer-term focused investors, the ability, I think, to harvest higher than expected returns than large cap in the coming years.
We're sub 2 minutes from this conference call from Oracle. Barb, want to get your thoughts on what we've seen in that print, how it sets us up for Broadcom tomorrow. We're also expecting an OpenAI reasoning model to drop before week's end. How much does this AI trade hinge on all of this?
Well, I think it is important because everybody is, is very spooked by the amount of spending. Is it going to be overcapacity? I mean, you saw what happened with Oracle in the last earnings call. The stock popped up 36% on this huge increase in backlog, some 350%. This time it looks like it's even more, 430-some%. Yeah, but the question is then they realized it was OpenAI. And OpenAI right now has spending commitments of $1 trillion. And can they make that? Will they be able to do that? And so I think those concerns may not be alleviated so soon. We'll have to see. The Oracle call, they will talk about, we hope, alternative financing, because they have a lot to finance. They added some 38 billion in debt on top of 105 billion. So they've got huge, issue. Their coverage ratio, though, is good at 6 times. But there's a lot we need to know about this, how you're going to fund all this. And that's not an issue I think is going to go away anytime soon.
All right. Barbara Duran and Brent Schutte, thanks for joining us.
Thank you.
Well, Thursday will be another big day for earnings. After the bell, we just mentioned we're going to get results from Broadcom and 3 big consumer-facing names as well, Lululemon, Costco, and RH. On the economic front, we will get weekly jobless claims and the September reports on U.S. trade deficit and wholesale inventories. And of course, we'll see how the market continues to react to and digest what we heard from Powell & Co. today.
Yeah, Broadcom, a big one for the overall AI trade. It's one that we were talking about yesterday. Over the year to date, 1 year, even 2 years, it's outperformed NVIDIA. So we'll see how much hinges on it.
Yeah, S&P flirting with a new high, Russell 2000 at a record high, and the mid caps at a 52-week high. That does it for us here at Overtime.
Fast Money starts now.
Live from the NASDAQ market site on a night when Tim's small caps closed at a record high. And the Dow jumped nearly 500 points. This is Fast Money. Here's what's on tap tonight. A bad omen. Shares of Oracle dropping after the software giant missed revenue estimates for the latest quarter. What the results say about the state of the AI and tech trade. And the Fed in focus. Stocks taking a leg higher after the central bank cut rates at its last meeting of the year. But how many more cuts are coming in 2026? And what will it all mean for the markets? Plus, Uber sinks as Amazon ups its delivery game. Netflix hits 7-month lows amid the battle for Warner Brothers. And a rare bright spot in the staple space, what's got shares of Pepsi bubbling higher today? And how long can the caffeine high last? Whoa. I'm Melissa Lee, coming to you live from Studio B at the NASDAQ on our supersized desk tonight, because it is a very important day. Very big desk. Tim Seymour, Karen Feinerman, Dan Nathan, Guy Adami, and Michael Schumacher, Wells Fargo Securities head of macro strategy. And we begin with the market reaction to the Fed's third and final rate cut of 2025. The committee cutting its benchmark lending rate by 0.25% in a 9-3 vote, while also reiterating its forecast of just 1 rate cut next year. Stocks finishing near their best levels of the session. The S&P ending just shy of a record close. The Dow gaining nearly 500 points. NASDAQ adding 1/3% to the small cap Russell 2000 set an all-time record close. Treasuries, meantime, firmer across the curve after the central bank said it will start buying $40 billion of T-bills this Friday. The yield on the 2-year down more than 7 basis points, while the benchmark 10-year pulled back after hitting its highest level since September 4th. For more on today's decision, let's get to senior economics reporter Steve Leisman, who is in Washington. Steve.
Hey, Melissa. Yeah, the Fed following through on an expected hawkish rate cut, reducing rates by 1/4 point to the new range of 3.5 to 3.75, but signaling might be done cutting, at least for now. It appeared to buoy markets, however, with a more aggressive policy than expected for the balance sheet. On rates, the statement, what it did, it used language that it had used in the past to signal a pause, and Fed Chair Jay Powell several times said policy is well positioned.
We now cut a total of 175 basis points, and as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Fed futures embrace that outlook, pricing in just a 24% probability of a cut in January, 44% for March, and a little bit more in April, a little bit more confidence as the year goes by the way, when a new Fed chair comes in June. The vote count was 9 for cutting, 2 against cutting, 1 for cutting 50 basis points. First time since 2019 we've had 3 dissents. But the dot plotter forecast of future rate cuts was somewhat more hawkish. 6 officials wanted no change in the Fed funds rate at this meeting. 7 want no change for next year from the current rate. The median, however, came out with 1 cut for next year and another one for 2027. More dovish was that balance sheet outlook that Melissa mentioned. It will begin on December 12th, the Fed going back in and buying securities sooner than the market expected, focused on bills, but potentially up to 3-year maturities. And here's the one that really was a bit of a shocker, totaling $40 billion for at least several months, also more than expected. Powell insisting this is not quantitative easing, but the Fed maintaining the size of the balance sheet relative to the economy and providing liquidity during times of strong demand. Call it what you will. The markets seem to like it, Melissa.
Call it what you will. I call it QE. I don't know. If you're basically enacting a measure that will
push down rates further beyond the rate cut that you just voted on, that seems to me a form of QE.
Yeah, I mean, I like the way you phrase that. In other words, judge it by its effect, not its intention. I think that's right, but I think what we're going to want to do is watch it over time. Does the size of the balance sheet actually grow in a way that's greater than the growth of the Fed's currency and other reserve liabilities that are out there? I think what's going to happen is you're going to get a flood for a couple months, and then it's supposed to drop off in April. We'll have to watch the management to see if this is quantitative easing in the sense of adding a lot of reserves to the system. Powell's going to tell you, hey, this is just reserve management, maintaining what they call an ample level of reserves.
Yeah, so, Steve, it's Seymour, and part of this is understanding what the intention of this is. Maybe you just hit it. Maybe we can put it to bed. There have been some spikes and massive repo infusions over the last month and a half. Is this something to counter, like so much for the end of QT? Do we need this here? I mean, I understand there have been, between the government shutdown and whatnot, reasons why we've seen a spike and concern around liquidity. But talk to me.
Tim, I think you're raising some really important context that the Fed's change in its balance sheet or its balance sheet stance and doing so quicker than had been expected by the market is in response to some of the tightness we've seen essentially in the plumbing of the financial system. These repo rates have traded towards the high end. There's been some disruption out there. And I think the Fed was getting the signal from the market that it had brought reserves down too far and too much relative to what the market required to operate in a way that would allow it to maintain the funds rate where it wanted it to maintain it. So I think the context is important that the Fed is doing this in response to that tightness in the repo market. And now we'll see if the provisions out there. I will say, for another day, there's a debate that the Fed could have done this differently in a way of not introducing the balance sheet, not increasing the balance sheet. A guy named Bill Nelson, former Fed guy, Kevin Warsh, other people had other ways to do this. But this is the way that Powell and the Powell Fed are running this system here, the ample reserve regime, which probably doesn't deserve but still requires an hour to talk about.
Steve, it's Karen. Just to talk about it for a little bit more. Does the news
as long as you like,
itself,
I'll do it.
Okay. Does the news of it itself help the situation and that maybe they really don't need to do it for very long?
It could be that this is coming, and so banks should not, husband their reserves. That's an idea that's out there. It could definitely help. You don't want to be talking about the repo market on TV. And I think that's a good metric because if we're talking about it on TV, it means we're in trouble, right? That's when we start to talk about it. And it's not something you should be thinking about. It should be operating in the background where essentially $1 trillion every day of stuff is repoed out there. It's like a $1 trillion daily trade in this stuff, and it goes seamlessly. But we've had some tightness in that market. It was the kind of thing that during the financial crisis we would look at every day. It was the kind of thing that kind of exploded, you might remember, after the reciprocal tariffs were put in place, and was a pretty good warning to the president that he needed to step back from those initial reciprocal tariffs. The market got very tight, and we're maybe within a few days of things, this would be melting down, so to speak. So I think that's a good point, Karen, that maybe they've nipped this in the bud, providing enough liquidity out there. We'll have to see. There are some key points that are coming up. Watch when these big 10-year sales come from the Treasury. Watch year end. Watch tax day. The chair mentioned that April 15th next year. After April 15th, there's this demand for money to pay taxes. Then things should ease off, and that 40 billion number should ease off as well.
Since we shouldn't be talking about repos on TV, can you talk to me about the message that Fed Chair Powell has about inflation? He says that inflation remains somewhat elevated relative to our 2% goal, but then he also said that something to the effect of further normalization will help the labor market, but also help the downward move of inflation after the pass-through of the tariffs.
Well, I think what they're waiting for is and there was this one point where a somewhat exasperated Powell said, if there are no further tariffs. So the idea that essentially these tariffs would pass through the system and the Fed could get back, I would say now, I'll use a term that Paul McCulley used, is sort of in the suburbs of neutral. Not quite at neutral, maybe a little bit tight relative to the 3% neutral rate there. So it's possible there's more room to bring rates down in order to help the economy along, help the job market, and not exacerbate the inflation problem. I think the Fed wants to see the data and wants to see what all this looks like on the other side. There's some interesting stuff coming down. I don't know if you guys are talking about this. I think you must have. The idea that there are big refunds coming next year. The average refund might be as much as $1,000 more than a year ago. That could help the economy. There's stuff in the triple B, big beautiful bill about expensing that might pick up investment next year. So there's stuff the Fed chair wants to see. What's interesting right now, we got the employment cost index this morning. We'll have to watch this. It does not appear, and Powell talked about this, that the job market is going to be a source of inflation that the Fed has to worry about. And that's something I think they want to see when you look at the household report. The unemployment rate tells you about that kind of tightness out there. If that happens, we could go lower. But I still think the Fed wants to see things clear a little bit. The fog of having no data, the fog of how these tariffs are going to affect the economy. The Fed wants to see that stuff clear, and then it can make policy and maybe head a little bit more towards neutral. You see that chart you have up there? I like that chart. Where would it want to be? Well, down towards 3%, maybe a little bit below that. Think of it this way. 3% funds rate minus 2% inflation gives you 1% real. I think the Fed would be comfortable in that zone.
Steve, thank you.
Pleasure.
Steve Leisman in Washington. We got to go straight to Michael on this. Thank you for being part of our extended desk on this very important day, final Fed day of the year. What did you make of the Fed's moves?
Yeah, I disagree with Steve. I think it was dovish. Despite the, quote, fog of having no data, the Fed cut. What does that tell you? They want to cut some more, I think. Probably not in January, maybe not in March, but the door is open. So Powell could have said, we're done, which is what the Reserve Bank of Australia did a couple days ago. The Fed did not do that. So the Fed said, hey, look, we might do this again. And buying T-bills, that's a very dovish move. Equities ripped. You all saw that. I will say the bond market didn't react as much as I would have expected, given a fairly dovish response. 2-year Treasury yields down 7-8 basis points, something like that. I thought it could have been 15, but still, I would take it as a dovish sign.
Do you also disagree with Steve?
I understand what Steve's saying. I somewhere in the middle, because there's a lot to decipher here. But I'll say this:
come on,
I think
guys,
in terms, I think in terms of the $40 billion, they're trying to put out a fire before it starts. They see the potential for one, and they're like, we're not going to let this get to that point, which I'm okay with. But I think you can make an argument this is bond bearish, and I'm on the bearish side. But this is definitely precious metals bullish, in my opinion. And I think if you look at the price action in some of the miners, the initial reaction was to sell off on the back of what they interpreted, and now the knee-jerk reaction was, wait a second. If we're going down this QE route, like you said, I mean, gold should continue to move, and I think that's my biggest takeaway.
We're going to break protocol here, because while I said goodbye to Steve, we'll bring Steve back in, because Michael so decisively said that he disagreed with him.
Oh, the rebuttal.
So Steve,
here we go.
Yes, the rebuttal.
You didn't know you had to do this either.
No, this is news to me.
I did not say it wasn't dovish. I don't know how you got that impression. I said it was a hawkish cut in the sense that they suggested, using a variety of language, that they were not going to cut in January, and maybe the next cut was further down the road. But I don't think this was more hawkish than I thought. I also thought the balance sheet stuff was pretty dovish. So I just want to correct that if you misunderstood me.
I think when you lead with hawkish, the natural interpretation I would have is it was hawkish. And I think versus market expectations, which were pretty bold up on the hawkish side, the Fed didn't quite get there. So Powell wasn't sufficiently hawkish to placate the hawks out there in market land. When you look at the moves and yields over the last 5-6 days, I think they'd really gone a bit to one side, and he wasn't quite there. So I'd still go, it wasn't particularly hawkish, meaning I thought it was dovish. Not screaming, but that way.
I think the one thing that would be interesting would be if you think it's that dovish that you're now saying they're going again in January. Are you that dovish?
No, we're not saying that at all. I think the door is open. So the market, in terms of a hawkish cut, what I would have labeled a hawkish cut is Powell says, no, we're effectively done. We're not going in Jan, not going in March. I'm going to pass the baton to some other lucky soul in May, and that person can deal with it. But I'm not going to do anything else. He didn't do that. So that's how I...
Your hawkish bar was much higher.
I think it is. That's probably the takeaway.
Steve, we got to let you go this time, for real.
I'm going. You can't fire me. I quit.
Thank you, Steve, as always. Dan, what's your take?
Let's bring it back to repos.
I'm just kidding. We're not supposed to talk about that on TV. You know, I take issue with the fact that the market ripped. I mean, we closed up 70 basis points. If you look at the intraday S&P from 2 o'clock, I mean, it was kind of muted, you know, and then you look at yields.
But small caps finished it at all-time high.
Yeah, your small caps did. But, you know, maybe that's a little bit of a catch-up trade, Tim. I know you've been on it for 3 years, but it's back, baby. No, I just think that, you know, yields didn't move. The dollar was down a little bit. Bitcoin didn't really move. Like, stuff that I was looking for, like some macro reactions, they just really didn't happen. All that said, we are very near, you know, the all-time highs in the S&P 500. It really feels like this is it. We get through these earnings this week and have a ball. What do you call it, guy? Like a Santa Claus rally or something like that?
Yeah, I use that term every year.
Ho, ho, ho.
Yeah.
Mistletoe.
One thing Powell said that I thought was interesting, how he just said, you know, we are still committed to 2%, and then moved on to something else. We're nowhere near 2%. Did he mean a 2 handle? 2-something percent? Because we are, if that were the case, if they were still committed to 2%, we would have seen a lot more hawkish rhetoric.
Unless he believes that the impact is solely because of tariffs and that there is a time at which that impact will roll off. So do you want to, you know, move monetary policy based on something, exactly, based on transitory inflation? That was my take. I don't know.
I think the Fed was influenced by the freshest data it had, which was this morning's employment cost index, which ECI at 3.5% on wages is not that hot. And the implication from this report also is that a 2% target, you're not far off with all the productivity gains that the labor market can certainly be absorbed, and actually some of the tariffs can be absorbed. And this gets you to a Fed that really should be on hold, seemingly. It's funny, Michael, because you've definitely been very adamant that you thought it was we're done, but that yet that we're not done. We threw a lot of stuff out there. Didn't he say 3 times, like, we're going to wait and see? Wait and see. Does wait and see mean we're not done? Because when I heard that 3 times, and he said it maybe more than 3 times, anytime he had a chance to say, we went today, but we're now going to wait to see how the economy responds. And that, to me, sounds like a Fed that is on hold, and it sounded more hawkish, but...
I would interpret that as being a Fed that's taken the right stance. They've got tons of data coming in just next week, as a matter of fact, so why prejudge it? But at least he didn't say we're definitively done, which other central banks have done. So that was my read on it.
What does this mean for the markets? I mean, as Dan had mentioned, we're just, you know, we're still basically at all-time highs.
Yeah, and I guess when I say 70 basis points on the close, you know, you didn't have Meta, you didn't have Microsoft, you didn't have Nvidia, right?
Isn't that good?
But you had 493.
Isn't this good?
I mean,
right. Equal weight outperformed.
What I think was really extraordinary, the other part of where he was, this may have been not a hawkish cut. That was definitely expected. But this was absolutely a call where the Fed said the economy's in pretty solid shape. This was a growthy Fed today, and I think you saw the kind of a barbell in the market that you actually got. So, you know, with your small caps, have a ball with your 1% position in small caps. I mean, whatever. I just think, by the way, to reiterate my view on small caps, it's not that small caps are a bad place to be. They've been a great place to be. I just think they get a disproportionate amount of attention for the amount of market cap and for the amount of exposure in people's portfolios. But discretionary, retail, materials, as Guy said, all rallied big, but so did semiconductors. So, I mean, all of those sectors were up more like than 140 basis points today. That's a big market day.
Yeah, I didn't mean that, you know, that the 493 versus what I'm saying is when they join the party, if they do join the party, I mean, Powell did mention on a couple of occasions, you know, the contribution of CapEx and what that means for the economy. And I just think that's important. Maybe these stocks are saying something different. Maybe, you know, these bands, you know, for the NVIDIA H200s, maybe they released, you can have a ball, China, buy as many as you want, but maybe they're not buying it. You know what I mean? And maybe that's the sort of thing that puts some pressure on CapEx. Who knows? I just think we're gotten to a point where we got to see some new models, because I got to tell you, ChatGPT 5 did not light the world on fire, and I think some folks are thinking that some of the scaling laws that they're relying on, you know what I mean, to keep this thing going, maybe they're not as sound as a lot thought, though.
And we should note that Oracle's down 2%. We'll get a little bit more on that in a bit, but the fact that the broader markets rallied today, and it wasn't the NVIDIAs of the world, and maybe we don't need that sort of CapEx, or that Blackwell and DeepSeek can exist in China, et cetera, and the rest of the markets can still go higher. And by the way, Powell did address the rise in the 10-year yield and said, well, maybe it's because it's reflecting growth out there in the economy.
Fed today.
Right, it was a growthy Fed.
Brought up tariffs as well. Yes, all those things, absolutely. I'll say this. To me, It's going to come down not necessarily what the S&P does. How does the dollar react overnight tomorrow? And what does the bond market do? I think the dollar sells off on the back of this, and I think gold rallies. I also think the bond market deteriorates from this as well. We'll see over the next 24 hours.
All right. Meantime, let's get to Oracle. We did mention that 10% move. Shares are at after-hours lows. The company missed revenue estimates for the latest quarter. The company just giving CapEx guidance on its call. Seema Modi is here. She's been dialed in. She joins us with the details.
I mean, this is all these people. This is like a party.
It is a party.
And we got the right people at the party.
And guys, we have new details just coming from the conference call. Capital expenditures, as you just pointed out, Melissa, to $12 billion. That's up from $8 billion the previous quarter. In terms of funding, right, we wanted more transparency on the company's ability to finance this mega data center build out. They say that they have a variety of sources available through the debt market. Public and private debt market was mentioned. Executives also adding that there are financing options where customers can bring their own chips to be installed in their data centers, suppliers who can lease their chips rather than sell them. Remember, when it comes to Oracle's role in AI cloud computing, their #1 expense is graphic processing units. And unlike other hyperscalers, Oracle is even more dependent on NVIDIA. And that brings me to the comments that founder and CTO Larry Ellison made in the press release today, where he talked about chip neutrality and how this is going to be a big policy for Oracle going forward. Yes, continuing to buy GPUs from NVIDIA, but he also said that they will be looking at other players as well. And we know that Oracle already has bought thousands of chips from AMD. There's also been talk about Google and Amazon, among others, when you look at where other hyperscalers are investing. So that was also significant. Going back to the road ahead, the remaining performance obligations that's the backlog of new cloud computing deals. That came in at $523 billion. That is up from the $455 billion that was announced last quarter. Remember, that specific metric is what sent shares higher by 36%, the biggest one-day pop we saw since 1992 in shares of Oracle. But again, the street seems to be sort of overlooking that number right now, focused on the financing options, a more definitive answer on what that could look like in the next 3 to 6 months. The call is ongoing. We still haven't heard from Ellison, who I imagine will address some of those questions.
There is a lot to unpack, but getting to the RPO number, because that was what caused the stock to spike on the back of the last earnings. And then we found out it was because of one customer. Do we have any clarity on who is behind this bump?
Glad you mentioned that. And that was the narrative that the company has been trying to build in recent weeks, even on the Investor Day. In this press release and even on the call, they mentioned that there's Meta, there is NVIDIA. So they are trying to show that it's not just about OpenAI, which is that $300 billion 5-year deal. There are other customers in the pipeline. But we want more details, and we'll get them.
Yeah, we should note that NVIDIA shares are down 1.2% on the back of this sort of slid, along with Oracle down in the aftermarket session.
Yeah, I think you framed it. I mean, she surrounded the trade, obviously. Totally. But if you go back to September 10th, when they kind of released this number, and everyone knew who it was, right? Let's be honest. They've been throwing around contracts all over the place as OpenAI. So you can talk about an RPO that's $500 billion, whatever you want. If they can't finance the build out, well, then they're not going to get the revenue, right? So, like, that's what I think the market is calling BS on right now. And look at the stock. I mean, it's well below where it was the day that reported in September. So, to me, I think the market, is both the equity and the debt markets are saying they're not going to be able to do it.
Yeah. I mean, the notion that they're going to increase spend by $4 billion quarter on quarter. But how do you do it when there's a spate of debt offerings in the market? I mean, the competition to raise money at this point is fierce.
Right. And so you just get into this vicious cycle of the price of the project goes up because the price of the debt goes up as everyone's trying to tap the same market.
Yeah, I mean, and you just get back into where we've often talked about with the company. We don't know anything about what really the RPO pricing is going to be, but what we do know is that their large language kind of AI model dynamics, the margins there, they've already said are going to be below the corporate average. I mean, there's nothing attractive about that business. Having said all that, I thought the setup for earnings was pretty good, and I actually thought it was going to bounce here. So I need to be clear. I mean, this was a stock that had rallied, almost 17% into today, and it looked like we'd been level set. And because there's zero AI price into the stock, I think this presents an opportunity. I don't like the stock's reaction, and the focus is too much on the business ahead rather than the business that's here now, which, by the way, OCI was good. Everything there was good. I think there's a room for this to bounce.
I thought it was going to bounce as well. I said it yesterday. I thought we'd get back into the gap, 245, 250. I thought the setup was really good into earnings, and obviously it didn't come, but it comes to a free cash flow on the back of that spend. Negative $10 billion is a problem when the street was probably looking for -5, and comes back to how you're going to finance this stuff and what does the balance sheet look like, and they're being penalized for it, despite the fact that on the margins it was a pretty good quarter.
Seema, what did you make of bring your own chips? It sounded like they're trying to reduce their cost by saying you can buy your chips and bring them here so we don't have to pay for the chips.
I think it suggests the company's looking at all sorts of favorable financing terms that they can lock in with not just their main supplier, NVIDIA, but others as well. There's also been the topic of vendor financing, this idea of another player like private credit playing a role in buying the GPUs and then using those GPUs as collateral. But then that brings up the whole topic of GPU depreciation. What is the shelf life of these chips? Is it 3 to 6 years, which makes it seen as potentially risky?
Yeah.
The term in college
vendor financing is the muscle memory around that is
Remember,
negative.
the term in college, bring your own chips. It was like BYOB, right? Yeah. I mean,
you're on brewskis. One thing I'll just tell you: if this stock goes to 150, the government's definitely taking a stake in it. So, like, shorts, beware. I mean, just think about Trump's relationship with Larry Ellison, that sort of thing. And there's no bid for this thing. I mean, like the bounce that you got over the last 2 weeks, that was the bounce. Have a ball buying it here at $200.
What is this an Oracle? Is this a specific story, or is this a broader read in your view?
I think when I think about Oracle and about data center financing and consider the impact on the bond market, it makes us nervous. So it's not this particular company, it's more this massive amount of issuance coming out. The U.S. government's got tons of bonds to issue. Government after government globally does the same thing. Who buys all the long-term debt? So we've been negative, as I've said a few times in this program, on very long-term debt. That's very much the case going forward. So to me, it just gives it a little bit more underscoring.
What do you think?
I mean, think about what Dan just said. I mean, now it becomes it's a balance sheet cash flow thing because obviously you're not valuing the business as well as you should have, as well as it might have done prior to September 10th. I still think it's worth a flyer here. Dan's probably right that the government steps in, but they're not stepping in at $200. But I still think it's worth a shot here on the long side.
If OpenAI were public right now, I've got to think it would be
trading lower.
Yes, trading lower, and that seems to be the sort of the epicenter of the whole thing. So I'm kind of with Downer Dan here.
But this is Sam Altman. You remember he was on Brad Gerstner's podcast like a month ago or whatever, and he got up all in Brad's grill. He's like, if you want to sell your shares, you want to I'll find a buyer. Well, good luck with that. Like, who's buying the thing right now? I mean.
Yeah. No mention of OpenAI just yet on the conference call. I have this the verbiage coming in on Otter, but any type of reassurance on that $300 billion deal with Oracle will be key.
Yeah, Seema, thank you. Seema Modi, keep us posted, by the way, on the conference call. There's a lot more fast money to come. Here's what's coming up next.
A soda pop. Shares of Pepsi fizzing up on a bullish call from JP Morgan. Why this recently struggling staple could be a sweet buy now. Plus, more international intrigue for NVIDIA. China's DeepSeek reportedly using the company's most advanced chips. We'll wade through the AI trade fallout here and abroad. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
The Nasdaq up nearly 0.5%, and the small cap Russell 2000 notching an all-time intraday high. Meanwhile, Pepsi with a nice pop after JP Morgan upgraded the consumer staple stock to overweight. Analysts saying it could outperform its peers in 2026. Shares, though, basically flat for the year. GE Vernova soaring more than 15% to a new record. The power giant last night, we talked about this, doubled its quarterly dividend, gave strong guidance through 2028. Finally, some after-hours action in the software space. Take a look at shares of Adobe, which are trading higher right now. Top and bottom line beat. Synopsys jumping after its own beat and a big guidance boost. Where do you want to go here, Tim?
Well, just the price action in Adobe is concerning. With that kind of a beat and where this thing hasn't gone, that's interesting. On Pepsi, I'd rather drink Coke, and I don't mean my consumer taste. I do mean, what I would rather own as a stock. So you didn't ask me, but Coke over Pepsi here.
So GE Vernova was just extraordinary. Yes. I don't know if you saw the interview with Jim and this morning. Just the size of the beat, the sort of runway, how great they think the business is, the leverage of the business, improving margins. I mean, there is so much to like here. I don't own it. I wish I did. I'm almost wondering, is it better today at this price than it was yesterday at that price?
So much more visibility.
And doubling their dividend. I mean, it's crazy. It's doubling the dividend.
Yeah.
I go back to Adobe and say, given the valuation and given the sell-off the stocks had, I thought this quarter should have been good enough to get a rally on the back of it. I'm surprised it's not higher. Adobe should be significantly higher. When I say significantly, 7 or 8% from where it's currently trading, based on the quarter and based on the recent sell-off.
All right. Coming up, all eyes on NVIDIA, how DeepSeek's reported use of the semi-giant's most advanced AI chips could trip up the tech titan. That's next.
CNBC TV 18 Prime, from Wall Street to your wallet, connecting the dots before the market does.
Introducing a brand new global business news channel. Your new destination for global business and market insights. Tune in to CNBC TV 18 Prime.
Real money, Real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Mackenzie Sagalas for the details. Mac.
Hey, Mel. So Coca-Cola says that CEO James Quincy will transition to executive chairman in March 2026. He'll be replaced by the current Coca-Cola chief operating officer, Enrique Braun. Quincy, he was named CEO in May 2017, and since then, the stock has risen about 63%. Mel?
Mac, thanks. Mackenzie Sagalos. We were literally just talking about this, and you literally just said you'd rather Coke.
That's what we do here.
You'd rather Coke with the new management.
Yeah, again, Coke doesn't make moves hastily, and these management changes were expected. Coke's business is a company that's not reacting to evaporating carbonated soft drink sales. It's a company that's thinking about global alternative beverages and waters and vitamin stuff, and they do it very efficiently, so I like it.
All right, meantime, NVIDIA rebutting reports that China's AI startup DeepSeek is using smuggled Blackwell chips. They are considered NVIDIA's most advanced AI chips. That was a report in The Information. NVIDIA shares falling today, now down almost 8% over the last month. Let's get a reaction from Fast Money friend Gene Munster, managing partner at Deepwater Asset Management. We will get into NVIDIA and all of that, Gene, but I got to ask you about Oracle, which is down 10% here. I don't know if you want to speak specifically about the Oracle story or how the market reaction to the Oracle story informs you about where the market and how the market is thinking about the AI trade.
I mean, that's the key takeaway, I think, for most investors on this Oracle news is Oracle had, I would say, inline-ish results. The guidance was really solid. The backlog increased $68 billion sequentially from the previous quarter. They had that big jump up to the 455. Now we're 60 billion plus on top of that. And yet you have a stock down 10%. You have the first two questions on the call were about how much capital they have to raise to fund this growth and when what's the exact timing about when margins on their cloud business are going to get to this 30 to 40%. Is it years away? Is it 2? Is it 5 years? And I think what it just ultimately speaks to is this funk that the AI trade is in. And we've been kind of going through this for the past, since really October 30th, after the mega caps had reported. It is, I would describe it as investors, AI investors are almost exhausted from good news. And as we get incremental positive data points, I think Oracle, even though I'm neutral on the stock, I think that what they showed tonight is positive for the broader AI trade. Investors are just shrugging it off, and not just like mildly shrugging it off. Oracle is down. The stock is lower than what it was before they even gave that big update 3 months ago. And I think it just really captures down 13% in the past month, and NASDAQ's up 1%. So we're just in a funk right now. And the question that I'm asking is, what's the timing of when we're going to get out of that? What are the catalysts that are going to get investors more excited about believing that we're still early in AI?
Gene, it's Karen. Thanks for being on. How do you think about trying to value Oracle? They've got this big ramp, but you got to discount that somewhat, and it's not seemingly inexpensive on the surface. So how do you think about it?
Well, again, I'm generally neutral on this, and part of it is because you not only have this big ramp, but you have these expectations that they have these high expectations out there. And so in some ways, when I think about valuation, I think the multiple piece is one of the more complicated parts to it. So effectively, if they don't get to this big ramp of the 500 billion plus in backlog, if they don't get there over the next few years, then that's negative for the multiple. You're going to get some compression. And so I'm at a spot right now where I see this more as a value trap, and I think of this as what are your better alternatives out there? I think I look at it in the context of where Google is trading or where Meta's trading, for example, as better alternatives.
Let's switch gears, Gene. I want to ask you about NVIDIA because you're actually very bullish, more bullish than the street, in fact, when it comes to sales for NVIDIA next year. In terms of this China, the information reported that these Blackwell chips are basically being transshipped, so shipped to countries that are allowed to have the Blackwell chips installed in data centers. They're then dismantled and shipped to China. And so that's how they got around the export ban. And separately, the information was reporting that the Chinese government is going to meet and decide basically whether or not to allow companies to buy the H200 chip. So there's a lot of stuff going on, sort of throwing into doubt that NVIDIA will actually see any sort of a China bump.
Well, I think for starters, I mean, the question, did DeepSeek train on NVIDIA chips? My sense is that yes, I would put a high probability that happened. There is this still disconnect. A year ago, when we saw the performance of DeepSeek, there was this question about how did they do it? And I think that at the most basic level is that when you think about advances in AI, the type of chips, the GPUs are really important, and more advanced GPUs are what drives better insights. And of course, DeepSeek had a lot of insights, and they proclaimed a very low cost of training. I don't think that was representative of what was actually as part of it. And I think that there probably was NVIDIA. NVIDIA is motivated to say that they didn't get those chips because of geopolitical reasons. They don't want to say that had happened. As far as this, turn that we saw this week with NVIDIA getting the green light to sell H20s, and then almost instantaneously, Chinese leadership said, well, maybe we're not going to be buying as many of those chips as you thought. I think that, again, it comes down to is chips are important. And the reason why that this has been held out as such a carrot in the whole trade negotiations and even beyond trade is the reason why these H20 chips have been held out for that carrot is because they are important. And so I see the commentary since Monday from China as more or less theater. I'm not sure why they're doing it, but more or less theater. And ultimately, they are going to be buying these chips. And I think that NVIDIA is going to capture probably something like $30 billion in revenue. So that should raise their growth rate from the street's looking for 51% to 65% or better. And so I think that, and that, by the way, is a kind of a more conservative estimate. So I think that at the end of the day is that these chips are important, and NVIDIA is going to do some business in China in the next year.
Gene, does the H200, okay, let's just say NVIDIA is able to sell them. Let's also assume that they have plenty of them, right? And that's the thing we were talking about last night. There is a black market for this. These are, these chips are being deployed in Malaysia and Singapore. They're getting used, right? And DeepSeek was probably trained on them. But how much of an advancement is Blackwell, the 200 there, to, let's say, the H200? Does it really matter if we're 18 months ahead of them training our models? And obviously, this is most important for training the models, not for inference. And so I guess if we had that wide of a gap, does it really matter if we're selling the H200s to them?
I don't think it matters that. I mean, I think there's an opportunity for them for NVIDIA to sell the powered down versions. So, but as far as does it matter having the most advanced chips in the grander scheme of AI? And I think the answer is yes, it does. I mean, I think that's just having the most advanced chips. Think about the power on these is somewhere in a magnitude of 4 to 8 times each generation in terms of its compute and battery improvements, or not battery improvements, power improvements. That is a 4 to 8 improvement cycle over cycle. And so why that matters is there is a race to get to general intelligence. I think there is an inherent benefit to being some of the first companies that get there. And so I think it does matter. And why does it matter? 1-2 years at getting there, that can make a big difference when you think about how the world is structured. And I know that.
Gene, just to be really clear, I don't mean it doesn't matter for the training. What I mean is the advance that we have in them. Like if you have national security concerns, that's what I meant. So that's fine. I just want to clarify. Great answer.
All right, Gene, thank you. Great to see you. Gene Munster. There's a lot to trade there. When it comes to the NVIDIA conversation, I think this is sort of it's interesting to see, BABA is in both of your acronyms. So U.S. investors are hoping and aiding the AI trade in China by investing in the likes of an Alibaba and a Baidu. And yet we are trying to, on this side of the, on the government side of things, to try and undermine the success of these very companies. It's just an interesting dynamic to think about as you were an investor in an Alibaba,
I'm an investor.
Or Baidu, or
I have to point out that it's not my tube. It's actually
Guy's tube.
It's Guy's tube. It's my band, which actually is a different beat. But last year it was Blycept, and I do think that Alibaba is a China trade that is an important one. And it's an important one because it absolutely has a lot to gain here. There's a lot to gain by AliCloud, most importantly, I think. So I think it's a great opportunity. And yes, I think U.S. investors are waking up to those opportunities. I certainly think they should be.
Yeah. Michael, in terms of U.S. versus China AI trade, where would you prefer?
I'm going to think about it from a currency standpoint. Sure. So the Chinese government's been keeping its currency intentionally weak for quite some time. That could go on a bit longer, but how much? That's our question. So I'd want to be long U.S. dollar versus CNH. I can't say I'd want to be long dollar versus very much after today, but that's one I would choose.
I think Alibaba, I think the chip portion is sort of the cherry on top. I think it's a valuation story, it's a cloud story, and I think where to close, 158 or something. I still think it's too cheap. I mean, this was a $190 stock earlier this year. That made sense to me. This, to me, is a discount.
Coming up, shares of Netflix have now fallen 6 days in a row. What the move says about the streamer's chance of winning its bid for Warner Brothers, and how it changes the landscape in the media business. More Fast Money in 2.
Business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Skydam sent a letter to WBD shareholders saying Netflix faces severe regulatory uncertainty and closing risk. Karen, you poured through this letter.
I only got through half of it. Yeah.
Okay, you
Came
poured
out
through
right
half
before
of
we
it,
started the show.
but in very detailed way for half of it. What did you make of it?
I thought it was really directed to retail shareholders. I think that a lot of it was, they were spinning their own story, right? I thought a lot of it was misleading. They talked about Netflix's stock portion being buried in the 8K. It was not buried. I mean, at all. They talked about 2 years for Netflix to get it done. I don't know where they came up with that. So I think they also said tender your shares right away. That's not going to happen. Why would you do that? If anything, you want to send a message, 30 isn't enough, Paramount. You got to pay more. I do think Netflix is trading down because people think Netflix will counter. They're already winning bid. But, Paramount presents a compelling case that 30 might be better than their package, certainly because Netflix is below the bottom of the collar now. So that's important. So Netflix, I think, is down because they have to bump. If they want it, I think they want it. I think they will bump.
And WBD goes higher and higher, and it does get to a place where the numbers just tell you that you have to at least expect this when you consider all the different pieces. I mean, right now it's a $33 stock. Now, do you have to wait for $33? I don't think so. I think this, back to the Netflix call, it loses if it wins. But I also think that there's a new light on Netflix, which may also hurt it even if it loses, which is that people view that the Warner Brothers and the other talent that's been a big part of kind of a royalty plan that's worked very well for them almost seems more essential than it ever has. And that there's a new day and age of AI content that people, I think, are concerned about, and that ultimately the value on legacy media assets is going higher here.
You think Netflix is a buy here?
It's close. I mean, I think what Tim just said. What'd you say? If they win, it's I think
if they win, they lose.
Yeah, I think it's the best thing that could happen. I mean, I think a lot of folks they were dying to buy this stock at this sort of discount. So again, it's they know what they're doing. But
I sold half my WBD calls today.
You did? Okay.
Yeah.
Nice trade.
Coming up, a delivery downer. Amazon's latest grocery push slamming Uber, DoorDash, and Instacart today. Just how tough the competition in this space could get. That is next. More Fast Money in 2.
CNBC TV 18 Prime, from Wall Street to your wallet, connecting the dots before the market does.
Introducing a brand new global business news channel, your new destination for global business and market insights. Tune in to CNBC TV 18 Prime.
money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
And why do you need an Instacart subscription, Guy?
Well, it's a good question. I'm canceling mine today. And obviously, you don't need Uber Eats
anymore. What about your Maple Bear?
You know what? It's funny you say the Maple Bear. We like the Maple. Actually, Haribo people are watching. By the way,
gummy bears.
If you're watching, Tim, show them. We eat your products every day. We're looking for our holiday swag box.
We deserve.
We deserve.
Shameless.
It is shameless. With that said, the Uber sell-off, 5% sell-off on the back of this, to me, is too much. Go back to last quarter. Listen to what they said. Look at the valuation. I think Uber's a buy right here.
Walmart was also lower on the back. I mean, this is very interesting who.
Well, this is Amazon fights back to Walmart.
Yeah.
Walmart, who's been eating their lunch in terms of Walmart Plus and also the grocery biz and their ability to do e-commerce online. I mean, that has been part of the Walmart story and the investment. Michael and I were just talking on the commercial. I'm not sure this is profitable business for anybody. I do think this is a market share grab for Amazon, which is, makes sense for them. But I don't know that it's going to help the company's P&L.
Yeah, it does seem strange that you can order everything the same day and not pay a dime more for the service. Like that now, yeah. As an Amazon Prime, subscriber, that sort of.
Is that just groceries or is that everything?
It's for
okay, I thought we were just talking about even
this is for groceries.
For groceries,
same day grocery,
right.
yeah.
Because my son called me today and he's got to be in a parade at school tomorrow and he said he needed something for his costume. And I'm like, why are you telling me this now? And I went on Amazon actually, and we got a shot, Connor. Got a shot. That's right.
I'm sure he's watching. Up next, final trade.
The future. Once.
Business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Good morning, everyone. Welcome to Squawk Box Asia on a Fed Day. I'm Shara Kang in Hong Kong.
And I'm Mandy Drury in Sydney. Hello, everyone, and thank you so much for joining us on the show. Let's take a look at the headlines for this hour, where US stocks jump and the S&P 500 closes in on a record high again. This is after the Federal Reserve lowered the interest rate by 25 basis points, while signaling it may hit the pause button for now. Fed Chief Jerome Powell says the reduction puts the Fed in a comfortable position as far as rates go.
We now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Shares of Oracle slide in extended trade after quarterly earnings missed on the top line despite strong demand for its AI infrastructure. Investors also continue to question the company's outsized AI investments.
And oil prices edging higher after President Trump said the U.S. has seized an oil tanker off the coast of Venezuela. It's the latest escalation of his government's pressure campaign against Venezuelan leader Nicolas Maduro. Welcome, everybody. Thank you so much for joining us here on the show. Of course, it's Thursday morning out here in the Asia Pac, or maybe even Wednesday night if you're following us from the United States. Good to see you there, Sherry.
Good morning, Mandy. Good morning, everybody. So it's really the Fed day, and we've been counting down to this moment. Obviously, the last FOMC meeting of the year, and I don't know, I had like more than usual dose of caffeine this morning. So let's actually go through what the Fed event delivered for the U.S. markets and what it means for Asia, Mandy. So we got that Fed cut as expected, as the market had been expecting. And this was the stock reaction stateside, looking pretty good, green across the board, with the NASDAQ actually higher by 0.3%, S&P 500 doing better, higher by 0.67%. But really, it's really the small caps that actually won out here. So Russell 2000 up more than 1%. Worth noting that the S&P 500 closed just shy of a record high. In Treasury markets, so a lot to go through here, and it's not just about reacting to the Fed's rate cut, but it's also the Treasury bill buying by the Fed that is expected later this week. But we've got yields pushing down, the 10s at 4.15% at the moment. When it comes to currencies, we did see a big tumble when it comes to the U.S. dollar. And let's take a look at what the dollar index is doing. 98.67 is what we see. Dollar yen at 156 at the moment. It's still early hours, but let's take a look at U.S. futures as well. Now online and shaping up like this. So a bit of a muted kind of action for now after stocks actually closed higher just overnight. On this side of the world, we've got New Zealand and Australia have already had the chance to react. So New Zealand shares higher by 0.2% or so, and slightly better for the ASX 200 down under, pushing higher by 0.6%. Tokyo comes online at the top of the next hour, and this is how we're set up. Futures are tipping a nice decent gains coming through at the moment. We've got the futures indicating actually 51 and change, 51,000 and change, Mandy. So it looks like it's going to be a positive day for the stock markets on this part of the world, really tracking the Wall Street action. But what does it mean, really, for the Fed's trajectory in 2026? I have a hard time trying to figure out whether this is a dovish or hawkish one.
Yeah, it's a really difficult one to know, especially as you've got to really throw into the mix the fact that the chairman of the Fed Chair, Jay Powell, is only going to be around for another couple of months. So obviously everything could change, all bets are off, depending on who is the next Fed Chair. But anyway, let's give a little colour as to what we saw overnight, where the Fed did follow through with that expected rate cut of 25 basis points to the new range of 3.5 to 3.75. But it did signal it might be done cutting for now. So maybe that's what you would call a hawkish rate cut. It appeared to buoy the market, as we just saw, with a more aggressive policy than expected for its balance sheet. On rates, the statement used language that it had used in the past to signal a pause ahead, and the Fed Chair, Jay Powell, several times said that policy is well positioned.
When the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. We've now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Well, Fed futures embraced that outlook, pricing in just a 24% chance now of a cut in January, 44% in March, and then a greater chance as the year goes on, with an 80% probability in June, when, of course, the new Fed chair comes into office. But for the first time since 2019, there were 3 dissents. The summary of economic projections, also known as the dot plot, suggested a somewhat more hawkish stance, with 6 officials wanting no change in the funds rate at this meeting. 7 officials want no change for next year. The median, however, came in at 1 cut for next year and 1 in 2027. Well, more dovish was the balance sheet outlook. Powell insisting this is not new quantitative easing, QE, but the Fed maintaining the size of the balance sheet relative to the economy and providing liquidity during times of strong demand. Well, let's bring in our guest now to chew over all of this material. We have Torsten Sluk, the Chief Economist at Apollo Global Management. Torsten, thank you so much for joining us today. Do you think that the Fed did the right thing in its meeting?
Well, I do think that they did the right thing in the sense that they did cut interest rates, but they are also signaling clearly that the U.S. economy is actually in quite good shape. We have now for quite some time seen inflation come down, and at the same time growth has been holding up. So the good news is that despite the trade war shock that we experienced in April, many people, including us, expected that the economy would have slowed down more. That shock is now more in the rear mirror era, and we're beginning to move forward, and we're beginning to see now the trajectory here of the economy, actually in particular with one big beautiful bill coming along in a few weeks' time in January, where you can do immediate expensing of capital expenditures. That should be lifting GDP growth. So we are basically at the bottom of the long, drawn-out U-shaped curve where we should expect to see things get better. So it makes sense for them to cut rates here and now to signal that they now would like to see how the economy evolves.
Even if things get better, and even if we do get that big fiscal boost from the big, beautiful bill coming in 2026, given the fact that it is likely that the next Fed chair is to be a Trump pick that would lean to the dovish side and perhaps execute on some of the desires and will of President Trump to cut rates aggressively, do you think that there could be a creation of inflation back in the system?
Yeah, this is a very important discussion, and this becomes particularly also important for Asia, because at the moment, of course, the Fed has clearly signaled that they are staying on hold. But it's also very clear, of course, that the president has articulated, has expressed views that he would like to see short-term interest rates go down. So the question is, when Jay Powell steps down on the 15th of May, will the next Fed chair come in and argue strongly for interest rates going down further? And if we do see more downward pressure on interest rates, and in particular, if the market gets the perception that this is purely for political reasons, it is absolutely correct that then we should begin to worry about that this might mean more of a boost to inflation over the coming quarters. So this issue of what will the new Fed chair do is a very important discussion point when we think about markets, and including also what it will mean for the shape of the yield curve. Because if short-term interest rates go down and the market begins to expect more inflation, then long-term interest rates will begin to go up. And that, of course, means that the risk is for world financial markets that we could have a steeper yield curve if we do get a new Fed chair that becomes more politically motivated. That's not our expectation, but it's very clear that this is certainly a very important discussion in markets at the moment.
It is an incredibly important discussion because it comes down to the credibility of the independence of the Fed, doesn't it? And when the Fed loses the credibility of the markets and investors, that's when you start to get into destabilization territory. Torsten, we're already seeing global yields in many markets back up to multi-year, if not multi-decade highs in some situations. Does this sort of undermine any efforts to cut short-term interest rates?
Yeah, this is really unusual because the Federal Reserve has started lowering interest rates in September 2024, and the level of US 10-year rates today is actually higher than where it was in September of 2024 when the Fed started cutting rates. So that's a different way of saying the yield curve has already been steepening significantly, or put differently, long-term interest rates in the US have just not gone down to the same degree that short-term interest rates have gone down. And we see the same pattern also, of course, in Japan, same pattern also in Germany and in Europe, where we have long-term interest rates have continued to drift higher. And that raises a very global discussion around why is it that long-term interest rates are still so elevated? And why is it that central banks, including the Federal Reserve, have almost lost control of long-term interest rates? And maybe the answer to that is indeed that we have some fiscal challenges, but maybe the risk is also that there are worries, in particular in the US, about Fed independence. So this issue about fiscal problems in Japan, fiscal problems in the US, now also fiscal problems in Germany, if that is indeed what is likely to put upward pressure on long-term interest rates, this is exactly to your question, implying that yes, the Fed can cut rates, but it's just not going to lower long-term interest rates the way that the central banks normally would like to see.
And what about the fact that the Fed is actually buying $40 billion worth of Treasury bills? In fact, that's beginning immediately later on this week. That is a form of quantitative easing, no? So would that further push up and further steepen the yield curve, in your opinion?
Yes, exactly. Because when you begin to buy the front end of the yield curve, the idea is indeed exactly to get short-term interest rates, to at least have them anchored around the effective Fed funds rate. So that also means that therefore the yield curve is a risk of turning steeper, because exactly as you are highlighting, we are expecting to see, of course, Fed purchases of 40 billion, and it is all in the very short end of the yield curve. This is not QE in the traditional sense of buying 10-year, 7-year, or 30-year government bonds. So therefore, the risk is that the Fed is clearly saying we're going to buy the front end, but not the long end, which is exactly raising the risk that in particular if the economy now starts to pick up next year because of the tailwind from the one big beautiful bill and the trade war now getting further and further behind us, that could imply that we indeed will begin to see, yes, the Fed is cutting, and we're also having QE to lower short-term interest rates. But at the same time, if the economy is still okay, and let's not forget that inflation today is around 3%, it's supposed to be 2%. So we already have that inflation is too high. So the bottom line in all this is that for rates investors and fixed income investors, we should expect to see the yield curve steepen as we go through the next several months.
What about productivity? So I know that there is some softening in the labor market. It definitely is sort of outweighing the inflation-related consideration at the Fed. Well, that's what it seems to us. Actually, Chairman Powell talked about how productivity is looking pretty good. A part of it is perhaps artificial intelligence. If it actually materializes in the form of AI adoption phase, let's say over the next couple of years, isn't AI supposed to be deflationary? Maybe that's what the Fed is weighing right now.
That is absolutely correct. And he was exactly asked about this. And this is indeed something that's very, very important for what the Fed will be doing over the coming years. Because if AI indeed is, exactly as you're saying, adopted more and therefore results in also productivity gains, not only in the Magnificent Seven, but also what is the S&P 493, meaning the rest of the economy, then it would absolutely be disinflationary and begin to weigh on inflation. And that could be helping us, similar to what we saw under Greenspan in the 1990s, where we also saw a productivity boom. But if this does not happen, then of course the Fed will have to keep interest rates elevated, because in that case, inflation is not going to come down as quickly. So this is a very important part of what we should all be watching for very carefully in 2026, namely, to what degree are we seeing the productivity gains from AI spreading to other companies? And when he was asked about that, Fed Chair Powell today, he clearly said, we're not seeing that yet. And we're still not seeing any meaningful rise in the unemployment rate. So that's why the jury is still out on to what degree will AI show up as major productivity gains over 2026. So therefore, for now, it is the most proper action to expect that they will keep interest rates higher for longer until we begin to see some evidence of AI actually helping, especially for the S&P 493, meaning all the other economy, or the companies in the economy that are not the AI companies.
Yeah, and that's actually a good segue to my next question, Torsten. How do you view the divergence that is playing out with the U.S. and the rest of the world? A lot of central banks over here seem to be done with their rate cutting cycle. What does that do to perhaps the growth trajectory that you're seeing for the U.S. and the rest of the world?
Yeah, so at the moment, of course, the U.S. is still in relatively good shape, and the baton being handed from the drag on growth from the trade war to now instead the tailwind coming from the one big beautiful bill. That does mean that U.S. growth should still be doing good over the next several quarters. And if that's the case, combined with the dollar having gone down earlier this year, is also very helpful for U.S. growth. Then we should expect to see a nice pickup, especially in the second half of next year in GDP growth in the U.S. The rest of the world, in particular some countries in Asia, they are still reeling from the trade war. They're still being dragged down from the negative effects that the trade war has been having on a number of exporting Asian economies. China is doing still reasonably okay, but a number of other EM Asian countries, of course, are still facing some headwinds because of the trade war. So the net result of that, to your question, is that we should actually expect to see some upward pressure on the dollar, because now interest rates are higher for longer in the US, and the level of yields have been going down in a lot of Asian countries. So there's a lot of FX implications, and there's also a lot of rates implications that ultimately come from the baseline outlook, namely that the US is actually still doing better and is not anymore expected to slow down the way that we had been seeing it, most of us in the market, through 2025.
So do you think for the US dollar that this bad year for it, in fact, its biggest decline since 2007 during the Lehman Brothers crash, do you think that this bad year is behind it now, that actually 2026 will see a gain overall for the US dollar?
Yeah, I do think the dollar will go up in the next several quarters, because now Chair Powell clearly today signaled we are going to only cut a few more times, and then rates will stay higher for longer in the US because we're still busy battling inflation. And in particular, if growth then begins to pick up at the same time, then there simply are any arguments now for cutting rates further. And if that's the case, then we have a steady and stable outlook for the U.S. We have a steady and stable outlook for rates. And with that backdrop, we should also have a steady and stable and with even some upside risk to the dollar.
You said earlier, Torsten, something very interesting, and that is that even though there's a 2% target for inflation in the United States, and of course inflation there is more around 3%, you know, there are central banks like the RBA here in Australia that have a target band of 2 to 3%, and even they struggle to keep inflation within that band. Do you think then that overall it's actually unrealistic now? Have prices structurally shifted higher around the globe so that a 2% target, even a 3% target, is increasingly difficult to hit?
Yeah, and this is a very, very important discussion because this begins to matter for when we think about the level of rates in Australia, when we think about the level of rates in New Zealand, when we think about the level of rates around the world. Because if you now suddenly have more structural upward pressure on inflation, then of course the central bank should begin to adjust. And you could then begin to have a discussion, maybe a 2% target is not the right target. Maybe they should have a target of, say, 3 or maybe even 4. What could be the reasons for that? Well, deglobalization, especially in the US, is, of course, a very pronounced force where at the moment, tariffs on goods that are coming into the US, of course, have been going up. That's inflationary. And also restrictions on immigration, meaning if there are restrictions on labor coming into the US, that also means that wages on labor in the US should also be going up. So deglobalization on its own, meaning saying goods are less welcome in the US, labor is less welcome in the US, means that the price of goods in the US should be going up and the price of labor should be going up. So to that discussion, different countries have different degrees of deglobalization, but the US is at the forefront because the administration started a trade war with literally every single trade partner at the same time, and which is exactly why the outlook for inflation is higher than what it is in Australia, in New Zealand, and most of Asia. And that exactly to your question results therefore in the risk that there is more structural upward pressure on inflation, namely because of the trade war and because of the immigration restrictions that have been imposed.
Yeah, and since you bring in, Torsten, inflation angle and deglobalization angle, I was just looking at this Venezuela story. Obviously, U.S. President Donald Trump confirming that the U.S. has seized a tanker off the coast of Venezuela. Obviously, some potential implications for the oil space, as well as what's going on with the U.S. and China. Do you have a line around this? And obviously, if you really stretch it out, it's really about what's happening with the yuan-denominated trade between China and Venezuela, because this is a world, Torsten, that has enjoyed low energy prices for a while now.
And this is also very important. So if we begin to write down a list of risks to inflation, if we just agreed that some upside risk coming from the tariffs and the trade war, there's some upside risk to U.S. inflation coming from immigration restrictions. Now, to your point, there's also upside risk coming from oil prices going up. And there's also upside risk, of course, from the dollar having already depreciated a lot. Remember, when the dollar goes down, it becomes more expensive to buy things abroad. That means that the price of things that is brought abroad also begins to go up. So therefore, the list of bullet points that ultimately is written down for the U.S. in terms of upside risk to inflation is just getting longer and longer. And perhaps the most important bullet point is exactly if we do now begin to see tailwinds to growth in the US because of the one big beautiful bill, we end up having 5-6 different reasons why the Fed should actually begin to stop cutting interest rates, because now there is a risk that inflation could begin to accelerate as we go into 2026. And that's problematic when the starting point is 3 instead of 2. In other words, when we're already above the target and we now have a list of risks that are saying that inflation is going to go higher, that is complicating the Fed's job, and therefore bringing us to the conclusion that interest rates in the U.S. will stay higher for longer as we go through 2026.
Complicated dynamics for sure. Torsten, it's great to have you on. Thank you so much for joining us. That was Torsten Slok from Apollo Global Management. More details on that Venezuela story we just mentioned. The U.S. has seized an oil tanker off the coast of Venezuela. It's the first known interdiction since Washington's major military buildup in the region began. The move suggests a sharper U.S. push to target OPEC member Venezuela's main revenue source, which is oil. Prices settled a little bit higher overnight, and in early Asia trade, we've got Well, 58 for light crude and 62 and change for Brent crude at the moment. Oil buyers in Asia are now demanding steep discounts on Venezuelan crude due to a flood of sanctioned oil from Russia and Iran on offer. We'll definitely continue to track the developments as we get them. Squawk Box Asia is taking a quick break here. We're back in 2.
Business trends front and center. That's CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
Well, today was a big day. Fed delivered. The market predictions were 100% accurate. 25 basis point cut. And what did the markets do? Stocks off to the races, led by the Dow Jones Industrial Average, at least in percentage terms. The S&P getting darn close to new all-time high close. And interest rates, they fell. But they didn't fall early. Matter of fact, early in the session, we saw interest rates rise. We saw a 10-year flirting with that 420 level. It slowly moved lower. And once we hit the Fed meeting at 2 o'clock Eastern, we definitely saw some activity in the entire Treasury complex. It gyrated. But after all the dust settled, interest rates moved lower. We had a bull steepening, meaning 2-year note yields dropped much more than 10-year note yields, steepening the curve 4 basis points to a level over 61, which is the steepest the curve's been in over 3 months. As for data points tomorrow, well, tomorrow we'll have initial continuing claims, which were highlighted by the Fed chairman during his press conference as a head scratcher that we don't see a bigger jump in initial and continuing claims, considering the anecdotal evidence showing less hiring and, of course, a weaker labor market. Finally, the dollar index. The dollar index got hit pretty hard after the Fed eased and hovering at levels on a closing basis that we haven't seen since early September. Finally, as for what may happen down the road, well, if you look at probabilities for 2026, it certainly seems though the meeting that may be in play, at least at this early point in time, would be the June meeting, which is hovering near 50% of a 25 basis point cut. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
It's 7:30 a.m. in Singapore and Hong Kong. The SGX Nikkei futures have just to come online. Let's take a look at what kind of setup we're getting. And as we saw at the top of the hour, at the top of the show, we are looking at some bid coming through. And obviously, we are really enjoying this Fed Day coverage, and might have something to do with it as well. Dollar yen at 155.80 as we speak. And let's also take a look at long-dated JGB yields right now, and a lot of talk about the fiscal profile of the U.S. as well as Japan, and how global bonds have been really selling off. We continue to see the long-dated JGB yields pushing higher, so the 30s at the 339 and change at the moment. Mandy?
Well, Sherry, we're certainly going to be watching the shares of Oracle later on tonight when Wall Street opens up. After hours, the stock plunged as much as 11% after the company reported a narrow revenue miss in the fiscal second quarter. The cloud infrastructure firm is seen as one of the big AI bellwethers, which has been committing billions of dollars to massive infrastructure build-outs. Investors, though, are growing concerned at the amount of debt that Oracle is raising, and of course the risks, Sherry, it faces should the AI market slow down. And of course that should apply not just to Oracle, but any of the big companies that are spending billions of dollars on this infrastructure build out for AI.
No doubt. How are they going to fund it? Will it pay off? A lot of key AI questions at the moment. In other stories, Mandy, Republican lawmakers are sounding alarm bells over President Trump's decision to let NVIDIA sell its H200 AI chips to China. Officials are warning that the U.S. should reduce China's access to advanced hardware, not increase it. CNBC's Emily Wilkins has more in this report.
President Donald Trump's announcement that he would allow NVIDIA's H200 chips to be sold to China was met with some opposition from Republican members of Congress in his own party. A number of lawmakers who I talked to said that they were concerned that allowing the chips to go to China would undermine U.S. dominance in AI. Several members who I spoke to expressing these concerns were Senators Lindsey Graham and Senators Josh Hawley.
Alarm bells go off in my head here. I don't know. I don't want to give them I don't mind doing normal business with China, but if you can prove to me this will accelerate their military capability, I'll oppose it.
But if we want to beat China, I think we need to constrain their ability to leverage our own technology. So I would think that we'd want to reduce their access to our hardware, not increase it.
It was only 2 months ago that U.S. senators moved a package that included a provision that would have banned the H200s from being sold to China. However, that provision was dropped from the final package. It shows some changing attitudes up on Capitol Hill when it comes to chips, because while some China hawks are opposed, some are actually open to the sale. I spoke with Senator Mike Rounds, who said that it could be beneficial, noting that the H200s were not the most advanced chips, and saying that chip developers developers and AI developers should be using U.S. chips to do their work. Members of Congress are considering other pieces of legislation, including the ability to track chips to see where they end up. But at this point, it doesn't seem like any more legislation on export curbs is likely before the end of the year. Emily Wilkins, CNBC Business News, Washington.
In related news, NVIDIA is denying reports that the Chinese AI startup DeepSeek has been using smuggled Blackwell chips to develop its upcoming model. NVIDIA says it has not received credible tips about the so-called, quote, phantom data centers. Blackwell remains fully restricted. But earlier this week, President Trump has allowed those exports of the less advanced H200 to approved customers for a 25% cut, of course, of the takings. DeepSeek has been under scrutiny since its R1 reasoning model shook the industry earlier this year, you might recall, claiming, Sherry, high performance at unusually low training costs.
Yeah, meantime, China has reportedly officially approved Chinese-made AI chips in an official procurement list. And this list created by the Ministry of Industry and Information Technology includes processors from companies like Huawei and Capricorn. The decision comes just before President Trump said the U.S. would allow NVIDIA to sell its H200 chips to approved customers in China. However, we learned from reports that China is set to limit access to the NVIDIA chip. Despite this, Chinese companies ByteDance and Alibaba have expressed interest in buying NVIDIA's H200 chip. Chris Miller is an associate professor at the Fletcher School, Tufts University, and he's also, of course, the author of the book Chip War. Chris, it's great to have you on. Thank you very much for joining us. And lots going on. But I do want to kick off with the China angle, and I think the conversation will flow very naturally. And there has been some pushback, like the likes of Alibaba, as I talked about in the story. When the Chinese, corporate China, some of these AI companies push back on this idea, okay, we need advanced chips here, and the Chinese government seems to be pushing back and really trying to bolster self-sufficiency. What do you make of this Trump administration's decision to allow back into the Chinese market H200 AI chips right now?
Well, I think the big question is going to be, first, how many chips the Trump administration allows to be sold to China, and then second, how many the Chinese government allow to be purchased by Chinese companies. We've heard confirmation from both Beijing and Washington that some H20s will be sold, but the U.S. is talking about security checks, talking about limiting the types of customers that can buy these chips, and the Chinese government has signaled that it still wants its companies to buy domestic chips too. So I'm going to be watching very closely on the volume of chips that actually get shipped, because that'll be a key data point that helps us understand how impactful this will be for Chinese AI companies.
And I would imagine the Chinese companies who want NVIDIA chips, they are so used to NVIDIA's hardware. They've built their systems around NVIDIA's ecosystem, so they find that switch to Huawei's and Capricorn's a little bit more difficult at this point. Is that what's happening?
Yeah, I think that's certainly right. The NVIDIA ecosystem around CUDA is substantially more developed than its competitors around Huawei, for example, or other Chinese firms. And that's meant that it's been much harder to train and deploy models on non-NVIDIA chips, which is one of the key reasons why Chinese firms still want to keep whatever access they can get to NVIDIA hardware. The second reason is that Chinese firms can't produce enough to meet demand in China, because they're not allowed to produce their chips outside of China, in Taiwan, for example, and domestic manufacturing for advanced chips is just limited in terms of its capacity in China. So even if the chips are okay, the volumes are small relative to what China's demand for AI actually requires.
In the meantime, we were talking about that DeepSeek story, reports suggesting that DeepSeek has been smuggling Blackwell chips for its upcoming model. Any intel, Chris, on how the smuggling of chips in 2025 is looking a little bit different from previous years because of so much chatter around this, there's so much revelation around the significance of these NVIDIA chips at the moment?
Well, I think it's clear smuggling is happening at a pretty substantial volume. Every week we get a new data point or an anecdote of smuggling happening. But I also think it's worth looking at the latest model that DeepSeek released just at the start of this month, which explicitly highlighted that they were struggling to acquire all of the computing power they needed to pre-train their model at the level they were hoping to. So in other words, even if they're smuggling, they're not smuggling at this scale that's necessary to reach the cutting edge. And I think that speaks to the challenges of smuggling as a strategy. You can smuggle here and there, but smuggling multiple data centers worth of chips is just really hard to do, and you can't fix things when they break. You can't get the spare parts that you might need. And so I don't think smuggling is a viable strategy for a country the size of China.
Mandy jumping in here. Hi there, Chris. What would you say to the Republican lawmakers that we just heard from a moment ago who are voicing their concerns about allowing the sale of the H200 chips to China? Essentially what they're saying is they're concerned that it might undermine US dominance in AI.
Well, I think that's a reasonable argument to make. It's certainly the case that China's been constrained in the amount of computing power it's been able to access over the last couple of years, in large part because of US restrictions on the sale of chips. And it's certainly as clear as it's ever been that if you want to build advanced AI models, you need access to advanced compute. I think of AI as having three key inputs: computing power, brain power, and electrical power. And China's the weakest when it comes to computing power, precisely because companies like NVIDIA and AMD have unique capabilities to manufacture chips at scale that Chinese firms today can't match.
There is, of course, the talent aspect in this. I mean, you know, where perhaps China doesn't quite have the computing power yet, they certainly will increasingly have the edge when it comes to talent, right? I mean, you know, we're watching the United States tighten up immigrant visas, you know, allowing tech talent into the country, whereas China is like, we're open for business. We've got the K visa. We want to attract the best global talent when it comes to tech, not to mention the fact that China's got a population about 4 times the size of the United States. Is just the sheer number of talent that's coming up and going to be trained on these AI chips going to be able to help them get an edge?
It's certainly an area where I think China's been improving its capabilities. There's been some good studies that have looked at, for example, the most widely cited AI papers and tracked where those researchers went to college, went to do their PhDs. And what you still find is that there's a substantial export of talent from China to the United States, but that the scale of the flows might be declining somewhat. So China's still sending talent on net. The US is still importing talent on net. But I think you're right to suggest that the pendulum has shifted somewhat in China's favor. And the US immigration restrictions and questions about visa availability are certainly part of that story.
How much of a story do we need to make of the fact that China controls the vast majority of the world's rare earths as well?
Thus far, we haven't seen really significant impact of rare earth restrictions on the semiconductor industry. I think for many types of critical minerals, the minerals are important for chip making, but chip making is a small percentage of overall demand for those minerals. And so, for example, when there were Chinese controls placed on rare earth magnets earlier this year, the primary impact was in the automotive industry. Because the chip industry was a small user, they were able to pay more for their magnets. And so we didn't see disruptions in chips. We saw them in other parts of manufacturing instead. And I think that's generally the rule for the chip industry, which is why it's been insulated from some of the Chinese restrictions in this sphere.
Of course, the flip side to the argument about let's not give them these advanced chips, let's not give China these advanced chips because it's going to help them with their AI capabilities. The flip side to that is, of course, there are some people out there who say, no, we really should give them the AI chips because we want them to be dependent on US technology. We don't want them to go full speed ahead and be self-sustainable in this department. Is there a valid argument in that?
And we've certainly heard that argument from some U.S. officials. For example, Secretary of Commerce Howard Lutnick has talked about keeping China, quote, addicted to U.S. chips. But I think we also see from the Chinese government a real drive and a willingness to spend a lot of money to become self-sufficient in the long run. And so when I listen to everything I hear from Beijing, it's about self-sufficiency as an overwhelming national goal. And so I don't think China's willing to be dependent in the long run.
You know, there was actually an interesting survey, Chris, in South Korea suggesting that the industry insiders are expecting South Korea to lose its chip lead to China by the year of 2030. I mean, it's just 4 years out. South Korea, there have been several reports of the cases of corporate espionage. South Korea experiencing a severe brain drain, and is it losing a lot of chip talent to China? Because it seems to me that China has been doing this very targeted sort of poaching campaign with senior executives of companies like Samsung and SK Hynix.
There certainly has been a poaching campaign, and in response, the Korean government has really dramatically tightened up their laws around technology transfer in a way that I think has escaped notice in much of the rest of the world, but it's really very impactful. But I would say this: I think if you look at the key innovations in memory chip technology, that's where the Korean firms lead. It's been Korean firms out in front when it comes to the high bandwidth memory that AI requires. And that, to me, suggests that there's still a whole lot of innovative potential in the Korean firms.
And when it comes to what South Korea is good at, it's not exactly a foundry powerhouse, but it's, as you suggested, it's really the memories. It's the high bandwidth memory chips. And it used to be a very cyclical sector that, you know, really depending on supply and demand and how many mobile phones get sold, then the stock would move, the export shipments would move. Do you think we've entered a whole different era because that cycle has broken because of AI?
Well, I'm always wary of anyone saying cycles are over, that they're a thing of the past. I think it's true we're in a secular shift driven by AI, but I'm sure AI will have its own cycles when CapEx goes up and down. And so I would be hesitant to say that memory is no longer a cyclical business.
You know, Chris, over the last 3 years, since, you know, developing AI capabilities has become sort of a matter of sovereign and national security, to the point where, like, it's a veritable arms race, isn't it? And so therefore, you could argue that, you know, some of the more ethical considerations around development have been thrown to the side because, you know, it's just about winning and getting ahead. Now, of course, there's a lot more scrutiny over the ethical development of AI. Given that both China and the United States probably have different views on what ethical guardrails look like, could that affect the speed at which they both develop, you know, their AI technology?
I think it could, and it might already be affecting the speed. We've seen plenty of suggestion, at least, that the Chinese government's concerns about what chatbots might say might have limited their embrace of AI in 2022 and 2023. I think in the United States, there's a not dissimilar debate about how to regulate the potential social impacts of AI chatbots. And the Trump administration, for example, has been trying to promote a unified national regulatory regime to prevent individual states from promoting their own regulation. So I think this question about regulation is going to be with us for a long time, and companies are going to, I think, struggle to push back against regulation because AI will be deployed in so many different ways. It seems almost inevitable that politicians will choose to regulate it. The question to me seems what kind of regulation and in what areas.
And that is a whole other conversation, which unfortunately we don't have time for now. Perhaps another time we can get you back on. Thank you so much to Chris Miller from the Fletcher School, Tufts University. We're going to go for a short break here on Squawk. Please do join us once again in a few minutes' time.
CNBC TV 18 Prime. From Wall Street to your wallet, connecting the dots before the market does.
Introducing a brand new global business news channel, your new destination for global business and market insights. Tune in to CNBC TV 18 Prime.
Welcome back. Here is a look ahead for Asia. The Philippine Central Bank is widely expected to cut rates later today. It's not just the Fed, following in the footsteps of the Fed's 25 basis point cut. Analysts warn that a reduction will likely add mild pressure on the peso, which is already one of Asia's weaker performers this quarter. The peso right now 59 and change per dollar, and definitely see the weakness that played out since the month of March this year. Meantime, here are some of the other stories we're watching stateside.
On the earnings front, chipmaker Broadcom is due to share results after markets close, along with athletic wear company Lululemon and wholesale retail giant Costco, which just sued the Trump administration for a refund on tariffs. Plus, we'll get data on wholesale inventories in the month of September, which was originally due to come out in early November, but was delayed by the government shutdown. And the Senate is set to vote on two rival health care plans, one from Republicans that would replace expiring Affordable Care Act subsidies, and another from Democrats to extend the subsidies another 3 years. Neither are expected to pass. And finally, Time will reveal its Person of the Year for 2025. The magazine selected President Trump for the title in 2024. For CNBC Business News, I'm Kate Rogers.
Business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
Welcome back, everyone, to Squawk Box. Well, it's another vote of confidence for India, where Amazon is announcing plans to invest more than $35 billion in the country by 2030 to expand AI capabilities, boost exports, and scale logistics. The move comes as US tech giants deepen their push into India, seen as a strategic hub for cloud, AI, and deep tech growth. The announcement follows Microsoft's record $17.5 billion pledge just a day earlier for AI and cloud infrastructure, and also Google's separate $15 billion commitment to build out data centers there, Sherry.
And strategy CEO Michael Saylor is blasting index compiler MSCI over a proposal that could bar his Bitcoin-heavy firm from, of course, some major U.S. equity indexes. Mr. Saylor called the plan, quote, misguided and harmful, warning that the move could punish companies whose crypto holdings exceed 50% of assets. The strategy currently holds about $61 billion in Bitcoin, over 85% of its enterprise value. MSCI is expected to make a final decision about a month from now on January 15th. Coinbase CEO Brian Armstrong spoke to CNBC's Dan Murphy at Abu Dhabi Finance Week, calling the UAE the second crypto capital of the world. Here is a slice of that conversation.
In the short term, Bitcoin is kind of trading like a risk asset, but over the long term, it's been the best performing asset of the last decade. So it had a brief dip, and in the last few days, it's gone back up. You know, we try to really think more long term at Coinbase. I try not to track too much the short term cycles because we're really trying to build products and services for the next 5 years or 10 years that'll update the financial system, create more economic freedom. And so, you know, you're never going to see zero volatility in Bitcoin. That would kind of defeat the purpose, actually. Like, you want it, it's kind of like a new gold standard for the world. A medium of exchange, like a stablecoin, you want that to be more steady. And so now Bitcoin, or I should say crypto, has both. We have a stable, you know, a Bitcoin standard with Bitcoin, but we also have stablecoin payments for medium of exchange.
Walk me through what you're expecting to see in 2026 and beyond. Of course, you've mentioned a couple of times now that at Coinbase you're thinking much more long term, and I actually think that really marries with what leadership here on the ground in Abu Dhabi is doing as well. So when you look at the product development, when you look at the improving sophistication of this ecosystem, what can we expect to see from you in the next 5 to 10 years? What's the North Star?
Yeah. Well, in 2026, I think we'll see more asset classes come on chain. We'll see stablecoin payments continue to grow. You know, the base ecosystem, I think, is going to have a lot of room to grow. I don't know, the one we haven't talked about yet, which is a very important trend, is probably tokenization. And so I think we're starting to see, we've seen that already. I mean, stablecoins are an example of tokenization, but I think in 2026, we'll really see like tokenized equities hit their stride. I think that we'll see new ways for companies and funds to raise capital, on-chain capital formation. You know, Coinbase acquired this company Echo, which was the leader in private capital formation on-chain, and we're going to be integrating that product in 2026. So my goal here is that any company in the world should be able to open their Coinbase account, click the raise money button, you know, market their prospectus to the world, and just the money arrives in their account 24 hours later. And we can just get the friction and the fees out of raising money. It'll help accelerate innovation and progress globally.
CNBC TV 18 Prime, from Wall Street to your wallet, connecting the dots before the market does.
Introducing a brand new global business news channel. Your new destination for global business and market insights. Tune in to CNBC TV 18 Prime.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
The power plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers. Weekdays, CNBC.
Good morning, everyone. Thanks for joining us. So welcome to the second hour of Squawk Box Asia on a Fed Day. I am Sherry Kang in Hong Kong alongside Mandy Drury in Sydney this morning. Your headlines of this hour. Asian markets are taking their cue from gains stateside after U.S. stocks jumped following the Federal Reserve's decision to lower interest rates by 25 basis points, while signaling that it may hit the pause button for now. Fed Chief Jerome Powell says the reduction puts the Fed in a comfortable position as far as rates go.
We now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
The IMF raises its growth forecast for China next year as it presses the world's second largest economy to speed up structural reform and rely less on debt-driven exports.
And oil prices edging higher after President Trump says the United States has seized an oil tanker off the coast of Venezuela. It's the latest escalation of his government's pressure campaign against Venezuelan leader Nicolas Maduro.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
Fed Chair Jay Powell there, and the markets are reacting to the Fed decision to lower rates by 25 basis points, while still acknowledging the tricky spot that the U.S. economy is in right now regarding inflation as well as employment. We are gauging reaction in Asia. Markets in Japan and South Korea just coming online, and we are looking at the green across the board. In fact, Nikkei 225 higher by 0.4%, ditto for the Kospi over in South Korea. When it comes to Japan, Topix index actually hitting a record high as well. So equities are up, and this is really a follow-through on the price action that we saw on Wall Street just overnight. And checking in on Korea's chip makers this morning. So we've seen commentary overnight that South Korea is considering building its own domestic foundry to support its own chip makers. And right now we are looking at a mixed picture, but the outperformance for Samsung Electronics, it definitely tells the story and how the market is digesting this kind of pledge or rhetoric coming out of South Korea, because that's really the company that does foundry, not so much for SK Hynix, which is really the pure memory play at the moment. We're going to talk Korean tech in much more details in the next hour of the show, so do stick around for that. Now, going back to the Fed decision and U.S. Treasury yields falling in the aftermath of the decision, we do see the 10s, well, actually, it's shot up right at the beginning of the Fed event, and then now coming back up, coming back down. So 13% is what we see there. So I don't know. I said it at the top, Mandy, that I don't really know how to read this. Sure, the market was expecting a hawkish cut. We got a cut, but I don't know if it was a really hawkish event, all that talk about, all that focus on the labor market, and Chairman Powell really sounding like he's sort of putting the inflation story on the back burner. What's your take on all this?
Yeah, well, I think the important point to note is that Powell also said that they're well positioned to just wait and see how the economy evolves. This is actually really important because after a central bank cuts interest rates, or hikes interest rates for that matter, if they make a move, it can take several months. It can sometimes even take 6 months or more for it to really show significant positive impacts on the economy. So, even though they've obviously, made, quite a number of cuts so far, for the full effect of those cuts to work their way into the economy, they do have to do a wait and see. So I think actually Powell is saying, look, let's just sit on our hands and see how things evolve. I think what's also important to note is the Fed probably also wants to see the fiscal impact of the stimulus coming from the big, beautiful bill in 2026. Because remember, we were talking with Torsten Sluk earlier on in the show, and he was saying, this could be inflationary and also, provide impetus to the upside for growth. So it really is very important to just take a wait and see stance when it comes to interest rates.
Yeah, so for now, looking at the dollar reaction, at least the immediate reaction in the dollar, and currency really matters going forward for businesses. And I think because of this big sort of ramp up in the U.S. dollar, especially in the second half of this year, of course, after coming down a little bit in the first half, that a lot of Asian currencies took a hit in the second half. And really, some market chatter around this is that that's the reason why that a lot of retail investors getting burned with the weakness in their own currencies are going for gold. And perhaps that's the reason why we see a little bit of gold consolidation as we are seeing the Fed digest. And I think this is a huge market story because sure, a lot of retail FOMO sort of locked in a lot of gold trades as well, and not to mention silver. Does that dynamic, the fears around their local currencies losing strength, does that carry on in 2026, or are we seeing a bit of a turnaround in that sentiment? I think that is really an important story to be watching as well.
Yeah, no, I'm really glad that you highlighted what's going on with silver and gold, because actually silver is a real standout. It's up 110% so far this year and is at a record high. Another thing that has been noted this year, which is quite unusual, is the tight correlation between gold and stocks. You've had both of them doing very well in tandem, whereas normally you might see, if stocks are doing badly, then gold is sort of a safe haven. So the question is, if you've got both gold and you've got stocks, sort of gold being a safe haven or a risk-off asset and stocks being a risk-on asset, if they're both moving up in tandem, what happens if suddenly both of them drop? Like, where do you actually go to hide? Where do you find a defensive place of cover? That's something that definitely is worth exploring perhaps later on in the show with our guests. But in the meantime, an update on a developing story. The US has seized an oil tanker off the coast of Venezuela. It's the first seizure since Washington's major military build-up in the region began. The move suggests a sharper US push to target Venezuela's main revenue source, which of course is oil. It's a potential major escalation as the US seizes the property of an OPEC member and one that sells a large amount of oil to China. Well, oil prices slightly higher in Asian trading, but as far as oil goes, it hasn't had the best of years, and in fact gas prices right in the United States, I think, are the lowest in over 4 years, which is a bit of a shot in the arm, a bit of a tax cut to the consumer. We'll be back in 2.
Global business trends front and center. That's CNBC TV 18 Prime.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime. Unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime.
It's Fed Day, and CNBC's Rick Santelli has more on what's moving the markets in today's Bond Report.
Good morning, Asia, Australia, New Zealand. Well, today was a big day. Fed delivered. The market predictions were 100% accurate. 25 basis point cut. And what did the markets do? Stocks off to the races, led by the Dow Jones Industrial Average, at least in percentage terms. The S&P getting darn close to new all-time high close, and interest rates, they fell, but they didn't fall early. Matter of fact, early in the session, we saw interest rates rise. We saw a 10-year flirting with that 420 level. It slowly moved lower, and once we hit the Fed meeting at 2 o'clock Eastern, we definitely saw some activity in the entire Treasury complex. It gyrated, but after all the dust settled, interest rates moved lower. We had a bull steepening, meaning 2-year note yields dropped much more than 10-year note yields, steepening the curve 4 basis points to a level over 61, which is the steepest the curve's been in over 3 months. As for data points tomorrow, well, tomorrow we'll have initial continuing claims, which were highlighted by the Fed chairman during his press conference as a head scratcher that we don't see a bigger jump in initial and continuing claims, considering the anecdotal evidence showing less hiring and, of course, a weaker labor market. Finally, the dollar index. The dollar index got hit pretty hard after the Fed eased and hovering at levels on a closing basis that we haven't seen since early September. Finally, as for what may happen down the road, well, if you look at probabilities for 2026, it certainly seems though the meeting that may be in play, at least at this early point in time, will be the June meeting, which is hovering near 50% of a 25 basis point cut. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
Let's bring in our guest now. We have Ajay Rajajaksa from Barclays, Global Chairman of Research. Ajay, thank you so much for joining us today, and welcome back. I know you've been on travels, including here in Sydney. Sorry, I missed you in person. But anyway, that's not what we're here to talk about. Fed, what are your thoughts on what they did, what they said, and where we go from here?
So I think I completely agree with what you said about 2 or 3 minutes ago. This was not a hawkish cut. I know it was originally branded as such. This was a Fed meeting where there was something for both the doves and the hawks. So on the hawkish side, you can make the argument that, look, there were 6 soft dissents. There were 2 outright hawkish dissents. All of that is true. But on the other side, remember, you also had this issue where Powell played down goods inflation. He didn't use the word transitory, but that is what he meant. He said that he was very worried about the labor market. He said that the Fed was not losing inflation credibility. All of that suggests that I don't think they are still done. Now, a lot of this, Mandy, is inside baseball. We can parse every word he says, his body language endlessly. Ultimately, it'll boil down to the data. If the data weakens, they go. If the data doesn't weaken, they stay on hold.
What do you think the takeaway is then for investors? What do they need to know about this?
So one of the more important takeaways, I think there wasn't enough focus on this. Look at the Fed's forecast. They pushed up their GDP forecast for both 2026 and 27 substantially, and they took down their inflation forecast. The only way to make that consistent is that the Fed thinks there is a big jump in productivity coming. I know in the press conference, Chair Powell played down AI-driven productivity, but I don't know how else to think about it. They took up growth, took down inflation over the next 2 years. If they are right, that is very, very growth and equity positive. That's what I think investors should take away.
But we were speaking with a guest earlier who was saying, you know, you've got the Fed who's been cutting, right? And as we were discussing earlier, Sherry and I, it does take, you know, up to 6 months, maybe more, for the full impact of those cuts to be felt in the real economy. So we've got that monetary stimulus working down the line. Plus, of course, we've got the big, beautiful bill fiscal stimulus kicking in 2026. Is this going to create an inflationary environment which might, you know, be a little bit difficult to stuff back into the genie bottle?
No. And the reason I say that, look, I'm not by any means saying that the Fed is going to get to 2% core inflation anytime soon. I acknowledge that the reaction function is asymmetric. They have missed 2% on core for 44 straight months, and they are cutting, like you said. But on the other hand, remember, shelter inflation is going to be a bit of a tailwind going forward. Powell is right when he says goods inflation will peak in Q1 and will be transitory. And the fact is there is some slack in the labor market. The unemployment rate was 4.1, 4.2 for 12 straight months and has started to drift higher. I think they're doing the right thing here.
So do you think, Ajay, it's time for the bondholders, the patient ones, to get rewarded? And is it time yet to increase allocation for high yield stuff?
I wish I could give you a definitive yes. I grew up in the bond market. I love bonds. But the fact of the matter is that even as I think monetary policy is reasonably placed, fiscal policy is not. It's not just the United States. It's also the United Kingdom, it's France, it's Japan. But in every one of these major Western economies, you know, we're basically spending money like drunken sailors on shore leave, and there is no political will to try to get that under control. Our deficits are going to keep rising for the foreseeable future. Debt to GDP is going to keep rising and rising at a faster pace than nominal GDP. It is very hard to be bullish longer bonds in an environment like that. If there is one part of the bond curve that I think you're supposed to own here in the United States, believe it or not, it's the 2-year point, even after today. Because our baseline is that the Fed cuts a couple of times. But I feel very, very comfortable that the upper end of that tail is cut off. They're not hiking, no matter what, in 2026. And there is some chance, if you're wrong about the economy, that they go down to 2%, 1.5%, and that's not yet reflected in the 2-year.
So as long as the Fed is not hiking or starts sounding more hawkish, I guess it's really risk on for some of the risk assets like stocks going into 2026.
I think it is. I mean, today after market close, Oracle reported markets were a little bit disappointed. But the fact is, guys, we just came off a stellar third quarter earnings season. You'll have people who are worried about the equity market tell you, well, you know, price to equity multiples for the S&P 500 are at a 20-year high. What they fail to tell you is that profitability, margins are at a 25-year high. And we are now going into a low volatility. There's nothing, I mean, you know, we're going on vacation. Low volatility environments for the last 2-3 weeks entering 2026 usually set the stage for what I think of as a Santa Claus rally. And I wouldn't be surprised if that's what happens this time, too.
Okay. And when it comes to the narrative, the dynamics around the U.S. versus international, where do you sit? Because earnings growth in the United States Did it mostly come from the AI, the technology companies? Did it also get supported by some of the mid-cap, small-cap stocks? Or are we going to start seeing a year where international markets actually are looking pretty attractive given the valuation concerns as well as the earnings, a tailwind that could actually come from the growth story from the United States?
So your part of the world actually looks pretty attractive, whether it be the Japanese equity markets. India, for example, has done very little on the equity side for the last 12 months. But the fact of the matter is that they have had 6 straight months of well above consensus growth. And the numbers are real. They are not being massaged. So I think it's only a matter of time before that kicks in into that equity market. Mainland China, it is a momentum market. It's not really followed the successes on HSCI. But the fact is that there's so much pent-up savings in the household sector in China, which would usually go into property. It will start going into the equity market. That is going to take off also. In the US, though, the big 6, the big 7 will rule for at least the first half of the year. I would bet on them over the S&P 493, at least in the near term.
All right, but what happens in the second half for the big 7, or as you put it, magnificent 7? Do you see some of the AI trades unwind, or is it sort of evolution of AI trades that some other names will start benefiting, or even small mid-cap stocks actually benefiting from the whole AI, dare I say, potential adoption phase?
I think that is exactly what will happen. We will move from the picks and shovels phase, from the fact that right now, the big tech firms are the ones that are seeing operational leverage on AI much more quickly than smaller businesses. Google doing 40% of its coding with machines is just one example, right? And it will spread to the S&P 493. And the bigger benefits over time of a game-changing technology don't usually stay in the picks and shovels part of the equation. They move to, there's this famous example of refrigeration. The winners of refrigeration were not any of the refrigeration companies. It was the company we all know it was Coca-Cola. Because think about it. Anyone's ever tried a hot Coke? It's not that fun. That's the use cases will all be in the S&P 493. It'll be in the Russell mid caps and small caps. And that's where the eventual benefits will kick in. You're absolutely right about that.
Jay, you mentioned Japanese equities in passing, but we can't talk about Japanese equities these days without also talking about the rise that we've seen in JGB yields, which has been marked, indeed 18, 19-year highs for JGB yields ahead of what is expected to be a hike from the BOJ on the 19th. Why do you not expect a spiral higher in those yields?
For a couple of reasons. One is because, believe it or not, the Ministry of Finance in Japan has an enormous amount of firepower. It really does. They just haven't used it so far. So far, all they have done is try to reduce issuance in the long end. They still have room to go on that front. That's number one. Number two is quasi-governmental institutions in Japan own over $1 trillion, not yen, $1 trillion of non-yen bonds. But here's the funny thing. They do not have non-yen liabilities. The reason that they went out of the market, out of the Japanese market, was because for decades, the Bank of Japan first pushed them out the yield curve and then pushed them right out of the bond market. But now as those yields start to become more attractive, more reasonable, it's not out of the question at all. I think it'll actually happen sooner than people think. But at some point, you start to see these guys say, someone sitting in Marunouchi, in Otemachi saying, look, there's no reason for me to own, $1 trillion of treasuries and euro bonds. I don't have any liabilities in that area. I finally get paid decently in JGBs. Here's where I'm going next. I don't think you're going to get a spiral in JGBs. No. It looks scary. The chart looks scary, but I think, it'll calm down.
I got to ask you also about oil in light of the fact that the US has seized an oil tanker off the Venezuelan coast in somewhat of an escalation between the two countries. Where do you think oil prices go? Because, you know, they've had a hard time getting off the mat this year. But could this be a game changer, or is it just a short-term consideration when it comes to the energy markets?
I think it is a short-term consideration. The fact is that you had 2 years with multiple skirmishes, outright wars in the Middle East, a war in Russia, Ukraine that is still continuing. You earlier in the year, remember, you had tit-for-tat sorties between the United States and Iran, Israel and Iran, and through it all, oil did exactly nothing. If that is the case, there's just no chance in my mind. Oil, like, again, I think one of you said a few minutes ago, was a tailwind for the US consumer in 2025. And I think it probably will be a bit of a tailwind in 2026 also.
Mm-hmm. I mean, we spent some time, Mandy and I, at the top of this hour talking about how really gold, or really just my take is, we need a new set of diversifiers, safe havens these days, because gold is actually showing a very strong correlation with the equity side of the market. I guess my question, Ajay, is what do you see in the new year as an asset that could actually be the gold of 2025, a great diversifier, or some kind of an upside that nobody is talking about at this point?
Right. So I think you might end up getting surprised, we all might, by a commodities, I don't want to use the word super cycle, but a commodities bull market that is non-oil driven. Base metals, for example, right? Copper is up very healthily this year, but you need it. Yeah. You know, just look at the United States, for example, names that we've never heard of, Colossus, Project Mica, Rainier, each of these are a data center a quarter of the size of Manhattan, and they are all being built simultaneously across the country, and they all need base metals. You know, so I wouldn't be surprised if that ends up being the big surprise for 2026. I hear you about gold not being as much of a diversifier, but I think it's done pretty well. Remember a few weeks ago, we had the Bitcoin flash crash and gold just looked straight through it and powered right ahead. I think the precious metals still have a place in portfolios, but I think it's probably time now for base metals to step up.
And what about AI trades? I know that we're going back to that theme, but I wonder if you have thoughts around this shortage of energy, power plays. I mean, Elon Musk is tweeting about that every other day. What's your what are you seeing in your universe in terms of getting that exposure to the power story?
So for 2026 at least, I do not think, even in the United States, so look, we all know that China has done far better in many ways on the power front, right? But even in the United States, I do not think that power considerations will be enough to put a crimp in AI capex. What I keep hearing is that the Permira gas basin, natural gas piped in, is going to be something that helps enormously, at least for the near term. Longer term, Musk is saying this, I get that. But on the other side, you saw Jensen Huang come out and say, look, he doesn't worry at all about AI pushing up power prices. And the reason for that is because he believes in Moore's law, the fact that you're going to get more energy efficient chips very, very quickly. And if he's right, there might not be that much of a story. I'll tell you, power names have not done very well in the last couple of months.
Ajay, it's great to have you on. Thank you.
Business trends front and center. That's CNBC TV 18 Prime.
money. Real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
This is Network 18, and you're watching CNBC TV 18 Prime.
Let's get a quick check on markets. So currently in a trade in Asia this morning, shaping up like this. And we are looking at a mixed picture coming through, and the wall is zooming out, and we definitely see outperformance coming through for the Kospi over in South Korea and ASX 200 down under. Nikkei 225 is not really getting that level of bid. Perhaps now the market's focus is moving on to the BOJ next week, Mandy.
Indeed, indeed. Well, anyway, we're an hour from the China Open, and the head of the International Monetary Fund, the IMF, has urged China to diversify away from its export reliance. This is an important story that we've been following for some time, years, if not decades, in fact. Elaine Yu, our China reporter, has been following this story for us. Hi there, Elaine. Good morning.
Good morning, Mandy. And indeed, the IMF is telling China that it is too big as a country of 1.4 billion people to rely on the rest of the world for growth, or it will risk a global trade war, it says. The IMF Managing Director, Kristalina Georgieva, wrapping up her visit to China, is urging China to take more forceful measures with greater urgency. And of course, we've been talking so much about how Beijing has repeatedly talked about expanding domestic demand, but the IMF is basically saying you need to move faster, you need to shift to export more forcefully and pivot to that consumption-led growth. Let's take a listen to what Georgieva said.
As the second largest economy in the world, China is simply too big to generate much growth from exports, and continuing to depend on export-led growth risks furthering global trade tensions.
And the European Chamber of Commerce also backed this up with a metaphor. The president, Jens Askelund, said the Europe-China relationship is like a fly waiting for a windscreen, saying that the ballooning trade imbalance, and along with an undervalued RMB and also the EU's various dependencies on China, is pushing Brussels towards more decisive action. But it did raise its forecast for China as well by 0.3 percentage point for 2026. So there is some silver lining there for the immediate term.
What about property? It sounded like the IMF wanted something more forceful. You got to do something about it.
Yeah, so domestic demand, China has said it will do something, but when it comes to property, right, it sounds like, I mean, a lot of economists have said it looks like China has thrown in the towel, and of
or
course
let the market handle.
Right, and a lot of economists have said that consumer spending is down because household wealth is tied up, with all these unfinished apartments, and the IMF has laid out a specific price tag now for a solution, saying Beijing needs to spend about 5% of its GDP to resolve these problems, including tightening management of fiscal and industrial policy, and is also urging Beijing to be more proactive, pushing developers to finish these unfinished homes, and saying more decisive action is needed to allow unviable Chinese property developers to exit the market. Georgieva said, "We call them zombie firms, so let the zombies go away," she said at a press conference. And speaking of this zombie firms, we'll see how things go with China Vanke as well. The deadline for the vote to delay payment on a local bond is due tomorrow, and perhaps maybe the IMF is suggesting that, well, maybe they shouldn't avoid a default. Mandy.
Yeah, thank you very much for that, Elaine. I'd like to fill in our viewers and listeners as to what's happening with the Aussie jobs scene. Does look like it's softening up. We've got a disappointing number for November employment out of Oz, down by 21.3 thousand. And indeed, that's a lot lower than the Reuters poll was expecting, which was a gain of 20,000. The November unemployment rate is at 4.3%. Reuters poll was expecting, however, a slightly higher rate of 4.4%. But of course, the devil is always in the detail, right? And when you take a look at the breakdown of full-time versus part-time, there was a massive drop in full-time employment, down by 56.5 thousand, but a jump in the part-time employment of 35.2 thousand. But you could say that, you know, we're coming into a holiday season where, of course, a lot of retailers and cafes and shops and, you know, hotels and things do take on part-time employees to sort of get them through the busy holiday season. So who knows what will happen to those jobs later on. So the participation rate as well, sitting at 66.7%, which is lower than the Reuters poll of 67%. Now, the Australian dollar is something that, of course, we always watch. It is moving to the downside right now on the back of this number. 66.6 US cents is where we're sitting. We did, however, overnight hit a 3-month high in the Australian dollar. We're off for a short break, but we'll be back very shortly.
The U.S. Treasury market is sort of like the biggest player in the global markets and in the global trade negotiations.
You can't have the tariff one day and the exemption on the next day and expect people to make medium to longer term investment decisions.
India is also trying to make inroads. Is there room for both India and China as we continue to see this frenetic realignment going on?
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Welcome back to Squawk Box Asia. We're on IPO Watch here in Hong Kong. We just did that yesterday, Hans.
There's 5 listings this week.
Oh, more? Okay, there we go. So tell us what you're watching today.
So there's going to be a new listing, another one. We're looking at Jingdong Industrial. So Jingdong, also known as JD.com, that would be the parent company. They already have a number of listings in the Hong Kong market. We're talking about JD Health, JD Logistics, and adding another one to its portfolio. JD Industrial is coming online in the Hong Kong market today. This is a supply chain technology unit, and the company priced shares at the midpoint, so in the middle of the range at $14.10, helping the company to raise $383 million in the process. This supply chain technology unit is going to be using the funds to enhance its industrial supply chain capabilities, to support expansion as well as pursuing strategic investments. It has secured $170 million from 7 cornerstone investors, names like M&G Investment, CPE Investment, Ivy Rock Asset, as well as CoreView Capital.
Now, this company, Jingdong Industrials, has taken a 2-year timeline to become a public company. It applied to the CSRC back in March 2023 and got approved only in September of this year. So it is taking quite some time, but finally, we're going to be watching the shares come online today. JD Industrials, or JDI for short, in the gray market yesterday was down about 2.5% on both the Futu platform as well as Philip Mart. So we are going to be watching out for how it trades today when it does come online. We've seen a lot of activity in the IPO space. Just this week alone, 5 IPOs coming to market. KPMG expects this IPO momentum to continue into next year. They say that $45 billion worth of IPOs will come to market in 2026. That deal value is almost a 30% jump compared to 2025. And the deal numbers are expecting to grow 100%, between 180 and 200 companies to be listing in the Hong Kong market. So it's going to be a pivotal year for high-tech listings here. This all comes as Beijing continues to encourage companies to pursue H-share listings. So A and H-share listings, we've seen this year Contemporary Amprex, which was the biggest Hong Kong listing, or the biggest listing in the world in terms of IPO funds raised. And we're watching that. Of course, it came to Hong Kong market this year. 17 AH listings listed this year, raising $17.5 billion. And KPMG says there's 92 active AH listing applications and 316 applications for listings currently in the queue. So this momentum is expected to continue, and KPMG is not alone. Ernst & Young, or EY, forecasting 180 listings next year, with fundraising to total $41 billion. So lots of IPO activity, and we are going to be watching the Hong Kong Stock Exchange today for JDI, or Jingdong Industrials, to come online. Mandy, it's back to you.
Great, we're really looking forward to it. Thanks for the preview there, Em. Well, some earnings that we're watching: an extended trade. Oracle narrowly missing its estimates for its fiscal second quarter. The cloud infrastructure firm posting revenue earnings of $16.06 billion, missing estimates by about $150 million. Shares of Oracle now in the deep red, falling about 11%. CNBC's Sima Modi has the full report.
Oracle's second quarter earnings came in better than expected, but revenue came in light. And the commentary from executives of the company on the earnings call around financing, not enough to lift sentiment. The company did get into how it plans to finance its data center build out, talking about using a variety of sources through the debt market, public and the private debt market. Executives also adding that there are other financing options where customers can bring their own chips to be installed in their data centers, and that suppliers who may lease their chips rather than sell them. And then follows comments from founder Larry Ellison in the company's press release, where he talked about the importance of chip neutrality, that Oracle will continue to buy graphic processing units from NVIDIA, but also other players. Remember, Oracle already bought thousands of AMD chips, and the company does require or depend on NVIDIA more so than the other hyperscalers. There's still questions lingering around how this chip neutrality strategy will ease pressure on the company's balance sheet. That has been a big concern. On the good news, though, Oracle's remaining performance obligations, or backlog of new cloud computing deals, is growing as it brings in new customers beyond OpenAI like Meta and NVIDIA. That RPO number coming in at $523 billion, up from $455 billion in the previous quarter, but shares continuing to trade lower here in after hours. For CNBC Business News, I'm Sima Modi.
And staying with the Ellison family, and the battle for Warner Brother continues. Paramount CEO David Ellison sending a letter directly to WBD shareholders outlining his case for the superiority of his company's offer versus that of Netflix. WBD's board still favors the Netflix offer, leaving Ellison no choice but to approach the shareholders directly. And according to reports, he has been meeting personally with some of the top shareholders as well. In the letter, Ellison outlined that Paramount is the safer choice due to Netflix's exposure to tech market fluctuations, and also warned of a lengthy regulatory process if Paramount is not selected. Meanwhile, President Trump continues to comment on this battle, and this time around has brought WBD's cable news network, CNN, into the conversation. It's worth a reminder, of course, that the Netflix agreement does not include WBD's linear TV assets, including CNN, but Paramount's offer still does. So let's listen into what the president had to say overnight.
I will be probably involved, maybe involved in the decision. It depends. You have some good companies bidding on it. I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue. I think CNN should be sold along with everything else.
Chip design software maker Synopsys also out with its earnings, reporting a revenue of about $2.25 billion. That's a beat on expectations. Synopsys is one of the companies at the center of NVIDIA's expansion plans, receiving $2 billion in investment to jointly develop new AI tools. CNBC spoke to the Synopsys CEO, Sassine Ghazi, earlier, and he spoke to the opportunity from China's potential reopening to U.S. chip makers.
The reason is very good news because the more you can build the AI stack on the foundation silicon that is US-based, like the NVIDIA or AMD or whomever, it's good news because it has stickiness to it. Because the more you develop software on the hardware layer that the US provide is good news. From a Synopsys perspective, NVIDIA, of course, as they're designing the H200 or whatever chip they're shipping, it's using Synopsys technology. Now, inside China, the race is on. There are many companies that are developing alternative chips. And if these companies are not under government control or restrictions, we can sell to. But increasingly, these companies, we cannot sell to them. And they're trying to find local alternatives to design these chips.
So what do you do about that? And how long before that becomes a problem and a ceiling to growth? Are there other ways that you can expand into various other markets and blunt the impact?
Exactly. So that's how we're looking at it. For FY25, our business in China was declined, was down about 20+%. So as we're looking at FY26 guide, we're assuming the environment in China is not changing, meaning we're not guiding or taking into account in our forecast an uplift in the market in China. So we're taking a more balanced, pragmatic view. However, the increase in investment in chip design and now with the ANSYS portfolio increasingly at the system level across the globe, in the US, in South Korea, in Europe, etc., we're seeing a very nice tailwind that is making up for the headwind that we're assuming in our guidance for China.
Nissan is riding the autonomous driving wave and with a new partnership to integrate the technology into its models. We'll speak to Wave co-founder Alex Kendall about that deal coming up next.
Follow the money trail in currency, commodities, and crypto. Tune in to The Big C on CNBC TV 18 Prime.
As a decision maker, you just don't need headlines. You need what they mean for your capital, for your plan.
Your next big move. You don't need opinions. You need perspective.
And context. And that is what CNBC TV 18 Prime aims to give you. Analysis, strategy, and context which is built for India for boardrooms and bold moves.
Built for those who lead, who don't just follow the story, they define it.
Tune in to CNBC TV 18 Prime, global business news for the global Indian.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Welcome back to Squawk Box Asia. Let's take a look at the latest on autonomous driving space. Now, we've got Japanese automaker Nissan and startup Wave moving forward with collaboration plans, signing a definitive agreement to integrate Wave's AI technology with Nissan's driver assistance systems, and this will be implemented across a broad range of Nissan vehicles. And Nissan has launched a prototype of their collaboration back in September, which demonstrated its assisted driving capabilities on the streets of Tokyo. Alex Candle is the co-founder and CEO of Wave, joining us live from Tokyo this morning. Alex, why are you working with Nissan? Why not some of the other Japanese automakers or some of the European car makers as well?
Well, hi, everyone. Look, wherever you go in the world, you see Nissan vehicles on the road. And so to be able to work with an automaker with such scale is very exciting to us. But the truth is, it's the bold leadership from Nissan. What we've seen is an ambition, throughout their history of bringing together frontier technology, and here to bring a new disruptive AI approach that we've been working on, bringing it to mass market vehicles, is something that we're very excited about. We think we have complementary strengths to really build a transformative product.
And you're pushing for plans for a mass production by 2027. But with the prototype that I just mentioned, with your pilot program that started earlier this year, what were some of the major discoveries, learnings that led to that mass production target?
Well, so what we've been building is a very different approach to autonomy. It's one that has the intelligence on board the vehicle to drive in new places it's never been to before. And this year we've seen that as we've taken the AI throughout the world, driving in over 500 cities autonomously through Europe, Asia, and North America. And so with Nissan, this is really a question of industrialization. And what we've been able to show is that we can run this technology in hardware that can be in mass-produced vehicles, not just the premium, but also the mass market vehicles that Nissan produces. Being able to demonstrate that and showing live here in Tokyo, as well as in the United States, showing that the prototype can achieve very performant and safe performance for autonomous driving is really what's enabled us to now move into an industrialization and production phase.
Mandy, jumping in here, you're talking about mass production, so maybe we can put a number on that mass production. What kind of volumes of cars are you expecting to produce with Nissan?
Well, look, Nissan are one of the largest automakers in the world. We're not publicly committing to volumes at this stage, but the ambition is to bring it throughout Nissan products around the world and as many markets as we can. It's really designed for global scale, and we're going to be beginning in financial year 2027, starting with the Japanese and United States markets. But the ambition is to really take this across the Nissan product line.
But do you have any outlook that you can give us in terms of your sales goals?
Of course, I think what we're seeing in the automotive industry is there's been a big shift in recent years to build software-defined vehicles. These are cars that have GPU computers on board and the right sensing to actually enable autonomy. And so now the question is, how do you bring in these autonomy features? And the benefits are clear, whether it's improving road safety or improved comfort or navigation on the road. I think we're going to see this technology become prevalent in the future. And what we want to be able to offer is automakers who perhaps want to partner and work with a leading AI that we can train at scale across the industry with better performance and economics, we think that this is going to become a prevalent technology throughout the market. And that's definitely the trend we're seeing. I think in the 2030s, you're going to see autonomy become as common as a seatbelt in cars and automotive products around the world.
Maybe you can give us a little bit more insight into the kind of financial metrics that you've decided with Nissan. How much of a cut, for example, are you going to be getting from the sale of each car that has your technology in it?
Yeah, look, we'll leave it to Nissan to share more about how they're going to price the technology, but of course we're going to share in the upside, and I think we're going to see a few things. Firstly, what this enables the consumers to have in these vehicles is an experience where they can take their hands off the road and over time get to be able to take their eyes off the road. And this is a driving experience that is going to improve the safety, have an AI that's constantly, never distracted, constantly watching out for you, as well as making it more comfortable and enjoyable to drive. And we think that consumers are really going to be delighted by this product. It's going to be a reason why they choose to buy a vehicle. And I think this presents a real opportunity for the Nissan product to become a leading choice for consumers in the markets that we're deployed in. So it's really one that's going to, I think, increase the attractiveness of the product and then present opportunities to, of course, provide better value capture and monetization as we think about, the increased value that this can bring to the product itself.
And by working with Nissan, you get to stay light on infrastructure, a part of the business. Do you see this movement towards sort of a software-defined approach for some of these startups that have the technology in the auto sector continue to play out? And do you perhaps see the similar trend playing out in some of the robotics verticals as well?
Yeah, that's a really great question because I think that the approach that we've taken enables us to build a software-defined vehicle where we can drive and be agnostic to a lot of the hardware that's in the car. So today, our software runs on NVIDIA and Qualcomm chips that drives the cars that are camera only or have radars and LiDARs, and in many different cities and countries around the world. And so that flexibility is really what makes this opportunity possible, that we don't need to build our own vertically integrated hardware like many other autonomy companies, but we can work with partners and work with the designs that they have with the vehicle architecture they choose and enable them to bring this autonomy to market. I think automotive is ahead of other robotics industries. If you look at domestic robotics, manufacturing robotics, humanoids, I think they're still quite maybe more fragmented, vertically integrated industries. But I think automotive has a leadership position here. And over time, what we will see is industries move towards more of a software-defined nature, where you have connected infrastructure, centralized compute, and the ability to put a brain in these systems to enable this kind of autonomy. But automotive is going to be first.
Glimpse into the future. We've been speaking with Alex Kendall from Wave. Thank you so much for your time.
Thanks,
We're off for a short break now, but do stay tuned for the rest of the market opens at the top of the next hour. We've got Taiwan, we've got Singapore, we've got Malaysia, all on standby to open their gates. We'll be back for the third and final hour of Squawk Box. Don't go away.
Introducing a brand new global business news channel, decoding global shifts and their impact on Indian businesses. Tune in to CNBC TV 18 Prime.
CNBC TV 18 Prime is your gateway to the global markets, your window to global business.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Sharp in Singapore. Good morning, everybody. We've got Singapore markets coming online and eking out small gains of 0.1%. Good morning, everybody. I am Sherry Kang, and we do have a ceremony actually taking place at the Singapore Exchange this morning. We're watching the catalyst ceremony for food manufacturing and distribution company Leong Guan Holdings Limited. Good morning, everybody. I am Sherry Kang in Hong Kong.
And I'm Mandy Drury in Sydney. Hello, everyone. Thanks so much for staying with us. Let's take a look at the headlines for this hour of the show. Asian markets are taking their cue from gains stateside after US stocks jumped following the Federal Reserve's decision to lower interest rates by 25 basis points as expected, while also signaling it may hit the pause button for now. Fed Chief Jerome Powell says the reduction puts the Fed in a comfortable position as far as rates go.
We now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
We're counting down to the China market open, and in the meantime, we've got the IMF raising its growth forecast for China next year as it presses the world's second largest economy to speed up structural reform and rely less on debt-driven exports.
And South Korea lays out a blueprint to strengthen its grip in the AI chip race, with the government considering plans to build a $3 billion foundry to make essential chips.
Welcome back. It's Fed Day. I said that multiple times throughout the show today. Let me say that again. It's really all about Fed, digest Fed in Asia, and we are looking at the Singapore, Malaysia, and Taiwan just joining the trading day, and we are looking at the moderate gains coming through. So we've got the TAIEX higher by 0.26%. Japan and South Korea have been open for an hour, with, of course, along with Australia and New Zealand. We actually see some gains coming through, but I think what stands out to me is really Nikkei 225 over in Japan. Sure, it's positive, but it's really underperforming other markets and in the region, and perhaps it's really the BOJ digest or BOJ action as well, BOJ related to market pricing. Meantime, U.S. Treasury yields are falling in the aftermath of the Fed decision, and let's take a look at the price action. We do see yields coming down across the board. Here is CNBC's Steve Leisman with more on the Fed and the reasons behind the 25 basis point cut as the Fed divisions continue over the path of the U.S. economy.
The Federal Reserve following through on an expected hawkish rate cut, reducing rates by a quarter point to a new range of 3.5% to 3.75%, but signaling it might be done cutting at least for now. It did appear to buoy markets with a more aggressive policy than expected for its balance sheet. On rates, however, the statement used language that it had used in the past to signal a pause ahead, and Fed Chair Jay Powell several times said policy is, quote, well positioned.
We now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Fed futures embrace that probability, pricing in just a 24% chance of a rate cut in January, 44% in March, and then a greater chance as the year goes on, with an 80% probability in June when a new Fed chair comes into office. The vote count for this meeting was 9 for cutting, 2 against cutting, and 1 for cutting 50 basis points. The first time since 2019 there have been 3 dissents. But the dot plotter of the forecast of future rates was somewhat more hawkish, with 6 officials wanting no change in the funds rate at this meeting and 7 wanting no change for next year. The median, however, came in at 1 for next year and 1 in 2027. More dovish, however, was the balance sheet outlook. The Fed announced new purchases beginning December 12th for its balance sheet, sooner than the market expected, focused on bills, but up to 3-year maturities. A total of $40 billion will be bought in the first several months, also more than expected. Powell insisted this is not new quantitative easing, but the Fed maintaining the size of the balance sheet relative to the economy and providing liquidity during times of strong demand and stress. Whatever it was called, the market seemed to like it. Steve Leisman, CNBC Business News.
The Fed Chair Jay Powell also gave some pretty interesting commentary on the current and future impact of AI on the US employment picture.
You can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. But really haven't much. So it's a little bit curious. Really significant technology innovation eras. You have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. You know, it's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see.
Let's bring in our guest, Rob Subaraman, who is Head of Global Macro Research at Nomura. Thank you so much for joining us today, Rob, as always. Do you think that AI has now fundamentally changed the outlook for how we need to think about the global economy?
Thanks, Mandy. It's great to be back. I think AI, we need to think about the timing around it. I think that you can think about short-term disruptive effects, which I think is what Chair Jay Powell was talking about. And here you can think about job dislocations, you know, young people struggling to get jobs, young grads, or maybe some people being laid off due to automation. And maybe even the massive investment into AI could actually put upward pressure on inflation in the short run. But in the medium to medium run, you know, if AI gets adopted around the world, like in the second half of the 90s with the internet, you could start to see productivity gains and positive supply side forces that leads to stronger growth and low inflation. And you know what I found really interesting, Mandy, in the FOMC projections, so this is all FOMC members, not just Jay Powell. It was interesting to me for 2026, the FOMC median projection for GDP growth was revised up from 1.8 to 2.3%, a pretty significant upgrade. But inflation was actually revised down from 2.6 to 2.5. So growth was revised up, inflation revised down. To me, that hints a little bit that the FOMC is starting to think about these longer-term positive supply-side forces, things that Kevin Hassett, who seems to be the front runner for the new chair, has been talking a lot about.
Mm-hmm. So what are the implications then for monetary policy in the United States? Because it certainly sounds like if it was up to Jay Powell, he'd probably just like say, okay, I'm done, I'm out, like, you know, I'm just going to sail into the sunset for a time. And although, by the way, he can stay on as a governor should he choose at the Fed, but in terms of, you know, the heavy lifting, it sounds like he'd be more than happy to just wait and see how things pan out from the economy's side. And the same for Asia. It feels like, you know, we're starting to see some hawkish pivots for a number of central banks on this side of the world, like from South Korea, like from Australia, New Zealand. BOJ obviously is on a hiking path. Is the easing cycle pretty much done?
So I would characterize the FOMC meeting overnight as a mildly hawkish cut. I don't think it was aggressively hawkish. The view at Nomura is that that was the last rate cut under Chair Powell. We think there will be more cuts next year, but only after the new chair is in. So we have the next cut in June, and then one final cut in September next year. So 2 more cuts next year, but there's a long pause between now and the next one in June. I think it makes sense, right? The Fed's cut 3 times now. It's who knows where the neutral rate R* is, but clearly with cuts, you're getting closer. And there's a lot of uncertainty around there where inflation's still above target, the labour market, parts of it are fragile. So maybe it is time to sit back a little bit and watch the data. Mandy, as for Asia, I think Asia is getting really interesting on monetary policy. I think, you know, this year, many Asian central banks cut earlier and more than the Fed, and so have got their rates down closer to kind of equilibrium faster than the US. And I think it's a very mixed picture now. We've just put out our outlook for 2026. We have, for next year, a few central banks hiking rates. We have many on hold, but we also have some cutting. So it's starting to be a much more mixed picture. I think, you know, after the pandemic, the world had this inflation surge. All central banks raised rates. And then when inflation was getting under control, all central banks cut rates. Now I think we're getting to a point where we're going to get more divergent monetary policies in 2026.
Yeah, really interesting point. And I wonder what needs to be done with regards to China and whether or not there needs to be further stimulus there. Because what they've been doing so far, and certainly there hasn't been any sign of a bazooka, just really hasn't been quite doing the trick, has it? And I do see that you've got and it's a quite out of consensus call for a sharp slowdown in Chinese growth next year.
That's right. For China, our view is that the demand side of the economy for various reasons is under a lot of pressure now, including still the property market, which still is has not found equilibrium yet. There's still excess imbalances and debt that needs to be resolved. And so we have China's GDP growth slowing down to 4.1% in the first half of the year. We do feel that probably sometime in the spring is going to impel the policymakers in Beijing to unleash more policy stimulus. What we feel, though, is very different to what we're seeing around outside China is we don't think it's going to be that focused on monetary policy stimulus. We don't see much in terms of rate cuts or triple R cuts. Rather, we think it's going to be much more fiscal stimulus. And a simple reason is China has a lot of leverage and debt, which the private sector is trying to deleverage right now. So easing monetary policy is a little bit like pushing on a string. There's not that much demand for loans by households or companies. And instead, in this situation, which you can characterize a little bit like a balance sheet recession, China needs to do more fiscal stimulus. That's where you'll get the bang for the buck. And we do think that's going to happen in the spring. And then, so second half of the year, China's growth rebounds back to around 4.5%. It's been a pattern in China, a weak first half, stronger second half, and we think that will be the case again in 26.
I'm going to use that as our teaser for next block, and of course we're going to go deeper on China, Rob. But I do want to go back to what you said about some of the Asian central banks potentially hiking rates sometime next year. Are you talking about more central banks other than Japan as well? And if inflation is going to be a problem for these Asian economies, perhaps the fact that you see the weakening in the dollar, the U.S. dollar, could actually help them out, that maybe they don't have to hike.
Yeah, thanks, Cherry. So actually, it's the two central banks that we think will be hiking rates going forward is no surprise, Bank of Japan, but we also think Bank Negara in Malaysia will raise rates late next year. But I think importantly, Sherry, it's not so much because of inflation. In fact, we think inflation for most of Asia is going to be benign next year. We don't see inflation being a problem for Asia. In fact, it's for many countries, it's below target. Japan is a little bit different. Japan is trying to generate demand-driven inflation, and wages are picking up. So there is that's a bit separate. But Malaysia, for instance, it's not so much inflation. It's more growth has been strong, but also we think there will be concerns about financial stability risks around, maybe too much credit growth, and maybe concerns about some asset markets as a reason to raise rates a bit. This is an interesting story, not just for Malaysia. We don't have rate hikes at the moment for South Korea or Australia, but the market is starting to think that it's possible they could raise rates next year. And in the case of Korea, again, it's not so much inflation, but it may be more financial stability risks around the housing market. In Australia, yes, inflation is a little bit high, but again, the housing market is starting to heat up a bit as well. So, I would say inflation for some countries, but only a few in Asia, it may be a bit of the reason. But a growing new theme, I think, in Asia is financial stability risks. And Asian central banks, I think, want to be ahead of that rather than kind of reactive to it.
What about India, Rob? One of your out of consensus calls is that inflation could undershoot there. I've been hearing some bullish commentaries about India, the economy, as well as the markets going into the next year. What are some of the policy implications that could come out of your call?
Yeah, I mean, we're very positive on India next year. We think it is in a Goldilocks kind of position right now. I mean, even this year, growth has surprised substantially on the upside. We're talking, over 7% growth, and inflation substantially on the downside. And we think that's going to play out again next year as well. Something is happening in India, and I think, there has been under the Modi government many years now of pretty solid public capex, and the infrastructure is improving. Digitalizing the economy has been happening, advancing. And so we do think that maybe productivity and potential growth is starting to pick up in India, and that means you have a higher speed limit of the economy before you start to get into inflation roadblocks. And so, yeah, it's in our view a very good story. Solid growth, low inflation, and that makes it very interesting. I think I wouldn't say in the next quarter or two, but from a kind of medium-term, multi-year perspective for the currency, because for decades the rupee, the INR, has been on a one-way trend, weakening against the dollar. But a big reason for that is because India's had high inflation, and so that's been eating into its competitiveness, and so the currency weakens to offset that. And now, if India is entering a more structural, low inflation regime, and we think it probably is, it's possible that the rupee does not continue to depreciate, and in fact may actually start appreciating in the coming years.
Very interesting call that there on India as well as the rupee. Rob Subaraman is, of course, staying with us for the entire hour of Squawk Box Asia this morning. We'll have more conversation when we come back. Stick around.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
CNBC TV 18 Prime, from Wall Street to your wallet, connecting the dots before the market does.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Back, everybody. Well, as we know, the US Federal Reserve cut rates as expected, and we're also expecting something out of the Philippine Central Bank that sounds a little bit in a similar vein, right, JP?
Yeah, Mandy, I think this is the thing too. Like, we're looking out for a number of central banks in Southeast Asia who are now trying to follow the lead, perhaps, of the Federal Reserve, and perhaps getting a little bit more room to ease policy, and perhaps none more so in the Philippines, which is set to make their decision later on at about 3:30 p.m. Singapore and Hong Kong time. Now, the expectations by economists heard by Reuters that the Bank Central will indeed follow the Federal Reserve's lead and trim rates by about 25 basis points, and there are a number of reasons as to why they have room to actually do this. On the one hand, we do have the Federal Reserve now cutting policy rates, which gives them room to ease as well, and making sure the policy differential is maintained, which means it could be just about 175 basis points above the upper end of the Fed funds target range. The other thing also is that there are growing concerns that the Philippine economy, which is one of the fastest growing in Southeast Asia, is in a bit of a slowdown. In fact, we have heard from the likes of the World Bank and the ADB, which have both lowered their growth targets for the Philippines, not just for this year, but also in the year ahead, because of slower infrastructure spending linked somewhat to the questions and the uncertainty brought about by the flood control corruption scandal that might slow down government spending and also impact growth in the Philippines. The thing we're also going to watch out for with regards to markets is the sign, at least, of foreign direct investments in the Philippines and inflows to the Philippines now slowing down to just over $300 million in the month of September. And again, they point out this is one of the lowest levels actually since December of last year and since the COVID-19 pandemic. So we're seeing sentiment actually getting hit, and perhaps monetary policy easing might be able to improve sentiment there. Of course, the Philippine peso also worth watching here, Mandy, because they've continued to weaken and still remain above 59 against the US dollar, with some of the more bearish FX analysts saying that there is a risk of them actually hitting 60 against the greenback if things do not improve. And definitely the Banco Central need easing policy might put more pressure on the weakening peso, Mandy.
It's always the trade-off, isn't it? What happens to the currency? Thank you so much for that preview, JP. We'll catch you later on. But in the meantime, why don't we take a look at the continued fallout from the major disruption to Indian air travel? Our CNBC travel and transportation reporter, Monica Petrelli, has been on the case since the very beginning. What's happening now, Monica?
Yeah, good morning, Mandy. So yesterday we heard from Indigo's CEO. Today it's board of director chairman Vikram Singh Mehta, who said that the company will be turning to outside external technical expertise to determine the root causes of what led to the mass cancellations that we saw this past week. Now, we also see Mehta saying that some of the criticism lodged at the airline, and there has been a lot, is fair, but some not. He's specifically taking aim at any notion that Indigo specifically engineered the crisis, that it tried to influence government policy, or that it compromised safety of its passengers. He also said Indigo at all times followed the new fatigue rules for pilots. Take a listen.
Indigo has followed the pilot fatigue rules as they came into effect. We operated under the new rules throughout, both in July and in November. We did not attempt to bypass them, nor did we do anything that negatively impacted our unblemished track record of safety. The disruptions of last week did not happen because of any deliberate action. They happened because a combination of internal and unanticipated external events, including minor technical glitches, schedule changes linked to the start of the winter, adverse weather conditions, increased congestion in the aviation system, and implementation of and operation under the updated crew rostering rules. This is not an excuse. This is simply the truth.
The Meta also called the past week a blemish on Indigo's otherwise pristine record, a record which now sees regulators stepping in to reduce flight capacity for the airline for the winter by some 10%, and also installing personnel in Indigo's headquarters to oversee operations. Now, we do see Indigo revising its third quarter guidance down, both in terms of capacity and passenger unit revenue. Yesterday, shares falling 3%, but since this debacle has started, some 14% overall. It's back to you, Mandy.
Thank you very much for that, Monica. Well, the Hong Kong and mainland Chinese markets are getting ready. They're champing at the bit. They're getting ready to open for their trading day. The bottom of the hour. We'll bring you the opening trades when Squawk Box Asia comes right back.
Introducing a brand new global business news channel, decoding global shifts and their impact on Indian businesses. Tune in to CNBC TV 18 Prime.
The U.S. Treasury market is sort of like the biggest player in the global markets and in the global trade negotiations.
You can't have the tariff one day and the exemption on the next day and expect people to make medium to longer term investment decisions.
India is also trying to make inroads. Is there room for both India and China as we continue to see this frenetic realignment going on?
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Welcome back. You're watching Squawk Box Asia. Markets in Hong Kong and China just coming online. Let's take a look at the price action here. And we are looking at, well, decent going for the Hang Seng Index, higher by 0.7%. And it's also that positivity is playing out for the technology names as well. Taking a look at some of the top heavyweights here in Hong Kong, and we are, of course, digesting a lot of China-related economic outlook. I mean, coming from the World Bank as well as the IMF. We are looking at the green across the board. HSBC, financial name, higher by more than 3% at the moment, and Alibaba's and Tencent's also pushing higher by more than 1%. Let's check out the opening trades for Jingdong Industrials. And now we've been talking about this in the last hour with Emily. Shares right now, so quite a bit of a drop off. So down more than 8% or so. Now this kind of price action comes after the JD.com unit raised more than $380 million after pricing shares at $14.10 Hong Kong dollars a piece, that is. So we'll be watching. I mean, it's really very early minutes and things can be volatile there. The mainland markets coming online at the same time and taking a look at what kind of kickoff we are getting. So a bit of a divergence playing out for Hong Kong and mainland China. We do see very subdued kind of a kickoff for some of these equity indices. The dollar in yuan at 706, so some strength coming through for the Chinese currency at the moment. Mandy.
Well, talking of China, the IMF, Sherry, is not the only one raising their growth forecast for China. There's also the World Bank revising its views on the Chinese economy. Let's get more on this with Elaine Yu. Good morning again, Elaine.
Hey, Mandy. Yeah, so the World Bank has come out with its projections as well, saying that it projects GDP growth in China to be 4.9% this year. So that's slightly below the IMF's projection of a 5% growth this year. And for next year, the World Bank is projecting 4.4%, also slightly below the IMF's 4.9% for 4.5% for the following year. So the IMF's outlook for China has immediately improved for now, but it has some starker warning in terms of the bigger picture here. The IMF, wrapping up its visit, has urged China to speed up its shift away from relying on exports to a consumption-led growth much more forcefully and with greater urgency, despite Beijing repeatedly signaling it has plans to do so. Let's take a listen to what IMF Managing Director Kristalina Georgieva said on this issue. Sorry, excuse me, we don't have a soundbite on this, but they're saying that China is too big to rely on exports for growth, or otherwise they'll risk a global trade war. And the Euro Chamber of Commerce in China backed this up with a metaphor, saying the current EU-China trade ties are like a fly waiting for a windscreen, saying that the ballooning trade imbalance and also the undervalued RMB is pushing Brussels towards more decisive action. And I also want to point out that, or bring up that the IMF's Georgieva was telling all the young Chinese journalists in the room at the press conference, saying that you need to help your mothers and fathers and grandfathers to change their attitude, to say that it's patriotic to spend money so that they can help lift domestic consumption rates. So quite a plea there, Sherry.
Yeah, no, that definitely reminds me of what happened during the IMF crisis in South Korea. People really just hoarding their the gold jewelry and making sure that they actually save the economy. It's patriotic. So there we go. Thank you so much, Elaine, for that. And we're back with Rob Subaraman, head of global macro research at Nomura. I'm not going to ask you a gold question, Rob, but China question. So you made some interesting points around what you expect in terms of policy stimulus potentially coming through next year. I know it's things can be very complicated and the property market still looking very messy. But my question is, what do you think the authorities there want to do with their currency going forward? We continue to see this sort of impulse at appreciating their currency. No, I mean, a case in point, midpoint yuan fixing actually coming in at the strongest level in about a year now.
Yeah, I think recently the currency, the renminbi, has been appreciating a little bit against the dollar. I think heavily managed appreciation. I would say, Cherry, that the bigger picture, I think, for China around the currency is they want a fairly stable currency. Yes, I think what the IMF is saying in that China is now the second biggest economy in the world. It can't keep relying so much on exports. But right now, the big driver of China's economy there's been two engines in the past. One was exports, the other was the property sector. The property engine is spluttering. It's not contributing to growth. It's subtracting from growth. And so there is right now an importance to still have the export. So I don't see, as a strategy to have strong currency appreciation, letting the currency just go at this stage. Also, the economy is close to, is actually on PPI in deflation. Do you want a stronger currency that could cause deflation to deepen? So I think, if you ask about the policy prescription, I think more fundamentally what China needs to do is find ways to try to generate stronger consumer demand. China has a lot of savings. You talk about gold in Korea after the Asian crisis. China right now has excess savings, excess household savings. They've got to try to find ways to get Chinese households to spend a bit more. And I think a big part of that is improving the social safety net to give Chinese households more confidence that they don't need as much precautionary savings. And I think one area in particular that at Nomura we're trying to really stress here is the pension system. I think particularly rural pensioners get very little pensions compared to their counterparts in the cities, particularly civil servants. And so we think there's a lot of scope to beef up the pension system, and hopefully that can help bring down precautionary savings. There's various other ways as well, but I think ultimately the focus needs to be to try to get more consumption going. That will then mean you don't need to rely so much on exports. And by the way, the export surge that we're seeing with China, it's putting pressure not just on Europe, on Asia as well. In China's backyard, a lot of countries are facing, a flood of inexpensive imports from China, and that's putting a lot of competitive pressures on their own local industries.
And going back to the point that you made earlier about how China needs to and could do more in terms of fiscal stimulus next year, aren't they already doing it? I mean, budget deficit expansion, is there some special bond issuances happening? It's not sort of the bazooka style that we're so used to with the U.S. and some of the other economies. It is happening. So in what form and at what scale do you expect that to happen in 2026, Rob?
You're right, it is happening. But, when you have had a structural decline in your property market, things don't reset in just a year. So you need multi-years of fiscal stimulus to get out of this rut. And so it is more needed. I would say, though, Cherry, that we need to see kind of a recalibration of the fiscal stimulus. I think historically, a lot of the fiscal stimulus has been centered around infrastructure spending or boosting the property market. Certainly, we need to resolve the property market, but I think that's more instead of building more homes. It's more about, there's already excess homes. It's more about resolving the debt issues, particularly around property developers, and getting households that have bought homes but have not actually had them delivered yet, that resolved. And as I said, I think consumption is the key area. You know, the other thing I would say for China around policy is some of the policy stimulus approaches of the past aren't going to be working as well in the future. So, you know, one has been this durable goods trade-in program, subsidy program where you trade in your old durable goods and you get subsidized to buy new ones. You can't keep repeating that trick year after year. And so I think that has less runway ahead. The second one is, you know, using the stock market, stimulating the stock market. Well, the stock market, as you reported, is doing very well. You don't want to overdo that and get into a bubble. So I think China needs to find new areas, and the one that we're really emphasizing is focusing on the social safety system.
Yep, beefing up the welfare state. Got to think outside the box. Rob, let's switch our attention to what's happening in Japan. Is the BOJ rate hike come December the 19th a lock? And is it absolutely necessary, considering that the higher yields there in Japan have already done some tightening for them?
Yeah, that's true. They have risen a lot, more than I think most expected. But Mandy, yes, we do think it's now very likely that the Bank of Japan will hike rates next week. I think the kind of subtle forward guidance that we've got from Governor Ueda and others, including in the media, has clearly signaled that now. I'd say, you know, there's fair reasons to do a hike. I think inflation is above target, but importantly, the currency has been on the weak side. And thirdly, I'd say the new Takaichi-san administration has just unveiled a very large fiscal stimulus package, larger than most had thought. And so, you know, more that also, I think, is providing room to start raising rates. I wouldn't call it tightening monetary policy. I'd say it's starting to provide less loose monetary policy. Monetary policy is still extremely loose. Real interest rates are still deeply negative. And so, you know, we don't think this is the end. We think that the BOJ will probably hike at least 2 more times, terminal rate of around 1.25%. But it's not going to be quick. I think they're going to space out the hikes with long periods in between, because the last thing Japan wants is to kind of overhike and get back into the deflation funk that they took so many decades to get out of.
Yeah, I'd love to ask you more about the Japanese yen, which is kind of back to where it was at the beginning of the year, but we have run out of time. Rob Subbaraman, thank you so much for joining us today from Nomura.
Thanks,
we're going to take a short break. We'll be back with Korean tech after the break.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
As a decision maker, you just don't need headlines. You need what they mean for your capital, for your plan.
Your next big move. You don't need opinions. You need perspective.
And context. And that is what CNBC TV 18 Prime aims to give you. Analysis, strategy, and context which is built for India for boardrooms and bold moves.
Built for those who lead, who don't just follow the story, they define it.
Tune in to CNBC TV 18 Prime, global business news for the global Indian.
Get a bird's eye view of the world, beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Welcome back to Squawk Box Asia. South Korea has unveiled plans to boost its chip manufacturing prowess further as the government there considers building a $3 billion foundry funded by state and private investment. Now, this comes as a special committee on semiconductors will be established under President Lee Jae-myung to act as the control center for national policies on chips. In the meantime, let's check on South Korea's chip plays. And remember, Samsung Electronics is really more of the foundry play here, and that stock is up more than 1%, while the pure memory play, if you want to call it that, in South Korea, of course, it had a sort of big rally earlier this week, and now finding some, letting some air out, down about 0.5%. Let's bring in Jong-min Shim. He is the deputy head of Korea research at CLSA, joining us live from Seoul this morning. Jong-min, it's great to have you on. Thank you so much for joining us. So a lot of chatter around what SK hynix is trying to do here with their potential ADR listing. I think that's more of a bigger sort of a market news than what President is talking about or what the government wants to do with the foundry. We'll get there. How do you expect SK hynix to really make this happen? I mean, it's really about, they're framing it as sort of a corporate value up story, but do you think it's really about SK hynix and needing to tap into bigger capital markets in order to ramp up their capacity?
Well, a lot of talks on this. Nothing's been confirmed yet, but obviously, with Hynix being listed in the U.S. via ADR, then it will attract investors and more flows into SK hynix. And then there are hopes that maybe SK hynix will be included in some of the ETFs that are listed in the U.S. so that they can attract more flows. But obviously, the talks on the Hynix ADR listing is utilizing their existing treasury shares, which is a bit controversial because the government is trying to implement the mandatory treasury cancellation for listed Korean companies. So if the ADR listing gets confirmed next year, then it becomes a bit, it will need a little more time because it needs to go through the board of directors and the shareholders approval for this. So I think it's not going to be a very short-term thing in my view because of these mandatory treasury share cancellation that the government is trying to push through.
Good point there, and some controversy to keep a note of and make a note of. But what do you think? The fact that it's floating, it's being under reviewed, it's being reviewed. The fact that SK hynix is talking about this and with this idea sort of being flown as a trial balloon, what does that suggest about really the mindset shift perhaps for some of these large conglomerates in South Korea? Because I mean, one of the questions that I got from a friend of mine who is actually in the markets looking very much with a lot of interest in the South Korean semi space, why aren't they listed? Why don't they have ADRs already, the Samsungs and SK hynixes? Do you think that mindset shift is happening?
Well, there are some of the Korean companies that are listed in the U.S. as well, but not many. So I think, it will be symbolic as this is one of the two big companies in Korea, and which are one of the most important stocks in terms of market cap and the as a symbol of the AI-related play in Korea, right? So I think if that happens, that will be important and material impact. But also, another issue is that the size of the treasury shares are not that sizable. So probably Hynix will have to buy back more shares and utilize that, and to list it in the U.S. So I think the details we'll need to see a bit more what they will announce on this matter, and then the actual event will probably take a little more time than what market's been, hoping to hear from SK Hynix.
Yeah, and what are you seeing on the ground in terms of the investor sentiment playing out for stocks like SK Hynix? I mean, it just had a stellar run so far in 2025. In fact, today is the day that it's taking effect, this investment warning status for SK Hynix as well as SK Square. Do you think there is a bit of AI chip investing mania that could be playing out in South Korea?
Well, I think if you look at the consensus earnings uplift for these semi-related names, I don't think the valuations are too stretched or there is too much of a hype ongoing. Just looking at the free cash flow and the earnings that these companies are generating, it's incomparable to what they have been doing in the past, right? So I think I don't think we are in any of this mania yet. I would say, comparing to other chip makers globally, like in the US or some of the AI-related plays in other countries, I don't think these companies are too overvalued or the hype is driving the market into a bubble territory or anything like that. So I think there is more momentum and earnings upside story that could pan out heading into 2026.
That's actually an excellent point. Mandy jumping in here, by the way, because I'm wondering whether if SK Hynix did successfully move ahead with a New York share listing, whether it would help close that valuation gap between it and some of its global peers, because even though the shares of SK Hynix are up about 243% so far this year, that still trails Micron on the NASDAQ.
Yes. Yeah, true. So I think that's possible, and that's what investors are expecting to see for Hynix. So I think that is a fair point, and that is probably one of the reasons why Hynix wants to list its ADR in the US. So I think that's a very possible scenario.
Jung-min, before we let you go, broadening out to the Korean equity outlook in general for 2026, bouncing off 2025, do you think that this was the year that really South Korea got put on the map in terms of foreign investors' portfolios?
Well, actually, if you look at the foreign inflows, it was not as significant compared to the past. So the foreigners have been net selling roughly around 43 trillion won worth of Korean equities since middle of last year until late April. And then starting from late April until October, the net purchase was only around 25 trillion. And then in the past 1.5 months, roughly around 15 trillion were sold off by the foreign investors. So I think, and if you look at the foreign ownership of Korean equities by foreigners, it's at around 34% or so, which is like at its 20-year average. So I think there is more upside to it, and I don't think the foreigners own enough of Korea. So for next year, it's one of the reasons why I'm still more positive on Korea, where I think the foreign inflows will be still pushing up the market for next year.
Excellent. Jung-min Shin, thank you so much for joining us today from CLSA.
Thanks for having me.
We're off for a quick break, but as we tail into that break, shares of Coupang continuing to slide stateside following the resignation of the CEO Park Dae-jun after the company revealed a massive data leak last month that affected 33 million customers. Ouch. We're back after the break.
Introducing a brand new global business news channel, decoding global shifts and their impact on Indian businesses. Tune in to CNBC TV 18 Prime.
CNBC TV 18 Prime is your gateway to the global markets, your window to global business.
Get a bird's eye view of the world beyond the borders. Foreign Policy Decoded on Global Lens on CNBC TV 18 Prime.
Let's take a final look at Asian markets following the Fed decision, mostly advancing with a couple of red spots there. So the TAIEX and Nikkei 225 over in Japan, they're not really enjoying the party, but there is a small party as the Fed's rate cut lifted mood here, and we do see markets like Korea and Hong Kong actually leading the gains on the board there. And in fact, one of the biggest winners in the region so far in 2025. And that does it for this edition of Squawk Box Asia. Thanks for joining us on a Fed Day. I'm Sherry Kang in Hong Kong.
And I'm Maddie Drury in Sydney. Have a great trading day. See you same time tomorrow.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
CNBC TV 18 Prime, from Wall Street to your wallet, connecting the dots before the market does.
This is Network 18, and you're watching CNBC TV 18 Prime.
Hello and welcome. You're watching Global Lens from the CNBC TV 18 Prime Ionic Wealth Studio with me, Parikshit Luthra. These are the top global headlines. America's top trade envoy, Jamieson Greer, tells the U.S. Senate that offers from India are the best they've received yet, and the Indian government has been forward-leaning. Also adds that India has been a tough nut to crack, and there is resistance over certain crops. Elon Musk's SpaceX is planning to go public in 2026. The company is likely to raise $30 billion at a valuation of $1.5 trillion. Global markets trade lower as attention turns to the U.S. Federal Reserve's policy decision. Later tonight, the Fed is widely expected to cut rates by 25 basis points. But a CNBC Fed survey shows sentiment is split. Only 45% of respondents believe the Fed should cut rates, a sharp contrast to earlier surveys. Top U.S. trade officials, Deputy USTR Rick Switzer and Assistant USTR Brendan Lynch, are in New Delhi for another round of bilateral trade talks. The Indian side is being represented by Joint Secretary Darpan Jain. This is U.S. government's second visit to India since President Donald Trump imposed a 25% duty and an additional 25% penalty on Indian imports over New Delhi's purchase of Russian oil. The MEA said that India and the US remain engaged in negotiating a fair, balanced and mutually beneficial deal, though challenges remain, particularly on arriving at a common average tariff level. In response to the Senate, America's top trade envoy, Jamieson Greer, said that offers from India are the best they've received yet, and the Indian government has been forward-leaning. However, he added that India has been a tough nut to crack and there is resistance over certain row crops. Meanwhile, Foreign Secretary Vikram Misri has also met Rick Switzer. In a post on X, the MEA said the discussions covered strong India-US economic and technology partnerships, ongoing trade talks and opportunities to boost two-way trade and resilient supply chains. Commerce Minister Piyush Goyal said talks with the US were making steady progress, but emphasized that trade negotiations have many moving parts and cannot be tied to deadlines.
यूनाइटेड स्टेट्स ऑफ अमेरिका की टीम मंगलवार से भारत में है और उनके साथ बातचीत निरंतर प्रगति कर रही है। बायलैटरल ट्रेड एग्रीमेंट की तरफ हम आगे बढ़ रहे हैं। आई एम होपिंग टू रीच बैक दिल्ली टुनाइट and I have parliamentary duties also, so we'll try to see if I can take out some time and have a meeting with them later in the evening, because tomorrow again I'm in Mumbai for the Italian Deputy Prime Minister. All agreements, all discussions have many different angles, many dots have to be connected, and we never negotiate deals with deadlines. Thank you.
We're now joined by Mukesh Aghi, President and CEO at US-India Strategic Partnership Forum. Mr. Aghi, we've already missed the fall deadline and now we're nearing the end of December. Do you really feel that the deal is in sight right now? Is it close to us?
Well, you have to understand, Parikshit, that the process has changed in Washington, D.C. as far as who makes the decision. And what we are seeing is that every key decision goes to the president, and then he decides how to take this forward. In the U.S.-India trade deal perspective, we have seen multiple times the cabinet rank secretaries have recommended a deal with India, but it has been pushed back or the goalpost has moved in a different direction. So at the moment, as our understanding goes, there is a recommendation from the USTR, from the Commerce Secretary and others, that this is the best deal India has put forward, and it's time to move forward. And I think everybody is waiting for the president to take a call so we can close the chapter here.
Right. Now, how do you read Jamieson Greer's testimony to the Senate Appropriations Committee. He was responding to a question where he said that, yes, we have been trying to get access to the Indian agriculture and dairy market. India has been a tough nut to crack when it comes to certain row crops. But at the same time, India has been forward-leaning. They've given us one of the best offers we've ever got as a country, and they remain a viable alternative for the US economy. Do you feel that even in this final stretch, the US is now pushing for access to India's agriculture market? Because many believe here that what Donald Trump said with regard to additional tariffs on rice, and now this statement by Jamieson Greer, may put a bit of a spanner in the works.
Well, every nation is going to drive a treaty which favors them. In the case of US, the focus is to get access to the Indian agriculture market is vis-a-vis what's happening with China. China is the biggest buyer of India's soybean and corn, and that has been a tough negotiation there, and Chinese just agreed to buy it. So they're looking for alternate market. From India's perspective, you have to understand that that market is closed. It's a red line for India because you have almost 50% of the labor force working in the agriculture market, generating approximately 15% of GDP. So it is in the interest of Indian government to protect the interest of the farmers, to protect the local agriculture market. And you have to understand agriculture is also national security. So you can't basically let a aspect of economy exposed to issues which could have an impact not only just on inflation, but on national security of the country. So I think the government in India is taking a position that that's a red line, and we will not move from that perspective.
Right. I would also like to ask you that from the industry, from the US industry, clearly there is, because of the tariffs, there has been an impact on India's exports to the US. But from the point of view of an industry chamber, what's your hope from the trade negotiations and the average tariff rate that we should arrive at?
Well, when you look at the exports from India to the US on the tariff category, yes, they are down. We looked at the data, but also the non-tariff category, they're also down. So that shows one is that the US economy is basically, or the consumer is spending less. They are feeling the impact of tariff. We can see that in grocery stores. We can see that in regular stores. The costs have gone up. And that issue of affordability is coming into the politics of the United States. When you look at one of the main reasons Mamdani won in the city of New York was on the issue of affordability. And so I think that's where you look at the president now going to Pennsylvania tomorrow for a rally to talk about affordability. So I think tariffs are impacting the consumer itself. So from that perspective, I would say that the slowdown is going to impact not only just India, but the rest of the world, because US will import less and less itself.
Right. I would also like to ask you that going forward, how will the movement of skilled professionals from India to the US also be impacted, Mr. Aghi? Because, you know, the US State Department has now put out an advisory saying that we earlier were conducting an online presence review of all students and exchange visa applicants in the F, M, and J non-immigrant classifications. Beginning December 15, we are expanding online presence review to all specialty, occupation, temporary worker, H-1B visa applications and their dependents in the H-4 case. In every case, we will take the time necessary to ensure an applicant does not pose a risk to the safety and security of the US. How do you think this is going to have a spiraling effect on visa applicants?
Well, you have to understand that every nation would like to protect its borders. And, you know, in the case of skilled professionals, especially in H-1B, we have seen certain cases of abuse happening. And the whole effort is to basically avoid that abuse. You have to understand that we have a shortage of skilled professionals in U.S. U.S. needs to basically import a large number of skilled professionals in every category. And these skilled professionals are contributing to the local economy. If you look at 60% of the AI startups today have some kind of an Indian component. Almost 75% of the startups in the US will have some kind of a Indian component. So I think you can't basically say, hey, you don't need skilled workers, but I think you need skilled workers who can contribute. And the whole process is to avoid the gaming of the system or the abuse of the system itself.
Right. My final question to you, Mr. Aghi, and it's coming back to the delegation of Rick Switzer and Brendan Lynch, who are here right now. The Ministry of External Affairs, when asked about this, called this a familiarization visit. Their sense was that Rick Switzer has been recently appointed. He's coming to meet people. The expectations from this visit seem to be low. What really are they seeking to achieve this time around?
Well, obviously, you have basically newly appointed leadership within the government in the U.S. They are coming to learn, educate themselves, and give feedback. But I have to come back to your first question as to how will this impact the trade deal? You have to understand, you have one person who will make a decision. Both the government of India, its diplomatic corps, its trade negotiators have put the best foot forward, giving one of the best deals to the U.S. And it's not just about tariff. I think it's also about politics, global geopolitics also. So from that perspective, I think we can keep on fine-tuning the trade deal, but until the president takes a call, nothing is going to move forward. And we're hoping that we're able to convince the president to close the chapter and move forward, because the relationship between India and the U.S. is not just about trade deal. It's much bigger, much broader. And I think we need to pay attention to the other aspect of the relationship, the geopolitics, the technology, and people to people itself. So I would say that hopefully we expect the trade deal to close in the near future and look forward to a very strong relationship between India and the U.S.
Right. Thank you very much, Mr. Aghi, for joining us on the program, making it also very clear and helping our viewers understand that the work on the trade deal is now done. And perhaps the answer to it is now what happens in the White House, whether Donald Trump signs on the dotted line or not in the days to come. Of course, the word is that the deal has gone to him several times in the past, as you've also said on Global Lens earlier. Thank you once again for being with us. Moving on and getting you other news from around the world, Palestinians brace for intense flash floods, strong winds and hail throughout Palestine, including the war-torn Gaza. Officials have warned that hundreds of thousands of displaced people are at risk because their shelters are weak and crowded. Meanwhile, Israeli military conducted raids across West Bank last night and this morning, arresting nearly 100 Palestinians. Ukrainian President Zelensky has said that its government is ready to hold elections within 3 months. However, the Ukrainian leader maintained that the United States and Kyiv's other allies must ensure the security of the voting process. This comes after US President Donald Trump suggested that the Ukrainian government was using the war with Russia as an excuse to avoid elections. Remember, wartime elections are forbidden under Ukrainian law, and Zelensky's term in office as the country's elected president expired last year. The US has told Thailand and Cambodia to stop hostilities immediately as border clashes extended for a third day. US Secretary of State Marco Rubio said that the two nations must follow de-escalatory measures outlined in a peace accord brokered by US President Trump in October. Trump has also said that he would make a phone call to stop the fighting. 7 people from Cambodia and 3 from Thailand have died during the clashes. Both countries have blamed each other for reigniting the fighting. Japan has scrambled jets to monitor Russian and Chinese Air Force conducting joint patrols around the country amid rising tensions between Tokyo and Beijing. The Japanese Defense Ministry said that 2 Russian Tu-95 nuclear-capable strategic bombers rendezvoused with 2 Chinese H-6 bombers flying near the East China Sea. The bombers, along with 4 more Chinese jets, then made a round-trip flight near Japan's Okinawa Prefecture. Japan also said it detected simultaneous Russian Air Force activity in the Sea of Japan. The United States has made a fresh commitment of $1.25 billion in Exim Bank financing for a mine in Pakistan's Balochistan. In a social media post, US representatives have said that the US-Pakistan partnership will drive economic growth in Balochistan. The post added that this could be a game changer for US businesses and local Pakistani communities. The trade deal between US and Indonesia might be falling apart. According to Financial Times, US officials are of the view that Jakarta is going back on the terms of the trade agreement. The report highlighted that US Trade Representative Jamieson Greer believes Indonesia was backtracking on several commitments it had made. Indonesian officials are not agreeing to some binding commitments made in the deal and have communicated that to the USTR. SpaceX is eyeing a $30 billion initial public offering in 2026. If successful, this would be the biggest listing ever. Bloomberg has reported that the Elon Musk-led company is targeting a valuation of about $1.5 trillion for the entire company. That would leave the SpaceX near the market valuation of $29 billion that Saudi Aramco achieved during its record 2019 listing. Time for a short break, but don't go anywhere. Prime Minister Narendra Modi is set to visit Oman, one of India's oldest strategic partners. Isa Saleh Abdullah Al-Shibani, Oman's ambassador to India, decodes the possible outcomes from the visit on the other side.
Introducing a brand new global business news channel, decoding global shifts and their impact on Indian businesses. Tune in to CNBC TV 18 Prime.
The U.S. Treasury market is sort of like the biggest player in the global markets and in the global trade negotiations.
You can't have the tariff one day and the exemption on the next day and expect people to make medium to longer term investment decisions.
India is also trying to make inroads. Is there room for both India and China as we continue to see this frenetic realignment going on?
Welcome back to Global Lens. Prime Minister Narendra Modi is set to visit Oman along with other key nations in West Asia in a major outreach. The visit comes nearly 2 years after Oman's Sultan's first state visit to New Delhi and is expected to further strengthen bilateral ties. Oman is not only one of India's oldest strategic partners in the oil-rich region, but also a key economic partner. According to Commerce Minister Piyush Goyal, India and Oman are exploring a free trade agreement. Bilateral trade between the two nations rose to over $10 billion in FY25, making Oman India's 28th largest trading partner in that fiscal. To take this forward, I'm now joined by Isa Saleh Al-Shibani, Ambassador of Oman to India. Thank you very much for joining us on the show today, Ambassador. Let me begin by asking you, what are the big expectations from Prime Minister Modi's visit to Oman, and how will it open up new avenues of cooperation?
Well, it's, I think, a very important visit and very strategic one, and it is between countries who have shared history, friendship for a very long time now. And, you know, likewise, when His Majesty visited India in 2023, the relationship has been elevated to strategic relationship. So the expectation for this visit also to get very high momentum, and it will, of course, support the relationship between the two countries.
There is a lot of hope among Indian exporters that the FTA with Oman will be signed during the Prime Minister's visit to the country this month. Could you confirm if the deal will be indeed finalized during the high-level visit?
So I think is where the stakeholders over there, the departments between the two countries, are working in it. I don't have information with regards to the signing during the visit, but the latest news that it has came out that the negotiation term and rounds has been concluded. So hopefully there will be some good news sometime soon.
How satisfied is Oman with the progress in trade talks?
Well, I'm sure both countries are satisfied. The CEPA agreement has been included and announced during His Majesty's visit. It has been on the vision documents between the two countries, and where it has also been giving the momentum and the support that you know, negotiation should start and concluded in a very short time span.
How will this FTA between India and Oman open up trade and help both the countries?
Well, absolutely. You know, usually FTA will come as a platform to facilitate trade, and I'm sure, you know, and to overcome so much of challenges that countries usually face in terms of bilateral trade. So as with any other FTA or a CEPA, where you know such conclusion of agreement will boost.
Ambassador, which are also the areas where Indian exporters could get more access to the Oman market?
Well, Oman is, you know, has been for very long where energy really a dominant sector, but under the vision of 2040, where the country has set a plan to diversify economy. Sectors would be like green hydrogen, IT, logistics. There are, you know, some of the very important sectors that Oman is really looking to enhance. Oman is well positioned as well in terms of either geographic location or relationships between the neighborhood and wider market, either in the GCC, Middle East, or Africa.
And which would be the areas in India where Oman would be seeking greater market access?
Well, Oman has been, you know, for now many years is looking into being one of the leaders in terms of green hydrogen industry. It has been where the government provided support in terms of developing the technology and seeing production by 2030. And I think there is, for us being in India for a few years now, where we see that the energy is a high demand. Manufacturing, of course, is one area that we think is either in terms of renewables or in terms of logistics, in terms of supply chain, where we have seen an increase and a need for this as well to be developed.
And how would you describe the priorities during the upcoming Suhar Investment Forum in Oman, and what are the kind of investments, the sectors from where you would want to attract investments from India?
So Suhar is really the Suhar Forum is a progressive event. It has been, this is the second or third time where it's held, and I think is where this time the focus is on sectors. The investors who will be participating will be given the opportunity to see on the ground some of the projects that have been accomplished, but also will be where the Suhar Authority will be announcing some of the opportunities, talking about the incentives. And Suhar is a very beautiful coastal city. Sectors we are looking into are, manufacturing, logistics, energy-related, renewables, as well as we think that Oman has abundance of a very beautiful location. So tourism is one of the key investment as well.
All right. Thank you, Mr. Al-Shibani, for joining us on the show. That's a wrap on another edition of Global Lens. Goodbye and many thanks for watching.
Follow the money trail in currency, commodities, and crypto. Tune in to the Big C on CNBC TV 18 Prime.
As a decision maker, you just don't need headlines. You need what they mean for your capital, for your plan.
Your next big move. You don't need opinions. You need perspective.
And context. And that is what CNBC TV 18 Prime aims to give you. Analysis, strategy, and context which is built for India for boardrooms and bold moves.
Built for those who lead, who don't just follow the story, they define it.
Tune in to CNBC TV 18 Prime, global business news for the global Indian.
This is Network 18, and you're watching CNBC TV 18 Prime. Down begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio. "26 years of CNBC TV 18.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Morning.
Hi, good morning. So we got the much anticipated Fed rate cut. So that trigger is out of the way. So now as we unwind towards the end of the year, what next, right? What are we looking forward to?
More rate cuts.
No, this year. I'm talking about calendar year 2025.
Winding it down,
Winding it down, right? There's nothing. Is there any trigger on the horizon, a large one?
Christmas. But it's not feeling like that, right? In our markets, on a day-to-day basis, coming in there, a bit of a bashing is what most investors are getting. But a bit of a challenging time. Hopefully it passes.
Yeah, and maybe some stability, right? Yeah. But let's see. But it's getting tougher. And pain continues, as we've sort of been highlighting for the last 10, 15 days. And, you know, in phases like this, and we've had this discussion with guests as well, it's better to sidestep if you, and there are lots of attractive opportunities, and, you know, our guests come on and talk about that. But it's about when you buy. I mean, you want to buy when, you know, there's a broad fall and stocks fall for no specific reason of their own. Or you want to buy in a more cleaner kind of environment? That's the question. But, well, near terms are tough to call. Let's start from the top, right? So market pain continues. Mid-caps, small caps, of course, has been there for a while. But even large caps, look at what happened yesterday. And, I mean, what, 13, 14, 15 days to go? Trading sessions to go for the end of the year. FOMC cut rates by 25 basis points. But it's a divided FOMC. And I just put that out. That is 9-3 vote. Only because in 2026, May onwards, it's going to be called Trump's Fed. But Trump's Fed does not mean that President Trump will get what he wants. As you can see, there were some dissents. There were two dissents, actually, in favor of a hold. And there was one guy, of course, Stephen Moran, who said, well, it should not be 25, but 50 basis point cut. So, you know, it's a committee which decides in that sense. On their own, though, I would say, the Fed Chair Powell sounded, I mean, the expectation was what? That it's going to be a hawkish cut. That the Fed will cut and is done after that, and no more cuts, at least for the next couple of meetings. But if anything at the margin, this was not as hawkish. I mean, the cut was not as hawkish because, you know, what did he say? He said two things. He said inflation, if you exclude the impact of tariffs, is close to target, right? That is one. And labor market is gradually cooling. I mean, actually, towards the end, he kind of put out some numbers for the labor market data, which suggests that actually monthly job addition is negative. So, you know, inflation near target and labor market starting to weaken a little bit, that's not hawkish, right? I mean, that does kind of, it's up to, of course, how they read the data going from here, and that's what they said, but that's where, you know, Chair Powell left it at. Now, there was one just surprising bit, $40 billion worth of Treasury bill purchases, which will start immediately. The quantum is also larger than expected. The frontier, especially the front end, the 2-year, 5-year, etc., saw some move. Even the 10-year yield lost about 4 basis points, and we were at about 4.15%. The S&P was up about 0.6%. By the end of it, NASDAQ up a little bit, but lesser than the S&P. Dollar index came off sharply, and 0.6% cut as far as the US dollar index is concerned. So, you know, again, nothing dramatic post the Fed decision, but equity markets higher, yields lower, and the dollar index lower as well. I guess we could live with that. Just one name, which has, of course, been, which has become, you know, it's kind of raised raised ahead from behind. Oracle. It was down 6.5% in after-hours trading. It posted disappointing cloud revenues. So more on this later, but I mean, the AI story is the big one. So Oracle, of course, is now also right in the middle of all of it. Oil prices 1% higher, 62.5 odd. You know, Trump essentially said that the U.S. has seized, and there's some videos going around on social media that U.S. has seized a large sanctioned oil tanker off the coast of Venezuela. Venezuela is a very, very large oil producer, and there's been military build-up, U.S. military build-up around Venezuela, talk of regime change and whatnot. So we'll see if this is going to be another flashpoint, really. Just to tie in the levels here, not very much with regards to change. I mean, the numbers change because the moving averages change. The Nifty 20-day is at about 26,022. We, of course, are under it. And downside level, not really supports in that sense, but I mean, it's about 1.5% away. Given the state of markets, you've got to keep that as a possibility. 25,320 is the November low. So keep that at the back of your mind. Bank Nifty 20-day moving average is 59,181. And we managed to close around it, close above it. Support stands at 58,600 or so as far as the Nifty Bank is concerned. All again within 1.5% of where we left off yesterday. Just the implied open with regards to GIFT Nifty indicating a strongish start, 90 points higher. I mean, the trick is going to be to start strong and then stay strong through the course of the day. Nigel is standing by. He's walked across with what the F&O positioning is looking like. Nigel, over to you.
Well, that's right, Prashant. By the end of today, we can end with some green or even the kind of opening that we'll like to see going by what the GIFT Nifty suggests. Well, the bulls will be very, very happy. But in yesterday's trading session, well, the sentiment was really sour and the broader market pain did continue. Looking at institutional data, though, the institutions were net buyers because the DI buying is outweighing the FI selling. And the FIs, yes, they're selling, but they're selling 1,500, 2,000 crores or thereabouts. That can be absorbed. The problem is when that number goes up to 3,000, 4,000 crores or thereabouts. So they're sellers, but maybe not as large as what we saw 2 or 3 months ago. So that's one data point. The other problem is the broader market pain. That continues. And even in yesterday's trading session, you'll see the Nifty ended lower, but the mid and small cap indices, they took a sharper cut. And the problem is the margin trading book, that's trading at record highs, which means this money is borrowed funds and you're making losses on those borrowed funds. We'll have to see some kind of cool off on this margin trading book. Remember, in March itself, it was at around 65,000 and that's ballooned up to around 1.12 lakh crore or thereabouts. So some kind of cool off on this front is warranted. Till that happens, you could continue to see shocks in the broader market and some kind of pain, particularly in smaller cap stocks. Well, moving to the FI's futures data then. They added shorts both on stock as well as on index futures, as this plate is telling you on the screen. And in fact, on index futures, well, the short positioning that started around 85,000 contracts, well, that's ballooned up to around 1.5 lakh contracts, which essentially means in the month of December, the FI net short positions have gone up in absolute terms by close to around 70% at around 1.48 lakh contracts, and in percentage terms at around 89%. So this market is net short. It needs to stop falling for you to hope to get a short covering bounce. For the time being, these shorts are getting piled in the system because the FIs believe there's no deal in sight and sentiment is really sour as well. So they need to get trapped on the wrong side. What do they do in index options? Well, they went ahead, they wrote 2 calls for every 1 put. And because of this intense call writing, the PCR has come down to around 0.73, which is the lower end of the range. But what's giving you some kind of hope is, there is some put writing as well that is there. And the call writers there have been having a gala time. But since the 25,750 put did see some writing and the premiums around 100 rupees approximately, the bulls will hope that that 25,650 level does get, protected on the downside. That support has been gradually moving down, but this 25,650 is an extremely important mark on the downside. Resistance, well, the 26,000 mark, 26,020 odd, that's where you have the 20 DMA as well. The Nifty Bank, well, that showed some weakness, but that needs to get back above the 20 DMA, which is going to be very, very important. That number comes up for you on the screen. I'll be looking at the tech index for a couple of factors. TCS has gone ahead, acquired a technology consulting firm for around $700 million. So that could be one stock in focus. And besides that, Oracle overnight, the revenues were a miss, negative cash flows, and the street is getting skittish on the big AI infra capex as well. So maybe that AI trade is gradually fizzling out globally, which may not be such bad news for tech out here. So I'll keep an eye out on the Nifty IT index as well, which has outperformed in the last couple of months.
Thank you very much for that. Just 3 thoughts on Oracle. Down 11.5% in post-market hours. So the disappointment was on the revenue front. It fell short on revenues. AI deals are piling up.
Yes.
The company's revenue, performance obligation, basically, which gives you revenue visibility for the future, went up sharply quarter on quarter and is at more than $500 billion. So why is the revenue falling short? It's basically the fear is monetization is lagging. Secondly, the company also raised the capex guidance. In Q1, they said it will be $35 billion. Now they're saying it will be $50 billion. Now, increasingly, companies, including Oracle, are resorting to debt to finance their capex. Earlier, tech companies were cash rich. They had pristine balance sheets. So they never tapped the debt market. But now, Oracle, Meta are increasingly funding their capex via debt. And third, just the hypersensitivity of these stocks. Just 3 months back, when Oracle came out with those blowout quarters, stock had surged, skyrocketed 35-36%. The market cap almost touched that $1 trillion mark, and everyone was asking, like, should Oracle get a seat at the table now with the Max 7? And then, one disappointing quarter and the stock is down 12%. But that's Oracle. Let's quickly move on to the other big story. That's Fed. We got the 25 basis points rate cut. Listen in to what the Fed chair, Jerome Powell, had to say.
The adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves. So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market. Because the labor market, unemployment was very low. If you remember when inflation was very high, there was a labor shortage. So we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people.
We got the third successive rate cut by the Fed and the final one for 2025. William Lee, Chief Economist at Global Economic Advisors and Milken Institute, is now joining us. William, thank you very much for joining in. What's your assessment of the signaling done by Jerome Powell and what lies ahead in 2026, according to you? Because this was a fractured mandate, and plus we are going to get a new successor to Powell sometime next year. So the dot plot says 1, but do you think it could be more than that? I mean, what's your own read?
Well, he's got a tough job, as you heard, in trying to dance around the fact that he said the economy is doing well. GDP growth is pointing at the 4% number, but at the same time, the labor market is weakening as we speak, and weakening fairly rapidly to the point where employment growth is negative. So I think that picture is one where he's trying to say to the inflation hawks, you're fighting last year's battle. We know inflation right now is being held up by the tariff bulge of tariff price increases that are working its way through. But within the time lag of monetary policy, which is about a year and a half, all of that push from tariffs should dissipate. And that leaves the high service sector inflation that is gradually coming down. And meanwhile, the labor market is weakening. So he is trying to make, I think, a very good case why we should have a larger cut, say maybe even 50 basis points, and sooner the better, because he said we're at the high side of normal right now. And when the labor market is weakening as quickly as it is, I think the case to be made for getting to the low side of normal is a very good one. Now, he didn't say that. This is my reading of and maybe, Myron's reading of it, but everyone else is hiding behind the cloud of uncertainty, the cloud of uncertainty of the lack of data regarding where inflation is and where the labor market actually is. And so I think he's dancing around a bit, but I think if you were to really read between the tea leaves and see where the forecast is going, the risks for a downside on the labor market is much greater than the upside on inflation.
William, hi, morning. Let's talk about something which can happen, right? One of those things. It's that time of the year when you start to reflect and then look ahead. And I guess we'll see lots of reports on 5 predictions, 10 forecasts and things like that. What's happening with this Venezuela thing, William? Will that be the next flashpoint? I mean, there's military build-up and it's a large oil producer. You think there's going to be an attempt at regime change?
That's a great question. Right now I'm so glad I'm no longer on the sell side doing my year-end outlook for the next year, because every one of these outlooks will change by February, right? And it's always changed by February. So they're really a pointless exercise, except that all your customers expect you to do it. But you bring up really the most important question I think that the risk managers are facing right now, which is geopolitical risk. And Venezuela is a big one because for the United States, many of our refineries have to refine heavy crude. Most of the shale that we produce is very light crude. Venezuela happens to be one of the big sources of heavy crude. So in some ways, the United States is very much dependent upon the kind of oil that Venezuela produces. And so I think our interest in securing our supply of oil from Venezuela, as well as shutting off the flow of drugs, is something that I think will tip the balance for more action in Venezuela rather than less action.
Have you seen that, William? I mean, on a lighter note, there's this picture was going around with American, whatever, one of those, the American forces, military personnel with guns and looking around. So, well, American geologists looking for oil.
Well, I don't think the soldiers themselves are looking for the oil.
Of course they're not. I mean, that was a joke.
No. I get it. But I think the point is well taken that Venezuela has always been an important source of sour crude for the United States because of these ancient refineries. And by the way, we're in this pickle because the environmental movement has prevented refineries from modernizing and rebuilding the more modern refineries that are able to refine the light sweet crude. So in some ways, the United States got itself into this pickle because of all of the regulatory nightmare that we've been living with for the last several decades, and something that the Trump agenda is trying to get rid of. But again, we have what we have, and we are stuck with these refineries, and they require the heavy crude that comes from Venezuela. And by the way, the other source of the heavy crude is Iran.
Okay, all right. Hi, William. Good morning. Good to see you in. A quick word from you on this entire AI trade. Oracle came out with a set of numbers. Another phase of the market, maybe the stock would have rallied, but now the street is looking at the cash flows, which were negative. They're getting a little bit cautious on the big capex spend as well, which has ballooned up actually in comparison to what it was a few months ago. What's your view on the AI trade? Because, overnight, post Oracle's numbers, you did some of these AI sensitives that also were lower in the after hours market. So your view on it.
Well, Nigel, you and Prasan are really hitting on my two favorite topics right now, which is what is on earth is going on with the AI trade. The capex spending that everyone is so believed in so much for the last several months seems to be fizzling out, in part because I think we're faced with an alternative model of AI development, which is what China is posing, which is to try to use much more in the way of software and less in the way of power and compute power. I think they're trying to get around the lack of compute power by improving the algorithms themselves. And I think a lot of the investors are asking the question, do we really need this amount of capex spending? And if we do, where's the cash flow that's associated with the profits that come out of all this, the payout that comes from all this cash flow? And I think those questions are being asked very, very seriously. And I think that's why you see companies like Oracle, crash and burn when they say, oh, we have to do more capex spending, without giving a clear sense to investors where the payoff from the capex is going to come from. And as interest rates, by the way, stay at the relatively high level, it sorts out the cats and dogs in terms of investments from the good investments, and only the good investments will survive. And so I think the AI trade has been doing every cat and dog possible to get this great innovations in AI, and we're not getting it. And I think the markets are finally starting to hold back and say, hey, we can't finance every stupid project that sounds like it's a good AI idea in a laboratory or in a textbook.
Okay, all right. William, thank you very much. Appreciate you joining us here for that great conversation. I hope we can squeeze one more in, or maybe two, before the end of the year. Thank you very much for being here on CNBC TV 18. Well, let's just quickly run you through the interactions which are lined up here. 8:35, we get Manish Tiwari of Nestle India to talk to us. That's coming up. Growth Outlook in focus. 9 o'clock. Jignashu Gore of Bernstein will be with us to talk about the strong demand on Swiggy's 10,000 crore rupee QIP. 9:20, Rana Gupta, Manulife Investment Management is a market master of the day. 9:30, Polymagic Cure talking about growth going forward. Patrick Law of Bank of America will talk about Forex and rates. currency very much in focus. And of course, the Marathon of Birla COP at 9:50 to talk about trends in the cement sector as we head into 2026. Lata starts her Outlook 2026 series. She speaks with Samira Chakraborty of Citi on how growth, inflation and the rupee may pan out next year. Okay, we'll take a quick commercial break here. A list of top stocks to watch out for with our research team on the other side.
"26 years of CNBC TV 18.
आराम से सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी।
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है? टिफिन लाए।
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
अपने दिल के हिस्से की सेफ्टी से समझौता? नो चांस। इसलिए पॉलीकैब ग्रीन वायर्स, जो है लेड फ्री और इमरजेंसी में दे कम टॉक्सिक गैस। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
सर, इतनी बढ़िया प्राइस पे कार खरीदना एक मास्टर स्ट्रोक है सर।
सर, बिना झंझट के मुझे कार लोन कौन देगा?
सर, सचिन?
अरे सचिन सर मुझे लोन क्यों देंगे?
सर मैं नहीं, बैंक ऑफ बड़ौदा देगा आपको डिजिटल कार लोन, एक्सटेंडेड रीपेमेंट पीरियड और क्विक अप्रूवल भी मिलेगा। बैंक ऑफ बड़ौदा से कार लोन लेना भी एक मास्टर स्ट्रोक है।
"26 years of CNBC TV 18.
Welcome back. You're watching Bazaar Morning Call. It's been a tough 3 days for our markets. The indices have shed about 1.5% on Nifty Sensex. Mid-caps down 2.5% in the first 3 days. But this Thursday morning, the GIFT Nifty is looking a lot better, up 75 points. It's just that a couple of minutes back, I think it was closer to a 100-point gain. Let's talk about stocks that you should have on your radar. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. But let me begin today with TCS, because TCS has announced a big deal. They've gone ahead and said they will be acquiring a consulting company called Coastal Cloud for $700 million in an all-cash deal. The company that they acquired had revenues of $132 million last year. And if you look at the last 12 months, ending September, it's about $141 million. Analysts say that because this acquisition will close on 31st of January, so you will still have about a 2-month impact. Contribution in FY26, there will be maybe a contribution of about 0.3% to the top line. But the signaling of this acquisition is important because TCS historically has been very conservative on acquisition. They've always preferred to grow organically. They didn't even hire laterals. They always promoted their own people, and that was the DNA of the company. But now increasingly we're seeing the company getting aggressive. So this is one large deal. But if you remember in the October quarter when they came out with their Q2 numbers, they announced an acquisition listing gauge that was $73 million, and plus the large AI data center build out. And then we got details about how TPG is entering in. So basically, I think this, of course, is a large acquisition, the largest that they've done so far, $700 million. And it's a good one, maybe a little pricey, but I think the signaling that the company is getting a bit more aggressive in the face of slowing traditional IT growth may be taken well.
Okay, all right. So that's one Tata Group company that will be in focus. That's TCS, and Tata Steel as well will be in focus. They announced a major capex program, but the street is waiting clarity with regard to timelines, execution, as well as funding. Now, the company will be expanding the capacity of NINL by around 4.8 million tons, which takes the total capacity of NINL to around 5.8 million tons. As we know, this particular unit has the potential to scale to around 10 million tons. So that's the biggest announcement, actually, and that's positive, though they have hinted about this expansion coming, going to be announced in the next few quarters, and that's precisely what's happened. Second, the company, they plan to, set up a 2.5 million ton thin slab caster as well as rolling facility in Odisha with the equivalent amount of finished steel capacity to around 2.5 million tons. That's positive. Third, the company will step up on its downstream, footprint. They're looking at establishing a 700,000 hot roll pickling as well as galvanizing line in Maharashtra itself. So that's about the downstream facility. And fourth, they have signed strategic partnerships with Lloyd Metals and Energy across mining, logistics, slurry pipelines, pelletization, as well as steel making in Maharashtra. Now, the plan includes developing a greenfield 6 million ton plant in 2 phases. Separately, Tata Steel has acquired close to around 50% stake in Triveni Pellets in Odisha for around 630 crores. Remember, the remaining is held by Lloyd's Metal itself. And this ensures secured supply of iron ore pellets and could result in cost savings as well for Tata Steel. And the collaboration basically provides Tata Steel with a strong presence in the Western market, which they have been absent, also gives them some raw material security. And finally, they'll be beginning work on a 1 million ton Hisarna-based facility in Jamshedpur. This is basically a technology that's more towards green steel. So we'll have to keep an eye on that. They've already done this in Netherlands. Net initiatives are positives. They address the long-term concerns with regard to their growth trajectory as well as market share. So a positive coming in there, but further details awaited on Tata Steel. Hopping across to Mangalam, he's picked up some scoop on Swiggy with regard to their fundraising plans. Mangalam?
Well, yesterday, the stock opened lower because the indicative floor price saw their 10,000 crore QIP was close to around 371 rupees. But towards the end, we did see the stock recover and end just about 2 rupees lower at 395. And we understand from our sources is that there has been good response to the QIP as well. More than 4.5 times demand for their 10,000 crore QIP. And it's a mix of domestic financial institutions as well as foreign institutions, long onlys, some of the hedges, as well as some PEs, the existing investors. So it's a decently well-bid book. More importantly, going forward with this fundraise and the Rapido stake sale that the company has done, their cash would be close to around $2 billion, which is pretty much at par with Eternal. So where it goes from here is something that we will be monitoring very closely. And if you look at both Eternal and Swiggy yesterday, as Swiggy recovered from the lows, Eternal was one of the stocks which was sold vociferously, so ended at the lower end of yesterday's trading range for Eternal after, there was recovery coming in on Swiggy as well.
Okay, all right, Mangalam, thanks a lot for that. Well, Lloyd's Metal, besides the tie-up or the strategic deal that they have done with Tata Steel, they've also announced that it will acquire 50% stake in Nexus Holdco FZCO for around $55 million. The deal, they're expecting it to close by around June 2026. Now, the acquired entity holds 80 to 90% equity in Surya Mines SARL, and 8 other entities in the Congo region. They will own multiple mining concessions as well as a copper processing plant as well. As of now, no revenues in this particular unit, but this marks Lloyd's entry into minerals beyond coal as well as iron ore. The street has been anticipating this diversification in the last few months, so it will not come as a big shocker. But further details are awaited on mine capacities, concessions, as well as the processing plant specifics. So we'll keep an eye out on that one. Net positive, but yesterday the stock ended up 3.5%. Moving across to Sudarshan to tell us some stocks in the news. Sir?
Good morning, Nigel. So I have 3 stocks. We'll start with Ola Electric. The stock is at 52-week lows in 2025. The stock has slipped almost 60%. Also, it's been losing market share. In the month of November, the market share had fallen to 6.7% versus 25% that company had in the start of 2025. Now, what's the latest development? S&P, a rating agency, has downgraded its promoter, that is ANI Technologies, which holds almost 3.64% stake as of September of 2025. And the rating is downgraded to CCC- from CCC+, and outlook is negative. So CCC- rating means default is very likely near term or inevitable without improved finances. And this downgrade is on continual cash burn and weakening liquidity. And ANI Tech faces heightened risk of covenant breach, and cash buffer continues to diminish on Ola Cab's operating losses. These are some of the reasons that why the ANI Technologies has been downgraded. Indigo, in the last 1 week, company has cancelled more than 4,000 flights. Now, company has come out with a release saying that its capacity will be impacted both in Q3 of FY26 and Q4 FY26. So in Q3, it has cut the guidance. Now it expects capacity growth of high single to early double digit versus earlier guidance of high teens. And as far as passenger unit revenue is concerned, it sees moderating by mid-single digit versus earlier target of flattish to slight growth. Also, remember, today, Indigo CEO will be meeting DGCA at 3 p.m. Last night, Scott's Kubota, it has announced some of the launches. It has launched BS5 compliant construction equipment range at XCon 2025. So first launches in earth-moving category introduced Kubota U226 mini excavator. Then second is Hydra 115 mining, a prototype stage variant designed for mining and quarrying conditions. And last one is Hydra 72, introduced as a concept stage pick and carry crane for higher height lifting applications. So I'm going with green for Scott's and red for Indigo and Ola Electric.
So that Indigo guidance is only for the third quarter?
Only for Q3 FY26, but they have said that in Q4 also capacity would be impacted.
Okay, all right. Thanks very much for that. More on Indigo coming up a little later. Ria is now joining us with more stocks with Newsflow. Ria, morning.
Well, good morning. Let's start off with Lind India first. SAT has upheld SEBI's directions on the company's material-related party deals. They have dismissed the company's appeal challenging SEBI's action on related party transactions. And SAT has also said that the company's interpretation of testing RPT was contrary to SEBI's provisions. Moving on to Prestige Estates, which will be in focus after 2 arms of the company, namely Prestige Falcon Realty as well as Prestige Projects, have invested roughly rupees 939 crores in Nagar Buildcon for a 67% stake. The last stock that we're looking at today is Cipla. They have launched Eli Lilly's drug called Yearpeak in India. This drug is used for the treatment of obesity as well as type 2 diabetes. Now, it's important to note that this drug launch has come right after the Delhi High Court yesterday restricted Sun Pharma from selling its semaglutide-based weight loss drugs in India until Novo Nordisk's secondary patent expires in March of 2026.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are TCS, Tata Steel, Lloyds Metal, Escorts Kubota, Linde India, Prestige Estates, Cipla and Swiggy. And stocks with negative news flow are Ola Electric and Interglobe Aviation. Moving on now to what's happening in the world of commodities. Manisha is now joining in. Manisha, how worried is the street about the developments in Venezuela, the tanker which has been seized off the coast?
Well, quite, because when you look at the prices, you can see a reaction onto that one. We've seen gains in the overnight market therein. And it's not just about the tanker in Venezuela. The street is also reacting to the fact that the Ukraine continues to strike shadow fleet tankers tied to Russian oil trade. The U.S. crude inventory is declining by 1.8 million barrels over the week, also have been supportive. So everywhere that you look, whether it's decline in U.S. inventories or the geopolitical tensions, including Venezuela, Ukraine, Russia, there is support coming into the market. Having said that, there also is higher output from OPEC Plus and its allies, and that is what is keeping the markets in check right now. But the major gains clearly continue in case of the precious metal prices. The gold price has gained up by a percentage point in the overnight markets, but it is silver which is making record highs every single day for the last 7 trading sessions right now. So $62.50 an ounce is done now, and with that we are now trading nearly 117% on the higher side. The Indian markets today might open at 2 lakh rupees a kg as well. Well, ETF inflows, the US cutting rates on an expected 25 basis points has been supportive for the other metals as well, where copper and aluminum in the trade today also are trading on the higher side in Asia.
All right, Manisha, thank you very much for that. So that's commodities with in focus, and the big one, of course, is oil. We take a break. Deepan Mehta, we'll talk some stocks with him on the other side. Stay tuned.
Years of CNBC TV 18.
2 hours of staring at clouds. 2 hours of staring, yes. But binge watching your favorites on this window? Bro. I love this window. That's Air India now.
आपके कलीग्स भी आपका परिवार है। इनकी सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैब ग्रीन वायर्स। इनके सुपीरियर इंसुलेशन इमरजेंसी में दे कम धुआं। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
As a decision maker, you just don't need headlines. You need what they mean for your capital, for your plan.
Your next big move. You don't need opinions. You need perspective.
And context. And that is what CNBC TV 18 Prime aims to give you. Analysis, strategy, and context which is built for India for boardrooms and bold moves.
Built for those who lead, who don't just follow the story, they define it.
Tune in to CNBC TV 18 Prime. Global business news for the global Indian.
We are everyone, but we're not just anyone.
I've made my choice today.
We choose progress over pressure. We say no to shortcuts and yes to the strength of discipline, to the pride of planning, to the thrill of watching our future take shape little by little. We are citizens, and you can be one too. Sip karo, citizen bano. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
26 years of CNBC TV 18.
Welcome back. You're tuned in to Bazaar Morning Call and hope you're having a good morning. Well, let's focus on Indigo. because that's been in the news and it continues to be in the news. In fact, the chairman spoke for the first time after the entire fiasco broke out. He claimed that claims that Indigo engineered the crisis are actually incorrect. Let's listen in to what he had to say.
There are some allegations that are untrue, that Indigo engineered the crisis, that we tried to influence government rules, that we compromised safety, that the board was not involved. These claims are incorrect. Indigo has followed the pilot fatigue rules as they came into effect. We operated under the new rules throughout, both in July and in November. We did not attempt to bypass them, nor did we do anything that negatively impacted our unblemished track record of safety.
Okay, all right. Well, let's welcome Deepan Mehta, Director, Alexa Equities, who joins us on the show. Morning, Deepan. Good to see you in as always. What do you do with a company like Interglobe Aviation? Gradually, at least from a customer perspective, things are actually improving on ground. Number of flights that are taking off at least. But as a shareholder, what would you do? Or someone who wants to be a shareholder, do you think it's come to those levels that you want to get in? Or are you expecting this to get far more prolonged?
Najal, good morning and thank you for having me on your show. We are shareholders of Indigo as a measure of disclosure, so we feel the pain of the stock price correcting and also sympathize with all the passengers who have been disrupted by this particular event. But look, end of the day, emotions aside, this is the largest aviation company in the fastest aviation market in the world. It's got a fabulous capacity expansion plan. 30% revenues now come from international flights, which, by the way, are not affected at all by the DGCA order. That ratio is expected to go to 40% in a couple of years or so. And end of the day, after this event is over and done with, they will still have quite a strong market share and adequate pricing power. All input costs remain pretty much stable. So I'm very positive on Interglobe Aviation. As I said, we are shareholders. And if I may just add that in FY24, this company made a net profit of 8168 crores. And I expect that in a kind of a steady state position, it can generate profits of 11,000 crores. And at 1,85,000 market cap, the stock is now trading at about 18 times what I think is its profit potential, which I think is extremely attractive for a business of this type and this size, as also the fact that it is the best play on travel and tourism within India, which is on a secular growth momentum.
Is the cut in revenue guidance shared by the company in line with the estimates that you had? You would be looking at the numbers very closely since you own it. Is it in line?
See, Rima, I don't track the numbers on a quarterly or even annual basis. I just see the profit potential. And I think that I don't know when they will make 11,000 crores profit, but if they made 8168 crores profit in FY24 and thereafter they made considerable progress in terms of new routes, in terms of international expansion and capacity addition, is just a back of the envelope calculation that they can do 11,000 crores. And I'm also would like to add that the next 2 quarters will be brutal. I think December quarter will be bad because of these disruptions as well as rupee depreciation. For every 1 rupee drop in the rupee against the dollar, they lose about 900 crores or so. So next 2 quarters will be extremely challenging, and this stock is not for the weak-hearted. It can go down further even from these levels. It's always been a volatile stock, but look at the bigger picture. If you have a 3 to 5 year type of a view, the returns can be pretty decent as they have been until this particular event took place.
Okay, all right, let's see if this one finally starts to stabilize a little bit. Deepan, morning. It was Keynes earlier, PG Electroplast, there were a few others which sold off, and yesterday was Dixon, which was down about 5.5%. Just your thoughts on Dixon or the space in general?
See, I think that Keynes, I'm not tracking it that closely, and I need to understand what exactly is the issue. Because we don't own shares of Keynes, so don't track it as closely. But I think that it will sooner or later come into a sweet spot. And in terms of corporate governance, disclosures, and other challenges which kind of result in a crash in the stock price. But in my experience, if the basic underlying business momentum is good, and the management comes out clean and makes adequate changes going forward, then pretty much we see recovery of lost ground, and that may play out in Keynes Tech as well. As regards the other EMS players, be it PG Electroplast or Amber or Dixon, I think it's just a spotlight has come on the valuation of these companies. No doubt growth rates have been good, but investors feel that they are perhaps overpaying for this particular businesses. And that's what we are seeing over here. But I remain invested in Dixon is one of our largest holdings as a measure of disclosure. And we remain pretty confident that at least the company's returns will be in line with the growth of the profits. So very positive on the sector. And it's good that from a long-term investment perspective, the P multiples have compressed. At some point of time, they will attract a lot of value investors, or at least investors are looking for growth on a serious basis.
You've been invested for a long time, or you've come in after this correction from 18,000 levels?
Dixon has been like 3-4 years. So.
Okay, so you've seen the...
See, what happens, Prashant, is that what happens, let me tell you, as an investor, if your purchase price is really low, then these 15-20% fluctuation or drop doesn't really affect you because your cost of acquisition is low, and it's easier to manage such corrections. But if you're looking at an actual loss when you bought the stock by 18-20% or so, then that can get quite unnerving.
No, absolutely, and of course, I mean, it's for recent entrants, it's a pretty sharp loss, right? Almost 19,000 rupees, and it's the 12,000 handle now. In that sense, we'll take a quick commercial break here. We'll come back in just a bit from now. Get you an interesting conversation with Manish Tiwari of Nestle India coming up. Stay tuned.
"26 years of CNBC TV 18.
अपनी लाडली की सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैप ग्रीन वायर्स। इसमें है 99.97% हाई कंडक्टिव प्योर कॉपर। ये साधारण वायर्स के मुकाबले जल्दी गर्म नहीं होते। पॉलीकैप ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
आराम से हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची? नमस्ते
जी।
हाँ, मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है? टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
As a decision maker, you just don't need headlines. You need what they mean for your capital, for your plan.
Your next big move. You don't need opinions. You need perspective.
And context. And that is what CNBC TV 18 Prime aims to give you. Analysis, strategy, and context which is built for India, for boardrooms and bold moves.
Built for those who lead, who don't just follow the story, they define it.
Tune in to CNBC TV 18 Prime. Global business news for the global Indian.
26 years of CNBC TV 18.
Welcome back. Let's get you an important corporate voice, not a voice that you hear often, and that's from Nestle India chairperson. In a conversation with Mangalam, he went on to say that the company will continue to target margins in the range of 22 to 24%. This is the word coming in from Manish Tiwari, Nestle's chairman and managing director. He's the new one who's taken charge. Listen in to a slice of that conversation as he outlines his vision for growth and more.
Nestle hit the 10,000 crore revenue mark in 2017, 20,000 crore mark in 2024. So it was about 8 years in which it doubled. Do you think the next 20,000 crores doubles in less than 8 years?
I would hope to.
You would hope to. 30,000 crores by 2030 possible on the top line?
It depends if the market momentum maintains. I think right now, like I said, 26 looks like a promising year. All the vectors are aligned. But it all depends on how well he executes. So comes back to that.
And all of them between this 22 to 24 sort of margin band that you've been at?
Maintaining the margin band? Yeah, I think, business has to be played with a net. You can't grow and say, I won't do the bottom line. I believe we have the tools to grow without sacrificing margin at this point of time.
You've typically done about 4.5 to 5% of sales. As a proportion of sales, will the ad spends increase?
Yes.
To what?
The intention is to move it up slowly. Again, it's ad spends is like cholesterol. They can be good and bad.
Yeah.
It's important to be very thoughtful and deliberate. But directionally, would we be increasing our ad spends faster than our top line growth? Yeah.
And that won't come at the cost of margins?
Hopefully not. The idea is to use technology to drive optimization in all parts of the organization.
What's the one category that you haven't yet scratched the surface of, but you want to lead in?
I think all this, we are very early in most of our categories, but if I picked it up, I think pet food be the one which I'm very, very interested. We have a business, but it's early days. My ambition for the business is much, much beyond where it is today.
Could you put a number to that ambition? Because, everyone's eyeing that market. We had, after Purina went into Nestle's fold, before that, there were a lot of the startups that did extremely well, got funded, etc. as well. Thereafter, you had a couple of listed companies come in. Godrej has announced its foray. Reliance also has announced its foray. So how big is the opportunity and how big would Nestle want to be in that?
No, I wouldn't go by size, but I would want to create the same trust we have with parents, with the pet parents also. I've been brought up on Cerelac. My kid has been brought up on Cerelac. That's the trust. That's the science which goes behind the products. We would want to do the same for our pet parents.
And you believe that the trust in Cerelac still stays?
No, absolutely.
Despite all the news around it containing sugar and all of that and stuff?
Absolutely.
That's showing in the numbers.
Yeah, see, I'm saying, that's why I keep on saying, we have to be very careful with the narrative and what we digest. There's so much of information flowing around. The first thing is, does it meet the law of the land? Yeah. The second is, today we have a zero added sucrose variant also. We give the consumers a choice, but does it have the trust? Yeah, absolutely.
When we look at Nestle at, say, 30,000 crores revenue or 40,000 crores revenue, what would the composition of that revenue be, according to you?
And let me call our more established businesses and our econs, the new businesses, because sometimes confectionery will go faster, coffee will grow faster. I would probably say that our newer businesses, which is Nestle Professional, pet food, the DRL, JV, Nespresso, these would go at 2 to 3 times of our main portfolio. Yeah, and therefore I see that's a kind of growth pattern I am seeing. Yeah, but what we have to keep in mind is none of our products have a monthly penetration like say a laundry of 98%.
Yeah.
Our highest monthly penetration would be 16-17%. So you get the headroom for growth.
You have a target on penetration by 2030?
I don't want to put a number onto it because but that's the focus for the entire group and for Nestle.
FMCG industry on the whole does about 35% revenue coming in from rural and 60% volumes coming in.
Yeah.
You're half of that. Would you reach the industry average in the next 5 years? Would that be your target?
A percentage is always misleading. But yes, we have to grow at maybe 1.5 times the normal rate in rural. And that's how I want to drive it.
A brand from Nestle Global's portfolio which hasn't come to India right now, or a category that hasn't come to India right now, which you are extremely excited about bringing to India, which you believe the market is ready for?
Well, there are a lot of innovations happening right now. I mean...
globally, Nestle is into what? Yeah. Packaged drinking water, ice cream, so many other categories, right?
Yeah, I think, no, we're not looking at those categories right now. I think I am still looking at how to get more out of my current brands. So I think the products, I think that's the advantage of Nestle, the innovation happening on the products, be it Kit Kat, be it noodles. I think there's a lot to absorb, yeah? And that's where the focus is. If a new brand opportunity comes up, I mean, we did that for pet food, we would look at it, but bigger, bolder, fewer will be the mantra.
So if one had to make, in tech terms, a word cloud of all the attributes that you bring, which would be the three boldest ones?
I think it would be, for me, the biggest thing is consumer. I always, if I speak to you or anyone else, and if the word consumer does not come up in 4-5 lines, I start getting worried. I think the second is this entire thing of how do we leverage technology to make our jobs more efficient, more easier, so that I believe all of us are trained to take very high-level value judgment, not to do the daily busy work. That can be done by machines. And the third is a little bit of bias for action, which is the fast, focused, flexible thought.
Okay, well, that is the Nestle management in conversation with my colleague Mangalam, and the full conversation and parts of it will play through the course of the day and later on as well. Now, the big movers from yesterday, which saw heavy volume action and just stood out in that sense. I'm assuming Dixon will find a mention there among others. Mangalam, Hormuz, take it away.
Morning, Prashant. And Dixon does find a mention where you talk about the listings of the day first. And Meesho made a very stellar debut yesterday, ended almost 54% higher at a time when the broader markets were selling off left, right and center. Shares with almost 7,000 crores were traded on its listing day. That was the kind of trading activity seen on Meesho yesterday. Aqueous also had a fairly decent debut, ending almost 21% higher. Shares worth almost 1,700 crores that were traded yesterday. And Vidya Wires, a quiet debut compared to the other two. Even that saw trading activity worth almost 550 crore. Now, you mentioned Dixon Technologies. The stock had its biggest single day fall since January. The stock fell almost 10% yesterday, in line with almost the sell-off that was seen in Keynes. The stock has declined in 9 out of the last 10 sessions. Yesterday's volumes were the highest in 6 months. Close to 10 lakh shares were traded. The 20-day average is 2.5 lakh shares. You would usually notice that on stocks that have very significant trading activity, the delivery volumes are lower. Not quite in this case. Almost 50% of those were marked for delivery. Almost 4.25 lakh shares marked for delivery. The 20-day average is only a lakh. The stock down 17% in the last 1 month, down 31% so far this year. And Balrampur Chini, sugar stocks had a fairly good day yesterday, gains across the board. And Balrampur Chini gained almost 7% yesterday, the biggest single day gain since March. The stock has been a bit of an underperformer, gaining only thrice in the last 10 sessions. Wednesday's volume is the highest in 3 months. Almost 45 lakh shares traded, 20-day average close to 3 lakh. But the delivery volumes yesterday were significantly lower compared to when the stock had declined on Tuesday. Only 3.5 lakh shares out of those 44 lakh shares were marked for delivery. The 20-day average of 1.5 lakh, and the stock has corrected almost 30% from its 52-week high levels of close to 650.
Thank you very much for that. Get into a break. On the other side, pre-opening rates, and we'll also be joined by Jignanshu Gore of Bernstein to talk about the strong demand seen for Swiggy's 10,000 crore QIP, and we'll talk about the quick commerce space and where it's headed. We'll also get in a few technical trades with our experts Sudarshan Sukhani and Mitesh Thakkar. Stay tuned.
"26 years of CNBC TV 18.
Rohit, we need to talk, okay?
Yes, sir. That's Air India now.
हमने 2.5 में सोचा था ये।
संजीव,
हाँ?
ये वाला घर पिक करना
एक मास्टर स्ट्रोक है।
ये घर बजट से ज्यादा है। कौन देगा हमें बढ़िया होम लोन?
सचिन।
सचिन क्यों देगा होम लोन?
सचिन।
अरे मैं नहीं, सचिन। बैंक ऑफ बड़ौदा देगा तुम्हें बढ़िया होम लोन और बेहतर इंटरेस्ट रेट भी मिलेगा। बैंक ऑफ बड़ौदा से होम लोन लेना भी एक मास्टर स्ट्रोक है।
As a decision maker, you just don't need headlines. You need what they mean for your capital, for your plan.
Your next big move. You don't need opinions. You need perspective.
And context. And that is what CNBC TV 18 Prime aims to give you. Analysis, strategy, and context which is built for India for boardrooms and bold moves.
Built for those who lead, who don't just follow the story, they define it.
Tune in to CNBC TV 18 Prime. Global business news for the global Indian.
This is Network 18, and you're watching CNBC TV 18 Prime. 26 years of CNBC TV 18.
Welcome back. As you can see to the bottom of your screen, where we're counting down and we'll get the firmer rates in terms of how we're likely to open up. But for the time being, let's welcome our technical experts. We have Sudarshan Sukhani as well as Mitesh Thakkar who join us on the show. Good morning, gentlemen. Well, the problem the last few days is we're making lower lows and the structure itself seems to be a little bit punctured. But Mitesh, you go first. What would your trade be? The problem is the GIFT 50 is suggesting a gap up. I'm not sure whether we'll get that because most Asian markets are in the red. And the last time I checked, the Nasdaq futures as well were indicating a 300-point downtick. So what's the trade?
I think Oracle is the reason behind the Nasdaq futures decline, but also is the fact that, Nigel, what you said is very important. The structure is weakened in the sense that most of the indicators on the daily charts have now started turning down, which means that the market, even if it doesn't go into a big decline, will go into a slightly stronger correction. So first, I think on the upside, as long as we don't capture 25,900, 950 again, I think, I would not take a bullish or an aggressive long stance. Though on stock side, you can still be trading on the long side. And a failure to get past 25,950 could suggest a deeper pullback, which we saw in the month of November as well, which means a test of 25,500 to about 25,400 could be on the cards. And if we break below that, then we'll look at further declines. But yes, I think, the overall bias could be slightly choppy and mildly biased on the negative side over the next couple of weeks.
Sudarshan, morning. When we spoke yesterday, you were also bearish on the market. What's the call for today?
Yeah, good morning. See, the Nifty is now giving signs of going through a small, steady decline. So if nothing else happens, if there is no special news, I think we'll slowly drift down to the same levels that Mitesh talked about, 25,500. But this is a very news-prone environment, so it's not as if this is a certainty. That's the way I'm looking at the markets. It's a sell-on rally markets. It changes its structure once it shows an affirmation of strength. That would be roughly, if it closes above 25,950, then the sell on rally trade stops. Till then, this is the trade I have. If you look for a rally, if you see the rally weakening, go in short.
Go in short. So basically sell any moves, up moves which appear. Gentlemen, morning. Good to have both of you. Sudarshan, in terms of specific names, what would you recommend?
Well, I have two long and two shorts. HDFC Life is a buying opportunity with a stop under 760. SRF is a buy with a stop under 2885. The intraday shorts are DLF, sell with a stop above 696, and KPI Tech, sell with a stop above 1225.
Okay, all right. Got that, Mitesh? What about you?
Yeah, I have 3 buys today. With a lot of stocks are looking promising, and Hindustan Zinc was a call yesterday as well. Even now can be bought afresh with a stop at about 503, half 504 for a target of 530. Some sort of a breakout took place on the charts of ICICI Prudential Life. It finally managed to get past that 633, 635 zones. So buy here with a stop at 632. Look for targets in the range of about 664 to about 670. Also a buy on Alchem, which has come down to an important support level. In the last 1 month, it's bounced back from these levels, which is around 55.70, about 4 or 5 times. So buy with a stop below 55.67 for a bounce back to about levels of 56.60. And one sell call, that's Bharti Airtel. If it breaks the support levels of 20.60, 26.57, which is about 10 points lower from here, then go short with a stop at 2076 for a target of around 2010.
Okay. ICICI Pru was a long, right, Mitesh?
That's right.
Yeah. ICICI Pru, I mean, the life insurance numbers for the monthly data came out, and numbers from ICICI Pru were the strongest, as I recall Yash telling us. And of course, I mean, there'll be many situations like this, stuff where fundamentals dictate price moves, but the overall market is depressed, so you don't see those reactions. And sometimes, things look a little better and stocks start to react to that kind of information. So keep an eye out on this one as we go forward. Mitesh and Sudarshan, we'll talk again. Thanks very much for joining us with those specific trading calls. Well, we have a focus on quick commerce coming up now. Swiggy's 10,000 crore rupee QIP has been subscribed 4.5 times. Well, let's talk about this. And of course, the debut for Meesho as well. Jignanshu Gore is Director and Senior Research Analyst at Bernstein. Jignanshu, good morning. Good to have you here. Prashant this side. Good demand for Swiggy's fundraise. And now everybody is sitting on pretty much like a war chest. The question is, should we call it a war chest or just a chest? Because will they be spending to... Swiggy, for example, has lost a fair bit of market share. Will they try and get it back? So which means aggressive pricing, discounting, and so on and so forth as we head into 26.
Thank you for having me, Prashant. Always a pleasure. I think it is a war chest. There is a war brewing, which is why Swiggy was very keen to do the QIP. There is a secondary objective as well, which is to try and raise the money from domestic funds and become an Indian-owned and controlled company. However, the primary objective is to ensure that you can go toe-to-toe with Blinkit, who is already sitting on close to 18,000 crores of cash, whereas you had around 7,000 after the stake sale in Rapido. So between the two of them, now you have 35,000 crores of cash, bonanza for customers, but largely in terms of discounts. I feel that effort will continue. And growth still remains the primary driver for quick commerce at least. So that's the primary objective for Swiggy and Blinkit. On market share, yes, they have lost market share. They will attempt to add more stores and gain it back.
Got that. Jignanshu, just a couple of days back, Albinder Dhinsa warned that India's quick commerce bubble could be close to bursting as the capital-intensive model's relentless fundraising will hit some limits. And he also said that a correction, whether it takes months or weeks, could come swiftly. You want to comment on this?
See, we are, when we analyze the quick commerce market, we think the potential is huge. But of course, there is not space for 6 or 7 large players in the market. So there will have to be some consolidation or concentration of market share. Today, of course, Blinkit remains the leader, and it is up to them to set the narrative, whether the idea or the metrics for the growth of the industry should be growth or profitability. And I believe right now they are shifting the narrative back again to profitability. We have seen it seesawing over the last 3 years. So I think the year of 26 might be, you have a war chest, but show me you can be profitable.
So Eternal is a core holding, I think, for most investors. But you said, right, Swiggy is now armed with a lot of money, matching that of Zomato, and it will try and regain lost market share. So if you want to increase your exposure to the quick commerce space, what is the advice to investors? Who is best placed now? And Zepto too soon will be launching, coming out with its IPO.
Yes. So I think it's a very interesting situation today because Blinkit is by and far the leader in terms of size, in terms of unit volumes, in terms of profitability metrics, as well as the growth rate that they're showing. So that is a clear winner. In our view, we expect them to remain the winner in the quick commerce space and the leader in the space for the next 3 to 4 years. So if you want to back a winner, our advice to investors for longer term, it has always been that Eternal is the natural winner for quick commerce space. Where we think Swiggy QIP also helps is, given the pressure on cash and competition from Zepto, the valuation on an SOTP basis of Swiggy's quick commerce business we thought was undervalued, which is why we advised investors to play that upcycle for Swiggy.
Jignanshu, sorry, Najal, you have a question on quick commerce? Because I was changing track to Meesho.
Yeah. No.
Jignanshu, any thoughts? Meesho, the big listing.
Prashant, we don't cover Meesho formally. However, from a broader consumer lens, I believe we've always said that the objective of retail is to transport one item from one place to the other. And hence, building a low-cost logistics network gives you a good right to win. Some of the other stocks that we cover and we like them are precisely for that reason. So right market in our view, but tough to comment on the stock itself given we don't cover it.
Any others you've initiated coverage on? Lenskart, some of the recent listings, Lenskart, etc.?
Not yet, Prashant. Very soon.
Very soon. So in the works, writing as we speak. Okay, got that. So top pick remains Eternal across your coverage universe.
Yes, I think as of now, especially given the correction that Eternal has also seen.
But you'd imagine, because as you said, began by saying there's a war brewing, it's possible you get better prices into 26 to buy Eternal.
Yes, I think the competitive landscape today versus 12 months later will be very different. So there will be ups and downs. You might get a better price on Eternal depending on what happens with the rest of the competition.
Jignanshu, we'll leave the conversation here. We've got about 3 minutes left for markets to open for trade. Let's get in 9-10 calls from Sudarshan.
Yeah, it's HDFC Life. Buy HDFC Life with stop under 760.
Mitesh?
I'll go with a buy on ICICI Pru Life for a target for around 665.
Okay, all right. Thanks a lot for that, gentlemen. Well, I'm focusing on Tata Steel. They have announced a major capex plan, but we're waiting clarity with regard to timelines, debt, execution as well. The big announcement that came in was that NINL, they're looking to add 4.8 million tons of capacity. It's a 1 million ton capacity, so it'll go to around 5.8 million tons, predominantly longs. And they've told us in the past that it has the potential to go to 10 million tons. They're also looking at setting up a 2.5 million ton thin slab caster as well as rolling facility in Odisha. The total steel capacity as well, flat steel capacity goes up by 2.5 million tons. Besides that, in Maharashtra, they're looking at downstream capacity around 0.7 million tons or thereabouts. And fourth, they have signed very strategic partnerships with the Lloyds Metals Group. That includes, slurry pipelines, pelletization, steel making as well. The plan includes developing a greenfield 6 million ton plant in 2 phases. Separately, they've also acquired 50% stake in Triveni Pellets in Odisha for around 630 crores. Remember, Lloyds Metal holds the remainder of that. Now, this ensures supply of pellets and could save them roughly around 500 to around 1,000 rupees per ton. We'll have to get the data point coming in from Tata Steel, but that could be the rough number. The collaboration, well, it helps Tata Steel move into the Western market, which has been ruled by JSW Steel, and it also helps them in terms of their raw material sourcing as well. And finally, they're looking at a 1 million ton Hisarna-based facility in Jamshedpur. Remember, this is more green steel, where they look at using lower grade of iron ore. They eliminate coke usage, and they also use steel slag. So put all this together, these are the big announcements that come in there. Tata Steel, it addresses their growth, outlook from here on, and consolidates their market position as well. So net positive. Further details are awaited on the capex plans.
Okay, all right, Nigel. So 0.75% lower on Tata Steel. Maybe just quickly put up Indigo and where that is settled at the end of the pre-open session as well. We can sort of move on from there. It's down 3%, 46.50. So 150 rupee additional knock after yesterday's 3% cut. So it's got to hurt. Let's just start with how things will open. First rates anytime now. It's kind of flattish. The indication that is 30 points on the Nifty now, and about 58,980 on the Nifty Bank. We are starting the day higher, at least in the large cap frontline indices. Mid cap index is unchanged. The small cap index is red, but largely unchanged there as well. So it's about 2:1 out of the gates in terms of advances to decline ratio, but that will settle. Yesterday as well, it was about 2:1. But I mean, just the nature of names which were on the advancing side, with that 2:1 advance decline didn't provide too much confidence. 25,770 is where the Nifty is opening up at 2% lower, it's not 3.5%. So some buying coming through on Interglobes, 4,700 plus. We've got first look at the Nifty heat map. You've got Tata Steel, Infosys, Wipro on one end. Indigo, of course, right at the other end of the spectrum. Power Grid, Titan are some of the other names. Split right in the middle. And I think it's telling that the Nifty is about a 1 point change. So absolutely flat. Rima.
Indeed, teetering between the red and the green lines. So flat opening, not quite the 7,500 point gap up that the GIFT Nifty was suggesting. In fact, Asia is also weakened. If you pull up the benchmark Asian indices, they're all in the red now. Well, let's get to the big winners then. Sectorally, strength is seen in IT, Infosys, TCS, Wipro, all up between 0.5 to 1%. The rate cut by the Fed helps. And plus, TCS has gone ahead and made a large acquisition for 700 crore rupees, $700 million, pardon me, and that is helping boost sentiment there. Tata Steel is your top gainer. Nigel was telling us the news there. So Tata Steel is up nearly about 1%. Both Eternal and I think Swiggy are coming in for buying today. Swiggy, of course, is up over 1%, but Eternal too, which was under pressure yesterday, has rebounded a bit. So green for Eternal. Eicher Motors is higher in trade, Max Healthcare. A couple of these pharma names like Cipla, Dr. Reddy's are getting bid up. On the way down, Power Grid, Bharti Airtel, subdued, Titan under pressure, HDFC Live, weak in trade. A couple of banking names like Kotak Mahindra Bank in the red, and Interglobe Aviation is now below 47.50. And so the cut continues on Interglobe Aviation. But all in all, absolutely flat now for the Nifty and the Sensex. So the downward pressure continues.
Well, that's right, Rima. Struggling to find a few winners, but I found one. DCM Shriram, they have signed an MOU with Bayer Crop Science for collab in agri inputs and digital advisory. So explains why that stock is holding with a gain of close to around 3.5%. Smart's uptake is what we get. I'm sure that we'll try to get the management later on to understand further with regard to this. What else is doing well? Lloyd Metal, I think the start was in the green, but however, yesterday getting into the announcement itself, the stock was up, I think, 3.5%. So we should get that one up for you. Actually, in fact, it's come in for some mild profit taking on that particular county. Uptown, that's a stock I think that's getting smacked. There was a preference issue, I think that's been pushed back. They've withdrawn the proposed preference issue of around 1.5 crore shares. So that explains why that stock, in fact, is down close to around 5% or thereabouts. Besides that, I think the markets are trading with a bit of a negative bias. The headline index is flattish. The broader market's under pressure. Equus Limited, the one that listed yesterday, that's holding with a gain of around 3.5%. Hindustan Zinc in line with what we're seeing on silver prices. A melt up is what we're seeing. In the last 45 years, numerous times, silver went to $50 and then U-turned. This time, it's moved to around $62. So that's why the street likes it. And that's the only way you can play silver. And Vedanta is the one that holds stake in Hindustan Zinc. So that as well is trading in the green. Otherwise, a flattish start with a negative bias on the broader markets.
All right. Well, I think, first rates are settling down. Interglobe was showing a 3.5% cut, is down 1%. So, under 1% now. So just a 40 rupee cut now on Interglobe. Well, more coming up on individual names in terms of broader markets, etc. But Rana Gupta is now with us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. I don't know if you own Interglobe, but talk to us a little bit about how an institutional investor thinks about something like this. I mean, a situation like this. Dominant leader, and of course, I mean, a lot of the criticism is for the dominant market leadership. And of course, I mean, the fact that because of its dominant leadership, there was so much pain and suffering all around for customers and flyers. And there are some remedial measures. How would you take a look at the situation? Would you say this is a great chance to buy, or would you say, there will be now measures over a period of time, not immediately, to encourage more players and kind of, reduce the over-reliance on one player? What's your sense?
Good morning. I think what happened to Indigo, I think taking a step back, for investors is very important to understand the revenue and cost dynamics. If I look at this situation, what this airline in question has to do, has to either cut capacity or increase staff. Either way, either the revenue per seat kilometer will perhaps trend down, or cost per available seat kilometer might go up. As of now, because its events are still very fresh, one does not know the impact that it will have, revenue minus cost per seat kilometer. That multiplied by the seat kilometer is basically the profit of an airline. So right now, there is not too much of clarity. We know direction is trending down quite a bit. I mean, there are news reports out saying government has asked 10% route cut. There are news reports saying that the airline in question has to hire 10% more pilots. So one has to wait and see how this revenue and cost equation settles. Before that, I think taking a call on this is very difficult.
The way you rattled off all that formulae, it looks like you've done the numbers. Am I wrong, Rana?
No, we of course run the sensitivities, and we look at sensitivities, but these are sensitivities. These are in an Excel sheet. We need to see how the numbers play out when the dust settles.
Rana, hi, morning. This is Rima here. On quick commerce, in the past you've said that you see long-term opportunity here. But the landscape is shifting. Companies are building a war chest, and it's large. And if the attention next year shifts to growth over profitability, and profitability timelines get pushed forward, the focus is on market share grab, how will investors read this? Will this be share price negative? Is there a possibility that quick commerce companies like Swiggy, Eternal come under pressure next year, and that could be the buying opportunity?
So I think quick commerce companies have already come under quite a bit of pressure in the last 3 months. The stocks are down quite a bit, actually. And we continue to like them longer term. To our understanding, that the one company that raised capital, they have still continued to guide towards the break-even sometime middle of next year. Now, I think it is very important to understand that not to track just the discounts. In fact, our analysis, bottom-up study of all this quick commerce and the dark store suggests if the discounts are building long-term customer repeat orders, then it's might as well worth it, because slowly but surely, because the asset turn goes up, you can sell more and you acquire more consumers, it is beneficial for the longer term. So while this happens, the war chests build up, and there are some short-term and medium-term concerns and competition. We remain very optimistic on the long-term outlook of quick commerce. It's a market with huge addressable huge TAM, and there are 2 or 3 dominant players emerging. So as such, we remain quite bullish, and the correction that has happened in the stock prices reflects the concern that is out there. And I would say on the profitability, when the dust settles on the growth and market share grab, we remain convinced that profitability swing will be quite rapid. And if you just look at, let's say, some of these companies, they release detailed shareholder letters quarterly. If you just look at their stores that they has opened a year ago, their profitability, and then draw the similar kind of math that stores they're opening now even if they reach half of that kind of profitability 1 year down the line, the profitability math will become quite clear to everyone. Right now, there are concerns, I understand, but I think as the stores mature, profitability is going to improve.
So buy at this juncture?
Profitability improve, I think it will take another because because the one company has just raised money, and we hear that the third player is also coming to the markets. So I think you have to give it 2 to 3 quarters, but within that, I think profitability will be quite apparent, at least for the larger players.
Okay, all right. So you're sounding reasonably optimistic if you have a longer term horizon. Got that. Rana, good to see you in as always, Rana. What about the other big theme, EMS? You know, they were trading at very, very high valuations, but there was not too much concern because people said growth will be there. Now, suddenly the focus has shifted from solely depending on growth to what about the cash flows? Some of them are negative. Receivables as well had spiked up. After the correction that we have seen, do you think some of these EMS companies are coming to a level that you'll be interested, given the kind of growth outlook that we have out there? Your take?
Sure, no, that's a very important and relevant question. So we are always enticed by EMS growth, but at the same time, the cash flows are also very important to us. In fact, a company which is growing very aggressively with low margin and high working capital is something that should always be avoided. And I can share with all of you that if you just study the balance sheet of any company and see that the net worth is represented by mostly 70-80% by the capital raised from the investors, then I think you got to have better check the balance sheets well and understand the business well, which means the company's company's net worth is basically funded by investors, and the company's PAT is not really adding to that net worth per se, because everything is invested in your inventories and debtors and whatnot. So the cash flows have always been important to us. So therefore, I think the point is that because the growth is there and the companies which can manage their cash flows, for example, let's say there is one company who has a very strong business in something and reinvesting their cash flow to ramp up the EMS business, that is something we would be actually quite positive on. In fact, those stocks have fallen because in sympathy, and we believe that the longer term, with keeping the longer term in mind, these could be actually quite good opportunities. It can take some time for the doubts to gradually clear away, but I think two things should be remembered. Number one is the broad goal that electronics production from $120 billion in this year is going to grow 3 to 4x by 2030. And the leading companies, which has a strong balance sheet and good cash flows, is going to take a majority share of it. So that is something I think we should remember. And of course, 1 or 2 companies will mismanage their balance sheet. That does not define the EMS trend that we watch.
No, that's well put. And I think that's sound advice for viewers and investors out there, how to kind of sort of look at some of these companies. One of the basic ways to look at some of these companies. Yeah, Neogen, I'm just highlighting a bunch of names which were not in the mix in the morning at open, but 7% on Neogen, so 1,058 coming through here. There's Keynes is up 2%. It had a 10% flip-flop over the last 2 days. BSC lost about 4% yesterday. That is up about 2% right now. And so it goes. I mean, volumes are thin, very, very thin still. About 1,400 down, 1,100, actually 1,200 stocks are higher. So it's not very, very, it's not very disbalanced. It's kind of evenly matched at this stage. Some of these, we talked about quick commerce earlier, Rana, but, names like Meesho, which came to the market. And actually, on this one, what's your view?
So,
okay, here, let me preface, right? We spoke with a company and they said, well, focus on their number one metric is free cash flow. And they are saying that we will generate tons of it going forward. And that's how you should look at us. Go on.
No, I think that's, like I said, that the cash flow is always a very, very important metric. It's equally important for us to understand the cash flow is coming from where. Is it about the company's pricing power, or is it about efficiency operations, or it's a combination of all the factors? If you look at in the question, I think they have gone out to say to investors that they do not charge their consumers or sellers. So basically, if a company is not charging the consumer and the sellers, then the profit has to come from logistics. Now, logistics in this case is open sourced. Of course, they have done well so far. Now, the companies, I think the net market value that they reported should be about 30,000 crores odd, supposed to go at 20-25%. So this number in 3 years will be, if I just take that math, that probably 60,000 crores and then 1 lakh crores and whatnot. Now, the key question for us is that can an open sourced logistics support such high turnovers? Now, today we cannot say with clarity. Maybe we need to understand this a bit more better. But it is important to understand in this case, the logistics and the ad revenue, or rather the videos the influencer put, are the main source of revenues. They are not charging the consumer and the sellers. This kind of business model, which we call social commerce and all that, has existed in other countries, in China and also. So I think we will require some more time to understand that how it can scale up in India.
The content-led sales already hit, I think, on an annualized basis, 1,200 crores. So let's see whether that turns out. But the management said that at least on advertising, that is a lever because their ad revenue growth is less than what you have in other markets. So that's one lever that they would like to pull. Of course, the big one is logistics. Rana, thank you very much for joining us today. Great conversation. So many numbers you've shared with us and a way of thinking about valuations and analysis of companies. But let's turn our attention now to Poly Medicure. Now, this is a medical device manufacturer. So they basically produce disposable consumable medical devices like catheters, IV sets, syringes. The stock is down about 30% in 2025 so far. Himanshu Baid, Managing Director of the company, is now joining in. And we will focus on the guidance for FY26, the recent acquisitions and the inorganic growth plans, and finally, the domestic and export business. Thank you very much, Ms. Himanshu, for joining in. Now, last quarter, you lowered your FY26 revenue guidance. From 20%, you brought it down to 15 to 16% on account of export drag. Are you on track to achieve 15-16%? And what has been the Q3 performance on domestic and export so far?
See, if you look at the international markets, I think we have seen some headwinds in the international market, especially in Europe. And I think there were a couple of reasons. One, Chinese have been dumping, globally products everywhere. And I think that has, resulted in lower revenue. Plus, there was extra stocking. So I think that is more or less now, we have kind of, leveled up with that. So I think Q3, Q4 looks better. And I think when we issue a revised guidance, you look at the Q3, Q4 numbers. And if you look from H1 to H2, we are expecting growth of between H1 to H2 around 22 to 25%. So that's a big jump. And I think, and that's where we see the traction coming back in the international market, as well as domestic continues to, grow at a steady pace.
Okay, so you're saying H2 revenue growth over H1 will be 20-25%, and that puts you on track to achieve FY26 revenue guidance of 15 to 16%.
That's correct, absolutely.
Okay, and on exports, you're saying the worst is behind us? Exports grew only, I think, about 2-3% in H1.
It was actually flat. Actually, it was flat.
Flat, okay.
And, so domestic business grew around 18-19% overall, H1 in H1. But when we look at the export international revenue, it was almost flat.
Okay. And H2, how will exports look like? And is there any risk that export weakness, spills over into FY27? You're saying it's temporary and not structural.
No, I think we are now, negotiating a lot of new contracts. So I think, and of course, we are waiting for the US deal to happen sometime soon. But that's something which is also holding us back in the US market, because a lot of, our customers are waiting for that to happen. And I think hopefully, we are hearing that it will happen sooner than later. So hopefully next year, FY27, US will start, pushing up. Europe will also start pushing up. So I think exports should come back to normalcy, I think, in FY27.
Okay, so till the India-US trade deal is struck, can we assume that exports will remain subdued?
This is maybe a small part of that, but I think majority of our exports were to Europe. And I think Europe is kind of coming back. So I think for us, Europe is more important today. And I think we are more focused to develop more customers out there. And that's happening as we speak.
All right. Hi, Himanshu. Good morning. Always a pleasure talking to you. What about the rupee? The rupee weakness is good for you?
It is absolutely good for us, Nigel. I think that's a blessing in disguise for sure. And, and of course, we were lucky that whatever acquisitions we did before the major weaknesses happened in the currency. So I think that happened at a level where euro was around 100, 102, which is currently around 105. So I think both the acquisitions, have actually, been a kind of, a big change in how we look at the international business also, because we have added 2 new specialities in our current business, and I think that takes up a notch above a lot of other companies in a similar sector.
You made 2 acquisitions, right? And you were just saying that you're grateful that you did it before the sharp rupee depreciation. How much will they add in FY26 and how much in FY27? Will the entire 280 crore, which you had guided for, come through in FY27, or scale up, ramp up takes time?
No, I think currently with both the companies, we are seeing a revenue of around 300 crores in FY27. And in FY26, we'll see, because the acquisitions happened in September and November. So we will only see, few months revenue in both the acquisitions. So in FY26, we are seeing close to 100 crores. And then FY27 around close to 300 crores.
Got that. And you would still have a lot of cash, right? Even after these acquisitions, what is the cash balance? And are you open to another acquisition in FY27?
No, I think we are looking at adjacencies, whether we can add more products. Let's say in ortho space, can we, we are in trauma right now. So can we add some more products around that space? Or in cardiology, can we add more products? So I think that's what we are looking at. But maybe smaller adjacencies, not maybe, big ones. But definitely, so we still have a cash balance of around 750 crores plus in the company. So I think that way is pretty healthy cash flow and balance sheet today. So we look at maybe more opportunities, but maybe adjacent to what we have done so far.
What's the cash?
750 crores.
750 crore. And domestic is about 32% of your overall sales right now.
Yes.
And we had the GST cut. So I think even on medical devices, there was a cut in the GST rates.
Yeah, there was a cut in GST rate, so everything goes to 5%. But I think the bigger problem is the inverted duty structure. And I think that is where it is hurting the domestic manufacturing overall. Because of the inverted structure, our cash flow is getting stuck in GST. Whereas for importers, I think it's the other way around, because their cost has come down and they don't have any inverted structure basically. So I think we are also, present to the government that at least they should look at this more holistically and allow, the refund process much quicker, and also allow refunds on services, because that is also, the money is also getting stuck there.
You all made a plea to the central government to get some protection to come in there, because I think in the past, Himanshu, whenever you have joined us, you have said those Chinese imports are worrying. So what is the status of the plea that you all have made?
So I think, it's a clear case of anti-dumping. In China, the Chinese companies, especially in renal sector, which I've been tracking very closely, and you are also doing it very closely, Nigel. I think they are, dumping the products in India. We have seen even the sales price is lower than the import price. When we look at the import data and we look at the, we have shared the data with the government, and, the selling price and to centers is much lower than the import price in many cases. So I think there's a clear case of anti-dumping here. And also, when we look at the cost now gets reduced because the GST has gone down. So for them, the import cost has come down actually. So it's actually hurting the local manufacturing, because we pay 18% on all our imports, GST. On the IGST side, or when we buy material domestically, we pay 18% GST. So there's a huge, disparity right now.
So you said about the company planning to add products in cardio, ortho, bring in some adjacencies. So for calendar year 2026, what are the top 3 priorities for Poly Medicure?
So I think for us, the top 3 would be to expand the ortho business and the cardiology business in India. I think that's what we are trying to do, because we acquired companies outside. We're trying to bring those products to India, start manufacturing in India. some of those products in India. So these are top two priorities. And then the third one is on the oncology side. We want to add more products on the biopsy side. So I think that's what we are trying to do. And I think because we already have an oncology portfolio for drug delivery, so we are also working on that. So I think these are three core businesses, because 50% of the patients in hospitals are covering these three NCDs, whether it's cardiology, oncology, or let's say renal failure. So I think these are some of the three things, as a team, we are going to stick to that theme and develop more products around that.
Thank you very much, Mr. Beth, for joining in. Great chatting with you. That's the word coming in from Poly Medicure. But Prashant, we've got another guest joining in, Patrick Law.
Oh, no, absolutely. And, we're shifting gears from corporates to markets. Patrick Law is head of Asia Pacific, fixed income, currencies and commodities at Bank of America to decode what's happening in the fixed space, really, as far as India is concerned, into 26. Thanks very much, Patrick. Great to have you with us here on the program. Prashant this side. So it's been a bit of a, write-off kind of year for India. A few years of very strong performance right on the top of the leaderboard in terms of equities. And this year, not so much. Even with regards to currency, if you compare it to other emerging market currencies, I think we are at the top in terms of how much we've depreciated against the USD. The general chatter and sentiment as we head into 2026, but these are forecasts, is that, well, it shouldn't get much worse, and maybe it'll get more constructive. What's the dominant driver, Patrick, to your mind, for India as an asset class into 26?
Well, from the FX point of view, the generally market expects a few things. First of all, interest rate differential versus the US. Number two is the balance of payment. And of course, number three is around the potential trade deal with the US. Unfortunately, the current account situation in India has deteriorated somewhat, swinging from a small surplus into a small deficit. And secondly, in terms of the capital flows, we have seen, equity outflows in India. So unlike back in 2023, there was a pretty good inflows into India. Last year was pretty much nothing. So the question is, among a lot of observers and also clients around whether, equity flows will come back. I think there's a lot of uncertainty around it because, the trade deal is still up in the air on one hand. On the other hand, the market overall is very focused on AI. And when we look at India, India definitely doesn't have a very big connection with the AI. So I think from that angle, the equity flows, may face some challenge into the next year.
Okay. So you're saying, and what will a trade deal change all of this sentiment around? I mean, is that the kind of the lever which will have the maximum impact?
Well, I think the trade deal would definitely help with the sentiment because right now the swing has moved from generally bullish or cautiously bullish to a little bit more bearish, given all the factors that I've mentioned on interest rate differential and capital flows. In the end, even with a trade deal with improving sentiment, we really need to see material capital inflows coming back to India so that the currency can, reverse the current depreciation trend.
On interest rate differentials, Patrick, I mean, the general assumption here is that we are done with what we've seen in terms of the last rate cut in India. In the US, though, we've got, the President Trump, who's pushing for more rate cuts, is, potentially the front runner for the next Fed chair has said, well, there's a lot more room. Now we'll need to see how much it... But if they were to get their way and rates were to drop substantially into 26, that problem kind of becomes smaller, the rate differential problem?
I would agree with you. If the US continue to cut rates while India holds rates steady, it would help support the India rupee for sure.
But you don't see that as a I mean, you'd assign some probability to it, that kind of a scenario?
Well, I think, from the Fed's point of view, the FOMC's latest dot plot basically calls for one more rate cut in the new year. And when we look at market pricing, the market is expecting 2 rate cuts. I think these expectations are quite reasonable. I personally would expect, somewhere between 1 to 2 cuts. But of course, the swing factor is going to be the new incoming Fed chairman. So we still don't know who that person is going to be. If that person is going to be more aggressive, pushing for more rate cuts, of course, the scenario will change quite materially.
Okay. Just your forecast for the currency here, Patrick, the rupee, dollar rupee?
Well, I think, there's still a lot of uncertainty around, the future direction on FX, mainly because, everyone in Asia, not just India, is being held hostage by the overall general direction of the dollar. Obviously, like what we have discussed, if the Fed becomes more aggressive in cutting rates, the dollar sentiment would change, and it would help not just the India rupee, but also Asia FX in general. But then, in the end, the Fed, is kind of moving very slowly. Then, I think it would be a struggle for Asia currencies to appreciate.
Yeah, got that. Now, just last thing, Patrick, commodities, right? Where do you stand on? Let's just take precious metals, if you have a view, into 26, and then we can talk about some of the base commodities.
Well, I think, on commodities in general, there are, divergence for sure. If we look at oil price, there are many, many reasons, to suppress oil price going forward. But of course, on the precious metal, the story is completely different because the demand for gold and silver is not just based on industrial demand, but also based on demand for safety. So, I think we will continue to see some divergence across the commodity space into the new year.
So bullish gold and silver, not so much the basic commodities. But I mean, we are hitting highs there as well. Look at what's happening with copper, look at forecasts there, aluminum, for example.
I would agree. But like I said, if the demand on the some of the commodities are not purely based on industrial demand, but based on other demand as well, then, those commodities can continue to rally.
Patrick, leave us with like leave us with like a non-consensus view, if you have one, across your area of expertise. What you think will happen, which no one expects will, in 2026?
Well, I would say that the market has some expectation that the incoming Fed chair will try to push interest rate lower. And as a result, the dollar can resume a downtrend. So I would say the out of consensus call would be the incoming chair would find it very difficult to push the Fed as a whole to lower interest rates more aggressively. And as a result, the dollar actually doesn't go down. If anything, it can go up. So that would be a very out of consensus call.
Okay, that's interesting. Thanks very much, Patrick. We'll leave it there. Appreciate you joining us. Great chat, and look forward to speaking with you again in the new year. Well, I think we'll take a quick commercial break here. Markets are down, and I think there was a flash I saw saying that the Nifty is broken below Tuesday's low. Yesterday, we kind of sort of held that, didn't break it, but today we have. Up next, we focus on corporates once again. Cement and Focus, the management of Birla Corp, speaks with us about demand trends in the cement space into the new year. Aditya Sarogi of Birla Corp in just a bit.
"26 years of CNBC TV 18. This is Network 18, and you're watching CNBC TV 18 Prime. "26 years of CNBC TV 18.
Welcome back. Well, the markets are still down 20 points or thereabouts, but at least as of now, that 25,700 mark has got defended, just mildly so. And the good news is that the mid-cap index is actually in the green. That's up 0.3%, though the breadth of the market is still in favor of the declining stocks. But as promised, Birla Corp, that's the next management on the show. Remember, the stock is down more than 15% in 2025 so far. Jefferies remains constructive on the cement sector, but they highlight that in the near term, there could be some kind of disappointment. To discuss this, pricing trends post the GST cuts, we're joined by Mr. Aditya Sarogi, the CFO of Birla Corp. Hi, Mr. Sarogi. Good to have you on the show, sir. Just going to highlight three main points that we'll be looking at and touching upon: demand and pricing outlook, the guidance for FY26, and as well as what is the capacity addition plan for Birla Corp. Mr. Sarogi, let's address the first problem with regard to demand. How has demand been on ground in Q3 so far, post the Bihar election getting out of the way? And in the first half of the year, I think you grew by close to around 8%. What do you intend to end FY26 with in terms of a volume growth?
Yeah. Thank you, Nigel, for having me on the show. Good morning. The demand has been quite sluggish in October and November. Usually, we see that after the festivals of Dharka and Diwali, there is a pickup in demand, but that trend has been elusive so far in this quarter. But in the month of December, we are seeing some green shoots in some of the markets. And we expect the demand to start picking up in the next fortnight or so.
Mr. Sarogi, what would that mean in terms of ending the year with? Some on the street are saying the cement industry is just kicking the can down the road. Every year, you're hoping for a better next year. The GST cut as well came about, but still, demand is still not as strong as what is expected. For your company, what do you expect to grow? 5 to 8% was a broad range you've given us in the past. If you want to narrow down on that?
Nigel, the broad expectation was that the industry will go in mid-single digit. And we had said that our growth will be in line with the industry. In H1 also, we grew at 7%, which was in line with the industry. But my own sense is that at least in third quarter, the growth of the industry will be flattish to low single digit because of the subdued demand. And our growth might actually lag the industry slightly because we have consciously stayed away from non-trade segment where the prices continue to be quite depressed.
Okay.
So we are not chasing volumes at the cost of profitability.
So then you'll end the year with close to around 4-5% volume growth. Would that be a fair estimate?
It could be flattish to low single digits is what I can probably suggest at this point of time.
Okay, flattish to low single digit for the year in terms of a volume growth. So you're bracing?
In H2, not for the
H2. In H2. Yeah. So then for the year, it will still be close to around 5%. 4-5%.
Yeah.
Got it. All right. So second half of the year appears to be a bit of a challenge in terms of demand then. Tell us about pricing. Post the GST cut, I believe most manufacturers, they passed on most of the price hikes. What is your, what happened for Birla Corp in terms of pricing in the various states that you all do function?
So the pricing, again, because of subdued demand, the pricing has also been soft. So compared to last quarter, on a sequential basis, we find there's generally a drop of around 2% on the overall basis. And my sense is that should be the trend. 2 to 3% is a drop, I would sense, for the industry as a whole.
So pricing is down, demand is soft as well. Then what does it mean in terms of profitability? In the first half of the year, you did around 715 rupees of an EBITDA per ton. So for the second half of the year, what would it be and what is the suitable range?
See, Nigel, rather than guessing on the EBITDA pattern, I would say that the EBITDA in absolute terms, usually it is better in second half. This year also our expectation is that the strength should continue despite the softness in demand and pricing in the third quarter, because we expect reasonable pickup both in terms of volumes as well as realizations in the fourth quarter. So that should translate into a better profit for in terms of EBITDA for H2 compared to H1.
Going by what you're saying, sir, quarter 3 is likely to be a bit of a very weak quarter or a washout quarter, and you're optimistic about quarter 4. Would that be a fair assessment?
Weak because again the base effect was also low. So on a Y-on-Y basis, I mean in terms of profit could be range bound. But Q4 again we expect on a sequential basis we expect to be a decent pickup in profit.
Okay, all right. EBITDA per ton will be better in the second half of the year in comparison to the first half of the year because quarter 4 will help in terms of profitability. Got that. Wanted to ask you about the jute business, the smaller part of the business. And every time I've asked you, Mr. Sarogi, why not you sell that jute business? And you have said, no, it's looking up. And in fact, this year, the first half of the year has been pretty good. Revenues are 250 crores and EBIT is positive as well. Seeing similar trend going ahead, and for the year, what kind of a revenue number can you clock?
Actually, Nigel, in jute, the raw jute prices are hitting the roof. So that is actually, at least in the near term, that is clouding the prospect of that business. So as price gets passed through the consumers and the government has not proportionately increased the price of the bag. So in the near term, that business is in a bit of a fix. But structurally, we are taking a lot of measures which should help us increase the profit of that business going ahead.
So for the year, you think you can do around 500 crores of revenue from the jute business and continue to remain EBIT positive?
Revenue should be possible. Profit will depend on the raw jute prices.
Okay, all right. Let's wind this down then in terms of your capacity addition plans. You know, at times like these, some smaller players will be in bigger trouble than the larger players. And you have fairly good size right now. Would you look at inorganic growth? What is the targeted capacity addition plan? And the debt number, net debt, I think it was 2,400 crores. Where is that one headed?
So in terms of capacity addition, we have announced that our capacity is slated to go up to 27.6 million tons from the current level of 20 million tons by FY29. So we are maintaining that. In terms of inorganic growth, since we are already embarked on the organic expansion, as of now, we don't have any intent of any inorganic expansion. In terms of net debt number, we expect to definitely close below 3,000 crores by the end of this year.
Below 3,000 crores. But you're already, sir, at those levels. You're saying despite the capex, you'll still end below 3,000 crores. I think the last accounted number was around 2,500 crores.
Yeah, so this year we will end below 3,000 crores.
Got it. Appreciate you joining in, Mr. Sarogi. Hoping for better times in quarter 4, but it's, I think, pretty clear the writing is on the wall with regard to the feedback that I get as well. And you're echoing that quarter 3 actually is going to be a very, very weak quarter for cement demand. Thanks a lot for joining in. Let's remain optimistic about quarter 4. Well, when we're having the chat with Mr. Sarogi, actually, the markets have drifted a little bit lower, even the headline index, on the verge of breaking the 25,700 mark. So, you know, the sell on rise continues. Today, you had a bit of a positive start, and that gave the bears enough order to come in there and add some short positions. We have Siddharth who joins us back on the show. Hi, Sid. What are you making of this? Where does it stop? If you're looking at a support level, where does it come in at?
Hi, Nigel. Good morning, and thanks for having me on the show, first of all. See, Nigel, if we talk about Nifty, last couple of sessions, the structure has definitely changed quite a bit in the index because, especially since we came down below 26,000, Nifty, no attempt to recovery is sustaining. And Nifty is making lower highs consistently, and also the reaction to the Fed policy is not very impressive in the index. So the structure definitely looks weak as of now. One level which we have to look very closely right now is the 25,800. because as long as we are below 25,800, even today, the top was made around that level. So as long as we are below 25,800, the next levels which we can see on the index are come straight in the region of 25,600, 25,550. Once we are able to go back above 25,800, then we can definitely start looking for some signs of a turnaround. But as long as we are below 25,800, we should be avoiding any opportunities to go, to go contrarian on the index, because the index definitely looks weak for now.
But can you go short if the target is closer to 25,550? Can you go short? And what about your stock calls?
Yeah, sure, Rima. Hi. See, two stocks, I think it is much better to keep a balanced approach in a market like this. So one stock to buy and the other stock to sell. The first one which we have to buy is KFin Technologies. See, Rima, just around the very important support zone of this stock, that we are seeing a very strong turnaround in today's session. It is trading very independently from the move of market. The stock has made an open low. It started running just around the levels where it opened. So the momentum looks good. KFin Technologies can be bought right now. The spot is trading around 1053. We can buy it here. The stop loss will be at 1035, and our targets being the first target 1090, the second target being 1110. The second stock, and this one we have to sell because the stock looks weak right now, is Titan. See, there was an attempt to turn around in Titan just a couple of days ago, but it has not been able to sustain at those levels. Even the stock has come down below its important level of 3,800. So I do think that if the market goes down from here, this stock will be one of the most weak stocks going ahead. So Titan can be short. We can go short on this one. The December futures right now is trading around 3,795. We can sell this one. The stop loss will be at 3,830, and our targets being the first target 3,740 and the second target 3,720.
Thank you very much for that. Titan is the top Nifty loser, 1.5% lower. It's followed by Asian Paints, which perhaps is feeling the heat of the rise in crude prices. So Asian Paints is down 1%, Berger Paints down close to about 2.5%, and oil marketing companies too are reeling with cuts of about 1.5%. And TCS too, after opening in the green on the back of the acquisition, has drifted lower. So TCS has a modest loss right now. But DCM Shriram is doing actually quite well, up nearly 5%. Ria joins in to tell us the news and the analysis.
Well, yes, Reema, DCM Shriram is up over 5% in trade today after signing a strategic MOU with Bayer Crop Science to advance sustainable and future-ready agriculture. Now, in terms of the scope of the MOU, they are going to collaborate across areas such as agri-input, sustainable farm practices, as well as value chain strengthening. They're also going to explore synergies in crop solutions, seeds, specialty plant nutrition, as well as biologicals. Apart from this, both the companies will also assess opportunities to jointly support farmer organizations and strengthen sustainable agriculture initiatives as well. And apart from this, they are also going to evaluate possibilities for partnership across select areas of the chemicals business as well. Now, in terms of the revenue contribution from all of these segments in FY25, the agri business, which consists of Shriram Farm Solutions, Bioseeds, as well as fertilizers, these segments contributed roughly 28% to the overall top line for DCM Shriram in FY25.
Thank you very much for that. And there is strong investor appetite even for these quick commerce companies. So Eternal is going strong, and Swiggy, of course, that 10,000 crore IPO saw a demand of nearly 4.5 times. Get into a break. On the other side, Manisha Gupta will join in to talk more about commodities. Stay tuned.
"26 years of CNBC TV 18.
Fly Emirates, fly better.
आराम से हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची? नमस्ते
जी।
हाँ, मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हीलचेयर, ये आपका और ये आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है?
टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्चे में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान।
चलो चलो एआई से पूछते हैं। डू फिश गेट थर्स्टी?
If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
We are everyone, but we are not just anyone.
I've made my choice today.
We choose progress over pressure.
The endless sky. I'll sip
We say no to shortcuts and yes to the strength of discipline, to the pride of planning, to the thrill of watching our future take shape little by little. We are citizens, and you can be one too. Sip karo, citizen bano. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
26 years of CNBC TV 18.
Welcome back. There have been many big moves in commodities this year, but the one commodity which has stolen the spotlight is silver. Continues to smash records. Okay, before that, the chief economic advisor says most India-US trade issues have been sorted out. This perhaps is, remember the US trade delegate is in India for the last, was in India, so maybe, this would be a big positive because it's been a headwind for the Indian markets. One of the reasons why India has been such a stark underperformer has been on account of the fact that the India-US trade deal hasn't been sorted out, despite India being the first one to begin the negotiations at the start of 2025. We'll be surprised if no India-US trade deal is struck by March, a timeline being put out, and many of the thorny issues seem to have been sorted out. These are very positive statements coming through from the chief economic advisor, and these statements are made to Bloomberg. We'll try and get you more on that, but this is the big trigger, and it would be a good way to end the calendar year, and it brings in a lot of optimism as we look into 2026. But back to talking about commodities, Manisha was just saying silver, that smashes record, and it's doubled in 2025. Put it in context, what we've seen this year.
Oh, well, absolutely. You could easily say that 2025 in a lot of senses and levels belong to commodities, and we've seen very, very strong gains come in for many of these multi-year highs, all-time highs as well. But the reason I'm focusing on silver is because this continues to dole out even more higher highs every single day. So $62.5 an ounce has been taken now, and this is another all-time highs that we have seen happen in the Asian markets a few minutes ago. If you look at the prices overall, we are up by 7% on the week itself, and for this year, we are up by 116% in the international markets. For the Indian markets, that gains account to almost 125% because of the rupee depreciation as well. But I want to show you it by numbers on what we've really done when it comes to silver. So when you look at the overall annual price gain that we have seen into the commodity, this is the second highest ever that silver has given you in a year there. This is the highest also that silver has given you since 1979. In that year, gold and silver both gained quite strongly. Silver was up 360%. And this is the year that you've seen 116% of gains come in. So this is the highest highest since 1979, and these are the 5 years that silver has given you max returns in an year there. But I also want to tell you on how silver has done in the last 20 years as well. So when you look at 2005, silver was trading at 13,000. By 2010, it had more than doubled to 46,000. The next 5-8 years, silver, all it did was consolidate really, and then we did see 2020 come back with 68,000. 21 was at 62,000, and 2025 clearly has seen very, very strong gains come in. I also want to show you on what we've done in last 3 or 4 years, because when you look at that, last year we were trading at 87,000 rupees a kg. We are trading at 2 lakh right now. So the last 4 or 5 years, silver didn't really do much. It's been trading within that 30,000-40,000 rupees a kg of a range, but the last 1 year clearly seems to have changed a lot. That rally actually started in October 2023, and since then there has been no stopping. We haven't seen any big profit taking as well, and a lot of people who have been buying are not bringing that silver back into the market, still holding, believing that you could be looking at higher highs next year as well. This is what we've done in sense of global ETF inflows. November was 487 tons, and we've already done in the month of December 475 tons. So clearly the buying in ETFs also continues to be quite strong. But it is still lower than what we saw as an all-time high or a peak in 2021 when it crossed 1 billion ounces. Currently in 2025, we are holding around 830 million ounces. So heading there, and if you see those kind of gains come in, then clearly the prices could be going on the higher side as well. The major theme for silver clearly has been the deficit. So if you look at the current year, the estimated deficit is 125 million ounces. If you look at the cumulative, because the deficits have been continuing since 2021. So since then, when you look at the cumulative deficit, that stands at 800 million ounces. The other reasons for the silver to go up overnight clearly has been the US Fed rate cut on expected lines. The second clearly has been about China now putting restrictions in sense of exports going forward from 2026. So some Chinese buying can be expected in the next 10 to 15 days as well. It also is about decline in US dollar index, strong industrial demand, investment demand, all of that very supportive. The central bank, apart from gold, also have started buying silver, some of them, and that has been supportive. Also, silver being added into the US critical mineral list. The C232 of an event or a process is something that also keeping silver markets quite jittery there. And then it is about lease rates and borrowing rates for silver also trading very, very on the higher side. And then speculative inflows, very strong physical buying in the Asian markets, especially India as well, where on one day we saw 40,000 rupees per gram, per kg of a premium as well. So very strong physical buying on all dips is what is keeping silver on the higher side.
Thank you very much for that. Get into a break. On the other side, Lata joins in and starts the Outlook 2026 series. She speaks with Samiran Chakraborty of Citi on how growth, inflation and the rupee may pan out next year.
"26 years of CNBC TV 18.
You want to talk business? Meet me in the On-Board Lounge.
होम EMI 50,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है? पूरे सीलिंग का 20,000। आउटगोइंग है जा रही, आपकी क्या तैयारी?
मौसा जी, मेरी शादी का गिफ्ट।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIP के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWP के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
Thank you.
Enjoy your meal.
Neither the middle seat nor the meal is a sandwich. That's Air India now.
तेरा ये बिजनेस एक मास्टर स्ट्रोक है यार,
है ना? पर मुझे लोन कौन देगा यार?
ओ गॉड, सचिन
सचिन क्यों देगा मुझे लोन?
अरे मैं नहीं, बैंक ऑफ बड़ौदा देगा तुम्हें MSME लोन। बॉब डिजी उद्यम के साथ 100% डिजिटल प्रोसेस, अप्रूवल इन मिनट्स। बैंक ऑफ बड़ौदा से एमएसएमई लोन लेना भी एक मास्टर स्ट्रोक है।
अपने दिल के हिस्से की सेफ्टी से समझौता? नो चांस। इसलिए पॉलीकैब ग्रीन वायर्स, जो है लेड फ्री और इमरजेंसी में दे कम टॉक्सिक गैस। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
"26 years of CNBC TV 18.
Today we inaugurate our Outlook 2026 series, where we will ask top economists and market masters how they see the year ahead. The current year, 2025, was a Goldilocks one, with growth at nearly 8%, being far better than what the Reserve Bank or the budget or economists on the street estimated. Likewise, inflation, averaging almost 2%, was lower than any forecast that we got earlier in the year. Will the Goldilocks continue? And if it will, why is the rupee struggling? What is the call on the rupee next year? Another 3% depreciation from current levels? Well, let me kick off Outlook 2026 for all these questions with Chief Economist from Citibank, Citi India, Samiran Chakrabarti. Good morning, Samiran. Thank you very much indeed for joining us and kicking off the Outlook 2026 series. First up, this Goldilocks scenario, growth being 7% plus and inflation being 4% minus, less than 4%. Do you think this can be our good fortune in 26 as well?
Good morning, Lata. Thanks for having me. This particular two numbers that you have said about the 7% and 4% higher growth being higher than 7% and inflation being lower than 4%, both things can continue in 2026 as well. However, just incrementally, it looks to us that the next year's growth will be a tad weaker than the current year's growth, and next year's inflation would be slightly higher than this year's inflation. On growth, the main argument is that most of the stimulus, both from the fiscal and monetary side, has been done this year itself. So next year, with the space of stimulus coming off, even if the global headwinds recede a bit, it might be difficult to repeat the same performance as in 2025. On inflation, the primary argument is mean reversion of some of the inflation momentum, as well as the base effect kicking in next year. These two things would imply that we'll probably be inching up on inflation, but I don't see next year inflation being such a concern which will prompt any sort of policy tightening pressures.
Okay. But the Reserve Bank has started on the note of being higher and then lowering, which is what they did for a better part of this year. They started the FY26 number with 3.7, then came down to 3.1, then 2.6, and now standing at 2. It was a serious revision down, and they have begun that process for the next year. For April, May, June, their first forecast was 4.9. It came down to 4.5, and now they are at 3.9. So can we see that revision lower as well? At the moment, they are averaging a little below 4. If the trend continues, it should be way below 4, isn't it?
So if you decompose this forecast revision for the current year, we started off with 3.8 and we are now at 2%. So this 180 basis points of inflation forecast revision that we have done, about 100 basis point is because of vegetable prices, 40 basis point is because of non-vegetable other food prices, and 40 basis point is because of core inflation, which is primarily due to the GST cut. So it's not that the fundamental trend inflation forecast has gone very different through the course of the year. It has been these idiosyncratic factors which has caused this massive revision in inflation this year. And next year's we are seeing is partly this momentum just being passed on for the first couple of quarters. But I suspect that we might not be as lucky to get all stars aligning the way it aligned this year for next year's as well. We'll have to be very lucky for that. We have to have another year of such benign vegetable price inflation. We have to have another year of China deflation impacting us positively on the inflation side, and another year of maybe another rate of GST cut. Can all of this happen together to have inflation to be even lower than what we are projecting now? I think that probability is a much smaller one right now.
You kind of answered my next question, which is that are you seeing a structural fall in inflation? Are we not anymore even a 4% inflation country? We are probably a 3.5 or 3 to 3.5% economy.
That's a fair question to ask and debate and do more research on, because clearly now, almost 2.5 years, we have got extremely benign core inflation numbers, closer to 3% or so. So at least on the core inflation side, there's comfort that this is not just a 2025 phenomenon. It has been continuing for a while now. But clearly, we always see food prices creating sort of a volatility around this core inflation number. And we've been lucky that this year the food inflation has been significantly lower than core inflation, which has dragged down the overall headline inflation number. But even on core inflation, I think the question that we are all grappling with is that to what extent this is because of improved supply versus lack of demand.
Yeah, that's the point.
I think that's the debate that we'll have to settle as we move into next year. We're going to have a new CPI series, maybe that throws up a better set of quality of inflation numbers as well, which will give us some clarity on this very important question that how much of this decline in core inflation is supply side versus demand side.
Okay, no, for the GDP picture also we need the inflation numbers right, because while, we may have grown well this year, a large part of the extraordinary surprise in GDP has come because the deflator is low. So, that's why I was dwelling so much on the inflation number. Time permitting, I'll come back to GDP. Let me first get the rupee issue out of the way. The shock of this year, despite a strong GDP growth, has been the fall of the rupee. Do we repeat an average 3% fall next year?
So what has happened is that the current rupee level is very difficult to explain from the standard valuation matrix that we have tracked in the past, like the 40-country RER and all. So rupee is significantly undervalued on those metrics. Now, typically, the economists start of the year thinking of rupee depreciation vis-a-vis the inflation differential. This year, the rupee has not moved at all in line with the inflation differential because India's inflation was significantly lower than global inflation. So by that logic, rupee should have appreciated rather than depreciated. So this is a very peculiar year where rupee has followed more the BOP than the inflation differential. And this is an unprecedented thing that after 1991, for the first time, India is likely to witness 2 consecutive years of BOP deficit. And that has put pressure on rupee. So our view is that as we move into 2026, in the first quarter, the Jan-March quarter itself, there's a possibility that the BOP turns into surplus, partly because current accounts is seasonally stronger in that quarter, and partly because we expect some capital flows to also come back. Now, if that works out according to our expectations, then there's a possibility that the RBI can put some floor on this rupee depreciation, and we could see some even appreciation bias coming in at that point of time. If that holds up, then possibly next year, when we are again expecting BOP surplus, then the inflation differential comes back into play. And because rupee has depreciated much more than inflation differential in 2025, we could see even a catch up next year where rupee does not depreciate as much as other countries that year. So we are looking at a 9 to 12 month target of around 91 on the currency, knowing fully well that this is not to say that rupee will never breach 91. It's more to say that where a more stable equilibrium would be reached is around that level. This is now a much more volatile currency, so there is always this path could be a very choppy one too.
Yeah. You know, your Outlook 26 also includes the stock market guesses in your last part of the report, and you're guessing that the foreign investor is going to return, but I'll reserve that for your equity team. Let me get to bonds. You have a very interesting chart of, you know, how much of bond issuances you are expecting, state government and central government in the in FY27, and then you're comparing it to FY26 and pre-COVID. If you look at the level of pre-COVID bond issuance, it is about 10 lakh crore. And next year, you're saying that state and centre will issue over 30 lakh crore. I mean, is there not going to be, whether or whatever the Reserve Bank does to interest rates, it looks like there is going to be an upward pressure on the 10-year.
Yeah, so this is the sort of macro challenge for India, that while growth inflation balance, as we started off this discussion with, that it's a Goldilocks situation for India. The challenge is that the fiscal and the BOP, the two balances, they are more difficult going forward. We have been getting enough demand to sustain this supply in the last few years, with some help from the RBI OMO demand. But as we move forward, the redemption pressure is also increasing quite substantially. So the need for RBI to support this bond market will be even more, especially because we are now coming very close to the end of the rate cutting cycle. So obviously for different actors, their appetite to hold on to these bonds is, or buy new bonds, is going to be that much lesser as we come closer to this. So some widening of the term premium at the end of the rate cutting cycle is just but natural. The only question is that at what level of widening of that term premium RBI would think that the relatively easier monetary policy to support growth is getting challenged. And to that extent, they will have to do OMO to support this. Last year, we've also done almost a 6 trillion rupees of OMO. That's while we are comparing the 10 trillion supply with the 30 trillion supply, we have to also say that we have never seen a 6 trillion a year OMO from RBI. So that trend, I suspect, would have to continue if this bond market has to be supported.
Okay. Well, this year the RBI supported liquidity by buying dollars till their face was blue. Next year, probably they will buy government bonds, you know, in huge quantities, probably in unprecedented quantities, to keep the liquidity going. Out of time, Samiran, thank you very much for kicking off our Outlook 2026 series with the news that we may continue with our Goldilocks scenario. Higher than expected growth, lower than average inflation. Wrap up on this Outlook 2026 series. Time for a break and then Chartbusters.
"26 years of CNBC TV 18.
Okay, so this year the Reserve Bank bought tons and tons of dollars and provided liquidity. Next year they'll...
Faster Wi-Fi on the new Emirates A350.
Of a teeth. Enamel is like a shell. Did you know a lot of what we eat every day has acids that can damage your enamel? Erosion of enamel could lead to multiple dental problems. I recommend using Sensodyne Pronamel daily. With over 20 years of research, Pronamel is formulated to give you 2 times stronger enamel protection. Pronamel, it's pro-enamel.
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
This is Network 18, and you're watching CNBC TV 18 Prime.
52, and in the hard currency markets, the U.S. dollar index, it did fall right after that Fed decision, down about 0.5%. Fairly sizable move for the U.S. dollar index, now below 99, 98.67. So we're seeing a little bit of weakness the last couple of days in the U.S. dollar against a basket of global currencies. All right, there are all the numbers. Let's get to the news and the stories behind them and hit some big conversations happening today. And of course, we begin with what else? The Federal Reserve deciding to cut interest rates by 0.25%. And Federal Reserve Chair Jerome Powell saying that cut puts the Fed in a comfortable position as far as rates go. We've got coverage all hour long, but let's start with our own Steve Leisman and more on that rate decision.
The Federal Reserve reducing interest rates by an expected 0.25 point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Myron. To recap, the vote was 9 for cutting 0.25, quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet.
1.5% would be a big cut, but Myron kind of on his own. Jerome Powell only has a few more meetings left as chairman of the Fed before his term is up and he is replaced. No formal announcement has been made about who may be nominated to take that spot. The Federal Reserve meets again on January 28th, then March 18th, and April 29th, so mark your calendars. All right, let's get more now on that interest rate decision and what it may mean for you and your money. And on our show, Power Lunch, we hit that decision right as it happened and also had a great group of market experts to discuss that move. Here is part of that conversation.
If you look at a chart of the unemployment rate going back to the 1970s, it's only been this low 2 times over that period, Brian. So I'm wondering why this is suddenly not low, particularly that we've only seen what I would consider a normalization in the labor market. In particular, this hasn't been broad-based across all age groups. It's been really focused on young individuals in the United States. So is this really a labor market that's quickly deteriorating? It doesn't look much like that much-feared hockey-shaped movement to me. Meanwhile, inflation has been above target for 55 months. So if I was looking at the bulk of the data and I looked at that dot plot and I looked at the Fed's forecast today, I would be saying, oh, they must have decided to hold or hike in that type of environment. What I want to hear from Powell during this press conference is, how the heck did you convince this committee to end with a cut today?
David, did they convince it? We had 3 dissents.
Well, no, and it sounded like we could have had 6 dissents. 6 dissents.
They dissented on what they call the dot plots, which I hate that term. It's like the Fed's light bright, where they put in where they expect rates to be. 6 non-moves on that, 3 actual dissents. So 3 people, I'm sorry, I'm going to say this, 3 people chickened out. Well, they wouldn't go on the paper and say, I disagree.
Well, exactly. And you can see that from the language in some of the speeches that we saw after the last Fed meeting, which actually convinced markets they weren't going to cut today, because some of particularly the regional bank presidents are really hesitant to cut, at least in what they say. But then when it comes to it, they give the kid another cookie. And actually, it's a slightly bigger cookie than expected, because they got this extra liquidity for the short end. But I do think this is, more dovish short term, but still pretty hawkish long term, because if Steve's reading of this is right, they've upped their estimate of GDP growth next year by a lot. We've got all these income tax refunds that are going to kick in the first half of next year. That's going to push growth higher, regardless of what the jobs market is doing right now. And it sounds like there are very few members of the Federal Open Market Committee who want to do more than one rate cut next year. And if you're only going to do one rate cut in the year, when are you going to do it? Maybe you wait all the way until December. So we're going to have it's going to be interesting here with the Fed perhaps going on pause in the first half of next year.
All of that said, maybe we can put this on the screen. The tech ETF, we were talking about this yesterday on a 12-day win streak. Well, it's now in the green after this move up to possibly have a 13-day stretch that would be its longest in about 8 years. So that's meaningful. We also have silver and gold on the positive and on the rise. Jim Karen, I was just going to bring you in on this because it seems, and I think John Spallanzani's phrase captures this perfectly, that he calls it, says, the repo vigilantes won. Because the big headline for a lot of people, even those who are more bearish on bonds, is the Fed's back, they're buying, and they're doing so. Maybe it's just bills, but it's significant that this action is now coming a little bit more quickly than people thought. What does it tell you?
Hi, Kelly. Listen, I think that's a great way to frame this. On balance, this to me is a more dovish meeting. Now, yes, it is true. And I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut, right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting, right now here in December. The Fed is basically telling us that they want to have pro-cyclical policy, I mean, they want to support the growth cycle. They're going to stand at the ready to cut interest rates if the labor market deteriorates further. And at the same time, they're worried about liquidity. They want to add liquidity back to markets. Call that reserves, call it what you will. The point, though, is that we need to get over the year-end turn, right? So liquidity constraints might come in at the end of the year. And the Fed wants to avoid that type of a stress in the marketplace. So net, the fact that they're willing to start to inject this liquidity, worry about reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raised the bar for the next rate cut. So I think it's a bit ironic.
Well, also, Jim, back to you, because a lot of people are listening or watching at home going, all right, this is great. What do I do? Well, to Kelly's point, the NASDAQ ticked up, the XLK on pace for its 13th straight day of gains. That would, I think, tie for an all-time record, or at least going back the 8 years. Why did stocks move up if prospects for more rate cuts went down?
Yeah. So effectively, one of the big concerns that was in the marketplace was that the Fed would have very inflationary policy, that they would be dovish and that they would push these long end rates higher because whoever the next Fed chair is, could potentially cut rates a lot. What the Fed is telling us right now is that they're not willing to do that. So what that's doing is it's stabilizing the back end of the yield curve. It's allowing the equity markets now to say, oh, we don't maybe have to worry so much about this inflation impetus that might come out of a Fed that's too dovish. So again, ironic. And that is actually something that's very supportive for the equity markets if rates stay relatively stable and well contained.
Yeah. And Steve, you want to jump in here?
Yeah, I wanted to back up what Jim was saying about the dovishness of the balance sheet decision. We asked in our Fed survey, which we released yesterday, about the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure, I would also point out that when I'm looking at the immediate reaction of the market, it's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper that was used to print it or the digital space it's taking up on the web.
That's an excellent point. As always, Steve Leisman. Francis, the Fed has two mandates. I mean, people forget about that. We always talk about inflation because of what happened during COVID and prices spiked and inflation was 9%, blah, blah, blah. But they also have the jobs mandate, maximize employment. How do we read the jobs part of the picture vis-a-vis what the Fed may or may not do?
Yeah, I've been thinking a lot about this because I keep wondering to myself, how can you be cutting interest rates when inflation is this high and per our forecast going to be heading higher? In fact, it's really hard to see when that next cut is going to come through. I have to agree with David here. When is the window to do that? Because by February, we see that inflation side moving higher. And yet, Brian, this is not interest rate driven inflation. This is tariff level inflation. This is inflation that is coming from a labor market that is shrinking, immigration, retirements that are coming through. And part of me wonders if this Federal Reserve is saying our interest rate policy is far less relevant to the inflation side of the picture than it is to the job side.
Okay, let me follow up with that. Do we ignore, I hate to say this, do we ignore inflation? If exogenous factors, tariffs, whatever, are contributing, labor costs during COVID, whatever, if they're contributing to inflation and there's nothing the Fed can realistically do about it, should they cut rates anymore at all?
Well,
why not raise rates?
Here's the rub here. The problem is if they don't actually contain inflation, it can spiral out of control. So you start with tariff level inflation, you start with some wage pressures that sort of create a floor underneath. If you don't respond to it properly, if you're too easy, then that can start to spiral. But there's another elephant in the room here, which is that we have phenomenal amounts of fiscal spending. And how funny it is to me that we spend so much time attributing monetary policy to inflation, and we forget that expansionary fiscal policy is also very inflationary. So the forces on inflation are wide-ranging and shouldn't just go to the Federal Reserve policy. So it's not a surprise to me that their bias is towards the labor side of the mandate.
Now, we should note that borrowing costs, they have not come down here in America. Even with the Federal Reserve cutting rates, the bond market has basically kept our 10-year government debt around the same level for over a year. All right, up next, the boom in one big stock that made a lot of investors very happy today. How energy is powering shares of the company that was born from the creation of the light bulb.
Today's Forex Update is sponsored by Interactive Brokers. 160 markets, 36 countries, 28 currencies.
Fly Emirates, fly better.
आपके कलीग्स भी आपका परिवार है। इनकी सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैब ग्रीन वायर्स। इनके सुपीरियर इंसुलेशन इमरजेंसी में दे कम धुआं। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
Exquisite comfort. Bespoke hospitality. Culinary excellence. Big words, huh? Trust me. The experience here is far bigger. That's Air India now.
आराम से आराम से। हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी।
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हीलचेयर, ये आपका और ये हाँ। आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है?
टिफिन लाया।
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
वाह भाई बिट्टू, वीकडे पे कोडर, वीकेंड पे ट्रैवल इन्फ्लुएंसर, पैसे बनाने का मास्टर स्ट्रोक सीख लिया तुमने।
वैसे एक सेविंग्स अकाउंट ओपन करना है जो फुली लोडेड हो, पता नहीं कहाँ ओपन करूं। सचिन, ये कौन सा बैंक है?
अरे मैं बैंक नहीं हूँ, बढ़िया सेविंग्स अकाउंट के लिए बैंक ऑफ बड़ौदा का मास्टर स्ट्रोक लाइट सेविंग्स अकाउंट है ना, तुम्हारे लाइफस्टाइल के लिए परफेक्ट है, विद ग्रेट फीचर्स एंड बेनिफिट्स। बैंक ऑफ बड़ौदा में सेविंग्स अकाउंट ओपन करना भी एक मास्टर स्ट्रोक है।
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
Be $22 billion. So it'll be larger than the whole power segment's revenue. And of course, the services revenue and the razor blade model is where a lot of the margin is. Right. So we have a lot of margin expansion into the next decade.
Did you give an aspirational long-term margin number?
No. We went to 2028, right, framed up where our backlog is going to go, talked about that services growth, also talked about things like small modular reactor in the next decade, how that can play a role. First things first, let's deliver on this framework between now and 28, but we'll be talking about the 2030s soon enough.
But that's this small modular nuclear reactor has taken over the fancy of our market.
Yeah.
I did not get the sense that even though there are some companies who say that there's going to be business next year, that you feel that way. It's just too expensive. It's expensive power. They want it. The hyperscalers want it because they have their zero carbon goals, not because it's economic.
Well, it is going to be more expensive than unabated gas. That's certainly true. Yeah. That said, we're working really hard to build a nuclear industry in the U.S. This is an area that clearly is the administration's focus. We're working very closely with Secretary Wright and Secretary Lutnick. We do expect we'll build new nuclear in the U.S. One of our customers, TVA, just received a $400 million grant last week to advance their project in Clinch River. I would expect us to get approval for commissioning of our first project in the U.S. next year. So this is happening. Now, is it going to happen at the scale of new gas additions? No. Gas is going to be the lion's share of the incremental capacity because it's so well suited operating parameters for what the world needs right now, and we have very inexpensive gas in the U.S., and you want to apply technology where the resources are most economically competitive.
Yeah, but there are a huge number of orders that we're getting from put out by the hyperscalers. Do you really think all that's going to be built? Some of it's multi-phase, some of it may be an overestimation.
Yes, I do think all of it's going to get built. Certainly everything we see in our backlog, without question, we see it getting built. Wow. We are working very closely with them on site selection, on project development. We're making progress. Now, what we talk about all the time is this is a larger market for a longer period of time. This isn't about just the next 3 years. This is going to be a 15-year build because there are a lot of variables that go into it. Construction company, permits, fuel availability, our long lead equipment. But the demand is there. It's going to be a larger market for a longer period of time.
You're not worried that these companies are spending too much, they won't be able to get the money to you, that the check will bounce?
Well, when you think about the global economy, I mean, a $135 trillion economy, half of it's labor. If we think AI is going to help, let's just say, drive 10% labor productivity in the end, $7 trillion annualized productivity, the hundreds of billions of dollars of CapEx we're talking about is going to yield quite a return. We're in the early days of this, and practically we see it in our business every day. Part of how we're driving that margin expansion is we're growing our gas business substantially with reasonably flat engineers. That's with AI investments. So if that's us, why isn't that most large industrial companies?
So have you given like a forecast on headcount or how much headcount might be suppressed because of AI?
Well, it's a tale of two cities in that regard. I mean, we've added over 1,500 production workers this year in the U.S. alone, about 1,000 in gas to drive this build and about 500 in grid because we are investing in our factories. So in that regard, a lot more U.S. jobs. Generally, with the salaried workforce in engineering, we're trying to manage this growth with a reasonably flat headcount, and that does require investments in AI, and we're seeing a lot of returns already.
Now, one of the things that I notice is part of my job is trying to pitch stocks. I don't think you were anywhere near as confident when that first day when they launched this company. Your confidence has increased rather dramatically, correct?
Learning every day. Reps help, Jim, right? And our team is developing, the culture of the company is developing. I think we're closer and closer to a lot of what we call new archetype customers, including the hyperscalers. So we're learning, we're getting better. We also still see a lot of opportunity to follow from here. So we're going at this every day with humility and with a focus on getting better. But yeah, 21 months in, we're pleased with our progress, but our objective is to reach our potential, and we think our potential still has a long way to go from here.
All right, last question. The president doesn't really care for wind. You lost a lot of money offshore wind. When can we just stop hearing about anything other than profits wind?
Well, we'll complete our offshore wind project in the U.S. largely this year. We have one other project to go. Clearly, that's a part of the business that's more soft. I think it comes back to we need to apply the right technologies where the right resources exist. Where there's really good wind and there's a lot of land close to a load center, apply wind. But our job is to have as many technologies that we can apply to the right economic resources that are there, and that's what we're focused on doing every day.
So how well has that spinoff worked? Well, shares of GE Vernova up about 380% since that separation from General Electric in April of 2024. Just about a year and a half ago, GE, of course, founded by Thomas Edison, who invented the light bulb. All right, up next, you're going to learn a lot more about a new pilot program launched by the U.S. government that all you crypto investors certainly will want to hear about, and you will, but only if you keep it here.
You want to talk business? Meet me in the On-Board Lounge.
बिजली का बिल 5,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है?
रूट कैनाल 25,000।
आउटगोइंग है जा रही, आपकी क्या तैयारी?
सीनियर क्लास की फीस
1 लाख रुपीस।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। एसआईबी के साथ इन्वेस्ट करो और जरूरत पड़ने पर एसडब्ल्यूबी के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपनी लाडली की सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैप ग्रीन वायर्स। इसमें है 99.97% हाई कंडक्टिव प्योर कॉपर। ये साधारण वायर्स के मुकाबले जल्दी गर्म नहीं होते। पॉलीकैप ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
चलो चलो एआई से पूछते हैं। डू फिश गेट थर्स्टी?
If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे पार्टी हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान्स।
Well, the best time of day ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
So for 3 months, we are requiring that we not only get weekly position and asset class reporting, that's on top of the normal reporting that our exchanges do, but we are also asking for a reporting of any significant operational issues relating to that digital asset collateral. So again, this is a safe way to understand the technology, to understand the uses for these assets, but in a controlled way, a safe way under our regulations.
And is your sense long-term, I mean, this is just, as you said, a pilot program, long-term that Bitcoin, Ethereum, Solana, other things like this would be able to be used as collateral and maybe not used as a like-for-like collateral, but even as, you know, you'd have Solana and you use that as collateral for Bitcoin or for some other trade that's, you know, done in dollars, frankly.
So that is a really important question that you raise, and that's why what we launched this week is actually 2 different parts. We have this limited pilot program, again, for our CFTC brokers for Bitcoin, Ether, and USDC, and then separately we issued guidance on tokenized collateral in general, and that's tokenization of real-world assets like U.S. Treasuries, money market funds, stable coins, and other real-world assets. So with that guidance, what we have pointed to, and this is building upon a recommendation of my Global Markets Advisory Committee and that subcommittee that was focused on digital asset markets. This is comprised of the largest banks, asset managers, and some of the crypto-native firms in the world, JP Morgan, BlackRock, Franklin Templeton. And so the recommendations that they did last November that we are now putting into place this week is that we should use the existing CFTC regulations, which are actually technology neutral. And so there are minimum standards for liquidity, for legal enforceability, for evaluating what types of haircuts you might need to take when you are using this as margin. So using those existing standards ensures that this is not a race to the bottom. And we encourage that firms use their existing policies and procedures for compliance, for risk management, for operational risk. And so that's the framework that we've put into place. That's more forward-looking.
Right. Let me ask you a different question just about leverage in the system and specifically leverage in crypto. Do you think there's too much? What do you think is the proper amount of leverage on any given trade at the moment? Do you think there should be limits?
So we've certainly seen on those non-U.S. exchanges, unregulated non-U.S. exchanges or offshore exchanges, that there are no leverage limits at all. And we've seen, I think, what happens when you have excessive leverage and auto liquidation. Those two things combined to have a dramatic, significant wave of customer losses, uncontrolled customer losses. And that's what's got people asking, what can we do to make sure that we are keeping Americans safe, because we know that they're accessing them through VPNs and other things like that. And that's why I've always said that we have to bring crypto inside the regulatory perimeter. You know, our futures exchanges have been the gold standard for market integrity, for liquidity, and capital efficiency for about 100 years. What is better than our futures exchanges and our securities exchanges to be keeping our investors safe? That's been proven time and time again.
You know, long term, there's a question about, and we've seen the battle play out between the SEC and the CFTC. And given the convergence of a lot of these issues, how you think that gets handled over time?
Well, like I said at the beginning of the year, this is all about getting back to basics and getting back to regular order. The CFTC is celebrating its 50th anniversary this year, and for all of our 50 years, we've worked closely with the SEC. And I think what you saw with the turf war in the last administration was really an aberration. I think the CFTC has shown how it can collaborate and work closely with the SEC. If you look at the 80s, if you look at SEC Chairman John Shad and CFTC Chairman Philip McBride Johnson, who was my professor in law school. I think we've also shown, I've known, SEC Chairman Paul Atkins for a long time. We had a joint roundtable, the first roundtable that we did together in 15 years, not since the implementation of the Dodd-Frank Act. And that was a huge success. That was at the end of September.
What do you think about the prospect of merging the SEC and the CFTC?
This is something that people like to bring up every 4 years, and it hasn't happened in 50 years. So I think that's your answer.
All right, up next, he is known as the bond king of Wall Street. We'll get Jeff Gundlach's reaction to the Fed's rate decision as soon as we come back.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Two hours of staring at clouds. 2 hours of staring, yes. But binge watching your favorites on this window? Bro. I love this window. That's Air India now.
सर इतनी बढ़िया प्राइस पे कार खरीदना एक मास्टर स्ट्रोक है सर।
सर बिना झंझट के मुझे कार लोन कौन देगा?
सर सचिन।
अरे सचिन सर मुझे लोन क्यों देंगे?
सर मैं नहीं, बैंक ऑफ बड़ौदा देगा आपको डिजिटल कार लोन, एक्सटेंडेड रीपेमेंट पीरियड और क्विक अप्रूवल भी मिलेगा। बैंक ऑफ बड़ौदा से कार लोन लेना भी एक मास्टर स्ट्रोक है।
In the future, AI will use massive amounts of energy. So what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान।
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
And he went on to basically repeat well-positioned when he was asked, are you really on hold now? And one of the most interesting things was he emphasized this idea that that's new to me anyway, that he thinks that the monthly jobs gains are 60,000 overstated. And so he says maybe a 40,000 stated job report is really a negative 20. And that sounded pretty dovish to me. And as he went on in the press conference, he seemed to de-emphasize inflationary risks. He's gone back to talking about break-evens from the tips versus nominal treasury market, which is appropriate. He's right about that. That's been extremely well contained in the mid-twos for quite some time. So he says he's well positioned, but he really emphasized things like, well, maybe, inflation will tick up because of jobs, being in demand or something, but I don't expect that to happen. He went out of his way to frame inflation as less of a problem. He even went so far as to say they're making good progress on inflation if it weren't for those darn tariffs, So he's trying to carve out some real estate for himself on these things. But when he says he's well positioned, I really agree with him, because at long last, the Fed funds rate is the same as the 2-year Treasury yield. It's fascinating that the Fed has dropped rates 175 basis points beginning a year ago, September, but the 2-year Treasury rate is completely unchanged. So a 175 basis point drop in Fed funds has finally gotten it back down in line with the 2-year. So I think he is well positioned, and he seems pretty clearly focused more on the employment risk of unemployment rising than he is on inflation being a problem. So I think this was sold, was kind of sold to be expected to be a hawkish cut, but I don't think it was. And when you ladle on top of the cut and the language surrounding it with the $40 billion of what some people will call QE, I mean, that's kind of interesting. We've been doing QT for a long time, and all of a sudden, out of the blue, we've ramped up QE, which is probably giving people some hope that there's going to be QE if needed, and I suspect that is going to be the case. One thing that's fascinating is that people keep talking about the Fed cutting rates to help housing. Well, the Fed cutting rates 175 basis points has not helped housing. What's happened is that long-term interest rates have risen as the Fed has cut rates 175 basis points. The long bond, the 30-year Treasury, is up about 75 basis points since before they started cutting rates, and the 10-year Treasury rate is up as well. So I continue to believe, and this has been my thesis since they started cutting rates, and the market action seems to have corroborated my view, that the Fed cutting interest rates is not going to be helpful for long-term interest rates. So today we had the Fed cut, and the curve steepened again. We're out to 2s30s, out to about 123, 124 basis points. The high this year was 130. So I'm thinking that we might see long-term interest rates actually rise on this more dovish Fed, but I think that this is not a hawkish cut, Scott, in my view.
I mean, I asked it the way I did because you could say, well, Powell says the bar is high for more cuts. As you said, they're well positioned to wait. Those are his words. You say, OK, that's the hawkish cut that we were expecting. But then when they lay on the announcement of the Treasury purchases, the market is at the highs of the day. The S&P could do a new closing high today. You'll say, well, maybe that was actually a dovish meeting because of what some already consider this to be QE light. You get where I'm coming from?
Yeah, I do understand that. The thing that's interesting about this meeting is the dissents. You know, you had the Myron guy wants 50 basis points all the time. Two didn't want any cut. And I guess there were a few what they call soft dissents as well. So the committee seems more hawkish to me than Jay Powell's press conference. So I guess in that sense, you could call it a little bit of a hawkish meeting. But from the statement and certainly the press conference, I thought it was more dovish than most people expected. And so when he was asked about, is it possible that we could have rates go one way or the other, you know, you might even hike rates, not just cut rates, Powell's answer was pretty much, there's no way we're hiking rates, is what I heard for the answer to that rather specific question.
Well, he said it wasn't the base case, right? He said hiking rates wasn't in any way the base case at this point, almost as if they're not even thinking about it at this point.
Well, that's right. Yeah, he's basically, one way to interpret that is we need the data to radically change for us to think about hiking interest rates. And my guess is that they're not going to cut rates. I don't think they're going to cut rates. I think he's going to go out with the Fed funds rate. If the 2-year Treasury stays where it is, he'll probably end his term with the Fed funds rate where it is right now. But if they're going to do one thing rather than the other, it would be cutting interest rates. And we'll have to see what that data comes out. He obviously emphasized multiple times that there's a boatload of data that's coming out between now and the next meeting. But we'll see how that goes. But
I'm confused, though, for a minute, though. If you just said that you don't think that he's going to cut rates again, but also noting that the chair said that they think that the job gains were overstated, that maybe the labor market is weakening still, and you still don't think that they're going to cut interest rates anymore. I get that the outlook is for only 1 in 26 and only 1 in 27. He'll be long gone, of course, as the chair by that point in time. But you're making a statement here that they're done?
Scott, I've said this so many times, I'm sure the listeners are tired of me saying this. The Fed follows the 2-year Treasury. They've been out of sync with the 2-year Treasury all the way through this cutting cycle, and now they've actually caught up. And so if the interest rate structure stays stable, and it's been so stable, the 2-year Treasury has been so stable for the past 2.5 years. In fact, most bond yields have been very stable.
Now, Gundlach added that in his opinion, Fed Chair Powell is focusing more on America's job situation more than America's inflation situation. What do you think? Right up next, sit back and enjoy the ride. The CEO of one of America's biggest airlines giving us a first look at his travel calendar for the new year.
Fly Emirates, fly better.
होम EMI 50,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है? पूरे सीलिंग का 20,000। आउटगोइंग है जा रही, आपकी क्या तैयारी?
मौसा जी, मेरी शादी का गिफ्ट।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIP के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWP के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपने दिल के हिस्से की सेफ्टी से समझौता? नो चांस। इसलिए पॉलीकैब ग्रीन वायर्स, जो है लेड फ्री और इमरजेंसी में दे कम टॉक्सिक गैस। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
चलो चलो AI से पूछते हैं। डू फिश गेट थर्स्टी?
If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
आराम से
हाँ।
सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी।
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये
हाँ।
आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है?
टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
You've got probably capacity constraint in the industry, but for Southwest Airlines, we have a lot going on that's unique to us. We are evolving and changing our business model and our product. We've got assigned seatings going in. We've got extra leg room. We've got free Wi-Fi for our members now. So many things that have been done in the past year. In my 38 years in the industry, I've never seen an airline do more in a year in terms of initiatives in Southwest Airlines. It is a transformation of the company, and I'm looking forward to those results showing up in 2026.
Do you frame it as the premiumization of Southwest? Because for so long, obviously, Herb's marketing from the get-go was about low costs.
You know, we still have all of our core advantages. We have the best domestic network. We have the best brand loyalty in the industry. We have low costs. We're 20% lower cost than the legacies. And above all, we have the best hospitality and service, and we have the best people. So we have not abandoned the core strengths of the airline that Herb built this company on, but we're evolving the model. And yeah, we're changing to meet the needs of the customer. So our customers want a differentiated product. They want access to extra leg room. They want products like free Wi-Fi. We've added Pete's Coffee. We're now evolving our online presence. You can buy Southwest Airlines on Expedia and Priceline and Google Flight Search. So it's an evolution of the model, but we're not abandoning the core strengths of this company.
We were very concerned that when you added a fee for baggage, that a lot of people would move away from Southwest. Judging by the fact that you're at your all-time high at $38.90, it may seem to me that no one really did abandon ship when you started chartering.
Well, it's a change. I mean, we have unbundled our products to give our customers choice. You can now buy a very basic product, or you can buy a product that comes with a guaranteed extra legroom seat, a differentiated product and customer experience, free drinks, that kind of thing. But no, we announced, the charge for bag fees. We've seen our NPS, Net Promoter Scores, fully rebound. In fact, on aircraft that have the extra legroom retrofit in place, we're seeing significantly higher Net Promoter Scores. Aircraft that are now coming with the new Recaro seat have an even more significant increase in the Net Promoter Score. So our customers have adapted to the choice of paying a bag fee or not, and all you have to do is have that Chase co-brand card in your wallet to get a free bag.
You're going to have to help me with this. I remember when the airline was fighting activists that were suggesting everything you did. Was the model wrong?
You always have to evolve. And everything that we are doing was in place as a plan prior to the activists and Elliott showing up. So we're executing our plan. And again, it's a stunning set of changes that have all been completed in 1 year. All the things that I listed before, and it's evolving the model of Southwest Airlines. So you have to constantly evolve and change, and you have to meet the needs of your customer, number one, and that's exactly what we're doing. Herb always said, if you don't change, you die.
Price. How much have you been able to raise prices?
Well, that's really a market factor. So I think it's two things. The fares have been relatively stable. When you look at the new fare structure, so what we're offering is for buy-ups, you get more as you buy up our products. So there's basic and choice preferred and choice extra. And you can also buy seating as an ancillary. You can buy that extra legroom seat. So, it's really about meeting the needs of our customer and then obviously producing returns for our shareholders. And I'm really looking forward to 2026 when all of this change comes home and produces the results that we're looking for, our shareholders are looking for, and our customers are looking for.
Now, Southwest Airlines, which is pretty much one of the biggest airlines here in the United States, not big internationally, that stock is up more than 18% this year. Not bad. All right, still ahead. Late-breaking results out of tech giants Oracle and Synopsys. We'll have all that for you as it happens right now. Plus, China accelerating efforts to boost its own domestic AI chips. Details coming up.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Tooth enamel is very important and you need it for life. So enamel is the outer layer of a teeth. Enamel is like a shell. Did you know a lot of what we eat every day has acids that can damage your enamel? Erosion of enamel could lead to multiple dental problems. I recommend using Sensodyne Pronamel daily. With over 20 years of research, Pronamel is formulated to give you 2 times stronger enamel protection. Pronamel, it's pro-enamel.
This is Network 18.
and you're watching CNBC TV 18 Prime.
DeepSeek, yes, it's reportedly training on smuggled Blackwells. Meanwhile, ByteDance and Alibaba, Reuters says, immediately asked for H200 orders as soon as Trump reopened the window. Now, this all exposes how far behind China's domestic chip sector still is. It also forces Beijing into a three-way trade-off that it can't win. Letting companies buy NVIDIA chips, that hurts momentum behind Beijing's domestic chip champions that, by the way, are now worth nearly $300 billion in market cap. On the other hand, blocking them slows its own tech giants and weakens China's best AI models. Third option, looking the other way while companies keep using gray market chips, that means giving up regulatory control altogether. So whichever way it turns, Beijing loses leverage. Now, the policy itself, it doesn't supercharge China's AI sector. It formalizes the dependence that already existed in the shadows, dependence that DeepSeek and others have already been exploiting. And instead of breaking from U.S. hardware, Chinese AI labs, they end up even more tied to NVIDIA's roadmap, stuck at whatever generation Washington is allowing. Now, TrendForce, an industry research firm cited by analysts, it predicted that China's high-end chip market would grow by over 60% next year, reaching about 50% market share. But that projection was built during a ban on U.S. chips. This reopening, that could change the equation and threatens all of that artificial demand that Beijing has spent years propping up. That's why, guys, this is not the strategic loss that some critics and China hawks, lawmakers, that they claim. Legal access doesn't actually narrow the gap. It just narrows China's options, and it keeps the ceiling on progress in U.S. hands, guys.
Yeah, I mean, there's so many questions. There's the geopolitical question, and then, Deirdre, there's the technology question, which you have. And that sort of lends credence to the idea, we were talking to Jack Kittery last hour about, we'll let them build off the U.S. stack so that we can kind of know what's going on there and be more in control. And then they won't do it themselves, and it'll be more of a black box.
And that's key, right? It's all about control, because we know that they were going to do it anyways. Even the first DeepSeek model that made all those headlines at the beginning of this year, you know, there's a lot of speculation that they were able to smuggle a bunch of NVIDIA chips to get there. So what this does is just kind of put Beijing in a real bind. Everywhere they turn, they're kind of losing. And remember, too, that for years they've been trying to build up their domestic chip makers that are far from the technology capable of the U.S. chip makers. So this really forces Beijing into a corner. The chip makers were going to do this regardless. Now it forces Beijing to choose who can and who isn't able to use these NVIDIA chips. And he uses the domestic accelerators, which, you know, end of the day, nobody actually wants to use. That puts this very clearly in focus.
All right, huge topic there. Right now, we got some stuff happening here after the bell. We got news out of Oracle and Synopsys. Oracle shares, they are actually moving a little bit. No, they're down right now in the post-market, down just over 5%. Their quarterly earnings did top expectations, although revenue a little bit lighter than some of the higher expectations. Oracle rather, did pick up commitments from Meta and NVIDIA during the quarter as its remaining performance obligations soared 438% from a year earlier. Meantime, some investors have questioned whether the company's artificial intelligence investments are fully justified. In the meantime, shares of Synopsys, you could see the other direction. They're the ones going higher. That's a software maker. Their earnings did beat expectations. Remember, just last week, NVIDIA announced it's taking a $2 billion stake in Synopsys with expanded computing power and a partnership. So right now, at least, it just happened. Oracle is down just a bit. Synopsys is higher just a bit. And with that, we're going to wrap it up. Folks, thanks for watching U.S. Markets Edition. Europe Early Edition is next.
At Interact.
You want to talk business? Meet me in the On-Board Lounge.
आपके कलीग्स भी आपका परिवार है। इनकी सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैब ग्रीन वायर्स। इनके सुपीरियर इंसुलेशन इमरजेंसी में दे कम धुआं। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
आराम से
हाँ।
सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते।
जी
हाँ?
मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये
हाँ।
आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है?
टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं। Rohit, we need to talk, okay?
Yes, sir. That's Air India now.
We are everyone, but we're not just anyone.
I've made my choice today.
We choose progress over pressure.
The endless sky. I'll sip
We say no to shortcuts and yes to the strength of discipline, to the pride of planning, to the thrill of watching our future take shape little by little. We are citizens, and you can be one too. Sip karo, citizen bano. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Early edition. I'm Sylvia Morrow, and here are your headlines this Thursday morning. The Fed delivers a rate cut, but the most dissent in 6 years as divides on the policy outlook reveal a split at the heart of the central bank.
We now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
Nasdaq futures falter as Oracle's data center spend surges, sending the stock down by double-digit percentage points in extended trade. This as Norway's sovereign wealth fund shows caution on investing in the infrastructure. And the Ukraine president, Mr. Zelensky, says the fundamentals of a post-war reconstruction plan have been agreed with the U.S. as Belgium reportedly seeks further concessions in Europe's frozen Russian assets row. This ahead of a coalition of the willing meeting later today. Good morning, everyone. Our top story this Thursday morning. The Fed has delivered an expected interest rate cut, reducing rates by 25 basis points to their lowest level in 3 years, with its statement citing increased risks to the employment outlook. But the decision exposed divides within the central bank. 3 policymakers dissented on the decision for the first time since 2019. 2 said rates should have been kept on hold. And, of course, Trump appointee Stephen Myron calling for a 50 basis point move lower. That uncertainty was also clear in the all-important dot plot projections, where 6 of the 19 FOMC members indicated they supported a hold in this meeting. For 2026, the median forecast showed 1 rate cut. That's in line with September's projections. But 7 members supported no further easing, while 1 suggested rates should be 150 basis points below their current level by the end of next year. The chair, Jerome Powell, said the Fed can wait to see how the economic outlook develops. Listen in.
When the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. We've now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
In addition, and perhaps this is one of the most interesting aspects of the meeting yesterday, the Fed also announced on Wednesday that it will buy $40 billion in short-term treasury bills over the coming month. This is in an effort to stabilize funding markets, just weeks after ending its quantitative tightening program. Powell said the move will not mark a return to large-scale debt purchasing and is not being used as a monetary policy tool.
Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves.
So that was the update from the Federal Reserve. In terms of the ECB, we also heard from Christine Lagarde. The president of the ECB said the European rate setters are likely to lift their growth outlook in the next week's meeting, which would mark the second straight upgrade to the forecast. Speaking at a Financial Times event, Lagarde also said that the euro area is performing better than the ECB had expected in the face of President Trump's tariff policies. And this gives us a good segue to look at how European futures are faring at this hour, indicating perhaps a flat start to the trading day, continuing ultimately the sentiment that we have witnessed this week so far. And this despite the fact that now we know the outcome of that Federal Reserve meeting that investors were wondering about. So let's see what will happen later in the session, and indeed if we're going to get a little bit more clarity in terms and conviction ultimately in terms of how European investors are positioning themselves. Let me take you to the dollar crosses too and show you how things are moving in this part of the investment world. At this stage, we're not seeing also huge swings when it comes to some of the moves between the greenback and the European currencies. But of course, this is also an important asset class to look at in the context of the outcome of the Federal Reserve meeting. Speaking of which, let me show you how markets have reacted on that as well. This is the close. This is how Wall Street closed yesterday. As you can see, though, we actually ended the day on a positive note. The Dow, for instance, up about 1% on the day. But let's get a check on how things are faring as we approach the open later today. Look at it. Futures actually indicating that we could see a slightly negative start to the trading day, in particular for the Nasdaq. And we'll be discussing the reasons behind that later in the show. But this is related, just to give you a little bit of a tease here, it is related to some of the comments that Oracle made yesterday as well. But broadening out the conversation and looking at what else we heard in terms of that important Fed decision, we had the chance to speak exclusively with the Bank of America CEO, that of course is Brian Moynihan, in the wake of that Fed decision. And he told CNBC that he expects to see further easing next year. Listen in.
We get in this great debate about a quarter here, a quarter there. But if you think about it overall, there's not a lot of debate about getting it down around 3%, but no lower. That people have to focus on, because that's a different rate environment that will have a 3%.
So a lot to digest after that Federal Reserve meeting. Let's discuss it with our next guest. He is Andrzej Szczepaniak, Senior European Economist at Nomura. Andrzej, always great to see you. What did you make of the meeting?
Good morning. Look, in some sense it was mixed. The actual decision itself, the rate cut, that was widely expected. Most analysts, markets were pricing it. It was very widely expected. In terms of the communication, though, that was slightly more mixed. You did have some commentary by Powell, as you mentioned, regarding the labour market. That was slightly on the dovish side. However, he did set the bar a bit higher to future rate cuts. He spoke about the fact that now actually the policy rate is within the range of neutral for most of those on the FOMC, and the Fed can take its time to wait and see, essentially. You have this scenario as well in the SEP. There were meaningful revisions upward to growth for next year. So you have actually a strong US economy in some senses on the growth side, risks the labour market is turning. Even though the SEP didn't show a rise in the unemployment rate, he nonetheless expects revisions to non-farm payrolls to be negative once those revisions from the benchmarking come in. And in terms of inflation, actually, he spoke about how core PCE is in the low 2s if you actually take out the impact from tariffs. So our US economists estimate tariffs have added 30 to 50 basis points to the annual rate of core PCE due to tariffs. And so that's what Powell says is very plausible, but it still paints a very challenging picture. And likewise, you saw in terms of the actual vote split, there were a lot of dissents. Not just actual dissents, so also tacit dissents. Those who still voted for a cut, but actually in terms of the dot plot, suggested they would not have voted for one otherwise.
There are just so many angles to this rate decision. What does it say in terms of where we are in terms of the health of the US economy?
I think Powell was very clear that a lot of the technical factors, so owing to the government shutdown, means we just don't know at this stage. You have a scenario whereby tariff price pressures have maybe been more muted over the course of this year than many analysts had expected. The US economy, from a growth perspective, has been resilient. Consumers have been resilient. It's true that now with non-farm payrolls potentially going negative, once you get those revisions in, the labour market is clearly weaker than we had sort of thought maybe 12 months ago, but it's not sort of crashing in any sense of the term. It's simply a more meaningful slowing versus prior expectations. In terms of sort of outlook going forward, we essentially think the Fed will cut twice more in 2026, so in June and in September, so broadly in line with market pricing. Markets, I think, are at 48 basis points cumulative by September. But it's a case of you have a scenario whereby during the first quarter of next year, inflationary price pressures should ramp up, we think, owing to further tariff price pressures. Growth should remain resilient, and the labour market shouldn't turn too meaningfully, which makes it very challenging. The question for many on the FOMC is, which policy mistake could you be entering the phase of? Are you actually in a scenario whereby you need to slow the pace of cutting rates to ensure you sort of get behind those price pressures and sort of essentially curb any of those price pressures further? Or are you in a scenario whereby the labour market could turn more aggressively, like Moran, for example, thinks, and potentially Waller to some extent, whereby you have to cut more aggressively?
So when you forecast 2 rate cuts for next year, are you potentially looking at the fact that you will also be dealing with a different chair of the Federal Reserve, or is that assessment basically based on economic data?
That's a fantastic question. Our own assessment is purely based on our view regarding the macroeconomy. We think a lot of the price pressures we were anticipating in 2025 and haven't come through will come through in 2026, Q1, Q2.
But therefore, so just to clarify, do you therefore have a risk here on the table that perhaps you'll see even further cuts if we get someone more dovish?
There is always the risk, clearly. I think there's also the risk that actually in the US labour market, generally speaking, it's very non-linear. So you could get a scenario whereby essentially the labour market turns sharply over the course of Q1 if those price pressures come in and households really pull back, obviously impacting firms and the whole value chain, and that could further raise the risk of further cuts in, say, H2.
There's one aspect that we haven't discussed about, and that's the $40 billion that they also announced in Treasury bills. Some of my colleagues have described this as light quantitative easing. How are you looking at this announcement, and to what extent do you actually say that this is not a monetary policy tool?
So the Federal Reserve have given themselves the option to go up to 3 years. We think they'll be loath to do so. We think they're going to maintain very short maturities and be very clear that it is not quantitative easing. When you think of typical QE, it's much longer end on the curve, essentially. You're talking 5 years, 10 years, that sort of thing.
Is it because of a technical concern, or do you see real concerns with the US economy with this move?
So the whole point of the purchases really is to ensure there's enough liquidity in the system. And the point is, oftentimes when it comes to the balance sheet technicalities, when we move towards QE, we stop doing a lot of short-dated purchases. The Federal Reserve balance sheet has a natural rate of growth, essentially, and historically it's always been very short-dated maturities. When we shifted towards QE, we stopped doing that, and they started doing much longer-term maturities, and you sort of forgot about the fact that you do need the short-term maturities to carry on. And now with quantitative tightening, you have to get to a stage whereby the balance sheet will grow naturally with the pace of the economy, irrespective.
So let's discuss also the ramifications here for other central banks, including the ECB. You know, usually, historically speaking, you look at these two central banks and the ECB is usually following the Fed, not the other way around. So walk us through these different dynamics at this stage.
So it's important to caveat that we're in very different scenarios. In Europe, you have growth getting towards its pre-pandemic trend rate. Inflation's basically at target, 2.2% as of the last HICP print. ECB monetary policy is at neutral. 2% is the neutral for the depo rate. The difference this time round really is the fact that markets are pricing 2 more Fed cuts. So long as the Fed delivers only 2 Fed cuts by September next year, you're not going to have a meaningful impact on the exchange rate to result in any more imported disinflation. So the ECB wouldn't need to cut rates further to react against that. I think it's important to caveat that all of that's already in the price action to some extent. It's also worth bearing in mind, you have had times in history when you have had both central banks diverge if the macro cycles warranted it. Think back to 2016-17. The Federal Reserve was raising rates, the ECB was cutting rates. The Federal Reserve was doing QT, the ECB was doing QE. You do have historical examples of asymmetric or asynchronous moves in both central banks if the macro backdrops actually warranted. The ECB got to neutral much more quickly than the Federal Reserve. The Federal Reserve is now kind of getting there. It's worth bearing in mind the long run dot in the SEP is still at 3%. So they still have a couple more rate cuts to get until you get to the sort of long run neutral rate for the Federal Reserve.
And just very briefly, as a result, what is your expectation in terms of euro dollar?
So over the medium term, we do forecast euro dollar at 120 by the end of this year, essentially, and that will maintain over the course of next year.
Let's see what will happen. But thank you so much for joining us this morning. Pleasure speaking with you, Andrzej Stepaniak, Senior European Economist at Nomura. Now, we're also looking ahead to more central bank decisions from across the globe. The ECB, Bank of England and Bank of Japan are among those meetings next week, while the Swiss National Bank will reveal its decision at 8:30 London time this morning. Carolyn will be speaking to the SNB chair, that's Martin Schlegel, today. You'll be able to check out that conversation on cnbc.com. Coming up on the show, Oracle shares sink in extended trade after weak second quarter revenue and the lack of transparency on financing plans. We'll have more details for you right after this break. Stay with us.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
बिजली का बिल 5,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है?
रूट कैनाल 25,000।
आउटगोइंग है जा रही, आपकी क्या तैयारी?
सीनियर क्लास की फीस 1 लाख रुपीस।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIB के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWB के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपनी लाडली की सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैप ग्रीन वायर्स। इसमें है 99.97% हाई कंडक्टिव प्योर कॉपर। ये साधारण वायर्स के मुकाबले जल्दी गर्म नहीं होते। पॉलीकैप ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
हमने 2.5 में सोचा था ये।
संजीव,
हाँ?
ये वाला घर पिक करना एक मास्टर स्ट्रोक है।
ये घर बजट से ज्यादा है। कौन देगा हमें बढ़िया होम लोन?
सचिन।
सचिन क्यों देगा होम लोन?
सचिन।
अरे मैं नहीं, सचिन। बैंक ऑफ बड़ौदा देगा तुम्हें बढ़िया होम लोन और बेहतर इंटरेस्ट रेट भी मिलेगा। बैंक ऑफ बड़ौदा से होम लोन लेना भी एक मास्टर स्ट्रोक है।
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है। थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान्स।
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
Morning, Matthew. Good to have you on the show. Look, yesterday we had someone talking about the economic outlook for the European economy with very positive reasons on why we should expect further growth in the new year. But you seem to be of a different opinion.
Well, thanks for having me on. Yes, I think we're just more measured, possibly. We do think growth is going to return and pick up a little bit in the region, but there's still significant global headwinds, mostly from the U.S. trading policy. There's still a lot of uncertainty. These deals that have been agreed can still change, as we've seen. And the global economy is starting to slow, and firms are having to adjust to a new normal. So that's going to kind of keep a lid on growth this year or in 2026. But then there's also hope that there are things afoot that give us hope for maybe further down the line, more going into 2027.
Right, like what?
Well, for instance, the big story that what we're all, well, those who cover the European economies have been waiting for is the big infrastructure and defense spending boom that we're going to get from Germany. Germany's announced, obviously, this adjusted its debt brake laws, so they're going to be spending over the next 12 years the equivalent of about a quarter of GDP. That's going to have a major impact, not just in Germany, but in Germany's trading partners, especially in Central and Eastern Europe. That's going to be seeing a lot of money going into infrastructure and defense. And so these are areas that we would be very bullish on. Certainly, once the money starts flowing, the German budget approved a 55% increase in investment spending. Sure, there are concerns about how efficient that spending will be, and whether it really truly will go all into infrastructure. But that should be a big boom for the European economy going forward.
So one to monitor in the new year how that's being applied. We also heard from the ECB president, Christine Lagarde, saying that next week they could be in a position to actually increase the growth outlook for the Eurozone in the new year. Just a reminder here that back in September, they forecast a GDP rate of 1% for 2026. What are your numbers telling you?
Our numbers are telling us that there could be a slight uptick in that number. It will be north of 1%. We've recently, I mean, we're talking about very small numbers, but we have recently upgraded our views for both the UK and France going into 2026. And also, I think what's will help that is Germany finally returning to growth after many years of stagnation.
Well, let's see what else the ECB will say next week. In the meantime, I would like to pick up on a line from the latest report as well, as you think about the outlook. It said the bond market jitters could continue. My question to you is where and why?
Well, you see, the problem is especially the countries like the UK and France are in this deficit populism doom loop, basically. They've got the large deficits, they've got the elevated bond yields, but yet any efforts to control or rein in deficits and spending and limit borrowing meet with adverse reactions from the populaces. And we've got this rise in populism in both those countries and throughout Europe. And so then that hits their popularity. So very few politicians really have the mettle, if you will, to carry on with any sort of fiscal consolidation. So I think these sort of things like what we might even see on the political calendar, the UK local elections, we got German state elections later in the year, are all have the potential to disrupt markets a bit.
Well, one also to focus in the new year. I'd also like to discuss China trade with the European Union in particular. Of course, the recent numbers already suggested an increase here in terms of the flow of goods from China to Europe. What does that mean in terms of growth, but also of inflation for the bloc?
Yes, it has both positive and negative impact depending on how you see it, and we do see this trend continuing. Certainly, China's looking for markets for its goods, and the U.S. has been fairly well shut off in many ways. So it's going to be shipping more of those goods to Europe, and that's going to, suppress inflation and even help maybe even lower consumer prices. So that's good for consumers. But it's not great for firms and especially in manufacturing that are going to be increasingly competing against more and more Chinese goods. So it's kind of a mixed picture. Good for inflation, for bringing that down, but not great for those companies that are outside of sort of the defense
Right.
infrastructure space.
But would you say it is a growing risk in terms of ECB policy for the new year as well?
Good point. No, I don't think it's going to have that big of enough of an impact to change the trajectory for the ECB. So we, like many others, think the ECB's done. It's I think, as your previous guest pointed out, they're well within the neutral rate for their policy rate. So we don't see the ECB cutting later this month or even at all in the coming year. And we don't see this having that kind of impact, impacting that decision.
All right. Well, let's see indeed what the central bank will also do in the new year. In the meantime, thank you for joining us this morning. Matthew Sherwood, their principal economist for Europe at EIU. Now, elsewhere in the corporate world, the CEO of the Magnum ice cream company, that's Peter ter Kulve, has told CNBC that the main reason for the company to demerge from Unilever was to allow both to focus on their core products. He also argued that spinning off will allow the company to invest in growth opportunities that were not possible as part of Unilever. Listen in.
Unilever needed to focus on its category, and we needed real focus on ice cream. I now have 19,000 people who go to bed thinking about ice cream, who get up thinking about ice cream, and we're able to invest behind a growth opportunity. And we don't have to balance that between all kinds of different categories in Unilever, but the focus is on ice cream.
And when questioned on the rise of obesity drugs such as GLP-1s, ter Kulve said the company was not heavily affected by it, saying that ice cream is not a, quote, mindless munching category.
The beauty is in the States, we have
unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime. unraveling complex global developments and what they mean for Indian business. Tune in to the Global Reset on CNBC TV 18 Prime. This is Network 18, and you're watching CNBC TV 18 Prime.
Hello and welcome. You're watching the Global Reset from the CNBC TV 18 Prime Ionic Wealth Studio with me, Surabhi Upadhyay. Joining me in just a bit from now today is Adrian Moet, who is someone who's watched the emerging market landscape for many, many decades. And of course, he has a very keen eye on India as well. We will be discussing all things Fed, the outlook ahead, and what lies for the Indian equity markets ahead in 2026. But before we get to that, let's quickly bring you up to speed with the overnight action. And it was all about the U.S. Federal Reserve. Now, in a widely anticipated move, a divided Federal Reserve approved a third rate cut in the current year, fulfilling expectations of what was widely seen as a hawkish cut. The FOMC has lowered its key borrowing rate by a 0.25 percentage point, placing it in the 3.5% to 3.75% range. However, the move carried caution about where policy is eventually headed here on and featured no votes from 3 Fed members, and that hasn't happened since September 2019. The split featured hawkish and dovish dissents. Governor Stephen Mirren favored a steeper 0.5 percentage point cut, while regional presidents Jeffrey Schmidt and Austin Goldsby backed holding rates in line. Remember, this was the third consecutive no vote from Mirren. In addition to the rate decision, the Fed also announced that it will resume buying U.S. treasuries. The central bank will start by buying $40 billion worth of treasury bills, and this starts on Friday. Reacting to this 25 basis points cut, stocks on Wall Street closed Wednesday higher. The Dow actually was up almost 500 points. The S&P 500 added about 50 points, and the tech-heavy NASDAQ also surged about 80 points. So all was well on Wall Street. That 25 basis points rate cut was delivered. However, markets in Asia started giving up early gains, and they were trading mixed. Back home, the Nifty has reclaimed the 25,800 mark, but questions remain on the domestic story here and, of course, the future of the India-US trade deal as well. And we'll get to all of that in just a moment. But first, let's start by putting the Fed action into perspective. Here's CNBC's Steve Leisman.
The Federal Reserve reducing interest rates by an expected 0.25 point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Schmidt, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Miron. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up a half a point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated, economic uncertainty also elevated.
So economic uncertainty and inflation remains elevated. Let's actually listen into the Fed Chair himself on the path of monetary policy ahead.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. The adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves. So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people.
All right, so that was the Fed Chair describing what he sees ahead as he delivered that 25 basis points rate cut. Now, as promised, we have with us Adrian Moat, investor, Hong Kong SAR. Adrian, of course, has been watching the global equity landscape for many, many years, for decades. Adrian, great to have you with us on the program today. So let's start with the US before we talk about Asia and India. And interestingly, despite all the turbulence and the tariff wars, for the better part of this year, the U.S. economy found itself in a pretty sweet spot, as did the U.S. market, and things have kind of rolled along quite nicely. How do you sum up, how the U.S. and the U.S. market, both the economy and the market, are positioned as we get set to wind up 2025?
I think the outcome for U.S. economic growth is significantly better than was feared during Liberation Day, when the Trump administration announced all those very high tariffs. It is worth, though, looking at the details within the economy. So we've got very large capex, but focused within AI spend, data center spend. Capex more broadly looks quite weak in the US. Plus, the US housing market is also poor in terms of transaction volumes in quite a lot of major cities. Prices are coming off. We've had, because of the government shutdown, data around the labor market missing. We're now beginning to get that data coming through. And as you note on your Fed comments earlier, that the labor market is no longer seen as having low unemployment, and that we're beginning to see evidence that the robust job growth, which really characterized the US economy post-COVID, has coming to an end. So I see a market where we're responding to the AI spend, the capex that's going on there. But when we look at the broader market, look at some of the retailers that have sold off more recently because of poor numbers, that the US economy is not necessarily as strong as the current level of the S&P implies. So interesting, looking at the Fed decision, two Fed governors dissenting, believing that they shouldn't be cutting rates, another dissent for a bigger cut. I think it's a very, very hard environment for the Fed, where the headline inflation rate, the core inflation rate, is also above their target zone. So I think it's going to be very interesting moving into the first quarter of next year. And there is an expectation of a slight acceleration in growth as some of the household sectors begin to get a benefit from the tax cuts that were in the big, beautiful bill. But it's also possible that that acceleration doesn't occur because the slowing in momentum that's beginning to appear in some of the data may broaden within the economy. So moving into next year, my level of confidence on projecting what's going to happen in US economic growth is quite low.
Interesting, because this year was more or less steady despite all that turbulence. Adrian, also, what did you make of the Fed's move to start buying bonds again? They've started with $40 billion in Treasury bills. And interestingly, the market doesn't seem to be fussing too much over Fed independence. It seems to be perhaps, taking the next Fed chief, the fact that they'll probably be quite dovish in their tilt and toe the White House line. The market seems to be, making its peace with that. So what are your thoughts on these fronts?
So I think when you say the market's making its peace, you're referring to the fact that 10-year bond yields came off modestly overnight rather than perhaps rising because of fear of Fed independence being undermined. I'm very anxious about the US bond market. So 10-year yields are 4.12 at the moment. The upper end of the Fed band is 3.75. So there's almost no term premium. You're really not getting paid for taking on the duration risk. At 10 years, you're getting paid a little bit more at 30. But remember, we're doing that when the fiscal deficit is rising into next year. Fiscal deficit is already extremely large in the US, as it is in many other developed countries. And I still see the bond market as probably the biggest source of potential volatility over the next 12 months. And it is possible that if the inflation data remains elevated, and if people's concerns over just how many bonds have to be issued begin to bear out in the market accepting a more reasonable term risk premium. I mean, just think about this as a number. The average yield curve prior to the global financial crisis was 1.75%, 175 basis points between 3-month money and 10-year money. That used to be the average. We are well away from that. So I think the context of the Fed ending quantitative tightening and perhaps announcing some flexibility around a bit of QE is them recognizing that there is significant risk from the bond market, that you do have a potential that the Fed is cutting and bond yields actually start to rise and could rise quite rapidly. We did have bond yields above 5% briefly in the last 2 years. That wouldn't be an unusually high level versus the historical context.
So interesting. You wouldn't be surprised if the US 10-year indeed starts heading higher once again at some point next year?
Yeah, so I go back to thinking about a world prior to the global financial crisis, prior to this period where we had zero interest rate policy and QE. And back in that world, if you exclude the periods of inversion and you looked at the average yield curves, the average difference between 3-month and 10-year rates, it came out at 1.75%. We're nowhere near that. It is perfectly reasonable for bond investors to be paid for taking duration risk. And at this point in time, they are not paid for taking duration risk. So let's say the Fed takes rates down to 3.5, having 5% long-term interest rates would be very normal in the pre-GFC world.
Yeah, and that's a world that we saw well over 2 decades back. So whether we move towards that normal or not, we will find out. We do have to take a break. Adrian, stay on with us. But as we take this break, let's leave viewers with the latest comment that came in from the US president on the Fed chief. Now, he was speaking after the FOMC announcement, and he called the Fed chair a stiff and criticized the pace of interest rate cuts. Trump suggested that the Fed's rate reduction was far too modest and should have been doubled. Listen in. We'll take that break and come right back.
Interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small number that could have been doubled, at least doubled. You know, I've wanted to say it. I do say it. I believe it. And we have to get a mindset that when a country is doing well, you don't want to kill the growth. That's what they're doing. They kill the growth. I don't know if you guys even agree with that. They kill the growth because they're so afraid of inflation. But you can have tremendous growth without inflation. Everything goes up with the growth. But that's not inflation. So I think we can do much better than traditional numbers.
Hi, I'm Gaurav Mehta and I'm the CEO.
Nope, you're a founder.
No. I'm not a founder. I've given you the details.
Well, then you forgot to add founder.
Who's my co-founder, by the way?
You don't have one yet. Your wealth is your first startup. Don't just manage it, scale it with the right co-founder. Ionic Wealth, co-founder in your journey of wealth creation.
Thank you.
Enjoy your meal.
Neither the middle seat nor the meal is a sandwich. That's Air India now.
चलो चलो एआई से पूछते हैं. Do fish get thirsty?
If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
Hi, I'm Gaurav Mehta and I'm the CEO.
Nope, you're a founder.
No. I'm not a founder. I've given you the details.
Well, then you forgot to add founder.
Who's my co-founder, by the way?
You don't have one yet. Your wealth is your first startup. Don't just manage it, scale it with the right co-founder. Ionic Wealth, co-founder in your journey of wealth creation.
आराम से हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है?
टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
Hi, I'm Gaurav Mehta and I'm the CEO.
Nope, you're a founder.
No. I'm not a founder. I've given you the details.
Well, then you forgot to add founder.
Who's my co-founder, by the way?
You don't have one yet. Your wealth is your first startup. Don't just manage it, scale it with the right co-founder. Ionic Wealth, co-founder in your journey of wealth creation.
Well, the best time of day ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
Hi, I'm Gaurav Mehta and I'm the CEO.
Nope, you're a founder.
No. I'm not a founder. I've given you the details.
Well, then you forgot to add founder.
Who's my co-founder, by the way?
You don't have one yet. Your wealth is your first startup. Don't just manage it, scale it with the right co-founder. Ionic Wealth, co-founder in your journey of wealth creation.
Welcome back. You're with us on the Global Reset, and we're in conversation with Adrian Moat. Adrian, so now we've set the context with what's happening in the US and what the economy is doing over there. I want to come to India and Asia now, really, because it's been one of those years where Indian investors have had to keep a lot of patience, and they have watched the India underperformance. In a year when markets like South Korea have rallied 70%, we have a paltry, 6-7% on the index to speak of. Do you see that changing in 2026?
I don't see a short-term change to it. So we've got a number of factors at work here. We have an ongoing trade dispute between the US and India, and the rhetoric on that still seems to be pretty hot, with issues around rice more in the last week. So the risk is that the rupee, which has broken through 90, could continue to weaken, will certainly remain one of the weakest Asian or even EM currencies. Because of this trade dispute. I think the other factor to be aware of, you talk about the move in Korea. Well, Korea's been a big beneficiary of semis related to AI, plus some of the heavy industries in Korea are defense spending companies. So it's been sitting with a market that plays on some of the key themes. Unfortunately, the Indian market has a very low exposure to the AI story. And yes, I appreciate that you've got your TCSs and your emphasis, etc. But AI could be a bit of a double-edged sword in that AI does the programming, and maybe you need fewer Indian programmers working for those companies, sitting in US businesses or supplying US businesses. So for now, I think, unfortunately, India's underperformance continues. And what we'd like to see is a reduction in the noise level around the trade dispute with the United States to allow the rupee to stabilize. Now, the bull case for India is, as people have discussed already, there is an acceleration in earnings growth going into next year. The market has derated a bit, although it could derate more, still being one of the more expensive EMs. So for now, I don't see a catalyst for a change in this underperformance.
Oh, okay. Well,
I just don't see what it is. Yeah.
You're calling it out as you see it. Absolutely, take that point. But I want to discuss this one by one, some of the factors that you laid out, starting with the trade deal that just didn't happen through the year, and we're almost rounding up 2025. In fact, allow me to bring in our colleague Abhimanyu into this as well. In fact, yesterday, the Indian Commerce Minister, Mr. Piyush Goyal, did make a comment on this. And he said that India cannot negotiate, with deadlines limiting those negotiations. Listen into those comments.
I've said many times that all agreements, all discussions have many different angles. Many dots have to be connected. And we never negotiate deals with deadlines. Thank you.
So that's what you heard. We also heard from the U.S. Trade Rep Jameson Greer yesterday. He was saying that, negotiations are tough, but they're ongoing. And there's a U.S. team that's been in New Delhi to take the negotiations forward. Now, where have things reached? Let's go across to our colleague Abhimanyu to find out. Abhimanyu, what is the latest?
Well, the negotiations are still underway. India and the US, both their teams are still talking in New Delhi. Now, this is not an official round of negotiations, not a formal round of negotiations, but all pending issues on the table are being discussed. All pending trade issues, including the issue of tariffs, which currently stand at 50%. Now, 50% tariffs also include 25% reciprocal tariffs. And despite the imposition of these tariffs in the first half of this financial year, there has been an uptick of 13.3% in India's exports to the United States. States. However, this also includes the time when tariffs were not levied. So, of course, post-levy of the tariffs, there have been concerns which have been increasing for several labor-intensive exporters, particularly in segments like leather and textiles. And many such exporters are already running thin as far as seeking opportunities in other countries is concerned. Now, speaking about other opportunities being looked at, they are trying to diversify into different markets, which cannot happen overnight. Meanwhile, the government is negotiating for the interests of not just these exporters, but also for the interests of farmers and fishermen across the country. And it has been repeatedly stated by the government at several levels that no interests are going to be compromised, particularly of farmers, fishermen, and even small traders for that matter. So speaking about market access, which the US is looking into the Indian market, these, of course, would be several issues which are going to be discussed. There are, of course, red lines, as earlier indicated too by the Commerce Minister. Meanwhile, India is also looking to diversify its oil import sources, which includes the possibility of increasing imports of crude oil and natural gas from the United States.
Yes.
So there have been such discussions also, which the Commerce Ministry has undertaken till now.
Absolutely. That's been India's stated promise that we will be increasing our energy imports from the US. But we need more clarity. Abhimanyu, behind you, I see a lovely, clear New Delhi day. But as far as those trade talks are concerned, we definitely need more clarity. Thank you for that. So, Adrian, to sum this up, and I take your point that the underperformance here could continue. FPIs have sold off almost $18 billion worth of Indian stocks here, right? But on the AI bit, now that's where we Indians are beginning to, notice global developments with a lot of caution. Overnight, we had the Oracle stock falling 10-11%, right? Do you expect global investors will want to diversify a little away from AI, including all the Asia AI plays as well? And if that happens, could you see some tweaking of portfolios? Are you hearing any conversations saying, okay, let's allocate a bit more to India, it's underperformed, and we need to diversify?
I think we've got to remember the starting point here was India had been outperforming for a number of years, with particularly big markets like China and to some extent Korea not doing so well. So we're probably still in a process of people reallocating out of India into these other emerging markets. And the level of underperformance, year to date, is about 30% for MSCI India in US dollars versus the MSCI EM and the China index. So that's a big number, and a very painful number if you haven't got a proper underweight in India running a global EM portfolio. There is a chance that the AI story starts to lose some momentum and you get a more significant correction. And, Oracle does have a very poor balance sheet, and you can see its credit default swaps beginning to reflect that. The underperformance of Oracle, particularly when it's announcing data center numbers that are a bit disappointing. But at the same time, we've had some very good news out of Alphabet or Google, where their chips are seen as potential competitors to NVIDIA. Their numbers are very strong. The share price sort of has hit 310, continuing to move higher. So I don't see the AI theme coming to an abrupt end. Definitely at individual levels, there are stocks where they're maybe overvalued, not pricing in some of the balance sheet risk. But Oracle is kind of the exception there. Most of the other balance sheets of these Mag 7s are very, very healthy. So for now, I think you have to keep on running the AI theme. And the chip stocks, the semiconductor stocks in Korea are actually very cheap on P multiple basis, on price to book basis. Now you could say, well, that's top of the cycle, but they are inexpensive. And even a TSMC, which has basically the monopoly on high-end chips, is probably fair value at these levels.
So hearing you, I don't get the sense that anyone's getting out of the AI plays out of Asia anytime in a hurry. So I think we'll just have to wait, and maybe the reset for India will have to happen in the form of that trade deal and better earnings here. And that's the hope with which we enter 2026. Adrian, it's been a great conversation. Thank you so much for taking out the time. Pleasure having you on the show today. Thank you.
Thank you.
All right, with that, we are out of time on this edition of the show. Many thanks for watching. We'll see you again tomorrow.
Fly Emirates, fly better.
होम EMI 50,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है? पूरे सीलिंग का 20,000। आउटगोइंग है जा रही, आपकी क्या तैयारी?
मौसा जी, मेरी शादी का गिफ्ट।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIP के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWP के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपने दिल के हिस्से की सेफ्टी से समझौता? नो चांस। इसलिए पॉलीकैब ग्रीन वायर्स, जो है लेड फ्री और इमरजेंसी में दे कम टॉक्सिक गैस। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
तेरा ये बिजनेस एक मास्टर स्ट्रोक है यार।
है ना? पर मुझे लोन कौन देगा यार?
ओह गॉड, सचिन।
सचिन क्यों देगा मुझे लोन?
अरे मैं नहीं, बैंक ऑफ बड़ौदा देगा तुम्हें MSME लोन। बॉब डिजी उद्यम के साथ 100% डिजिटल प्रोसेस, अप्रूवल इन मिनट्स। बैंक ऑफ बड़ौदा से MSME लोन लेना भी एक मास्टर स्ट्रोक है।
Tooth enamel is very important and you need it for life. So enamel is the outer layer of a teeth. Enamel is like a shell. Did you know a lot of what we eat every day has acids that can damage your enamel? Erosion of enamel could lead to multiple dental problems. I recommend using Sensodyne Pronamel daily. With over 20 years of research, Pronamel is formulated to give you 2 times stronger enamel protection. Pronamel, it's pro enamel.
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
This is Network 18. And you're watching CNBC TV 18 Prime.
In markets yesterday on the back of the decision and the conference is that there were rumors swirling we could see up to 5 dissents, people who voted to hold rates steady. That's not what we got.
We saw
2
6
dissents.
of 19, didn't we, or whatever? Not including the voters, the non-voters.
Well, exactly.
Yeah,
so
yeah.
including the voters, you got 2 people voting to keep rates unchanged. And then you got Stephen Mirren.
Who wants them at 0, basically, or something like that.
Yeah, he probably wouldn't
something
mind
near 0
rates.
would be fine, yeah.
But yeah, so maybe, I mean, when it comes to the market reaction, this was a so-called hawkish cut, but was it a more dovish, hawkish cut than the market had been expecting? That's what it sort of seems like.
I've had 2 raps in my ear, better listen. I'm back. You don't expect me to behave, do you? The Fed delivered an expected interest rate cut, as we said, reducing rates by 25 basis points to the lowest level in 3 years, with its statement citing increased risk to the employment outlook. But the decision exposed divides within the central bank. 3 policymakers dissented on the decision. I think we might have mentioned that. For the first time since 2019, 2 saying rates should have been kept on hold, and Trump appointee, the aforementioned Stephen Mirren, calling for a 50 basis point move lower. That uncertainty was also clear in the all-important dot plot projections, where 6 of the 19, we've kind of mentioned this, but it's great, isn't it? 6 of the 19 FOMC members indicated they supported a hold in this meeting. Now, for 2026, the median forecast showed 1 rate cut, in line with September's projections, but 7 members supported no further easing, whilst 1 suggested rates should be 150 points lower than where they are currently. I can't even, who the heck could that be? Who could that person be? Fed Chair Jerome Powell said the Fed can wait to see how the economic outlook develops.
When the risks to the 2 goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. We've now cut a total of 175 basis points. And as I mentioned, you know, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
I'm more interested in how the Treasuries perform because I had some brilliant conversations in the Middle East, actually, about people's appetite for Treasuries, and that's exactly where you want to be looking, where the appetite is as well. Anyway, cut a long story short, the 2-year trading at 3.53, the 10-year 4.123. In coming chosen episodes and conversations, I'll tell you a little bit more about some of my findings about people's appetite for US paper. The Fed also announced on Wednesday that it will buy $40 billion in short-term Treasury bills over the coming month in an effort to stabilise funding markets, just weeks after ending its QT program. Mr. Powell said the move will not mark a return to large-scale debt purchasing and is not being used as a monetary policy tool.
Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves.
And the dollar has done this, 116.88 on the euro-dollar pair. The pound, steady as she goes. But yeah, for all the rancour about how bad people thought the UK budget was, the pound hasn't moved an inch. Wasn't that bad for the markets, was it? All you naysayers. Anyway, just saying. What else have we got? Dollar yen trading at 155, 156 as we are. Would you like to talk about the market reaction?
I think it's worth taking a look at them. Let's take a look at U.S. equities. We ultimately had a strong close to the trading session. All three of the majors ended higher. The Dow added about 1%. The S&P 500 added about 0.7. The Nasdaq added 0.3%. So the market reaction to the Fed decision, pretty straightforward. A bullish reaction in equity markets. And as Steve just walked you through, we saw yields move lower across the curve in the U.S. We did see a steepening of the yields curve, though, so bear that in mind. Now, in terms of the tech trade, it wasn't just the Fed that drove the narrative at the end of the session yesterday. Into extended trade, we had Oracle numbers come through and essentially drive concern around using debt to fund AI build-out. That was a story around Oracle and the shares selling off in extended hours. You can see the stock down about 12%. Overnight, and that has had an impact on Asian tech trade. So let's take a look at some of the key players in Asia. You've got SoftBank shares down almost 8%. You've got TSMC also coming off about 2%. SK Hynix off almost 4%. So clearly there are jitters around how some of these companies are funding the AI build out. Now, in terms of Asian markets more broadly, here's a look for you at the major indices. You got the Nikkei 225 off almost 1%. The Shanghai Composite also trading lower by about 1%. So we're not seeing the move higher that we saw in U.S. trade at the close of the session yesterday filter through to Asia. And also for Europe, let's take a look at futures and where they stand right now. Interestingly, we're also looking at a pullback there. So Europe following Asia lower in contrast to the U.S. markets ending the session higher yesterday. So that divergence, certainly something we'll talk about throughout the show today.
Well, we heard exclusively from the Bank of America CEO Brian Moynihan in the wake of the Fed's decision yesterday. He told CNBC he expects to see further easing next year.
We get in this great debate about a quarter here, a quarter there. But if you think about it overall, there's not a lot of debate about getting it down around 3%, but no lower. That people have to focus on because that's a different rate environment that will have a 3%.
Peter Rupert. Rupert is a professor of economics at the University of California, Santa Barbara. Oh, my goodness, sir. Thank you for joining us in Santa Barbara at a terrible hour. I mean, you should be out partying, sir.
Happy to be here.
You're very kind, Peter. Look, Peter, what do you think about what we saw in the last 24 hours from the Fed?
Yeah, I listened to what you said. I understand the dissent idea, but, it's not normal. So that's the difference between, here and in the UK. And especially seeing the kind of dissent that we saw. And you're right, it was probably expected. But, if you read, and, I hate to do this, but I'm just going to really quickly read just two sentences from the statement today. Available indicators suggest economic activity has been expanding at a moderate pace. I'm going to skip through. And inflation has moved up since earlier in the year. Any other time, if you read those two sentences in the same paragraph, you would say that either they were going to hold it steady or raise rates because the economy is doing fine, inflation's up, and, so those kind of things indicate that it's probably not the time to be lowering rates.
Yeah, do you know, this is really exciting for next year, isn't it, Peter? Look, we know that what Trump has been calling Jay Powell and the FOMC as well. I mean, I can't help thinking this is the battle that, I mean, it's ongoing now, but when the Fed chair's term ends, and of course he's still going to be on the FOMC, potentially, on May 15th, is that when the real battle starts, Peter, and that's when the markets need to be very careful?
I don't think so. I mean, at the end of the day, there's 19 people are sitting around the table. Only 12 of them vote. That's for sure. And the chairman, typically what they try to do is they want consensus. Now, why they want consensus, I don't know. There's many times where there's dissent. But I think that, nobody can come in and say, I want to lower rates by, 100 basis points. That would not work, And so I don't think that's going to be a big change. The people sitting around the table are very smart, very adept at using these things. And I don't think that, any one person, including the chair, can make those kind of judgments.
Good morning. Really clear that those two parts of the statement that you chose to highlight. And you mentioned that at any other time, if those two things were true, that we would not see a Federal Reserve cutting interest rates here. So what are you implying about what's different this time around?
I think that there's a lot of uncertainty out there still. And if you read some of the statements from some of the members, over the past few months, that uncertainty is playing a big role. In my view, that the job of the Fed is really job one is to control inflation. I know they have a dual mandate, but they're not close to 2%. It's been rising, and if you look at the dot plot, which by the way I think they should completely get rid of because it actually doesn't tell us a damn thing, in the sense that if you look for 2026, the members are saying it's going to be somewhere between 2 and 4%. That's just not very helpful. I mean, okay, we got it, and so I think that, at the end of the day, it's really about the Fed's main role. They can't control things like really unemployment and things like that. That's a much different ballgame. They have a little bit of control over inflation. They haven't hit 2%. They're not close to 2%, and it's not trending toward 2%.
Well, on the inflation point, the official statement described inflation as somewhat elevated, but Powell didn't elaborate on that in any meaningful way in the press conference. He sort of brushed off the inflation risk as stemming from more from the goods side and tariff effects. How do you think about the risk here that inflation does take off next year, and the risk that the Fed has been not only complacent but perhaps dangerous with cutting rates here?
No, I completely believe that. I think, through right around COVID, I think the Fed made some very big mistakes. I think they kept the rates too low for too long, and we saw inflation rise pretty quickly. It got up to 6, 7, 8%, which, was pretty bad for our economy. And it's much harder to kind of start bringing it down. So, I don't like to see the Fed, again, making the same mistake that they made before, in keeping rates too low for too long.
Peter, I'm loving this conversation. I am beginning to have a lot of conversations with people worried about the longer end of the curve. And if, despite all of those safeguards you mentioned about the components and how many FOMC members there are to act as safeguards for irresponsible policy, despite that, if rates are moving too low, too quickly, and for too long, people are beginning to worry about the appetite of paper at the medium to long end from conversations I'm having. So actually you could be in this strange situation where rates are going down, but actually the yields on the longer end are actually staying roughly where they are or not moving down by the same proportion. Is that something that is on your radar, or actually not something to worry about?
I don't think it's that to worry about too much. I mean, I think that, the yield curve in lots of ways gets a little bit too much play, in the sense that, people are worried about an inverted yield curve. And it really depends on reasons why the curve is moving that way. If you believe that it's a view that there's going to be a recession in the future, that's one view of the yield curve, how it could change. On the other hand, if your view is that the Fed is in control, they're setting expectations in the right way, then actually even an inverted yield curve isn't a big deal for the reason that the longer term is going down. So it really depends on your view of what's driving that long end.
Peter, let me follow up then. The Fed isn't in control necessarily of the demand of others, the largesse of others as well. And when I see yield curves picking up in places such as Japan, on the JGB and elsewhere, then people begin to question the carry trade. Again, something I guess you're not that concerned about.
I mean, the carry trade is obviously, important. I think that, that whole side of things on the investing side and it's not something really the Fed should be too worried about. I'm not saying that we shouldn't be worried about it, but the Fed's job is pretty clear in terms of inflation, not really about climate change, the yield curve. Those things affect it, of course, but if the Fed did its job, controlled the inflation and expectations of inflation, as you said, they can't control what the rest of the world is doing, and the yield curve is going to do what it wants. But the Fed really has to keep its eye on the ball.
Peter, let me just wrap up the conversation by moving away from rates and the decision we got yesterday and on to the Fed's announcement around beginning reserve management of purchases of Treasury bills. This seems to have come as a little bit of a surprise here, and it marks the first time that the Fed is going to be expanding the size of its balance sheet since ending QE in spring 2022. Now, obviously, this isn't outright QE here, but how significant do you think this announcement was?
I actually think that was a big change. Yes, I think it's very significant. I think that, when they announced, a while back that, they were not going to be, increasing their purchases, they were going to be shrinking the size of their balance sheet. I think people took that to mean that, we weren't going to be doing something like QE or something like, more stimulus or whatever you want to call it. And I think that was very important, which helps people really think about, inflation, in that the Fed is going to stay back. And if you look at the Fed's balance sheet, which I'm sure you have many times, before the Great Recession, it was about an $800 billion bank, and then it got to be like $8 trillion. And the Fed does not want to be holding mortgage-backed securities, nor should they. The Fed shouldn't be involved in these long-term securities and the other things that it does. I mean, the history of the Fed was all short-term securities, and playing the game, like I was mentioning before, of trying to fix the yield curve doesn't seem to be a useful venture for the Fed.
Mm-hmm. Peter, we thoroughly enjoyed the conversation. Thank you so much indeed. It's not that late, is it, where you are? It's only about 11:15. But no, not too bad as well. Well, thank you very much indeed. I'm really not lucid at that time, but thank you. Peter Rupert, who is Professor of Economics at the University of California, Santa Barbara as well. Mind you, I'm not particularly lucid any time, am I? We will hear from one of the Fed's dissenters on CNBC. It's Austin Goolsbee, the Chicago Fed president. Do not miss that exclusive conversation at 1:30 London time. Tomorrow, he says. Yes, tomorrow.
We are looking ahead to more central bank decisions from across the globe. The ECB, Bank of England, and Bank of Japan are among those with meetings next week, while the Swiss National Bank will reveal its decision at 8:30 London time this morning. Carolyn is going to be speaking to SNB Chair Martin Schlegel today. You'll be able to check out that conversation on CNBC.com. Coming up on this morning's show, UK Chancellor Rachel Reeves admits leaks ahead of her budget were damaging. We'll discuss after the break. Plus, Oracle shares sink following weaker than expected second quarter revenue. And we'll look at the outlook for crude and the IEA's monthly oil market report. That conversation at 9:45 London time.
You want to talk business? Meet me in the On-Board Lounge.
आपके कलीग्स भी आपका परिवार है। इनकी सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैब ग्रीन वायर्स। इनके सुपीरियर इंसुलेशन इमरजेंसी में दे कम धुआं। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे पार्टी हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान।
आराम से आराम से। हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी।
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये हाँ। आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है? टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
We are everyone, but we are not just anyone. We choose progress over pressure. We say no to shortcuts and yes to the strength of discipline, to the pride of planning, to the thrill of watching our future take shape little by little. We are citizens and you can be one too. Sip karo, citizen bano. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
वाह भाई बिट्टू, वीकडे पे कोडर, वीकेंड पे ट्रैवल इन्फ्लुएंसर, पैसे बनाने का मास्टर स्ट्रोक सीख लिया तूने।
वैसे एक सेविंग्स अकाउंट ओपन करना है जो फुली लोडेड हो। पता नहीं कहाँ ओपन करूँ। सचिन, ये कौन सा बैंक है?
अरे मैं बैंक नहीं हूँ। बढ़िया सेविंग्स अकाउंट के लिए बैंक ऑफ बड़ौदा का मास्टर स्ट्रोक लाइट सेविंग्स अकाउंट है ना, तुम्हारे लाइफस्टाइल के लिए परफेक्ट है, विद ग्रेट फीचर्स एंड बेनिफिट्स। बैंक ऑफ बड़ौदा में सेविंग्स अकाउंट ओपन करना भी एक मास्टर स्ट्रोक है।
Exquisite comfort, bespoke hospitality, culinary excellence. Big words, huh? Trust me, the experience here is far bigger. That's Air India now.
I previously said was necessary. This wasn't true.
The UK housing market is showing fresh signs of cooling following the autumn budget. A new survey of chartered surveyors has revealed homebuyer inquiries have fallen at their fastest pace in more than 2 years, and that the leaks and uncertainty in the run-up to the budget added to the slowdown. One of the key measures announced was a new annual tax on homes worth more than £2 million. The latest economic forecast from the British Chambers of Commerce found that the budget will do little to kickstart the UK economy and that medium-term growth will remain subdued. The BCC says the government should maximize the AI rollout and seize global trading opportunities to lift the economy out of its low growth cycle. Ritika joins us now in studio. You might have got a glimpse of her in the opening just a couple of moments ago. Ritika, if the British Chamber of Commerce is saying that the budget is not going to do a whole lot to kickstart growth, I mean, what does that say about the government's initiatives more broadly when Rachel Reeves has defended all these measures, defended their overarching policy as being one that is pro-growth? They say that's the priority for the Labour government.
You know, Juliana, I can't say that I'm too surprised that the BCC is saying that her budget is unlikely to be a game changer when it comes to UK growth. The OBR has said something similar. I can't say I'm too surprised by this because there wasn't really a whole lot of pro-growth policies within her budget. It is ironic, though, that a Chancellor who has positioned herself as very pro-growth hasn't really put a lot of these policies into a budget. A lot is going to be made of that figure, the tax burden, of course, rising to the highest since World War II, 38% of GDP. But arguably, the bigger issue, again, is that the budget was not doing enough to boost growth. Today, that is the biggest challenge facing the UK, arguably. And I spoke to Vicky Price. She is the chair of the BCC Economic Advisory Council about the structural constraints that's dragging the UK down. Take a listen.
think one of the problems is the one that highlighted, which is investment. There hasn't been sufficient investment in the UK, both from the public and the private sector. If you put it all together as a percentage of GDP, fixed investment is considerably lower than all the G7 countries, which is an issue that has kept productivity low for quite some time. We haven't recovered, which is also what the Office for Budget Responsibility that produces this forecast for the UK has said. We haven't recovered from what happened after the financial crisis, where we had austerity, very low productivity growth. And then, of course, we had Brexit, which affected the UK negatively. Then we had COVID. Other countries have suffered those later crises as well. But we seem to have carried on this low productivity period a lot longer than others.
So that's Vicky Price of the BCC there, saying that there's not enough investment in both the public and the private sector in this budget. A lot of the growth coming from the big spending and the low productivity. She's talked about coming a permanent issue here. Now, if we talk about the budget, of course, there was some good news in that the Chancellor was able to nearly double that headroom, nearly to £22 billion. She stuck to her fiscal rules. There were some disinflationary measures in there. But beyond that, it was hard to be a whole lot more optimistic. The BCC forecast being that growth downgraded next year to 1.2%. Business investment, they say, to fall significantly to 0.9%. Unemployment to rise further. So a lot of issues here, really, for the UK economy.
It's about confidence. It's like...
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
बिजली का बिल 5,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है?
रूट कैनाल 25,000।
आउटगोइंग है जा रही, आपकी क्या तैयारी?
सीनियर क्लास की फीस
1 लाख रुपीस।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIP के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWP के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपनी लाडली की सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैप ग्रीन वायर्स। इसमें है 99.97% हाई कंडक्टिव प्योर कॉपर। ये साधारण वायर्स के मुकाबले जल्दी गर्म नहीं होते। पॉलीकैप ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान।
चलो चलो AI से पूछते हैं। Do fish get thirsty? If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
Well, the best time of day ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
This is Network 18, and you're watching CNBC TV 18 Prime.
Hello and welcome. You're tuned into CNBC TV 18 Prime. Let's get cracking on a brand new edition of The Big C from CNBC TV 18 Prime Ionic Wealth Studio. I'm Manisha Gupta, back with your daily dose of commodities, crypto and currencies. As always, before we head to our guests, here's a quick look at the action that unfolded in the global markets. Stocks on Wall Street closed Wednesday's trading session slightly higher on the back of the Federal Reserve's decision to cut interest rates by 25 basis points. The Dow gained nearly 500 points, while the S&P 500 added nearly 50 points. The tech-heavy index Nasdaq surged up by nearly 80 points as well. Meanwhile, the markets in Asia-Pacific are trading mixed, giving up early gains that we saw the day start with after the Federal Reserve delivered its third interest rate cut in this year. Back home, the Nifty has climbed to the day's high, inching closer to those 25,900 levels. Take a look at the crude oil prices then, and they have paired the previous session's gains as investors weighed prospects of supply disruptions against a generally bearish crude outlook for 2026. The U.S. has interception of a sanctioned tanker near Venezuela, prompting a pullback on shipments from the South American producer. And it also highlights fears of escalating tensions. On the money market front, the Indian rupee has slid back yet again to near its record low levels, even as prospects of a trade deal between India and US are as of now awaited. But it is the precious metals that continue to shine, and silver has hit an all-time highs at $62.50 an ounce, with the key trigger being the Federal Reserve's interest rate cut decision that was widely in line with expectations. In India, the domestic prices are set to cross 2 lakh rupees per kg, tracking the gains in the international benchmarks, and continued strength also in the industrial demand therein. Take a look at the gold prices, and they are holding above those $4,200 an ounce mark as well. Joining us then on the show is Jörg Kiener. He's Managing Director and CIO, Swiss Asia Capital Singapore. Jörg, hi, thank you so much for joining in. And I want to start with silver first, because that clearly seems to be making headlines right now, outperforming not just gold, but various other commodities and asset classes in the being. How are you looking at silver at 62.5, almost 115% higher in this year till time?
It's certainly been one of the best performing assets this year, but woken up actually really late on the year. So it's been sleepy for a very long time. And don't forget, we just taken basically the 2011 high up of $50 about a month ago. So it's still a very young bull market, and it's driven basically by supply constraints.
Jörg, what is your sense? Would you say the silver rally is done, or is this just the beginning?
I think your $60, which we've taken out, has now become your new support. I think we might be consolidating here a little bit, and I'm looking at significantly higher prices going into 2026.
Are you looking at much highs from here? Because various global banks and brokerages seem to be talking about 65 and 75 and a possibility of $100 an ounce in the next 2 or 3 years. What is your own sense?
Look, I don't know how high the price is going to go. It's a tiny market. So we have an incredible big number of outstanding derivatives, which need to cover in an environment like that. It's becoming costly to be short. And short squeezes can always go much higher than what people think. So moving into the periods of probably 68 in the short term is probably not too far away. And then for next year, we'll see how high we're going to go, but probably significantly higher.
It's been a long time that we have seen any meaningful correction in silver. The rally started in October 2023, and it has been a progression of newer, higher highs. Do you see any chance at all of a profit-taking or correction? So when you have to put a range out for silver and not exactly targets, how do you look at silver then?
Look, there are some people who believe we might go back down to 50, basically the old breakout level. I don't think we're going to go back down that level anymore, because the outstanding shorts which need covering are just too big. So if you do that, it might be, a glitch in the system, basically, but not really by demand supply or by covering delivery structures, which are going to be squared, which we tried already when the exchange closed in United Exchange. And they closed in quite a few books, and despite that, the market continues to go up, and this is a typical sign of a very fundamentally driven bull market. So 60 is probably the new support.
All right. Jörg, how would you read the latest reports on how China perhaps is going to restrict exports starting 1st Jan 2026? Not just silver, but various other metals as well. And this is as they prioritize their own consumption, also safeguarding perhaps critical minerals, etc. How would you look at that impact going forward?
So if you look at statistics and you look at AI, which is in everybody's people's mind, then you actually realize that AI might require a lot of silver, probably about 3 times as much silver as we used to have in other electric application. So that's about 350, 400 million ounces of silver, which are going to be taken up over the next 3 or 4 years, more than what we have today. That's basically about half the yearly production. And that means anybody who wants to be in that space and has visions on how to compete will have to build inventory. And that makes every short in the market actually trying to cover. So the setbacks will be very, very short as people are building up inventories to be prepared actually for the requirements for military and AI applications.
Jörg, every market has to, at some point in time, consolidate, stabilize, correct even. When it comes to silver, almost all fundamentals still point to a very volatile and higher prices from here. We hear of short squeezes, as you just talked about, and then a very, very strong industrial demand. Yeah. How much longer do you see this rally continue? 25 we've seen. Is it going to go on in 26 and 27? What is your longer term view on this?
Look, I don't know if you go into 27, 28 or 2030 in this market. It depends how quickly it's going to run. But look at the old silver rallies. I mean, we had a rally which went from 350 to 50 in 2.5, 3 years, basically, twice in the last 40 years. So that's like 8, 10-fold, 12-fold your money. And right now, we basically just about came out of the old resistance level, and people think it's already overbought. It's overbought by moving averages, but not by the fact that the market is tiny, and the bull market in tiny markets are always explosive. So there's a long way to go. I don't know how big the corrections will be in between, but I think it will have to go significantly higher to have an impact for people which have inventories to let go.
Yeah, the other point about silver also is about investment, family houses, institutions, speculative money. All of that seems to be coming in silver. I get your point. We are still below, record levels, whether in ETFs or physical buying for that sense. But a lot has moved in silver, would you say?
No, not really. I think I hear a lot of people talk about it, but if I really look at the volumes as such, not really. And we start seeing that people are offering significantly higher prices to cover the shorts. And I don't see that we covered the shorts yet. So I think there's a long way to go in order to get a sharper, deeper correction, which is lasting thereafter a bit longer. So we're going to move quite a bit.
All right, that's a very, very bullish. You're keener on silver, but what's your sense also on gold? Because all-time highs here and maybe 45 times in this year is when we made newer highs. 60% plus kind of moves here as well. Is gold just consolidating? And what is your sense on this one too?
Look, gold has been the darling until about 2 months ago. And the last 2 months it's been silver. So gold is always the first mover, followed by silver and then the palladium platinum group. And then we start moving then on the end into copper, the base metals. And once, the last big commodity moves are coming into energy and coal and bulks, then probably we run into the bull market. So until we start seeing that, we have only short-term consolidation, sideways moves, not big corrections, and the trend which could be going up until we start seeing the heavy, big bulks basically peaking.
Yeah, would you have a target or a range for gold in 2026?
Look at it's only 12 months. It's really relatively short considering we moved already so much this last few years. But let's look at if you want to cover M0 in the United States, we need about $9,000. And will we do that in 12 months or 3 years? I don't know. But I'm looking at basically about these numbers to be achieved before we're settling into an environment where we have stability.
Well, that's about gold and silver, Jörg, but we have to go for a very, very short break. When we come back, we want to ask Jörg Keener about the energy markets and, of course, dollar index, because that has seen an 8% decline in this year. How would it be next year, and how would that impact commodities after this very short break?
Two hours of staring at clouds.
2 hours of staring, yes. But binge watching your favorites on this window? Bro.
I love this window.
That's Air India now.
In the future, AI will use massive amounts of energy. So what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
Thank you.
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान।
आराम से आराम से। हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी।
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है? टिफिन लाए।
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
We are everyone, but we're not just anyone. We choose progress over pressure. We say no to shortcuts and yes to the strength of discipline, to the pride of planning, to the thrill of watching our future take shape little by little. We are citizens, and you can be one too. Sip karo, citizen bano. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You're with us at the Big C, and Jörg Keener continues with us. Jörg, you spoke about copper as well, on how we've seen money rotating from one to another and how it continues to be a bull market. But when it comes to copper, and we've seen an all-time high into this one, aluminum is trading at a multi-year high. There's a lot of support that we've seen in zinc come in 2025 also. How are you looking at the fundamentals for this? And as you said, is there an expectation that the base metal prices will continue to surge from here?
I think, if you look at commodities and you use the CRB index as an example, and you compare it with, let's say, the Dow, and you start realizing we've basically gone 90% down versus the Dow over the last, 14 years. So we have a long way to catch up to actually square that book. And why do I think we're going to do that? We have seen massive underinvestment till about a year ago because people couldn't make any money. So you start high grading, your production gets a bit tired. We've seen a lot of mines which have been in difficulties lately, and it takes time to bring them back on stream. So the market will basically penalize that, and it will re-rate faster until this new production is coming back on stream.
And would you expect all the metals to do well, or do you think the greener metals, especially copper, would perhaps outperform the others, as it has done this year?
I think silver is probably the one which will continue to really run really hard because AI and the green investment is asking for roughly about 350 million ounces of silver supply to get that going. And 350 million in today's production is about 40% more production over the next 3 years, which is required. I can't see that work. So it's going to need higher prices to accelerate new production. And new production is a question of licensing, investments, getting things done. It takes years. So we're going to see that certainly the silver space, we see the palladium, platinum space, we see it in copper for sure. We see it probably in all other metals too, because on the end they're all correlated. And once the index starts turning, you're going to get investment funds coming in, playing the market. So we're going to go at least to the mean level for all commodities. And that's a long way to go for all of them. If you think oil, we are at $60, maybe we fall down to 50 before we go to 80. But if you look, oil is cheap, very cheap, considering we had massive inflation over the last 10 years with trading at a discount. So if you want to have a little bit of purchasing power parity for commodities, they have a long, long, long way to go.
Jörg, while you clearly are very, very bullish on silver and it perhaps would continue to outperform going forward as well, how are you looking at the dollar index from here? Because some support perhaps many of these commodities did get from dollar index and those interest rate cuts. Do you see a repeat of that in 2026?
I'm looking at a failed currency, basically. And the failed currency has been seen on how the BRICS are rearranging their business, where they don't use dollars. Therefore, you're going to have fewer dollar reserves. You're rolling over fewer dollar reserves at the time when America has an investment cycle to onshore. So they need to issue more debt on themselves, which they have to buy themselves. And in general, that means a lower currency or less purchasing power. And it's going to be probably a mix of both.
How would you also look at the interest rate trajectory going forward, Jörg?
In a way, when you start having to rebalance the global structure in finance to that level, the only way you can do that is by actually supporting it so you don't have a recession, because restructuring means always headwinds. So we're looking at governments to print much more money. So debasing more money, and that's creating actually an inflationary support wave in that environment. And that means you as an investor who then looks to park money, is getting really difficult which way you want to go. And then you see the United States, which recreates its own currency. And the question is how we do back the short end and how do we back the long end of the treasury at a time when maybe foreign demand out of Asia will slow down. And that creates, in general, higher interest rates, particularly on the longer end. And that creates havoc in today's environment. So the only way you could do that is monetize even more. That means more debasement and higher prices.
Jörg, we've seen on what's happened with Japan, what with the currency and the yields as well, bond yields as well. But the way we've seen gains come in for euro and perhaps a Swiss franc and even Chinese yuan within the Asian markets did well. And look at the Indian rupee trading at a record lows. Yeah. How have you seen various currencies on why and the way they've done it?
I mean, if you think the US has been lowering interest rates and they're going probably another round lower if it comes to Mr. Trump, to stimulate his economy, at least in the short end. And that means, when you have interest rates now in Japan being higher than actually in the US, why would you take your money in Japan and go back to the US? So we know we have a weak currency, but now we start getting paid slowly but surely more than in the US. So whilst we might still have a bit of a currency crisis, interest rates become attractive for domestic people without having currency risk. So don't be surprised on the end if maybe the yen will have a certain turn. The credit market is already showing in the US that we have problems. So if these problems escalate further, some of that money from overseas might actually disappear on the overnight scene and basically stay home instead of going out in foreign markets and peddle around.
All right. Jörg, I have to talk to you about the crude oil prices also, where we're looking at prices continue to decline. Clearly, overnight has been a bit of a gain with the Venezuela and Ukraine attacks on Russian oil facilities yet again. But we do understand that we are working with a surplus here, not just this year, but the next as well. And that is keeping prices really in check. What are you watching out for in case of crude prices?
Okay, if you look at actually oil, you have so many different prices around the world. We have different quality, we have different supply structure which are dislocating. So when everybody just looks basically at NYMEX or one of the indexes, it's really representative to what people pay on the end. And the answer is probably not. You can probably buy Russian oil at a discount, significant discount. That's probably the floor. But at one stage, the market will start looking at the higher cost because of all this logistics problem we have. Tankers are a problem. We see tanker freights going up significantly. So I would look at maybe the financial market trying to pressurize energy down for another round. But I think that will be a hockey stick structure with high inflation, higher prices going into 26, 27.
And what would a range that you would put out here? Because in this case as well, again, just quoting various other banks as well, there has been a range that talks about 52 on the lower side and then 75 on the higher side.
Yeah, the higher side could be even higher than that. But yeah, 50, 52, somewhere there is probably good support, even if the cost structure of the lower producers are much lower. I think on the end, it's capital investments into the commodity space, which might drive the prices. And if you look at most Wall Street banks like Morgan Stanley, Goldman Sachs, JP Morgan, all of them are coming back and saying you should actually rethink your asset allocation. Today, you have close to nothing in the precious metal market. You have nothing in the commodity market. You're long, basically, NASDAQ AI, which is going through a large investment capital cycle, whilst your energy companies are sitting on double-digit free cash flow. So I would expect that money will start flowing into the space which has free cash flow. And that's probably going to drive prices higher.
Jörg, how are you looking at the natural gas also? Because that seems to be like a lone gainer there. Coal just about turned positive. We've seen heating oil, gasoline prices kind of decline in this year. Of course, natural gas is very, very volatile from where we started to where we stand, an expectation that we could perhaps decline yet again by the time it's March as the winter demand gets done with. But overall energy as a pack, and add in the fossil fuels like coal into it as well, how would you look at the mix going forward?
Look, I think it's driven by policies which are changing everywhere. And who knows if the war finished in Ukraine, we might get gas coming back into Germany. So there might be a great support. At the moment, I can't see that. I think we're still looking at escalating wars. Mr. Trump is against the war and Europeans are pro-war. So I think we're going to find sooner or later a settlement because this war is, from my point of view, already more or less decided. The losses are just too big, and I think it's about time to get into a peace settlement. And that might mean actually more flow from Russian gas into Western Europe if we'll find a settlement. And therefore, it's getting really difficult to predict natural gas prices.
Yeah, a final question, and I want to wind it down with agriculture. While we understand that the inflation has been in control for the last couple of years, especially the current year, but as money does rotate, as there is a pattern there as well, do you see agriculture at any point in time gaining or funds allocation getting in that space as well?
I think we've seen allocation already to cocoa and coffee, the smaller areas, particular things which are being produced in emerging markets, which have been well supported. And I think we have harvest problems. We have as well different ways of exporting them nowadays. So they look quite well supported. The grains, I don't really have a very deep opinion. I think grain depends quite often on the climate, but as well on energy. It's quite costly and energy hungry to produce that. And the third entry on the grain is the Ukraine, which probably will be having a shortfall down the road, and probably with export market if they can't get through Russian territory and their port. So it's going to be landlocked. So that might drive prices in the short term. But I'm not having a very big opinion about where price is going to go, but I would expect quite a bit of volatility.
All right, and that's exactly what we are prepared for 2026 after what we have seen in this current year as well. Yaqeenan, always a pleasure talking to you. Thank you so much for taking us through the whole segment, asset class, that is commodities, and expectations on what 2026 could shape up as. But with that, that's all the time that we have on the show. Thank you so much for watching.
Fly Emirates, fly better.
होम EMI 50,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है? पूरे सीलिंग का 20,000 आउटगोइंग है जा रही, आपकी क्या तैयारी?
मौसा जी, मेरी शादी का गिफ्ट।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIP के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWP के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपने दिल के हिस्से की सेफ्टी से समझौता? नो चांस। इसलिए पॉलीकैब ग्रीन वायर्स, जो है लेड फ्री और इमरजेंसी में दे कम टॉक्सिक गैस। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान्स।
Tooth enamel is very important and you need it for life. So enamel is the outer layer of a teeth. Enamel is like a shell. Did you know a lot of what we eat every day has acids that can damage your enamel? Erosion of enamel could lead to multiple dental problems. I recommend using Sensodyne Pronamel daily. With over 20 years of research, Pronamel is formulated to give you 2 times stronger enamel protection. Pronamel, it's pro enamel.
सर, इतनी बढ़िया प्राइस पे कार खरीदना एक मास्टर स्ट्रोक है सर।
सर, बिना झंझट के मुझे कार लोन कौन देगा?
सर, सचिन?
अरे सचिन सर मुझे लोन क्यों देंगे?
सर मैं नहीं, बैंक ऑफ बड़ौदा देगा आपको डिजिटल कार लोन, एक्सटेंडेड रीपेमेंट पीरियड और क्विक अप्रूवल भी मिलेगा। बैंक ऑफ बड़ौदा से कार लोन लेना भी एक मास्टर स्ट्रोक है। Well, the best time of day ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
Waiting for an opening print. There you got it. Stock 600 teetering around the flat line right now. Worth remembering that in terms of European futures throughout the morning, they have evolved. We started out all futures in Europe, all the major indices pointing lower, and then sentiment improving in the last half an hour or so. So it will be interesting to see how the trading session shapes up. And for context, U.S. markets closed higher yesterday as investors reacted to the Fed's hawkish cut, but some saying there were enough dovish signals in there to support sentiment. But then after the markets closed, we had the Oracle numbers come through, and the lack of transparency around how they're financing their AI build-out weigh on sentiment. That stock down almost 12% in extended trade, weighing on the Asian market, and then this morning getting factored into the European narrative. So let's get to the sectors. You can see on your screens construction materials leading the gains this morning, up about 0.4%. Industrials, chemicals, and insurance also trading higher. On the downside, what's lagging in the early moments this morning? Utils down about 0.5%, technology off about 1/3%. So nothing major in the tech sector, which is notable given that in Asia we've seen the tech names lead the losses there. So a fairly steep sell-off in the likes of SoftBank and others. But so far in Europe, the tech sell-off contained. Of course, it is just the first couple of minutes. Media and banks also coming off a little bit this morning. As far as the regional split goes, here's how the bourses are holding up. You've got the FTSE 100 down about 12-13 basis points. The CAC 40 up about 0.25%. But here, context matters. Yesterday, the CAC 40 underperformed. It dropped about 0.4%. Its fourth negative session in a row. So a little bit of a catch-up trade perhaps in the French market this morning. You've got the Italian stock market trading a little bit weaker, and we are waiting for an opening print on the Xetra DAX. Now on to Oracle. I mentioned this. Obviously, it's a big factor in the overall market narrative. Oracle shares sank almost 12% in extended trade after the database software maker posted weaker than expected revenue for the second quarter as it continues to ramp up its spending on AI infrastructure. Now, here was the kicker. Investors were unimpressed amid a lack of clarity on the earnings call over how exactly the company plans to finance its CapEx plans. Its order backlog, though, soared 438% to $523 billion, driven by fresh commitments from companies including Meta and NVIDIA.
Sharon Bell is Senior European Equity Strategist at Goldman Sachs and joins us. Sharon, lovely to see you. Thank you for joining Juliana and myself. I have a conundrum with long-term forecasts, and so do you, because David Costin last year, just over a year ago, said, we think, potentially over Goldman's, it could be a 3% return per year for the next 10 years. I think year to date, we're up around about 17%, I think it is, or something crazy on the air, 17%. Do you struggle with long-term versus the medium to short-term view on these markets?
The problem with the long-term...
And I know that's, by the way, the US, not Europe.
For sure. It is the US. Look, the problem with the long-term right now is stock markets generally deliver about sort of 7 or 8% return. The S&P has done, I think, more than that over the last 50 or 100 years. So very, very good return. But the starting point is not brilliant right now for investment because you've already seen the market rally, as you said so much in this last year, and valuations are high versus history. Whichever sort of way you figure out your valuation. If you look at price divided by earnings, just classic PE ratio, we're at 22 times, which is the 95th percentile of its history. We're right at those top levels. So the economic backdrop is good, but the valuation already expresses that.
So what do you do? I mean, on this side of the Atlantic, and so that's the helicopter view. Stateside. What do you do over here? I mean, with that as a backdrop, you really wouldn't invest in anything if you kind of were that worried.
Well, I mean, we still think you should be invested, and often quite at the end of the cycle, you can have several years where valuations can stay high. A bit to your point, it's fine to say in the very long term this is sort of a very high valuation mark, but in the next few years you can still do very well. The macroeconomic backdrop is good. The drivers that we have out there, not just sort of macroeconomic cycle, but the structural drivers like AI spend for so many different sectors, not just the tech sector, is important as well. And then here in Europe, we're not as highly valued. We're trading on 14 times PE. It's not super low. It's not like we were a couple of years ago, but it's more average, maybe slightly above average. So I'd say diversification is a way to avoid just concentrated exposure to one or two very large cap companies and themes.
When we think about the European market and the opportunity heading into 2026, how tied is Europe's fate to the U.S.? And should we think about them as correlated or highly correlated, or is Europe likely to emerge as a key diversifier? And actually, we could see some divergence there.
Yeah, look, in the end, all equity markets are highly correlated with each other. So it provides some diversification, not complete diversification. If you see a large bear market, a big correction, you will tend to see all markets sell off. That being said, it does a bit depend on the driver, how much Europe diversifies or how much it is correlated. If the driver is genuine concerns about economic growth, everyone will fall together, more or less. And in a way, Europe may fall more. It's got higher cyclical, economically sensitive companies in the index. But if it's tech concerns, as we've seen in the last couple of days, then actually the US will probably underperform more. And that's exactly what we saw earlier this year when we had the sort of DeepSeek moment hitting the tech stocks in the US. Actually, Europe outperformed. So it did provide diversification.
And what are you thinking about the China-sensitive plays in Europe? It feels like that's one of the biggest open questions right now for investors, how to position around some of these names, because there are some signs that the Chinese consumer is improving. We look at some of the luxury earnings that have come out over the last few months. But how are you thinking about those plays heading into next year?
It's a tricky one because we actually upgraded our China GDP forecasts but by quite a big slice. We took it up to 5% for this year, almost 5% for the next couple of years too. So pretty good economic growth in China, but largely driven by export achievement rather than sort of domestic demand. So for European corporates with exposure to China, what they really want is to see the consumer doing extremely well, and that's the weaker spot in China at the moment. And actually, to the extent that China is exporting more, it's potentially taking share from some European companies. So I think slightly better growth in China, though some of that will come through to domestic demand and the consumer, and yes, probably not as bad as they were earlier this year.
Okay, but nothing to get, when you think about the net effect here, nothing to really get too excited about yet. So how are you thinking about your sector preferences then heading into next year?
I mean, we still like banks. It's been a strong performer this year. It's, I think my only concern about it is that it's quite a consensus trade. Lots of people are in there and have seen it done extremely well this year. We do, though, still expect quite a steep yield curve. We expect good economic growth next year globally. This is a good environment for banks. It's also a sector still on a single-digit PE. We talk about where to diversify away from expensive, concentrated market like the US. Then European banks couldn't be a better diversifier from that perspective.
Sharon, I've already mentioned to one of our guests today that Juliana has to listen to me drone on about whatever book I'm reading at the moment. I'm actually reading two at the moment. I've got side by side, and they're both brilliant. One's Andrew Ross Sorkin on 1929. The other one is this great book, which was the FT Book of the Year Award winner, Stephen Witt, on Jensen Huang. And on that latter book, it starts off talking about Samuel Brannan. Now, you may not know who Samuel Brannan is, anyone, but he's the guy who made all the money out of the picks and shovels for the California gold rush. He's the man. He's almost like the one they allude to when they're talking about Jensen Huang now as well. Samuel Brannan just absolutely cleaned up from selling picks and shovels. My problem with picks and shovels at the moment is that they've got themselves all tied in to the customers and the customer's debt profile and indeed the success of that gold rush, or whatever you want to call it, AI rush, compared with when you just sold them, when Samuel Brannan just sold them picks and shovels. Are you worried about the picks and shovels side of that equation? Because when I look at some of the bottlenecks, there should be some really amazing opportunities.
You know, honestly, obviously, the technology and AI is an entire ecosystem. They're all dependent upon each other to some extent. That's not necessarily a bad thing. As we've seen in the last few years, these companies have done well in terms of earnings. I do think the market is realising, as you point out, that there is more aggressive forms of financing going on now. And there's so much talk about parallels to, say, the dot-com era or other eras where you saw vendor financing, for example. Having said that, you know, I do feel that there's a super awareness in the market. I hardly go to a meeting where someone is not mentioning the word bubble. You know, to me,
I reckon those same people have still got the market.
Yeah. Well, you still see these companies on relatively high valuations, although not bubble valuations. This is the thing. We look at the Mag 7 in the US, those biggest 7 companies, they trade on 25, 26 times PE, which is high, undoubtedly, for really big companies, where perhaps some more aggressive financing is going on. But on the other hand, their balance sheets generally are still good, and that's half the valuation of the top 7 companies in the dot-com bubble. So to me, if it is a bubble, it's a relatively small one versus that period of time.
Can you give us a little bit more color into what clients are asking right now in meetings? Where's their focus as they prepare portfolios for 2026?
Yeah, that's a very good question. I think we've already covered one of the focus. You know, the tech bubble, you know, AI, capex, etc. I think for Europe, it's more. I like the idea of diversifying. I like the idea of finding some value, but where can I find it? In Europe. European markets have gone up a lot this year. We can look at banks, but they've already performed well. Maybe rates are peaking. If they're coming down, then that could be a concern for the bank stocks. So that's a constant question. I would like to diversify, but where can I diversify? Yeah. China's risky, Europe as well. These markets are value for a reason.
And on that point, when it comes to Europe, I mean, you still like the banks, and even so, you've noted that they've had an incredible run so far. It feels like a sort of consensual trade, and yet, if you have been a European investor wanting to diversify, it hasn't really worked out that well unless you're in, banks or defense. It's been a difficult year in Europe. It's been so concentrated, the momentum.
Yeah, I mean, I don't think Europe has been as concentrated as the US, to be fair. But you're right. I mean, there may be 4 or 5 different sectors that you had to be in. What's also been interesting, and this is true on both sides of the Atlantic, correlations between stocks within sectors have gone down. So there's a bit more of a dispersion, I guess, between the winners and losers within sectors. I guess the obvious example would be consumer stocks in the US. Where those facing the lower income consumer are more hit than those facing the middle or upper end consumer. So we're seeing this though in every sector to different degrees, that correlations are coming down. So that should be a little bit of a better environment to go into next year in terms of stock picking.
Underweight autos, the value trap of all value traps or whatever. I mean, people, have you seen those mid-single digit PEs? They're so exciting. You're underweight them still though.
Yeah, I mean, they are the cheapest sector in the market. So if you take
have been for our entire career, haven't they?
Exactly.
Actually, that's interesting. Have they been for our entire career, the cheapest?
Probably had some competition with
banks. If you took out Ferrari and Tesla.
Yeah. So in Europe, in the terms of stock sectors, it's the cheapest sector, and I suspect is rarely not been the cheapest sector. Probably only when its earnings have collapsed, and therefore it seems to appear on a higher PE. But I often say to people, banks is still interesting because it's the second cheapest sector. And then, of course, they immediately want to know what is the cheapest sector, and then I say autos, and it kind of, yeah, okay, fair. But yes, autos, I think, look, some of the premium manufacturers, I think they could, they're already improving models and trying to compete better in China and in Europe. I think that could well come through in the next few years. But yes, I think the competition with China, all the expense of moving to electric vehicles and the uncertainty relating to it, all of that's going to still weigh on the sector generally.
Love the conversation. Thank you. We're not going to say on air, but we're asking all our guests where they're going for holiday, and I've got to be honest with you, if there was a chart at the moment, Sharon Bell would be at the top of it. Have a brilliant holiday season.
Thanks.
We're looking forward to it for you.
You too.
But I won't say any more. Sharon Bell, Senior European Equity Strategist at Goldman Sachs.
Schneider Electric has announced an up to €3.5 billion share buyback, the first from the company in almost 3 years. Ahead of its capital markets day, Schneider also said it aims to increase adjusted core profit margins. Shares of Italian luxury conglomerate Brunello Cucinelli are rising after the firm upped its full-year revenue growth forecast to 12% from its previous guidance of 10%. The firm said sales are strong in markets globally. The stock up by about 2.2%.
Do you know anyone who can afford a Bruno Cucinelli gift?
I do. I think she usually sits in this seat. Who likes a Brunello Cucinelli gift?
If my wife bought me a jacquard turtleneck sweater from Brunello Cucinelli, I'd say she's lost her mind. How much do you think? Sharon Bell's still with us. Welcome back, Sharon Bell.
I have no idea.
Welcome back, Sharon Bell. How much do you think a jacquard, and I have to say it in that voice, a jacquard turtleneck sweater from Bruno Cucinelli is? For a gentleman. A man of discerning taste and a rich wife. How much do you think? Go on, come on. It's the first jumper that comes back. Come on.
I would say 4 digits for sure.
For sure.
Really, you think 4 digits? Wow.
£2,800.
2,800.
But if you're feeling really, and Mr. Tattlebaum was feeling, I'm getting a lot of love from him, he might get a calfskin bag as well.
I'm afraid Mr. Tattlebaum will not be getting that.
3,850 quid. Okay, shall I go on? I will do. Okay, now how about this though? The cardigan, it looks really nice though, and it's got metal buttons. It says here, cardigan with metal buttons. Come on, last time, Sharon, your last comment on CNBC this year. How much do you think the cardigan? It's really nice. It's got the kind of big kind of.
And it's got the metal button.
It's got metal button.
So maybe it starts with 5 and 4 digits.
Oh, very good. It's $4,000.
Sharon's going to be upgrading the luxury sector after this conversation.
I'm afraid Dr. Bao, my husband, he'll be getting M&S. Not the.
No, I shouldn't say it. Right. I mean, goodness me, $4,000 for a sweater.
I feel like this conversation is biased without Karen here defending.
This is one of the
price tags
senior Goldman Sachs bankers, and she's not buying Bruno Cucinelli. Who is it? You're all very rich. That's it. It's all of you lot. Coming up on the show, thanks, Sharon. The Fed delivers a widely expected rate cut, but the decision exposes divides within the central bank. We'll be back right after this very short break.
You want to talk business? Meet me in the on-board lounge.
आपके कलीग्स भी आपका परिवार है। इनकी सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैब ग्रीन वायर्स। इनके सुपीरियर इंसुलेशन इमरजेंसी में दे कम धुआं। पॉलीकैब ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
चलो चलो एआई से पूछते हैं। डू फिश गेट थर्स्टी?
If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
Rohit, we need to talk, okay?
Yes, sir. That's Air India now.
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान्स।
So the Fed delivered an unexpected interest rate cut, reducing rates by 25 basis points to their lowest level in 3 years, with its statement citing increased risks to the employment outlook. But the decision exposed divides within the central bank. 3 policymakers dissented on the decision for the first time since 2019. 2 saying rates should have been kept on hold. And, yeah, you guessed it, Trump appointee Stephen Mirren calling for a 50 basis point move lower. That uncertainty was also clear in the all-important dot plot projections, where 6 of the 19 FOMC members indicated they supported a hold in this meeting. Well, the Fed for 2026, the median forecast showed 1 rate cut. That's in line with the September projections. But 7 members supported no further easing, whilst 1 suggested rates should be 150 basis points below their current level by the end of next year. Come on, all of you, guess who that one was? Done it? OK, we'll lock that answer in. Meanwhile, the chair, Jerome Powell, said the Fed can wait, I beg your pardon, to see how the economic outlook develops.
When the risks to the 2 goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
The Fed also announced on Wednesday that it will buy $40 billion in short-term Treasury bills over the coming month in an effort to stabilise funding markets, just weeks after ending its quantitative tightening programme. Powell said the move will not mark a return to large-scale debt purchasing and is not being used as a monetary policy tool.
Such increases in our securities holdings ensure that the federal funds rate remains within its target range, and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves.
UK Chancellor Rachel Reeves has admitted the leaks and speculation ahead of her autumn budget were very damaging. Speaking before the Treasury Select Committee, Reeves also said the Treasury would investigate how the full budget report was made available online ahead of her speech. One of the major leaks was a report in the Financial Times revealing that Reeves was dropping plans to raise income tax. While that did turn out to be true, the Chancellor said the report falsely implied that she was ditching her fiscal rules. Take a listen.
On Thursday, the 13th of November, there was a leak to the Financial Times about one element of the budget. The leak presented partial and inaccurate information and an inaccurate picture of the budget strategy. The implication that some could take from that story would have been that I had ditched core elements of the budget strategy that I'd set out just a few days before in that speech, and that I wasn't going to build up the headroom that I had previously said was necessary. This wasn't true.
The UK housing market is showing fresh signs of cooling following the autumn budget. A new survey of chartered surveyors has revealed homebuyer inquiries have fallen at their fastest pace in more than 2 years, and that the leaks and uncertainty in the run-up to the budget added to the slowdown. One of the key measures announced was a new annual tax on homes worth more than £2 million. The latest economic forecast from the British Chambers of Commerce found that the budget will do little to kickstart the UK economy, and that medium-term growth will remain subdued. The BCC says the government should maximize the AI rollout and seize global trading opportunities to lift the economy out of its low growth cycle. Ritika joins us now with more. Ritika, flesh out for us what the British Chambers of Commerce had to say this morning.
Yeah, Juliana, the BCC coming out with its economic forecast and saying that the budget is unlikely to be a game changer when it comes to UK growth. The OBR said something similar. I can't say that this is too surprising analysis, because one of the criticisms from the autumn budget has been that there has been very little when it comes to pro-growth policies, which is kind of ironic in a way, because this Chancellor Rachel Reeves had really positioned herself as a Chancellor for growth, but we didn't really see that so much in the budget. Now, a lot is going to be made of that tax burden rising to its highest level since World War II, 38% of GDP. But arguably, what is the bigger issue really of the budget is again about the lack of pro-growth policies that are seen to be much more of a short-term fix. And we're seeing a lot of structural constraints really dragging on the UK. And it's hard to be too optimistic when you look at some of the BCC forecasts. Growth downgraded for next year. Business investment to fall significantly to 0.9%, unemployment to rise further in 2026 as well. Now, the BCC has actually said that one of the ways that they could maybe maximize or increase growth is actually to maximize the AI potential. And I spoke to Vicky Price, who's the chair of the BCC Economic Advisory Council, and this is what she had to say on that topic.
There is no doubt that what we're seeing is that a lot of the benefits of AI seem to be going to just a few big firms. The smaller firms that we do absolutely need to engage and also export a lot more tend to just use AI to just cut down on costs and cut down on labor. What you absolutely need is to get that AI use spread across in such a way that improves productivity in the economy as a whole, and not just in some sectors which perhaps will be able to export more, but at the expense, if you like, of competition from the smaller players. And I think we do need that, and we do need that program to become really entrenched in the economy. I think the private sector has a big role to play, but the government needs to help as well.
That was Vicky Price of the BCC there, talking about the AI and how actually what is needed to maximize the benefits from AI is really spreading that across the economy. So it's not just certain big firms that benefit, it goes across sectors. She also discussed about low productivity in the UK and some of the bigger constraints, structural constraints dragging on the UK economy, and that how we're seeing low productivity really becoming a permanent issue, and that's something she's concerned about.
Well, it seems seems like one of the big questions for investors, for residents of the UK, is what is going to drive the long-term growth picture here in the UK, and it doesn't seem clear. Certainly the BCC would agree with that view. Ritika, thank you for bringing us that story. Coming up on the show, the SNB is set to announce its latest policy decision in just a few moments' time. We'll bring you that as it breaks next.
This is worth sharing.
Faster Wi-Fi on the new Emirates A350.
बिजली का बिल 5,000।
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है?
रूट कैनाल 25,000।
आउटगोइंग है जा रही, आपकी क्या तैयारी?
सीनियर क्लास की फीस
1 लाख रुपीस।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIB के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWB के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
अपनी लाडली की सेफ्टी से समझौता? नो चांस। इसीलिए पॉलीकैप ग्रीन वायर्स। इसमें है 99.97% हाई कंडक्टिव प्योर कॉपर। ये साधारण वायर्स के मुकाबले जल्दी गर्म नहीं होते। पॉलीकैप ग्रीन वायर्स, इंडिया सेफ हैप्पी कनेक्शन।
हमने 2.5 में सोचा था ये।
संजीव,
हाँ?
ये वाला घर पिक करना एक मास्टर स्ट्रोक है।
ये घर बजट से ज्यादा है। कौन देगा हमें बढ़िया होम लोन?
सचिन।
सचिन क्यों देगा होम लोन?
सचिन।
अरे मैं नहीं, सचिन। बैंक ऑफ बड़ौदा देगा तुम्हें बढ़िया होम लोन और बेहतर इंटरेस्ट रेट भी मिलेगा। बैंक ऑफ बड़ौदा से होम लोन लेना भी एक मास्टर स्ट्रोक है।
आराम से आराम से। हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची?
नमस्ते
जी।
हाँ? मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये हाँ। आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है?
टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
Well, the best time of day ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
Inflation near the bottom of the target range, low end of the central bank's 0 to 2% rate. All but 2 economists polled by Reuters in the run-up to this expect the S&P rate to stay on hold. 2 economists expected a cut. So if there's a cut, that's where the real sizzle is going to be. And that's where it'll be exciting when Caro speaks to the central bank governor as well. But I'm waiting. I've got 8 seconds to go. I can barely wait.
They're in a different situation, I think, than central banks, other central banks around the world. Inflation low, not worryingly low, but certainly low. Well.
Shock and horror across the world financial news. Dollar Swissy. Yeah, moving by 0.0003, 004 now as well. Completely unchanged. I haven't seen any more commentary yet. When I do get it, I will bring it to your attention as well. But let's get out to Carolyn, who has A, the enviable task of making this move sound exciting, and B, the really tough task of finding out what Mr. Schlegel thinks next. Hello, Caro. How are you, my friend?
I'm wonderful. Like you, I've been looking for a sizzle here. I haven't found it yet. Maybe my next guest can do that. His name, of course, is Stefan Gerlach. He's the chief economist at EFG. As expected, no change. I mean, that's positive that we're not seeing a sizzle or anything exciting in this report, given that that's what central banking should be. It should be boring, right?
Oh, absolutely right. I mean, central bank is best when it's boring, but there's no need for big changes in policy. So, yeah, it's a good day, I think.
Is the S&P right not to move this quarter?
Yes, I think so. And they also said that they will not go negative. It's okay if inflation is a little bit low for a while. The bar for reintroducing negative rate is very high and so on. So I think people would have been very, very surprised if they had gone negative today. So it's a good decision, I think.
However, Stefan, don't you think that there's a risk of more entrenched deflationary trends, given that some of the CPI prints have been a little more negative than expected?
Yes, but if you look at domestic prices in Switzerland, those services prices and so on, they are powering on. The reason inflation is low is largely because imported prices are are coming down, and that's just so happening from time to time. So one shouldn't overreact to that.
A major headache, obviously, for the SNB and Mr. Schlegel has been the strength of the Swissy and for the exporting sector alike. It hasn't done much against the euro. It's appreciated quite strongly against the US dollar, 12-13% last time I checked. Which one is the bigger headache here?
Of course, for Switzerland, the exchange rate vis-à-vis the euro is much more important. And over a year, it has essentially not moved 1% or something like that. So the move against the US dollar is not problematic.
What is important for the SNB and the Swiss economy, by extension, of course, is the fact that a tariff deal has been struck. We heard yesterday it's been struck retroactively towards mid-November, 15% on par with Japan and the EU. How difficult was it for the Swiss economy when taxes were sky high, or the tariff rather was 39%?
It would at some stage have become difficult, but you have to remember that the Swiss economy is extremely resilient and it reacts very well also to large shocks. Just imagine the exchange rate shock in 2015. We were all worried that this would lead to a big recession in Switzerland, but of course in the end nothing happened. So the Swiss economy is uniquely able to deal with these large shocks. We should not forget that.
But if we take a look at the third quarter numbers, we saw a GDP print of negative 0.5%. That was the first shrinkage in, I believe, 2 years. How quickly is the Swiss economy going to bounce back from that?
I think it will bounce back very quickly, actually, and I wouldn't be too worried about that. I would be more worried if you saw a large increase in unemployment rates and so on. We don't see this. I mean, the Swiss economy is doing well, and if you look at sentiment indicators, there's no evidence of a recession or anything like that. So I wouldn't be too worried about this.
Let's talk about the international context, Stefan. We heard from the Fed yesterday, as expected, cutting by 25 basis points. But maybe more interestingly, we heard from Schnabel from the ECB earlier this week about the next move for the ECB potentially being a hike. How relevant is either that for the SNB?
So it's much more relevant for the SNB what the ECB does than what the Fed does. And Isabel Schnabel spoke about this being the next move, which would happen at the earliest in a year's time or something like that. So it's far in the future, and the future is very hard to predict. But of course, if the ECB were to tighten interest rates, it would impact on the Swiss economy. We will start to depreciate the franc a bit, which perhaps might be something that the SNB would be happy to see.
Yeah, that would be very welcome news for the SNB and, of course, for the Swiss economy. Let's stick with the SNB for a moment. Chair Martin Schlegel, he's been in office for a little bit more than a year now. How's he done? What's your report card for him?
Yeah, I think this is his fourth meeting. I think he's done very well. He has shifted SNB sort of, in some sense, perhaps modernized a little bit. It has become more transparent. You remember they published the summary of the discussions at the last meeting, which I thought was very helpful. Not too much happened in September, so you wouldn't have expected a lot of extra information. But in general, that's a very good move. They publish more speeches on their website. There's a bit more research coming out from the staff and so on. So I think he has shifted the bank in the direction of becoming more transparent, which I think was very welcome. I think he's had a very good year.
And that's been lauded by many of the economists, not just by yourself, of course. Now, when we take a look at the broader toolbox of the SNB, obviously negative interest rates has been one of the major tools been used in the past. The bar to employ those once again is going to be very high. That's what Mr. Schlegel has always pointed out. But then there's always verbal intervention and actual FX intervention. Yeah. How likely is it that the SNB would resort to either of the two?
I think if the exchange rate, if it started to appreciate dramatically against the euro, or if it started to depreciate dramatically against the euro, the SNB is there, and they will start signaling they feel uncomfortable, and they would intervene if there is any need. So they have that policy tool. They have used it surprisingly effectively over the last 10 years, I think. They're ready to use it again, and they manage policy very well, I think. They're very, very credible as a central bank.
Final point for me, we talked about this off camera. When we come back to the currency moves, the Swiss has had a really good year against the US dollar, like many other currencies so far this year, up 12-13%. But there's another currency within this region that's done even better. That's the Swedish krona. Yeah. Why do you think that is?
Well, I think, first of all, the krona has been very, very weak for a long period, since 2013, in fact, and I think this may be a bit of a rebound. It could be money flowing into the krona. I think there are at least some investors that are getting a little bit worried about what happens in the US, the very high asset prices in the US, the risk of some political uncertainty and so on, and that might have diversified the portfolios. And then, of course, the Swedish krona could be one currency that you buy. Of course, you would probably mainly go into Swiss francs or something like that, and we see that in the exchange rate change. But of course, you could also go into the krona.
Stefan, I don't know if you've noticed, but we've got a few bubbles floating around. I don't know if that's an indicator for any currency, any stock market trend, anything out there. I'm not going to ask you about AI bubbles. I know that's not your remit, but thank you so much for coming out here and braving the cold. Stefan Gerlach from EFG. Guys, let me hand it back over to you. I don't know. I'm sure you've talked a lot about bubbles given the market moves today and overnight. Let me hand it back over to you.
Caroline, thank you for bringing us that conversation. Great to see you. We miss you anchoring this morning, but good to have you on covering the SNB. You've got a busy morning because you're going to be speaking to the SNB chair, Martin Schlegel, today. For viewers, you can check out that conversation at cnbc.com. Let's take a look at European markets. We are looking right now at a fairly flat trade. When you look at the index level, the Stock 600 really hovering around the flat line, and that's because we're seeing mixed trade across the region. FTSE 100 up about 3 basis points. The CAC 40 outperforming today after some recent underperformance, up about 0.3%. ADP at the top of the board this morning at the Stock 600. It's the best performing stock in Europe. Xetra DAX under a little bit of selling pressure, down about 17 basis points, and the FTSE MIB also trading just a touch below the flat line. Breaking it down by sector, here's what the split looks like. You've got construction names up 0.8%, retail catching a bid this morning, insurance and autos also gaining some ground. On the downside, what's dragging markets lower in Europe, utils down 0.8%, media, tech, and healthcare also on the back foot. Now on to U.S. futures, and this is, I think, very essential for the overall narrative. U.S. futures pointing sharply lower this morning, in particular the NASDAQ. It's off about 300 points right now. That's the indication. The Dow looking to pull back about 200 points, and the S&P also looking at a weaker start, despite the fact that the initial reaction to the Fed decision was positive from an equity market perspective. Now the focus seems to have quickly moved on to the tech sector and whether we should be concerned about an AI bubble, whether we should be concerned about some of the debt that companies are raising to fund the AI build-out.
I heard you. I heard what you said.
I thought I could push past it.
We're missing you anchoring on Squawk Box today, Caro. I know what you meant.
It's been a smooth few days while you were in Abu Dhabi.
Okay, is this because of the present?
What press? Oh, I thought you weren't going to mention it on air.
Well, no, because you attacked me. I come back at you. Is this about the book?
This is an indirect attack on my poor
we're
husband.
talking about what we're buying, our other halves. In my case, my better half. And actually, I've done pretty well. You know, it's about 7 or 8 things to fill the stock in. I've done really well so far. You have bought zip for your other half so far. In fact, all you've done so far is it's that time of year, gentlemen. You know, we're not the only. This one here. This is what Juliana Tattelbaum done. We got given a load of books to read, of which I've read 2 of them, no one else read any of them, of the FT books of the year. You know, so there was some great book on progress, which I've read, the Jensen Huang book, which won, that I'm reading. There was another book there, which I won't mention because I don't want to spoil the surprise for someone. She's taken it home and wrapped it up and put it under the tree for her husband.
He's a frugal man. He'll appreciate.
He's a frugal man. He's a hedge fund. Wow, what a lovely place. How thoughtful. You wrapped up a book that you got given at work for me.
Well, now I'm going to have to get him something else.
Oh, I know what you can get him. Viewers, you know this. CNBC's changing its logo. I'm thinking a lot of you have seen the logo. And so marketing is getting rid of a lot of old peacock stuff. You know, things are changing, yeah? Why don't you wrap up some of that stuff for him?
Poor guy. The thought did cross my mind.
There's some really rubbish umbrellas in there, the little ones with the wrong logo on. Why don't you give him one of those?
I'm telling you, he would have appreciated it. Now I think he may be a little disappointed.
Hopefully he's busy trading and he's not watching. The world's largest sovereign wealth fund. It's not a Bruno Cucinelli jumper, is it? That's for sure.
It might have to be now as an apology
there's a market,
gift.
Isn't there? Free book nicked from work, Bruno Cucinelli jumper. I mean, you know, that's the good big ask, isn't it? You can get something in between, maybe.
You know, this show is all about balance, this cast. So we were missing Karen here. I'm one end of the spectrum. She's the Brunello Cucinelli side of the spectrum.
I thought I was the bottom end of the spectrum. You have just out-Sedgwick with your cheapness. The world's largest sovereign wealth fund says it doesn't currently plan to invest in data centres, saying that it is careful with sectors that are volatile. Wow. Alexander Knapp, who is the new head of the real estate for Norge Bank Investment Management, said he did not want to take undue risk. NBIM holds companies in its portfolio that own data centres but doesn't have direct stakes in the technology. That is fascinating, isn't it? That you've got one of the biggest sovereign wealth players on the planet is just saying, I'm slightly concerned about this at the moment as well. Although, as we quite rightly said there are companies which they hold which do have data centre build out as well. But it's just very, very interesting that. And I found this. I was at a lunch on Tuesday. After programming, and there was a lot of big CEOs, some really big CEOs, and some of them were in stablecoins, some of them were in cryptos, and some of them were in more traditional forms of financing as well. And honestly, even at that table, and it was really, you can almost cut a knife with the tension on this one as well, because there was the advocates of the AI trade and the Bitcoin and the stablecoin, which seemed to get basketed together, even though they're very different things. And then there was one gentleman who was a senior financier at the other end of the table who said, nope. Well, what do you mean no? Because I'm not investing in any of this stuff. I think I don't understand. And still to this day, when you've got some really smart people in finance are still turning around and saying, I don't understand it, I'm not touching it.
Yeah.
I thought it was really interesting. I said, what about your clients? Do your clients not want you to? I said, nope.
It is hugely divisive.
So much so.
I also think about,
more so than whether you put a stolen book under the Christmas tree.
A smartly acquired book, I would say. It was just an efficient use of the gift. I think, you talk about the divisiveness of crypto, and, Jamie Dimon comes to mind. He's somebody who has come out saying...
Oh, he came up at lunch as well, yeah.
Oh, really? Yeah. On the topic of crypto. Yeah. Well, because he's come out, really slamming crypto. He doesn't necessarily believe in it. And yet, JP Morgan as an institution has ramped up its services, ramped up its offering, because that's what clients want. Exactly, yeah. So it is super divisive, but I guess you can still, sort of play both sides.
Let's take a look where Bitcoin's trading. It's actually calmed down a lot, hasn't it? From 124,000 down to roughly 80,000, and then it just steadied right up around this level. But it is down 2.5% in session.
The CEO of the Magnum Ice Cream Company, Peter Turkolve, has told CNBC that the main reason for the company to demerge from Unilever was to allow both to focus on their core products. He also argued that spinning off will allow the company to invest in growth opportunities that were not possible as a part of Unilever.
Unilever needed to focus on its category, and we needed real focus on ice cream. I now have 19,000 people who go to bed thinking about ice cream, who get up thinking about ice cream, and we're able to invest behind the growth opportunity. And we don't have to balance that between all kinds of different categories in Unilever, but the focus is on ice cream.
And when questioned on the rise of obesity drugs such as GLP-1s, Trkulva said the company was not heavily affected by it, saying that ice cream is not a, quote, mindless munching category.
The beauty is in the States, we have retailers who sell the Glips and ice cream. So we have amazing data. And what we learned is that for every 12% penetration, that's double of current American penetration, the market loses 0.5% volume growth. Actually, not a lot. Why? Because it's not a mindless munching category. People take ice cream to give themselves a treat. And the beauty of ice cream is the caloric profile of ice cream is way better than chocolate or potato chips. It's somewhere, who's all 400 to 600 cal per 100 gram. It's somewhere between a fudgicle 30 and a fully loaded Ben & Jerry 300. So it gives choice. So action.
And calcium.
And a lot of calcium and protein. You know, think about. I don't know whether you have tried Yasso. It's now grown 5 years, 20% a year, on a high protein Greek yogurt basis. So there's choice in ice cream.
Seriously? Seriously? I mean, the guy's at the top of his profession. He's a CEO. He knows his stuff. But ice cream isn't a mindless munching category? I mean, I've never heard a statement on there that I would disagree with more.
Well,
I'm talking very personally here.
I think
not a mindless cookie dough. my kids try to hide the ice cream at the back of the freezer to keep away from me.
Well, I would say it's so funny when you talk about, you have a sweet tooth actually, because if viewers could see what you typically eat for breakfast every morning, it is the furthest thing from anything sweet, anything desirable. Don't scare viewers. Don't show them. I mean, it's up to you.
What's the name? Do you want to see it?
Once you see this, you can't unsee it. And I can confirm the color is incredibly consistent, like shockingly consistent every day. You manage to get it
20. I make this every night, and it's got about 20 different ingredients in it.
That I would say is not a mindless munching category item.
No, but it gives me. If I start the day off with something like that, which is, I think it's probably the healthiest thing on the planet. Really. Yeah. Thereafter, it's free reign. I can eat what I like.
I don't know if that's quite how it works.
In my mindless munching categories.
I love that as a category name. Yeah. I actually kind of agree with him.
Is he talking like, as opposed to, let's be honest about it, Doritos or
exactly like chips,
or Pringles, what have you? Chips, no,
or crisps. Sorry, we're living in a what do you call it? A multinational house. It's hard to remember what everything is called. My poor daughter has no hope. But yeah, I would say chips or crisps. That's mindless munching. Ice cream, it's it's so enjoyable.
It's
I kind of agree with it.
It's a broad church. I can mindlessly munch savoury and I can mindlessly munch sweet.
You just cannot mindlessly munch that drink.
No, I appreciate that it's an acquired taste.
No, I don't even know if we can call it a drink with how thick it is. That's one of the most alarming
because if you don't have it,
I
mean, everyone who has a healthy smoothie in the morning knows if it's too liquid, you put too much liquid in it, then it doesn't feel like food, so it doesn't fill you up.
Well, you do not have that problem as someone who sits next to you every day.
Indeed. What's coming up on the show?
That's a solid. Okay, coming up on the show, from resource scarcity to heightened AI competition, we'll look at the geostrategic factors set to shape 2026. We'll be right back.
Fly Emirates, fly better.
Thank you.
Enjoy your meal.
Neither the middle seat nor the meal is a sandwich. That's Air India now.
तेरा ये बिजनेस एक मास्टर स्ट्रोक है यार,
है ना? पर मुझे लोन कौन देगा यार?
ओह गॉड, सचिन
सचिन क्यों देगा मुझे लोन?
अरे मैं नहीं, बैंक ऑफ बड़ौदा देगा तुम्हें एमएसएमई लोन। बॉब डिजी उद्यम के साथ 100% डिजिटल प्रोसेस, अप्रूवल इन मिनट्स। बैंक ऑफ बड़ौदा से एमएसएमई लोन लेना भी एक मास्टर स्ट्रोक है।
चलो चलो एआई से पूछते हैं। डू फिश गेट थर्स्टी?
If AI will use so much energy, then what is the future of energy?
Infinite clean energy. Avada, always clean, always on.
Well, the best time of day ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
We are everyone, but we're not just anyone.
I've made my choice today.
We choose progress over pressure.
The endless sky. I'll sip
We say no to shortcuts and yes to the strength of discipline, to the pride of planning, to the thrill of watching our future take shape little by little. We are citizens, and you can be one too. Sip karo, citizen bano. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
That elsewhere around the world, and you expect that to persist around the world.
Yeah, we do expect it to persist, and it's definitely a global phenomenon. And in some ways, it wasn't even necessarily invented in the US. I mean, I think I often say at the moment, you know, you look at China's new industrial policy, but in fact, in 2015, it created the Made in China 2025 policy,
Right.
which was exactly this. It was industrial policy to nurture certain sectors. But the EU has its own armoury of interventions at the moment too. UK, where we're sitting, does too, and so you see it in Australia, you see it in other places too. And actually, even in emerging economies, you're seeing governments intervene, for instance, if you have raw materials to try and boost your own refining. And so it's definitely not a US-only thing at all. I think it's a really global feature. And again, as you rightly say, it's something that will persist for many years.
I couldn't be more fascinated. Sorry, I know this is turning to book club, but I've just read a whole book on progress about the role of government. It was one of the FT books by Benedict Frey, and it's a really good book about the government relationship with private sector and with industry and what is the best combination of that. And one thing that comes out is that governments are notoriously bad at running industry as well, but the best industries and the best governments are the ones where it's providing the guide in hand, it's providing the right infrastructure and institutional framework as well. With what you're talking about, with this advent of greater state intervention in industrial policy as well, I can't help worrying that actually it's overreach on the private sector, which is far better at running businesses than government will ever be.
Yeah, and I think it's interesting. I mean, the world has come almost full circle. I mean, I started my career in what was the Department of Trade and Industry here in the UK, and
well, things have gone upwards since then.
At that point, you know,
who were you under then? Peter Mandelson.
I think it was, my First Minister, yeah. And so at that point, in a sense, industrial policy was a relatively dirty word, and the world was liberalising and was globalising, and international trade was going to kind of lift all boats. But we are in this very different world, as you outline now. And as you say, governments are intervening in economies in different ways. And sometimes that's for things like sustainability policy, national security. So these are valid policy objectives. But as you say, they're clearly, I don't think we know yet what the right balance is of intervening for those objectives without sort of intervening so much that you're actually damaging the economy.
Because it comes not on its own, and this is the problem with state intervention. It comes with a form of protectionism, and it comes very often accompanied by tariffs as well. And as we've seen with the current environment, with the highest set of global tariffs initiated by the United States since the 1930s, that didn't augur well back then as well. So I do worry again about the role of state intervention within the broader remit.
Yeah, and I think you touched on a second point we talk about in the report. So I think you've got state intervention in the form of kind of industrial policies, and you've got state intervention in terms of the tariff piece, which has obviously been in the news enormously for the last year or so. But again, if you look at the tariff story, it's quite interesting. If you look at the data, in fact, sort of non-liberalising tariff measures have been outweighing liberalising for sort of 10 years or so now. So again, it's not just a sort of post-April the 2nd issue. It's actually quite a long-seated issue. And again, from a business perspective, I think you have to be, belt up and be clear that the tariff story is here to stay. It is being used as a policy intervention across so many different kind of policy goals, if you like, as well. And so again, it's a big theme of our report, which again is very similar to last year in many ways, which is tariffs are here to stay. It is the tool that's being used now, and businesses are at the cold face of that economic competition or the search for economic sovereignty.
A very quick word on AI rivalry, one of the other determining factors you see shaping 2026.
Yeah, and this is one where I think it's different to, say, this year, and definitely different to last year. I think we've really seen AI and both the software and the hardware that underpins AI becoming really economically important and strategically important for countries. And we've seen that this year, and that's going to accelerate next year. And again, to your previous question, that's not just the US. I mean, we've seen that with the EU and all its sort of proposed AI Act. Right. We've seen Middle East countries, really try and become the third pillar of the AI world, and China, of course, as well. And so there's a competition for control of the software, there's competition for control of the microchips, there's competition for the control of the rare earths that underpin the technology. And of course, there's sovereign AI, and there's big, and I think you were talking about a little bit earlier, sovereign AI being a really sort of really big feature. And so again, that is a bit new. I mean, it's happened this year a bit, but it's accelerating. It's the accelerating force, no question.
Oliver, appreciate the time this morning. Thank you for stopping in. Oliver Jones, Global Client Insight and Research Leader, EY Parthenon. Coming up on the show, we're going to talk about the latest decision out of the Fed, so do stay with us. We'll be right back.
होम EMI 50,000
आउटगोइंग तो जा रही है, आपकी क्या तैयारी है? पूरे सीलिंग का 20,000 आउटगोइंग है जा रही, आपकी क्या तैयारी?
मौसा जी, मेरी शादी का गिफ्ट।
मनी की आउटगोइंग रहेगी जारी, इसीलिए कर लो तैयारी। SIP के साथ इन्वेस्ट करो और जरूरत पड़ने पर SWP के साथ सिस्टमैटिकली विड्रॉ करो। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
आराम से हाँ। सामान देना भैया।
अब आगे क्या करना है? वो पिट्टू की पर्ची में देखो ना, कहाँ गई पर्ची? नमस्ते
जी।
हाँ, मुझे पता है वो पर्ची में क्या लिखा होता है। आप चलिए मेरे साथ। व्हील चेयर, ये आपका और ये आपका। पर्ची में शॉपिंग की बात तो जरूर लिखी होती है। थोड़ी पेट पूजा की बात कोई पर्ची में ना लिखे, ऐसा हो सकता है? टिफिन
थैंक यू।
अरे पर्ची मिल गई।
पर्ची में तो ये सब लिखा ही नहीं था।
हम है ना आपकी पर्ची।
सिर्फ वर्ल्ड क्लास एयरपोर्ट्स नहीं चलाते हैं, आपके सफर में हम सफर बन जाते हैं। अदानी, हम करके दिखाते हैं।
मुबारक हो सर, आपका रिटायरमेंट प्लान रेडी है।
थैंक यू।
जिम्मेदारियां हमसे बांटी, हल्का लगेगा। इंडिया फर्स्ट के लाइफ इंश्योरेंस प्लान्स।
Well, the best holiday ever's finally over.
When you fly Emirates, your holiday isn't over until your flight is over.
This is Network 18, and you're watching CNBC TV 18 Prime.
Powered by LIC, हर पल आपके साथ.
We've sort of decoupled from Asia. Asia's actually in the red. Nikkei is down about 1% as it closed up. The Taiwanese markets were down more than 1.25%. So that's looking good. And there is no single sector which is in the red. Gains are dominated by capital market plays. So across the board, strong strength seen there. Auto, pharma is surging. But it's quite a broad-based up move. But 1 hour to go, and our viewers are watching Closing Bell.
No, absolutely. And by the way, just mentioning that this whole Oracle business has really spooked Wall Street. Futures are down between 1% to more than 1% on indices like the NASDAQ. So let's see how that plays out. And typically, we've seen that in the past. It could be a very short-term sentiment-driven thing. But when there's a big sell-off in global markets because of AI, tactically, maybe just for a day or so, India does tend to see some flows. We will see if that indeed plays out as we go along. But lots lined up on the show as we promised you. So it's an action-packed final hour that's coming up. We have plenty of stocks to go over and, of course, all of the day's trading action as well. So here's the lineup. We'll be tracking the recovery. The markets come back to 25,900. We'll, of course, get you all the trading calls as well, track the big movers, and then track the big move on the rupee. It again hit fresh all-time lows now, getting closer to the 90.50 mark versus the USD. So what is the market bracing for? What's the chatter in dealing rooms? We'll talk about that. And then, of course, we look at the US Biosecure Act, and what it means for CDMO players here. That's actually seen this entire sector. It's seen stocks spike higher, likes of Divi's and Syngene. Brokerage firm Macquarie has reiterated an outperform stance on the sector because of the US regulations, and we'll do the analysis on that in just a bit. Tata Steel has unveiled an extensive capex strategy, and there's an MOU that's been inked with Lloyd Metals as well, so we'll analyze all of this as we go along. But first up, the trades for the last hour. We have Mitesh joining in. Mitesh, good afternoon. What are the calls now?
Good afternoon. Oh, I think, on the index, we said in case, we don't break 25,700, 720, which is the gap area, I think we'll bounce back to about 25,950 or so. Only, I think, once we start closing about that, and we are very close to that level, then I think, the weakness will kind of be taken care of at the ebb, and, you might see the range-bound markets come back into picture. So for the timing, we're watching 25,950 closing. But right now, I have one buy and one sell call. PB Fintech or Policy Bazaar, that's on the buying side. Buy here with a stop at about 1914 for targets of 1980. And ONGC is a sell with a stop at 242.5 for targets of 232.
Thank you very much for that. The other big story is the Indian rupee continues to plummet, hitting fresh all-time lows. 90.47 is the record low, beating last week's low of 90.42. Dealers attributed to more hedging demand by importers on signs that the trade deal may take more time, and hence rupee recovery is unlikely. Lata joins in with what she's learned. Lata?
Yes, the previous low of the rupee of 90.42 reached on December 4th has been taken, and that happened actually around midday. We went to 90.48, and thereafter it's kind of remained at all-time low levels. The fall was surprising because today would have been a day when you would have expected the rupee to do well, because the dollar index has fallen, and so has crude. Crude is at 62, dollar index at 98. One would have thought this may not be the day when it will set a fresh all-time low. So this is a bit of a surprise. With stock markets doing well, the surprise only increases because one would assume that it is FPIs who are buying. Dealers claim it can also be importers who are buying dollars, because now the street is almost veering over to a one-side view of the currency that it is headed towards 91. There are no two sides. Initially, when 90 crossed, the expectation was, that perhaps the Reserve Bank will block there. Now, the Reserve Bank clearly is not blocking any level. That the market is very clear. It's just maybe smoothening sharp volatilities by supplying. The cue today apparently came from the NDF market, that is the offshore market, where the rupee already was showing signs of weakness, and that's getting translated over here. The feeling in the market now is that the Reserve Bank is allowing this both in onshore and offshore markets because that seems to be a natural way to correct any trade deficit, exports becoming cheaper because of the cheaper rupee and imports becoming dearer. You can see all steel companies, etc., are rising, partly because now the competition from China or competition from elsewhere becomes a little more expensive. There's more breathing space for Indian domestic makers. And finally, the statements that came from Delhi, the commerce ministers, the CEAs, the chief economic advisor, all of them indicating, saying that we can't rush into a deal is what the commerce minister approximately said. We have to look at every point. Seems to give the impression that the deal is not tomorrow or end of the year or something. It seems to be a distance away. People are speaking of March now. So that's again led to this one-sided view that, the rupee there is more declines. Let's not be surprised.
Okay, all right. Got that, Lata. Maybe you want to stay on and take some questions as well. We have Dheeraj Nim, economist and FX strategist at ANZ Research, joining in. Dheeraj, thanks so much. Let's just take up those points. I think what Lata said made so much sense, that the market has become completely one-sided now. There's no one calling for the other end at all. So it kind of then starts becoming a self-fulfilling prophecy, doesn't it? Can you tell us what you've noted in the market today and whether you are expecting lower levels even before the year ends?
Right. So thank you for having me on the show. Look, I completely agree that the expectations about USD INR are a bit one-sided right now. So once we had crossed the 90 level, I think some pain was taken out of the markets because some positions were booked. But I think fresh importer hedging demand could be coming in because most people do expect that trade deal more or less remains elusive. The comments from the CEA, etc., do not indicate any clarity that it's happening any time near in the near future. So I do think that most people are positioning on a one-sided manner as far as USD/INR is concerned. Yeah.
Okay. So do you see lower levels, Dheeraj?
Look, I think the rupee weakness is further to go. As long as high tariffs stay in India's economic configuration, we are projecting rupee at 91.5 at the end of next fiscal year. But given the kind of momentum we have seen, those levels can be attained much sooner than we are currently projecting.
What about next year? We normally see fresh allocations when the year begins, and the FPIs will be now staring at a far cheaper rupee and stocks that have not run up compared to other comparable geographies. As well, we always know that the Jan-Feb-March quarter is a time when trade account also posts a surplus. So is January the new hope that the rupee will turn?
I would assume so. Seasonality could play out in Q1 of 2026. In fact, we have put Q1 forecasts at 90, which is appreciated from the current levels. But, the understanding is that fundamentally we are looking at a weaker rupee in the medium term as long as tariffs are there in the picture. But, of course, point taken, seasonality could play out.
Dheeraj, the other thing that I pick up from FPIs, or those who talk to FPIs, really, the interlocutors, is that now the Indian capital gains tax and withholding tax is hurting. Time was when returns from India were so high that these taxes could be paid. Now foreigners are losing on the currency and the stock markets have not really given gains in most counters. So the tax is a pain point. Is that a hope that will get addressed in the budget? Is there even a chatter with people you speak with?
I really don't think so, Lata. So if you look at the government's tax situation overall, it's not looking great. In fact, to me, there's a bit